top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Okay, those are very interesting visuals to start your day with. I must confess, I wasn't expecting to see that. Good morning to you, and thanks so much for joining us on India Market Open. We've got a power-packed show for you. You want to match those moves, guys?
Wouldn't mind. I mean, 100%. You can just keep going left and
there
right.
you go. Kiran's got the moves. The question is, do you at the start of trade today?
Will the markets let you make those moves today is the question.
No, so I'm pretty sure that over the course of the next hour or so, we'll give you everything that you need so that you can make those right moves. I don't know about whether you think Donald Trump is a great dancer. Well, let us know in the comment section. In the meanwhile, let's talk about what happened overnight. I'm going to start, in fact, not with what he said at that event, but a very key data point that has emerged. It's effectively the fallout of Trump's policies during the first 100 days in office. And that is the fact that US trade deficit has spiked 9.6% to 162 billion in the first quarter. The deficit has soared because companies have rushed, understandably, to import more goods ahead of the imposition of tariffs. In fact, goods imports have risen $16.3 billion to an all-time high of $343 billion. Consumer goods imports have risen as much as 27.5%. Why is this important? Imports are a subtraction in the calculation of GDP, and the record high imports are likely to sharply drop the US GDP growth in the first quarter. And Goldman Sachs, among several others, has already seen a GDP contraction of 0.8% in the first quarter compared with a 2.4% growth in the previous quarter. The advance estimate of that Q1 GDP will be published later today, so expect Wall Street to react to it. Now, yesterday, overnight, you had an easing further of trade tensions. In fact, you had Donald Trump saying that a deal is around the corner. He said that the US is very close to a deal with India. Listen in.
India is coming along great. I think we'll have a deal with India. The Prime Minister, as you know, was here 3 weeks ago, and they want to make a deal. We'll see what happens. Thank you. Thank you.
All right, so that's one positive, and certainly it is a positive for us here in India as well. But there's more. Treasury Secretary Besant made a similar statement. He said that there are substantial talks that were also held with Japan. The contours of a deal with South Korea could be coming together. And Commerce Secretary Howard Lutnick said that one deal was close to be done, but he refused to disclose which country that he was talking about. He said that the country's Prime Minister and the Parliament would first need to approve that deal. What else happened? Auto tariffs are being softened. In fact, there was a Trump proclamation that offered to offset a portion of the tariffs on auto parts. Listen in.
And to help these automakers bring their factories home as rapidly as possible, I've just signed an executive order to give partial tariff rebates to any company that assembles its cars right here in the U.S. In other words, if they can't make it in time because they have to do it here, otherwise they have it, I'm giving them a little bit of a break, right? They took in parts from all over the world. I don't want that. I want them to make their parts here. But I gave them a little bit of time. It's 15% and then 10% of the parts, so it's not so bad.
Okay, not so bad, 15% and 10%. Let's explain what that means for you and the implications possibly for Indian auto component manufacturers. The offset aims at giving automakers a little more time to shift their supply chains to the US. That is, of course, the intention of the tariffs, saying manufacture and make in the US. Car makers will be provided credits for 15% of the value of vehicles assembled domestically. In the second year, that credit will fall to 10%. Now, what does this mean? Take an illustration. If a car maker builds a car with 85% of US localization, there will be no tariffs owed in the first year. If the car maker, however, builds a car with 50% localization, a 25% tariff is applied to 35% of the value. Basically, 15% of a break is provided to them. What happened overnight? Very quickly, the Dow has risen, so has the S&P 500 and the Nasdaq all gained in trade yesterday. The S&P 500, in fact, rising for a sixth day, posting its highest close since Liberation Day, and the VIX has fallen below 24 for the first time since that event. US yields have fallen to a 3-week low, and you have the 10-year that is now at 4.16. The dollar index, however, remains close to 99. Brent has fallen overnight but has recovered somewhat to about 63, and US futures currently are in the red. So let's see how that pans out. For now, Asia Pacific is also opened a little mixed with more losers than gainers, and the indicative open, I think, is going to be in the red for the Indian market as well. But let's talk about what happened yesterday.
Right. So in terms of domestic markets, both the Nifty as well as the Sensex ended flat. Bharat Electronics, Trent and Tech Mahindra were the top gainers on the Nifty. The top losers were Ultratech and Coal in India. In terms of broader markets, Nifty Midcap 150 and the Small Cap 250 ended slightly higher as compared to the benchmark indices. The Midcap 150 closed 0.21% higher, and the Small Cap 250 in the similar fashion closed around 0.21% higher. In the mid-cap space, Cochin Shipyard, Mazagon Dock were the top gainers, again from the defense space. In the small cap 250, Data Patterns and Garden Reach, again from the defense pack, were the top gainers. In terms of sectoral picture, the Nifty IT emerged as a top sector of the day, led by LTI Mindtree and Tech Mahindra. Nifty Oil and Gas ended higher for the second day in a row, but the top sectoral loser was Nifty Pharma, which was dragged by Aurobindo Pharma, Sun Pharma, as well as Dr. Reddy's. In terms of the overall FI and DI picture, the foreign portfolio investors stayed net buyer for 10th straight session, that is on Tuesday, and they obtained stock worth rupees 2,385 odd crores. In terms of domestic institutional investors, they stayed net buyers for third session in a row, mopping up equities worth rupees 1369 crore. And this is, of course, as per provisional data that is provided on the National Stock Exchange. But here, in terms of the trade setup today, what do you think? Will the kind of volatility that we've seen will continue, and it is more, I think, an earning perspective market rather than right now seeing as to how global is faring right now?
Absolutely. I mean, global, yes, a marginal impact, but key focus is in terms of earnings, as you're mentioning. But what's happening over here is earnings cuts is something that the markets are already pricing in, because we've spoken about it, or the expectation has been in probably low single digits as well, in that 5 to 7 to 8% kind of a range for FY25, right? So that is something that you're looking at. What the market is looking at from an earnings perspective is the kind of commentary that companies are coming out with regards to FY26. So that's the key. But very quickly, if you talk about the Nifty, a range bound market is what you're anticipating, because if you see in terms of implied openness, that we're almost seeing 100 points cut coming in on that front. 24,328 is what you're tracking in terms of gift Nifty. Overall, selling pressure is what is coming in at higher levels, and the stock specific action will continue. There is that some bit of indecisiveness that's happening between the bulls and the bears, and that's the reason why that selling at higher levels is what you're seeing. Nifty, yes, needs to break above those 24,550 levels, and a fall below 24,250 could actually lead to further selling pressure. So today, 24,250 becomes a crucial level that you need to watch out for as well. And overall consolidation is expected in that range of 24,550 to 23,800. That's the range you should be watching out for, and volatility is expected to remain elevated. Quickly pull up the VIX as well. It's above 17 in terms of yesterday's session as well. In terms of Bank Nifty, last 5 trading sessions, you have Bank Nifty, which is consolidated in a 2,000 points range. A sustained move above the recent high of 56,098. Only if that happens, then you could see an upside trigger in terms of Bank Nifty as well. But otherwise, that range-bound trade will continue, and the support is seen at 54,000 and then of 53,500. So that's the overall setup, what we are watching out for. But let's quickly understand what the derivative indicators are telling us. Puneet is joining us with more. Puneet, what are you indicating?
Well, essentially, a lot of traders will be on the sidelines. We have the expiry today because we have a holiday tomorrow. So essentially, we are expecting the immediate support on the Nifty to be broken, at least in the implied open. That's what's of 24,300. That is expected to be broken down. We are anticipating a lot more support at the 24,000 level, but we are way away from that level. So 24,300 is at least on the Nifty level to watch out for. In terms of Bank Nifty, another very interesting day today. A lot of action was happening over the last week. We were expecting a subdued day, but a lot of news flow essentially in terms of Bank Nifty for both SBI as well as IndusInd Bank could be one of the triggers to watch out for on Bank Nifty. A lot of traders already on the sidelines. When you look at the open interest distribution, in terms of both calls and puts, we have seen a sustained buildup of calls on the 24,500, which is continuing from yesterday, which we spoke about. But we've also seen another 24,400 level seeing a lot of interest in terms of open interest calls. In terms of puts, that we have seen some reduction, at least in open interest for 24,000 as a level, but that is one of the highest levels where the highest number of puts are seen. In terms of both stocks, as in terms of open interest gainers as well as losers, we have seen some long build up in PNB Housing as well as Sona BLW. Sona BLW, of course, reacting to the news of the Trump tariffs and some concessions for auto parts, while we have seen some short build up on stocks like Tata Tech, Ambuja as well as Exide. In terms of open interest losers, some short covering actually seen in stocks like Tata Chemicals as well as KPIT Tech. And KPIT Tech was one of the key reactors in terms of news flow and results again. Apollo Tyres seeing some long unwindings. They've also had some fundamental news flow in terms of the Netherlands operations. And Deepak Nitrite also seeing some short covering. So overall, we are expected to open in the red. Essential to keep that level of 24,250 and above, something to watch out for on the Nifty.
Okay, well, Puneet, thank you so much for breaking that down for us. Now, shifting focus, another big story. Prime Minister Narendra Modi held a high-level meeting with Defence Minister Rajnath Singh, National Security Advisor Ajit Doval and the chiefs of 3 armed services to deliberate on countermeasures in response to the Pahalgam terror attack. NDTV's Aishwarya Jain joins us with more details on the same.
Well, the meeting at 7 Lok Kalyan Marg, which is official residence of Prime Minister Narendra Modi, alongside with Defence Minister Rajnath Singh and the 3 service chiefs, the CDS and NSA, lasted for almost 1 hour and 30 minutes. The Prime Minister, according to our sources, had clearly stated that he affirms that our national resolve is to deal with the crushing blow to the terrorism, and it is in the best interest that the government of India and Prime Minister, who had completely given the operational freedom for the armed forces to decide on the mode, targets and timing of our response. PM also expressed complete faith and confidence in the professional abilities to our Indian armed forces. Remember, it comes a day after the 3 service chiefs and also the CDS briefed Defence Minister Rajnath Singh and about the current situation in Jammu and Kashmir, the search operations which are going on to completely, sideline, and also, as Prime Minister earlier also stated that we will track, identify and punish the terrorists, and those perpetrators who are sitting across the borderline will not be let alone. After this particular meeting, and a message to our armed forces by Prime Minister that they have full confidence and they have left to the armed forces, they have given free hand to them as to what action they have to take at what time, at what place. It is Home Minister Amit Shah now who had arrived at 7 Lok Kalyan Marg at Prime Minister's residence. Remember, this afternoon at the Ministry of Home Affairs, the DGs of the BSF, the National Security Guards, CISF and CRPF officials were called in, and it was the Home Secretary who chaired that meeting. The developments that are taking place in Jammu and Kashmir, the brief was given to the Home Secretary and that report was submitted to the Home Minister Amit Shah. Now Amit Shah has reached at 7 Lok Kalyan Marg after that high-level meeting at 7 Lok Kalyan Marg with Prime Minister, Defence Minister, CDS, NSA and all three service chiefs.
Okay, so that's what we know as of yesterday evening, and that was a report by our correspondent from NDTV. But the Cabinet Committee on Security, the Cabinet Committee on Political Affairs and the Cabinet itself will meet during the course of the day, and the Prime Minister will chair all of those meetings. In fact, most importantly, a meeting on security. We will bring you those details once we have information on what has taken place and what has been decided, so do watch us through the day. For now, let's turn to possibly the story of the day, and to tell you more about what has occurred. We're talking about IndusInd Bank. We have had earlier in the week, or just a short while back, the Deputy Chief Executive Officer resign. Yesterday, unexpectedly, the Chief Executive Officer has also resigned. Vishwanath Nair, banking editor, joining us in studio to tell you what this means and why this took place. Wasn't expected, Vishy.
Partly yes, partly no. I mean, it was expected that he was going to resign.
Yes.
We weren't sure when that resignation was going to come in. So it coming in on the 29th of April is a bit of a surprise. Essentially, this entire saga started on the 10th of March, which is when the bank came out with a disclosure to the exchanges saying that, listen, we've found certain discrepancies in our derivatives portfolio. There's going to be a financial hit that the bank is going to take. At that point in time, we had no clarity about what the specific issue was or how exactly this would hit the bank's balance sheet. After that, some disclosures came and then the disclosures completely stopped at the bank. Of course, we found out through our sourcing that this is primarily because of poor accounting that happened on the internal trades that the bank was doing, essentially converting foreign currency borrowings into rupees so that they could lend. So there was an issue in the way that they were doing that, and that's why this financial hit is coming in now. Since then, the bank has also disclosed a problem in its microfinance portfolio, and the bank said that its internal audit department is investigating it, and that EY, global consulting firm, they are actually supporting the internal audit team in this search. Now, going ahead, of course, on 28th of April, you had Arun Khurana, the deputy CEO of the bank, as well as the person who was actually in charge of the treasury function at IndusInd Bank, resigned, and then now. Of course, we've got Sumanth Katpalia. But I think we already have Abhijit Devanji on the line. Mr. Devanji, good morning. I know we spoke last evening, but I just wanted to get a sense from you. Now that you've had some time to sort of gather your thoughts, I just want to get your sense as to the exit of the CEO at a time when there's a lot of governance-related questions that are being raised about the bank. The board has now appointed a committee of executives to run the bank in the absence of a new CEO. There is likely going to be some amount of fast track. How are you seeing these developments reputationally, functionally at the bank? How are you seeing this?
One, Vishy, I think it was very obvious that it's going to happen. Question was when it's going to happen. And in my opinion, the sooner the better. We've had precedents, where RBI had shortened the terms of some ex-CEOs, which, Shikha in particular, and she stepped down and said, I want to step down from the board. There's no point continuing. So I think it's kind of furthered the move. It was the inevitable that was waiting to happen. But, as I was reflecting, as you rightly said, since yesterday, and I was reflecting that why has all this triggered? And this all triggered, of course, there was a derivatives problem and the accounting moral responsibility has been taken by the CEO, and that's fine. That can happen in any organization. But look at the larger picture. This is regulatorily driven. What has really happened is that the real kicker is not the derivative transaction. The real kicker has been RBI saying that your term is extended only by 1 year, effectively saying that I'm not going to extend it for. Effectively putting the organization or a bank in the limbo where it is operating only on a short-term basis in 1 year. And it was inevitable that the bank had to find a new CEO. Thereafter, of course, the derivative disclosures happened and it hastened the whole process. And I rightly think it's hastened the process because at least gives some more certainty. The bank will look more aggressively for a CEO maybe earlier. So that is going to happen, and the bank will get back to stability quicker. But the real issue is that this is a regulatory driven move. Imagine something like this happening in the corporate world in a manufacturing company, where there is no regulator who decides what's the tenure of the CEO. The CEO would never have resigned.
Yeah. Abhizar,
Look at it that is such a regulatorily driven thing, where unless the regulator says, sorry, I'm not extending your term, the CEO does not go.
Yeah.
The other thing is that, we have a board which is so regulatorily driven again. How much do I put responsibility on the board is the question I'd like to ask. Because the regulator says every policy has to be approved by the board, and the board gets so involved in the nitty-gritty of the organization that the larger business picture is missed.
Yeah.
So, this is maybe an overtly vigilant regulator pushing down on a bank or a regulated financial institution. So I would look at it more as that, because we've discussed enough about the derivative issue.
Yes, okay, that is fair. I just want to ask Abhizar, with regard to what happens over the course of the next 3 months. Hi, Alex here, good morning, and thanks so much for joining us this early. But the question really that I think investors are going to be asking is that there is clearly going to be a period of uncertainty. And while you're saying that we've fast-tracked perhaps, or rather the bank has fast-tracked the process of that cleanup and the return to stability, what happens in the interim? Because a bank cannot be a democracy. Would you agree?
Oh, absolutely. Absolutely. So it can't work in committees. So I think the appointment of the CEO will happen much quicker. A committee is just an interim measure. Though I would actually say that, when you had such a long tail in terms of deciding, 2, 3, 4, 5 months. And I think a smooth transition by appointing a new CEO would have been a better option than appointing an executive committee, but I'm sure they have their compulsions. But having said that, you just look at the larger picture and what has happened to other banks. Like we've had, RBL, we've had Yes Bank, we've had Tamil Nadu Mercantile Bank, all these kind of banks who've then had interim people coming in once the CEO has gone out. Even after a new CEO has come in, there has been elongated periods of, you can call it stability, but I would say, recalibrizing of an organization. And that recalibration period takes time. If you look at, RBL, it started at a peak of, its optimism, and then there was a regulatory overdrive. The new CEO comes, the new CEO focuses, one, on cleaning up the book, and secondly, pleasing the regulator. And then he starts his growth process. And some people do successful growth. Some people, become victims of market cycles. But irrespective of that, the whole period of stability is just not appointing of a new CEO. It's that CEO then stabilizing the organization over time, making sure he's on the right side of the regulator, and then focusing on growth. So I think that's a 2 to 3 year process, in my opinion. That will happen, in my opinion, may also happen in the current bank.
Quick question. In the absence of an interim CEO, that essentially the board is unable to decide who is the person who can stabilize the ship in the interim, it's safe to say then that you wouldn't see an internal candidate come in the list that goes to the RBI, right?
Maybe there could be internal candidates coming. I think it's just that the board may not have decided on its shortlist, but it's also, in all likelihood, if you go by past history, of other banks, it's external people come in, and again, if you look at past history, I think the odds are in favor of a PSU banker sometimes coming.
Thanks so much, Abhizar, for joining us this morning. I think a lot of investors will have listened to this conversation and gotten more clarity than they had yesterday.
Thank you.
All right, let's talk about the stocks that I've picked. And I have picked IndusInd Bank at the start because yesterday, remember that the stock reacted positively to the resignation of the Deputy Chief Executive Officer. So at least in the near term, this should be seen as a positive development. Of course, as Abhizar was pointing out, there's going to be a period of uncertainty, and that uncertainty may well stretch to 2 to 3 years while a stabilization takes place by the new management. So remember that there could be a pop in trade today because some of that uncertainty gets resolved. The next stock that I've chosen to talk about has to do with Bajaj Finance. And this is actually BPCL. BPCL is what I'll talk about next. It's a thumbs up. The revenue is down about 1.7% or thereabouts, but it is ahead of expectations. The earnings before interest, the EBITDA basically has come in at 7,765 crore rupees. That's up about 2.4%. And the margins have improved to 7% versus 6.7%. The net profit is down about 31%, but this is also significantly better than expected. So what are the factors that you need to bear in mind? There were higher refining margins coupled with inventory gains that drove a beat. The refining margins came in at $9.3 per barrel, and that compares with a Singapore GRM of $3 per barrel, which is considerably higher, of course. The net profit is down on account of provisions of 1,774 crore rupees, and that related to an impairment in the investment in an arm that they had. The under recovery for LPG in the quarter stood at 3,200 crore rupees, and for the full year, it's at about 10,400 crore rupees. By the way, the gross debt has gone up during the quarter because there has been elevated capex. There's one note that I picked through for BPCL, and that's Jefferies. They've maintained a buy with a target price of 370. They've hiked it from 330, and they're positive on the numbers. They say it's a beat on refining. The inventory gains will reverse in the next quarter, though. The marketing is in line, and the profitability is a little inflated currently. The capex has risen sharply. They alluded to this as well, and they said that the net debt headed higher. In fact, the debt to equity ratio is now 0.29 versus 0.24 previously. The last stock I'll talk about very quickly, because we're going to talk about this in more detail just in a minute. Bajaj Finance. It's a thumbs down, and there was a little bit of debate that I had with Harsh, our researcher who tracks this very closely, and what he's saying is that it's a thumbs down because the outlook is not as good as one would have thought. So focus on this. There are elevated provisions that came through in the fourth quarter. They're up as much as 14% sequentially and higher than the street had expected. The forward guidance is weak on growth, ROE, as well as ROA. The long-term ROE guidance has been cut to 19 to 21% versus 21 to 23% earlier. The ROA guidance has been revised downwards to 4.3 to 4.7% versus 4.6 to 4.8% earlier. And the FY26 growth has been trimmed to 24 to 25% due to higher credit costs. Remember, growth has been upwards of 30%. So let's go to Jnanada Vaidya, who is a research analyst at BFSI, at Axis Securities. Thanks so much, Ms. Vaidya, for joining us this morning. To what I was saying, would you say that the street will look at this negatively because they've gotten so used to that higher trajectory of growth? And though Bajaj Finance is saying it is optimistic rather than cautiously optimistic about the future, it has brought down its estimations for ROA, ROE and growth.
Yeah. Hi, good morning. So Bajaj Finance's results were largely in line with our estimates. However, the miss was on credit costs. Now, talking about growth, 24 to 26% is just a tad bit lower than the earlier guidance, but we are estimating around 25% CAGR growth for the company, which given the size is still not a bad growth. Though there could be a negative, sentimentally negative given the results, we continue to remain positive on both in terms of growth as well as ROAs. It's the NIMs that are getting it down. Q4 was a slight deterioration in NIMs on a sequential basis. That's because the company has changed its pricing in certain unsecured products, as well as there was a slight increase in the cost of funds. Going ahead, there will be some improvement in the cost of funds, which should support NIMs for the company. Yeah.
Jnanada, this is Hiral on this side. Good morning. Apart from this, the other bigger aspect right now is in terms of the bonus and the stock split. How good a trigger is that going to be with regards to liquidity as well as a tailwind in terms of the stock? And to that, how do you see investors reacting in terms of the action?
Yeah, so that we consider that as a positive. Of course, it will improve the liquidity. So that is a given positive for Bajaj Finance.
Okay, and Jnanada, just for our understanding, so when you talk about the 1:4 bonus, right? And the split. So if an individual is holding one share of Bajaj Finance, what do they get with the stock split and the bonus? What does the calculation come up to?
So it's for every 4 shares held, the investor will get a bonus share, and the face value will be split into from 2 to 1. So that's 1:1. That's the 1:1 ratio.
Are you saying that a person who's holding one share will, in the end, get 10 shares?
I'm sorry?
A person who's holding one share of Bajaj Finance will get
It's 1:1.
10 shares. Yeah, so overall will be 10 shares, right? After the split and the bonus.
Approximately.
Okay.
Okay. Right. So I just want to come to the conclusion, Nyanada, on how you see the valuation as things stand right now. Do you think that it currently prices in, based on the multiples that the street has given to this company over the course of the last several years, with the trajectory of growth that it has had, do you think that that multiple is fair, given that the company anticipates a slowdown, relatively speaking, in growth? It's still the fastest growing NBFC among the large caps, but it's slower than what it used to be.
Right. So the stock has seen a very sharp run up. If I look at a 6 months perspective, it's up about 30% now. So there has been some catch up on valuations. However, those growth has slowed down slightly in terms of the guidance. Bajaj will still continue to deliver a very, very strong 25% CAGR growth in that's what we are expecting in terms of earnings. So the premium valuations, also the asset quality for the company continues to remain pristine. The outlook on asset quality as well as credit costs has been slightly optimistic now versus what we've seen in FY25. So we remain positive on Bajaj from a medium to long term perspective.
Right. Nyanida, the other aspect is in terms of the estimates. Now, they have gone ahead and trimmed their FY26 growth to 24 to 25%, and this is mainly on the back of higher costs. What does this imply in terms of, do you see any valuation cuts coming in going ahead? Do you expect any downward pressure on the stock price as well? How would you look at the entire year then?
So the market may not like the downward revision in the growth estimates, of course, but that the overall impact on an ROA kind of perspective doesn't look it's not very meaningful. We are still going ahead with a ROA delivery of 4.5% over FY26 and 27, and that's largely in line with what the company has also guided for FY26. It also aligns with the company's long-term ROA targets. So at least at Axis, we are seeing a continued, so of course for a meaningful re-rating, we would want to see growth come back at Bajaj Finance to the higher levels of 25-27%. That will be a key re-rating lever for the company.
Hi, Mahima also joining in. I just wanted to understand, you did mention that valuations are at premium right now, but do you think that the kind of guidance that has been revised by the management, is there a derating in valuation that you would pencil in?
So currently we are not looking at a very sharp derating. Maybe a near-term challenge on the stock price given a tad bit softening of the overall across metrics in terms of guidance. But from a medium to longer term, we believe that premium valuations will sustain for Bajaj Finance.
Okay. Thank you so much for that, Nyanida, and thank you so much for taking our time and speaking with us at NDTV Profit. With that, it's time to slip into a very short break. We'll be right back on the other side and get you more stocks that you should keep an eye on definitely. Stay tuned to NDTV Profit.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the
Welcome back. You're watching India Market Open. Well, 3 stocks on my radar today. The first one is Trent. The earnings came in the last few minutes of trade yesterday. In terms of how the earnings fared, well, there was strong margin expansion which the street was not expecting, which is why we saw an uptick in stock in the last very few minutes of the trade. There was soft like-for-like growth, but overall store addition did meet guidance. PAT, there was a one-off in the last quarter of around 543 crores. Otherwise, adjusted PAT grew by around 46%. The gross margins for Westside and Zudio remained stable, which is a positive. Depreciation grew 30% this quarter, and this is on the back of rising Zudio stores. Star format is still a concern because of competition from quick commerce, and revenue growth there stood at around 16%, but the like-for-like growth was only at 2%. The slow like-for-like growth was on account of weakening demand, plus the overall cannibalization of new stores in the same micro areas, and potential of course, competition coming in from smaller players as well. Now, what are the brokerages saying about Trent earnings? Macquarie has maintained outperform and hiked the target price of 7,200. They're saying that this is a better than expected mid-single digit growth, and lower operating costs have driven the Q4 EBITDA. They see FY25 as a more representative of business health, and a strong traction across cities and improving store accessibility will make Trent confident on their growth going ahead. Morgan Stanley has also maintained an outperform with the target price of 6,359. Q4, according to them, was some hits plus some misses. Greater than expected gross margin compression in Q4, and this is on the back of inventory write-offs as well. And PAT, overall profitability metrics did improve according to them. The next one on my list is Praj Industries. Thumbs down for this particular counter. Overall revenue and EBITDA was impacted by slower execution as well as rising input costs. The negative operating leverage led to a 200 basis points margin dip as well. Weakness in revenue is driven by two major factors. First is deferral in start of new bioenergy jobs, plus potentially on account of delays for customer getting funding approval as well. The order intake for the quarter was around 1,032 odd crores, and consolidated order backlog as of March 31st stood at 4,293 odd crores. They've also entered into a strategic partnership, and this is for overall asset as well. And last one on my list is Prestige Estate. They have launched the Prestige City in NCR region, and this marks the debut for them in the NCR region. So the expectations are here that Prestige might open.
And this was a major overhang for them,
exactly,
right?
because it was not getting approval, and now that it has gotten the approval, I think it should be a big positive for the counter.
That's going to be interesting. Whereas you're an Oberoi, which didn't have any approvals in the quarter, you know,
exactly.
so that, I mean, it's a very interesting space to watch out for. So on my list, I have an India Mart Intermesh. You know, this is an interesting one because initially we were debating whether this would be a thumbs up or thumbs down, but research has come to a consensus that this will be a thumbs down in terms of India Mart Intermesh. And the reason being is that overall, the revenue growth has been flat. Your EBITDA margins have mainly been supported by lower investments this time around. If you would reduce all of that, it would have been in that 32, 33 kind of a range. And in terms of the net profit, that has mainly been aided by other income, which has been higher because they've reinstated their investment value in terms of FY25. So that's a thumbs down coming in on India Mart Intermesh. The other one on my list again is a Vishal Mega Mart. Now that's a thumbs up because if you talk about the revenue growth, that has mainly come in from the same store sales growth, which has come in at around 13.4%. I mean, again, your festive season where some of the events were preponed, that is what has aided the quarter. Cost efficiencies and the kind of operating leverage that the company is seeing is what has aided the profitability this time around as well. And the PAT, the other income also aided your profit number. Let's quickly look at the third one, which is Schaeffler India. Again, this was a point of contention because not many analysts cover it, but as per estimates, it seems to be below estimates. But if you have to look at the overall numbers, it's a thumbs up in terms of Schaeffler. If you talk about the net profit, that has grown around 14%. Your margins have improved as well by around 40 basis points. Now, exports is one of the key that has actually worked for Schaeffler India. So again, the aspect in terms of outcome from here on is going to be the key, because across verticals, your vehicle lifetime solutions business is what has led to the strong growth. Revenue has increased. Your export revenue is mainly driven by strong performance in the European Union region, as well as the foray that they've made in terms of newer markets. And there's a con call today at 10:30 with regards to Schaeffler. So please, wait for the con call details to come in as well. But a thumbs up on this one as well. So these are the three stocks we should be watching out for. But let's also welcome in our guest now, Milan Vaishnav, founder and technical analyst at Gemstone Equity Research, as well as Mayuresh Joshi, head of research at MarketSmith, joining in. Welcome to the show, gentlemen, and a very good morning to both of you. Mayuresh, let me come to you first. How are you looking at markets right now, taking into consideration the ups and downs that you're seeing? Volatility is at its peak. Trump tariffs are somewhere behind us, because there is some bit of positivity also that is coming in with the announcements that he's making for the auto-related tariffs. The key is in terms of the geopolitical tensions. Taking all of this into consideration, what's the mood looking like?
I think two things. One, I think from a global macro perspective, what really happens in terms of the Trump tariff resolutions over the next couple of months are going to be key for the markets. What kind of negotiations take place ex-China, what happens specifically with China is going to be something that the markets will probably watch out for. And the bodies will probably reflect it in the next 2 month journey on the perception and the developments coming there. But obviously, I think back home, the macros are looking a lot more stable as we speak. Food prices have corrected, which gives a lot of comfort in terms of our trade deficit, current account deficit numbers as well. The expectations in terms of consumption coming back slowly but very, very strongly as we head into the second half of this fiscal will probably mean that one of the tenets in terms of GDP growth, which is consumption, should remain extremely strong, aided by the festive season as well. Obviously, I think the government capex expectations of the liquidity pushed through by RBI is also expected to boost investments. And at some point of time, we hope this private capex comes back. And therefore, tax collections, fiscal deficit probably seems to be on track as well. But from a macro perspective and a global background, India probably looks much better placed. And therefore, when you look at the micro perspective, when it comes to corporate earnings, a large part of the market believes that Q4 will largely be soft and muted. But the expectation, again, because most of these factors will go through, is that the first half of this financial year, the base building for earnings should start getting built in. And second half, there should be some significant recovery as far as earnings is concerned. So I think India is better placed than most countries in the globe as we speak. Obviously, I think the risk factors that stay put is what happens in the next 2 months as far as tariffs are concerned, the global backdrop, global GDP, emerging currencies. And second, do earnings come back with a lag? So do they get delayed for some reason or the other? And that's the only risk that the markets probably have. In my opinion, I don't see a structural downside of the markets. But I think the markets might just consolidate and just go into a time-wise consolidation for the next few weeks.
Hi, Mayuresh. Good morning. We've been having a debate about IndusInd Bank. And Milan, very good morning to you as well. But I do want to go back to Mayuresh because this is going to be arguably the stock of the day. So two stocks, Bajaj Finance and IndusInd Bank. But I'll talk about IndusInd Bank first. My perception is that the chief executive officer resigning amidst this controversy is a positive development in the context of an overarching negative pall of gloom that this bank is going to go through over the next maybe 1 year or more. So would you say that this, would you agree with that? And how would you stay away at this juncture to wait for clarity to emerge?
So morning, Alex. I think two things as far as IndusInd Bank is concerned. One, I think the price correction and the expectations in terms of the hit that they've probably taken on the book largely seems to be behind us. Unless there is there are some more skeletons that probably come out of the closet. You never really know. But I think a large part of that price correction is largely behind us. But again, I think banking is all about trust. And what has largely happened in the last few weeks, what we've probably seen in the last few years as well, as far as industry is concerned, there is some kind of controversy that probably comes through, financial or otherwise. The last controversy has been a financial hit on the balance sheet. And I think it takes some element of time for the trust factor to probably come back. So I think all the management changes that we are seeing, what action probably comes through in terms of the forensic audit, what do the regulators probably think, and how does that trust element probably come back to the bank, both from a depositor as well as an investor perspective, is something to be seen. So my own opinion, I think the bank might just consolidate, but within the space, I think there are much better names to probably at least 10%.
So that's the view with regards to IndusInd. Milan, I'll come to you with respect to charts for Trent. Yesterday, in the last few minutes, it did see a significant uptick. In terms of the stock performance overall, it's been under pressure since quite some time now. Do you think now the charts are attractive enough for a buyer to enter in?
Yes, they are. In fact, Trend peaked out sometime in October last year, and since then it's been under a corrective retracement. But of late, it has made a very strong attempt to put a base in place between March and April. And I feel that now it's on the verge of reversing a trend. Of course, we are yet to get the confirmation on the charts, but there are very high possibilities that Trend may inch meaningfully higher from current levels.
Milan, so Trent, I agree. We've gone to the reverse order. We've taken your top pick as your first question. But with a Trent, what's your next best pick in terms of the markets today and your view as to how you're looking at Nifty as well as Bank Nifty?
My second pick would be Zydus Life. I recommend buying above 888, expected targets of around 930, and we'll keep a protective stop at around 860 rupees. Now, coming to Nifty, of course, we have a lot of external things going around us. We have a lot of GDP concerns, a lot of geopolitical tensions. The tariff war is around us. But I would like to take a look at the charts in isolation. And if I do that, then I see that from the lows that we made on April 7th, the opening lows that we saw on 7th of April. From there, Nifty has rebounded over, say, 11 odd percent from that level. And right now, it is high time that we can see the markets taking a breather and consolidate. Now, there is a difference between consolidation and retracement. If I say it from a very short-term perspective, we have 200 EMA at around, say, 24,050. So that's the nearest support we can expect. And if Nifty keeps its head above 24,000, I expect that the markets will consolidate back and forth, not just for today, but for at least next couple of days. Another major support in form of 50-week moving average falls around 23,900 odd levels, 900 plus levels. And therefore, this makes 23,900 to 24,050 a major support area for markets if they choose to consolidate. Now, if it violates 23,900, let's say, for example, then we can see some modest corrective retracement, but I still don't see any major downsides coming in for the markets. By and large, I expect the markets to trade in a range, to spend some time oscillating back and forth in a range and consolidate with a small possibility of minor retracement from the current levels. But by and large, the underlying trend, I expect that it will stay intact.
So the underlying trend is intact. Milan, I do want to come back to you very quickly on whether or not you're suggesting any derivative strategies today in particular, because you're talking about monthly expiry. And if you're saying that the underlying trend is intact and there could be oscillation, so how do you deal with that as a derivative trader?
See, as a derivative trader, I would not trade anything for today's expiry. That is point number one. And if I take a very short-term view on the market, I don't expect the Nifty to move well past 25,000. I don't expect it to fall below 23,500. So I would play out a 1,000-point strangle here, where I would be selling 25,000 call for 8th May expiry, and also selling 24,000 put. And if I do that, even if this with this wide band, I'm still realizing around 5% potential yield. We are collecting around 149 rupees of premium on single lot, and we can expect maximum profit to be around 11,000 plus. So we are still able to extract 5% yield on this strangles trade, even if the market stays in a range and doesn't take any directional bias beyond 25,000 or below 24,000.
Right, so that's with regards to Nifty 50 overall. Another stock very quickly I want to touch base on is a Bajaj Finance, taking into consideration the excitement around the bonus and the split, and they've trimmed their guidance in terms of FY26. A quick view, how would you expect the stock to react, taking into consideration the run-up that has already happened, plus there is liquidity and a tailwind in the form of a stock split and a bonus, and then again you're talking about a trim in terms of the FY26 growth guidance?
Well, is that for me or for Bevresh?
Bajaj Finance. That's for Mayuresh. Mayuresh.
Yeah.
Sure. So again, I think a mixed set, right? I think numbers in terms of guidance have been coming off, but they have been supportive in terms of the corporate announcements that have probably been done. So what does the market probably pay heed to? I think to a certain extent, I think it will be a mixed reaction onto the stock. But a large part of the expectation, Viral, that is probably getting built in is that there should be a slow and steady growth that probably comes through as far as this stock is concerned. And my own sense is that in the second half, as we see some element of consumption trends coming back, the durability in terms of consumer durable as a segment expected to come back as well. And with that base case as a scenario, I think with Bajaj Finance optimizing their digitalization aspect across the organization, expectations of operational efficiencies kicking in, and operating costs probably remaining far more stable, you can expect a stable performance expected to come through. So I think it will be a mixed reaction today. But in my own opinion, anybody holding the stock should continue.
So that's the view with regards to where Bajaj Finance is concerned. Now, shifting focus to the auto space, there's a lot of excitement around the Ather Energy IPO, aiming to raise nearly 3,000 crore. And with the IPO closing tomorrow, what can you share about this, Puneet? I mean, what is the traction that has been seen in the first day, of course, first and second day, of course. Today, it's the second day today's the last day for the counter. For 2 days, what's the subscription been like? And what's the response that the audience is giving after, 2 months of having no IPO at all?
Well, definitely it's an interesting time for the IPO for Ather Energy at a time where the market is not very buoyant, as well as the auto space is also seeing a lot of volatility because of tariffs amongst others. So currently 28% is the subscription after end of day 2. Retail has been subscribed by more than 1 time, but the others are still seeing some lesser subscription as of now. So we look at that. But overall, they are looking to raise roughly 2,969 crores with a fresh issue component of 2,626 crores. There are 2 interesting things in the IPO. First is, of course, the use of proceeds. They've earmarked 750 crores of the funds that they're going to use in the IPO for R&D specifically. So this will, and it's a company that prides itself on its research and development. So they've earmarked a large portion of that. Apart from that, they are also moving roughly 927 crores for an additional manufacturing facility in Maharashtra, despite having most of their or components being outsourced in terms of manufacturing. So it is largely going to be an assembly plant, but yes, they are very and this is interesting because they only have current capacity utilization of 40%. So they are looking at the future in terms of IPO as well as the company going forward. When you look also at the sales split by models, very interesting trend because the new Rista models now contributes 50% of the company's sales. Rista was only launched a year ago, so it has expanded the addressable market for something like an Ather, while also bringing in profitability as well because it's priced at a very competitive price compared to the competitors, but it's also increased the demand for its scooters for the Ather brand. And finally, in terms of comparison with Ola, and here is where things get interesting because the valuations for something like an Ather is actually more expensive than Ola at the current market price, because when you look at the 9-month revenue, EBITDA as well as PAT for both companies, it's quite comparable. Both have an EBITDA margin loss in the mid-20s. Profit is loss. There's also a loss at the PAT level as well. But essentially on EV to sales, the price to sales metric, Ather is at 5.7 times versus 4 times for something like an Ola Electric. And on EV to sales, it's at 6 times versus 4.7. And since they are not comparable on profits, we can't take the price to earnings or EV by EBITDA. So on both these metrics, it's very negative in terms of valuation with the current listed peer who's seen almost a 67% fall from its highs, and essentially at a time where the market is getting consolidated by Bajaj and TVS. So very interesting to see what happens with the subscription today and the eventual listing next Monday.
So point well made. Puneet, thanks so much for that. Mayuresh, I want to come to you on this one, right? Because ultimately, one would compare these two. One would look at Ola and one would look at Ather and say, if you have one, then should you have the other? Neither of them at IPO were cheap. So Ola, of course, has seen its fair share of troubles. But what's your opinion on Ather as things stand right now?
No, again, I think very comprehensively put, and very whatever you're seeing of numbers, right? It's not very encouraging, at least on the operating front, and therefore I think how this entire space evolves is going to be very, very interesting. We're obviously seeing a lot of competition intensity come through, not just from peers compared to Ather, but even the bigger names who are already there in the market. The bigger two-wheelers have already started having their launches done. And let's not forget that the kind of distribution that they probably have, the dealerships that they probably have, the after sales that they probably have, the control in terms of the entire inventory and the entire value chain as well, right, from inputs to the exact product that is probably being made, is pretty comprehensive. And therefore, I think unless numbers start showing a huge tectonic shift, I think I really don't see any sense in terms of why somebody should probably invest in this IPO. I think there are much better listed players to probably look at within the operating space.
Right, so that's with regards to where Ather and Ola go. Milan, very quickly, if you have to look at, in terms of Ola on the charts, what is that stock indicating so far?
Is extremely weak, and if it slips below 47, we can see some incremental downsides coming in. And so long as it's trading below 54 rupees, I don't see any potential for a meaningful upside.
Right, so that's with regards to where Ola goes on the charts. But shifting focus, if you talk about the volatility Nifty has seen this year and how the momentum strategies have often never worked during periods of market downturns, that has led our research team to analyze the allocations of the focused and value-based mutual funds and how one of the sectors that could be a contra pick. Mika brings in the details. Mika, from the analysis, which is the sector which has become a contra pick right now, and what are the key details you should be watching out for those companies?
Yeah. So it's actually the gas transmission space that has come forward. We looked at what focus funds have been selling and what value funds have been buying based on the monthly as well as the annual change in their average holding and allocation in the space. Focus funds has been selling gas transmission, realty, construction and IT, while value funds have been buying gas transmission, banking, chemicals and non-ferrous metals. So it's the gas transmission sector that does coincide. Now the key question is there value in gas transmission space? And we're asking this simply because of the investment strategies that a focus fund and a value fund follow. A focus fund is more concentrated, thereby they buy what's going up and sell what's going down. However, value funds analyze a stock based on fundamentals and often select stocks where the markets are not in their favor. That's why they're buying what's going down, but at attractive valuations backed by fundamentals. Now, what's working for the gas transmission space is stable and rising CNG as well as PNG demand, expansion into new geographical areas, lower competition from alternatives, as well as better clarity on margin trajectory than what we had last year. Now, last year we saw a lot of deallocation and then reallocation of APM gas, and just in the start of April, we saw the APM gas allocation for gas stocks again cut, but this will now be replaced by new well gas. Now, new well gas is cheaper than other gas sourcing options, however, just $1.3 more expensive than your APM gas. However, this, if replaced well, if the cut volumes are replaced well, then analysts say that margins can improve for something like an IGL and MGL. That's why the margin trajectory going forward is much clearer. In terms of the valuations, the 1 year forward PE currently for an IGL and MGL stands below than what the average we have been seeing in the past year. So we have current valuations below the historical average, even in terms of earnings potential. So now if you go to see, IGL has also posted its FY25 numbers, and the growth expected in its revenue, EBITDA and net profit stands at 10% and 15% for the revenue and EBITDA. For something like an MGL and a GGL, it's key to know that FY25 numbers are not yet to come in, but these analyst estimates are based on consensus estimates. But even they are expected to see growth here on MGL of 4% net profit growth, Gujarat Gas is 17% on net profit growth. Lastly, we're looking like what does the street think. For something like an IGL and MGL, the street is largely bullish on the counters. 18 buy calls for an IGL, 21 buy calls for an MGL, and relatively lower hold and sell calls. Even the earnings potential stands at 10 to 14%. However, lastly, a Gujarat Gas has more of a bearish sentiment with only a 2% potential upside.
All right. Thank you so much for breaking that down for us, Mihika. We'll be right back after a short break. But Mahesh, I'll definitely come to you because IT is in focus on the back of both of these funds. So I'll come to you on that, but with just after a slight break.
Apollo ties. Now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place.
Welcome back. You're watching India Market Open. Mahesh, I'll come to you on what I was addressing earlier as well. IT is being sold by both, that is your focus funds as well as value funds. If at all the valuations look slightly attractive right now, do you think that is there a scope that people might now see some buying in the IT space because uncertainties are still an overhang on the entire sector?
So, Mahima, I think valuations have become a tad bit more attractive after the huge price correction that we've probably seen for the sector as a whole. Numbers largely in line with the estimates. I think the large belief was that it will be largely soft and muted, and the commentaries will be soft and muted as well. And that's what exactly happened, except for a few outliers like HCL Tech, which probably posted better set of numbers, something like a Persistent or an Emphasis within the mid-cap pack, which had better sets of numbers and a better commentary as well from the management. Having said that, I think the entire thesis will now be how the tariff resolutions probably take place. If that probably happens, the kind of definitive improvements that you probably see in discretionary spending across BFSI, retail, manufacturing, not just in North America, but also in Europe, will probably aid a large part and abet a lot of concerns that are probably surrounding the sector as a whole, both in terms of order wins, both in terms of pricing related to these orders. And therefore, I think all these elements need to be watched out. What also needs to be watched out is the kind of attrition that you're probably seeing and the bench strength that a lot of these companies are probably having at this juncture. So if there is any kind of a delay or a deferment that probably happens for any of these reasons over the next few quarters, I think the earnings get delayed and deferred to a certain extent. I think the hope right now is that the second half of this financial year, earnings should recoup and start coming back very, very strongly. But for some reason or the other, if this gets deferred by a quarter or two, you're probably pushing back earnings recovery to FY27. And that's the fear that the markets probably have for the sector as well. So leaving aside a few of the stocks that I've just mentioned, I think the sector probably looks a little bit soft and muted as well.
The soft and muted moves in terms of variety that could be on the cards as per what Mayuresh is mentioning. But let's also welcome in Chandan Taparia, Head Technical and Derivative Research at Motilal Oswal. Chandan, good morning and welcome to the show. Key levels that you're tracking in terms of Nifty as well as Bank Nifty.
Good morning. Thanks for having me. So we have seen a consolidative move in the market in last 6 trading session. The good part is that Nifty took support at 23,850 zone, which earlier used to be a hurdle. So we are witnessing the sign of role reversal, which is a bullish implication as per the technical setup. On last trading session, Nifty index remained consolidative, formed a doji sort of candle. But even after that, it gave the highest daily close. And we believe that supports are intact. So overall, till Nifty holds about 24,050. Ongoing bullish bias could continue to take it towards 24,500 to 24,650 marks. If I look at the seasonality and the relative rotation graph, then May remains dull, but June and July remains positive for Indian market. So I believe that momentum could continue if someone is looking for positional point of view. So for intraday point of view, if any small decline happens, that can be utilized to buy. And for positional point of view, we are expecting Nifty to head towards 25,000 to 25,500 level. Now talking about Bank Nifty index, Bank Nifty to Nifty ratio is at 2.23, and Bank Nifty has really done well in last 4 weeks. It rallied well by more than 7,000 points. Supports are intact until it holds above 55,000, and a small decline could be bought for an upside target towards new lifetime high of 56,098 marks.
Hi Chandan, good morning. Just want to know what you would be buying today, if at all, and what are your picks today?
So I'll focus on the selective defense name because in last couple of days we have seen renowned buying in most of the defense counter, and stock like BL, HL, GRSC, Mazgaon Deo has seen a strong momentum with volume surge, which clearly indicates that this sector can outperform the market. So first it is buy on BL. It has given a consolidation breakout, and I believe the small follow-up can cheer the stock towards new lifetime high. So one can buy BL with support of 310, and it has potential to head towards 330, and then finally heading towards its new lifetime high of 340 level. Second trading area, that is buy on Tech Mahindra. Nifty IT has bottomed out, and Tech Mahindra has been making higher top side bottom. It managed to hold its 50-day exponential moving average, and support-based buying has lifted the counter to higher side. So one can buy with support of 1465, and Tech Mahindra can head to 1555 marks.
So those are the two top picks that are coming in from Chandan as well. But moving on, a few other things that you need to watch out for in terms of today's day of trade is a BPCL in terms of the earnings. Let's quickly pull up that one on the screens, because yesterday it was last couple of trading sessions have been pretty strong in terms of the OMCs, but BPCL 2.5% up move. Mayuresh, your call in terms of OMCs and any top picks in that segment?
I think it's a tactical call. So I think it really depends in terms of how numbers play out. And you're not really sure, right, every passing quarter, how GRMs will probably play out. What are the downstream spreads that are probably happening, which probably affect their petchem business as well to a large extent. Obviously, I think the transmission volume should hold up pretty strongly for oil marketing companies. And to a large extent, I think how crude is expected to behave at this juncture. If it stays in a range as we are speaking, the kind of inventory gain stroke loss hit that these companies probably take, I think that probably gets reduced to a large extent. But you never really know how these macro moments might happen. And therefore, I think it's just a tactical bet as we see it. I think they seem to be in fine momentum at this juncture. And therefore, I think it can be a momentum pick for a few investors that will probably look at momentum as a play. Obviously, I think the supporting factors related to liquidity, whether it's a BPCL or an IOC, probably stays intact. So again, I think it's a momentum play and a momentum pick for momentum investors.
Right, so that's with regards to the OMCs. Mayuresh, one other question I have is with regards to the defense pack as well. Very quickly, your view taking into consideration that has been the sector of the day. Yesterday, with the kind of moves that we've seen, last 5 trading sessions have been absolutely strong. You're talking about the geopolitical instability. Order book in terms of the opportunity is looking absolutely strong. Do you think a good bet in terms of defense at the current valuation? And if so, your top picks?
So revenue visibility stays intact. The order book remains extremely strong. The book to bill remains extremely strong. The margins at which these orders have come through are pretty decent as well. I think the past couple of quarters, execution has been a sort of a concern. And let's not forget that the kind of base that these stocks had built up over the last couple of years in terms of earnings, even that probably will play out in terms of numbers as well. Having said that, I think the expectations in terms of more orders coming their way, expectations of Europe as a zone, building up their buffer in terms of defense spends, and some part of components expected to come through India. I think that's the hope in terms of export orders as well. And that is what is keeping the sector probably far more buoyant at this point of time. Having said that, I think it's all about execution for all these companies. And therefore, as a space, I think stocks like Mazda or Cochin is something that we continue holding in our portfolios. BL has done exceedingly well over the last few months as well. And therefore, as a space, our own sense is that these shipbuilders should probably continue doing well. BL can also probably continue doing well in terms of top line growth, margins, execution, and expectations in terms of earnings delivery over the next few months.
All right. So that's the view on the comprehensive view on the defense pack. By the way, let's move to a big brokerage call of the day. I need to slow down a little bit. And that is Jefferies, which has put out a bullish note on CG Consumer, so stock that is in focus, and a lot of brokerages are turning their attention to this one. It's a buy rating with a target of 480 rupees. Harsh joining in to tell you why they're positive. Harsh?
41% upside from here is what Jefferies sees on this one. 10% odd in terms of how the stock has moved year to date. So that's a potential opportunity. Also trading 10% below its historical averages, and therefore Jefferies calling that out as well. But what they're saying is essentially you're expecting a better set of numbers from FY25 to 28. Profit growth will come in strong. The 2.0 strategy will work better according to them. And that work has already started in FY25. In terms of the 9-month period, you're seeing a better number in terms of profitability. The growth has kicked back in. The consumer-led innovation, premiumization, cost controls and synergies, and digital focus, all of these are factors which are helping and aiding the numbers for Crompton. Over and above that, the premium fan segment is doing extremely well now. As a share of the total fans revenue, it's now 25% versus the 12 to 13% number it commanded just a few years back. Premium is growing faster, of course, than the other fan segment. Better distribution is also aiding the numbers overall. In terms of what to expect, you are expecting an EPS CAGR of 22% over FY20 to 24. Levers include improving product mix, new orders in solar pumps, sales revival in lighting, and turnaround in Butterfly. Butterfly margins have gone up from sub 3%, it's above 7% now in just a matter of 1 year, which is 9 months. And therefore, in the 9-month period, you're seeing significant gains even with regard to how Butterfly is performing. They're giving this a target PE of 40 times and a target price of 480.
An interesting one. 1.3% is the kind of move that you're seeing with regards to where Crompton Consumer goes. We will take a question with the analyst on the same as well. But before that, let me quickly pull up Adani Green that is going to be in focus because the company has allotted convertible warrants to ADA, which is a member of the promoter group of the company, on the 25th of January 2024, and this was done by a way of preferential allotment on a private placement basis. The issue price of 1,480.75 per warrant, out of which 370.159, which is 25% of the issue price per warrant, was received as the initial subscription amount at the time of allotment of the warrants. Now, ADA opts to convert these warrants to shares, which is at a 60.7% higher or at a premium to the current price of 921. As we already mentioned, 1,480.75 is the convert at the price at that time, and they're worth around 9,350 odd crores in terms of December 2023, out of which 2,337.5 crores worth were already converted back then in January 2024. Today they've announced conversion of additional 500 crore worth of warrants, and the remaining due will be converted in July this year in the next 3 months. So that's the update coming in with regards to where Adani Green goes. And if you talk about the rupee, that has also opened stronger against the US dollar. If you quickly pull up that one on the screens, and that will tell you the levels that you're tracking in terms of the Indian rupee till we get that. But overall, Crompton Consumers, Milan, what are charts indicating for this stock? Okay, I think we've lost Milan. Chandan, I'm very sorry for that. I think I was just before alluding to Milan, who was there before the break. Chandan, with regards to Crompton Consumer, what are charts indicating? I mean, a positive view from a fundamental perspective. Are you seeing further strength?
Yeah, so I think some support-based buying could be seen in the counter. However, it has been consolidating in a range, but now risk-reward ratio could favor. So as of now, the multiple supports are visible near 325. However, one need to keep in mind that in last almost 8 months, it has seen a corrective move from 480 to 300 marks, and now bottoming out by taking the support at the previous hurdle zone. So risk-reward ratio favor, but major trend has not changed yet. So look for only bounce back move. Those who are looking to play the bounce can keep the support of 328 for a bounce towards 355 in Crompton.
Okay. Well, Mayuresh, any view on Varun Beverages? It's expected to post its earnings today, and the street is penciling in a 25 to 30% growth in terms of revenue. What's the view like, and do you think that the acquisitions that the company has made will now start being accretive?
Oh, absolutely. And in fact, I think if you just leave aside one territory in India, I think both India and their overseas operations in terms of volume growth are expected to do exceedingly well. Obviously, I think the kind of mix that they probably got in terms of beverages, in terms of packaged water and juices, I think appropriately placed at this juncture. And therefore, I think the management itself sounds very, very optimistic. In fact, even in the past, after the past quarter's results, they were very optimistic in terms of superior revenue growth, expectations of them able to maintain gross and EBITDA margins as well. And therefore, I think the appropriate product mix that they probably got, expectations in terms of leverage being decent on the balance sheet, and core dynamics expected to continue to improve as we speak, both for India and their overseas operations, probably holds this stock in a good store.
That's with regards to the view coming in on Varun Beverages as we speak. In fact, we're just 40 seconds away. Chandan, a quick view in terms of what Trent and Bajaj Finance are indicating on the charts. A good bet for today?
Yeah, I think Trent could be the good bet, and if I look at the level, one can buy with support of 5,300 for target of 5,600. Bajaj Finance is going to be a conditional trade. If it holds above 91.50, then look for an upside target towards 9400 zone.
Right, so both these counters that you should be watching out for in trade, but we're just around 10 to 11 seconds away from pre-open. What is going to be interesting is whether the financials continue to support or not, what happens to the defense space after the kind of run-up that we've seen in the last 5 trading sessions. But let's quickly look at your initial rates which are coming in right now. There you go. A gap down was what was on the cards, and that's what I think we are inching towards. We are below that 24,300 mark in terms of Nifty 50. Sensex also pretty much on the borderline at around 80,000, the 200 points cut coming in there, and a 0.4% kind of a cut coming in terms of Bank Nifty. So there is that selling pressure with regards to banking names as well. Nifty IT on the borderline as we speak. Let's quickly pull up the mid cap and the small cap index, also 0.2% lower. So the moves in terms of the broader markets, as well as if you talk about the large cap space, seems to be pretty much in line right now as we speak. Not the kind of cuts that we were seeing in terms of implied open, but yes, 24,300 is what we've broken in terms of Nifty 50. So the pressure probably could build up from here on as well, tracking the technical views. Let's quickly pull up the sectoral heat map to understand where is the pressure coming in and where is the support start coming in. Defense is an outlier, I think, because it continues to be the top sectoral gainer today as well. Real estate is bucking the trend. Pharma, healthcare, oil and gas. Auto, I think, is something we should be watching out for, because in spite of the Trump tariff commentary, it seems to be on the sidelines right now. So Nifty Auto, there you go, 0.8% lower. Media continues to be under pressure. PSU Bank down, consumer durables, metals, all of them down. But defense, realty, pharma, three sectors which are hogging the limelight right now. Let's pull up the heat map in terms of Nifty 50 as well to understand the stocks. There you go. Dr. Reddy's, Bharat Electricals, Sun Pharma, HDFC Bank, Bharti Airtel. These are the names which are on the uptrend. But the advanced decline ratio still is in favor of the declines on Nifty 50 as well. So that is something which will be concerning from here on. And the pressure continues in terms of the Bajaj twins, and that's the numbers. I think the street is taking the FY26 guidance cut negatively. I think even the stock split and the bonus is something which is not enthusing the investors so far. Trend, after the run-up that we saw post the numbers yesterday, today down around 4%. That is going to be in focus. IndusInd 2.5% on the back of the exit is what you're watching out for. Very quickly, if we can have the VIX. So it's inching towards 18, a 3% up move on VIX. So that is telling you to be cautious as well. So Alex, overall, I mean, the breadth seeming to be towards the negatives, and I think the pressure will continue that you've broken the key levels in terms of Nifty 50 as well. We are below that 24,300 mark right now, and I think Chandan Best will be able to answer us that question once you take us through what's happening in terms of individual stocks.
No doubt. And monthly expiry, a holiday midweek at a time when there's elevated global uncertainty, all of that playing out. But let's talk about individual stocks as well. And let's talk about a few that have stood out to us this morning, right? So we've already spoken about the large caps, but let's talk about something like a Praj Industries. It stood out, and Mahima spoke about this. This is a weak set of numbers. There's no two ways about it. And the street is looking at it and saying, yes, well, the kind of valuations that you were getting based on the kind of growth and the optimism around the stock, it's not justified perhaps. And so the stock is taking a bit of a battering, 7% in trade lower today. Alembic Pharma, it's got an EIR from the US FDA and it is mildly positive. Let's see if that holds through the day. Something like an Ambuja Cement posted its results yesterday, but brokerages have come through very bullish on the stock, and the stock is reacting positively, up about 0.7% as things stand right now in an otherwise slightly muted market. Now, BPCL is something that we pointed out is a significant positive on the back of a big beat on the margin front, and it is reacting positively. If at all, I would also like to pull up IOC if we can, and HPCL just to round off the list. IOC also looking up about 2% and HPCL up about 2.3%. The only thing is the implications for these two stocks. They haven't posted their numbers yet, but the margin improvement for BPCL bodes well for both of those stocks as well, so keep them on your radar. Prestige Estates from the real estate pack is something that we're focusing on. It's up about 1% or so, and there is a new launch, of course, that we spoke about. In fact, Mahima pointed this out to you in the NCR region. This is something that was being held back on account of approvals, and it has come through. It's a positive for this stock. Sami Hotels, Blue Chandra Private is selling about a 4% stake. This is a stock that has seen tremendous up move in the recent past, so a bit of a cool down is warranted, and that's what we're seeing in trade today as well. Vishal Megamart, it's arguably one of the stocks of the day, if I'm not mistaken. Yeah, there you go. So it's up about 4.5%. It's an 88% increase in the PAT, and so understandably, Street is looking at it positively. What else? Schaeffler India. A strong segmental and export growth is what the company reported. It's a decent move in trade today, up about 1.5%. IndiaMart Intermesh, another stock that is reacting positively despite the fact that there are growth challenges going forward. It has cooled off from the high point of the day, but it still gains about 2% in trade as things stand right now. By the way, we have recovered from the low point of the day for the benchmark indices. The Nifty Bank currently trading with just about 0.2% lower. The Nifty 50 just about flat. So I guess the question is, do you see a continued buy on dip approach, Mahima, at least for these large caps? and what do you do with the stocks that have reacted very sharply to earnings on the broader end? Do you see anything more that's moving?
Absolutely. So in terms of the Nifty total market, stocks that are really gaining in trade today are once again the defense pack. There's Paras Defense, which is up around 6.8%. There are stocks like Garden Reach, Shipyard, HAL, all counters buzzing on the back of the defense pack being as a whole in positive. Some counters like VMart are doing well because Vishal Megamart's overall same-store sales growth was a stellar double digit. On the back of that, VMart is buzzing. There's IOC, there's HLE Glasscoat, which is doing well. CESC, Lloyd's Metal back in the green after being cratered in trade for straight 2 or 3 odd days. But some counters which are in the negative on the back of earnings, we have Shoppers Stop, Bajaj Finserv, Sterlite Tech, KFin Tech and UTI AMC that are seeing significant amount of pressure. Chandan, I'll come to you. How are you reading the charts right now? Considering the expiry also, how do you think will the Nifty 50 and Nifty Bank range be like in trade today?
Yeah, so first of all, we need to look at the behavior of the India VIX. Because in last 6 days, the VIX has seen a spike from 13 to now 17.75 or 18 marks. So if VIX remains high, then roller coaster ride could be there. But we need to keep in mind that immediate structure of the market is positive and buy on decline stance could continue. Because 4 days back, market took support at 23,850, which earlier used to be a hurdle, and it made high near 25th of March. So role reversal kind of pattern is visible, and such kind of pattern usually turns out to be bullish. So looking at that scenario, I believe till Nifty holds about 24,050, we will go with buy on decline stance, but volatile swings cannot be ruled out as VIX is at 17.7 or 18 marks. For immediate point of view, I believe 24,200 can be utilized as a support zone for a bounce towards 24,444 and 24,500 levels. Looking at the Bank Nifty index, we have seen buying interest in selective private bank, and Bank Nifty has been consolidating and managed to hold 55,000 marks. We have seen some put writing at 55,000, so one can use the support near 55,000 for a bounce towards 55,555 on immediate basis. So both the indices are likely to witness buy on decline or positive to range bound bias for immediate point of view. If someone is talking about positional, then both the indices have potential to even move much higher from current zone.
All right, very quick individual view on Bajaj Finance, and I do want to circle back to Mayuresh as well based on the kind of start we've had. Chandan, what would you do with this? Bajaj Twins under tremendous pressure, down over 4%, not every day that you see this kind of pressure. And how would you trade it?
Looking for a conditional setup in this counter, but it started from lower top, lower bottom. It opened gap down and now hovering near its 50-day exponential moving average. If it holds below 50-day EMA, then short-term trend could change. So I'll avoid. I don't want to go for bargain buy here. As of now, 88.50 is going to act as a major hurdle. And if it fails to hold those one, or if it remains in selling pressure, then I believe it can drip down to us 8,300 marks. So either I'll avoid or look for sell on bounce stance looking at the short-term time frame in the counter.
100 is what you should watch out for on the downside. Mayuresh, circling back to you now on what we spoke about. If I'm not mistaken, I think Hiral asked you about Bajaj Finance and what you made of the numbers. But based on what we're seeing on the screen, it's carnage for the individual holder of Bajaj Finance, right? So do you think that the dust will settle sooner rather than later, or do you anticipate that there's going to be a period of consolidation in this particular counter that people will have to brace for?
That seems to be the case, Alex, because what has largely happened is that the guidance is something that has ruled the markets, and rightfully so. But again, I think the thesis that I'm trying to bring forth is that the second half of this fiscal, with expectations of consumption coming back, and with expectation of consumer durable also expected to come back strongly, should start benefiting larger players like Bajaj Finance as we speak. Obviously, the digitalization efforts that they've been probably taking over the last few quarters have started paying off and will start paying off because the operating costs will remain under check. And therefore, my own sense is that it is reacting to the guidance, rightfully so. It might consolidate for the next few days, for the next few weeks. I'm not really sure. But my own sense is that the second half probably might look tad bit better, in fact, significantly better as we speak. And that should show signs of improvement with every passing quarter, with the hope and expectation that the bottom line base case of consumption and consumer durable consumption coming back holds true.
Mayuresh, any view on these retailers? Vishal Megamart stunning set of numbers, and V-Mart also on the back of that is up in trade today. How these tier 2 and tier 3 city players in the retail space have grown immensely in the past 3 or 4 quarters. Any view with regards to where that stands, and do you think that this will kind of have some pressure in terms of competition on a big giant company like a Trent?
So, Mahima, I think if you place these retailers, right, if you look at B2 retail as an example, Vishal Megamart, if you look at V-Mart as an example, I think a large part of their mix in terms of revenue growth largely stays apparel and a mix that comes to probably in terms of non-apparel and FMCG as well. Now, within the apparel segment, I think the kind of price points that they're selling at is largely in the 300 to 500 range. For Zudio, since you mentioned Trent, I think it's below the 1,000 rupee mark as well. But for these players specifically, I think because they're operating out at tier 2, tier 3, and circling back to consumption expected to come back very, very strongly. And in tier 2, tier 3, I think it's not largely salary driven, but it's more agrarian driven. And if the expectation is of La Nina conditions brewing, expectations of a better monsoon this time round, you'll start seeing the Rabi output come into the market with a better Kharif season with better monsoons expected and a better Rabi season to follow. The expectations in terms of discretionary rural incomes coming back very, very strongly, a trend that you're probably seeing right now, might actually accentuate and accelerate. And if this happens, I think the placement that these stores probably have in tight areas are going to affect them significantly in terms of volume growth, in terms of footfalls, in terms of same store growth, and that will get reflected in better margins and bottom line growth. So my own thesis is that watch out for players like a V2 retail, V-Mart. They might actually do well as we head into the second.
Might actually do well. That's an interesting take coming in from Mayuresh. But thank you, Mayuresh Chandan, so much for joining us on the show and sharing your views clearly. In terms of markets as well, 80,140 is what you're tracking in terms of the Sensex Nifty 50 as well. Seeing cuts of 0.2%. We're still below the 24,300 mark as we speak. Remainder of the day still with us to see if there is further selling pressure or not. But let's quickly slip into a short break. On the other side, we'll be back with Jignanshu Gore of Bernstein SocGen Group to speak about consumption and what's happening with a trend.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
Welcome back. You're watching India Market Open. Now, Trent is in focus on the back of its Q4 earnings. Well, the stock did see a significant uptick in trade yesterday in the last few minutes, but the stock is under pressure today. In terms of how Q4 panned out, well, significant beat on margins, which was not something that the street was expecting, but a soft like-for-like growth has come in, and the store additions, however, met guidance. To discuss as to how this has happened overall, we are joined by Jignanshu Gaur, analyst at Bernstein Group, joining us now. Jignanshu, I'll come to you. Your overall reading on trend. Of course, margin was a big surprise here, but like-for-like growth was at a lower end of the spectrum. What's your reading? And plus, of course, these tier 2, tier 3 players have also come out with their business update, and Vishal Mega Mart did come out with its earnings as well. How do you compare the two?
Thank you so much for having me here.
Thanks for being here.
Lovely to be here. When I look at trend, and when you look at it from a slightly longer term perspective, when the company says that their fourth quarter LFL growth was mid-single digits, I think we really need to separate out Zudio and Westside. One change which has happened in Trent as a company over the last 4 years is the complete reversal in the contribution of Zudio and Westside to its fortunes. Zudio today, by our estimates, is more than 60% revenues and a 10,000 crore brand by itself. We think Zudio is still doing double-digit like-for-like growth. When the company says mid-single digits, they are sort of averaging out what Zudio and Westside are doing, and the broader struggle is on the Westside. Now, there are two reasons for this. One is the fact that Westside has more concentration of its product portfolio in the more premium range, which has been struggling, as we are broadly partly seeing with probably Shoppers Stop as well. And second is Zudio has done a lot of densification of its store networks. So they're adding stores in the same cities, same pin codes, which gets it a better share of the micro market, but in the short term hampers SSSG or LFL. So I'm not very concerned by the fact that Zudio is, or rather overall number seems to be in mid-single digit. I think Zudio as a franchise is doing well. Comparing with other value retailers, I think there's a difference in how we see consumption patterns in urban between the top 40-50 cities and the rest 400 cities.
Okay.
I think the inflation in the real consumer inflation on real estate, on medical and education is far higher in the top 40 cities than we see in the other 400. So companies like Vishal Mega Mart, V2, V-Mart, Style Bazaar, even Reliance Retail, who have a lot more focus there, have sort of benefited from this dichotomy, whereas Trend has that challenge that a lot of their stores are in the top cities. So that's what explains, in my view, the dichotomy of performance.
So one question I have overall, Jignanshu, is the kind of deceleration that we've seen in the revenue. If you have to compare in the last, say, 4 to 5 years since the pandemic, this is the slowest revenue growth, if I, in terms of that has been reported for this quarter.
Yeah.
And it's not only Trend. You talk about any Indian or a global apparel player, they are witnessing this kind of a trend versus the boom that was seen post-pandemic. So if this is a trend that you have to look at, do you think the valuations do not support the performance and hence a valuation correction that could be on the cards?
When we look at the growth of the, if you look at quarterly growth, one of the reasons why we saw the dip for growth under 30% in 4Q was because they did not add enough stores early enough. The store addition was so back-ended that the revenue impact of new stores did not materialize in their P&L. The same thing happened in Q4 last year as well, which is why Q1 of FY25 was very, very big. I think the same thing will happen now. However, the base effect, I think it's natural for companies to have a decelerating revenue. The question, I think, from a valuation perspective is whether we draw the line to 25% or 30%. I draw the line above 30%, just given the store growth that they have done in the last few.
How much above 30%?
Right now for FY26, we estimate a 35% revenue growth on the back of the close to 40% which they did for FY25.
So it's still a far cry from what they have achieved, and 50% is definitely not on the cards. Nothing has changed on the ground, right? So just to drive home that point on the dichotomy that you've pointed out in the demand centers for Trent, and it's a dual point that you've made. One, I think you've made with regard to Shoppers Stop and Zudio, and the premiumization play for West Side, and the other, the concentration in urban centers. So what I'm trying to get at is, does anything materially change? A lot of people are talking about the new tax regime coming through, consumption getting a fillip, the first salaries will come through today, tomorrow. Do people go out and spend more is the question. What are you building in?
So we build there is an impact that we build for consumption to be better than last year. There is a base effect again here, which is positive. But we also build in the fact that there is some impact of tax cuts, rate cuts, and for next year, probably pay commission. All increasing the disposable income that consumers have. A part of it will go to deleverage the already leveraged household sheets. However, it will relax the consumption pressure a little bit compared to last year. So we do build in that the SSSGs will revive back to, let's say, 10% or 12%, but we are not thinking of 25%, which was the baseline for FY 23-24. So very moderate impact of overall consumption. I think given the geopolitical tensions, that has become even more of a concern on how free the customers will be. So I think there's broad positive, but bigger is a base effect, and bigger is just their network store expansion.
I just want to have a follow-up to what Hiral already asked you, just to ensure that we've driven home the point. She asked you whether a derating might be possible based on the slowing down of the trajectory. At this juncture, in your opinion, what is a fair multiple to give to Trent? And do you see that changing if some of the expectations that you have built in, and perhaps the street has built in, do not come through?
Yeah, so I think today the consensus seems to be a 70 times multiple for 27 earnings. And I think it's a relative multiple. The slabs that generally exist for is mid to single digit high ROCE companies like FMCG firms have around 40 to 50 earnings. So a 25 to 35% growth company should command 65 to 75 earnings. I think that's the broad thesis. If the earnings growth slows down below 30% next year, I think there will be a material derating in the company. If that happens, I don't expect that to happen. But if that happens, then there will be
So Jignanshu, then the target price on it, and do you ever think it'll go back to your 8,100, which you had envisioned earlier?
Yes, absolutely. So I think the 8,100 was when the growth percentages were much higher.
Yes.
For now, for the stock to go there, I think they need to find a non-Zudio lever of growth.
Okay.
I think at what my current price is, which is let's say 6,500 to 6,700, probably most of the Zudio growth potential is priced in.
Okay.
The next 1,000, 15% up needs something more, a new lever of growth. They are trying multiple things. We don't know what will work out.
Right. The interesting part in the earnings was also their Star Bazaar business, where like-for-like was only around 2%, but revenue growth was at 16% this time. Two things there. I think stores, people are still going to stores, but I think Star Quick is picking up for them. Is this something that you are also observing? And do you think that Star Quick will be able to compete with likes of Zomato or a Swiggy?
So I have a structural view that in-store pickup model for quick commerce is inefficient compared to a dark store model. What Star Quick, from my understanding, does today is they have folks pick up the products from the store and then deliver. I think the cost structures there make it very difficult to become viable in the long run. On Star itself, yes, I think the 2% LFL was a combination of high base and competition from other organized forms. We don't build in a material growth in Star. I think the current, if you are investing in Trent because of Star, I think there is something structurally wrong with how you're investing. You should focus on Zudio and Westside as the value drivers.
One question I have is on the Shopper Stop. I know you don't have a rating on it, but what's going wrong? I mean, 7 to 8% is the kind of cuts that you're seeing. If you see in terms of the numbers as well, I think it's the profitability hit that you're talking about. But from a structural perspective, how are you looking at the strategy in terms of Shopper Stop?
See, while we don't cover the stock, we don't have a rating, but I think at a department store concept in general, these concepts struggle when there is down trading across consumption, because consumers fear that entry into the store will expand their wallets more than what they have bargained for. So they like to go for value retailers which offer a ceiling on how much you will end up spending in those stores. So that's at one point which is cyclical. Structurally, as retail markets mature, customer segmentation and hence product/positioning also needs to be segmented, and hence specialists emerge, especially in something like a fashion. And I think that's the other trend that we are seeing, which is where all department store formats are facing that competition.
So then with that in mind, we've primarily spoken about Trent and you've maybe referred to a couple more. But in your coverage universe, does anything else stand out, or does Trent remain by far and away the most preferred pick?
So I think it's a toss-up between DMart and Trent. DMart is the other one which I cover. I have been very positive on it because I don't think that people are, or rather I think that people have overestimated the impact that quick commerce will have on its core business and customers. Today, I would prefer to wait for DMart's margin numbers on Saturday. But DMart has, from a stock perspective, it has more news flow driven drivers possible. We know that they're likely opening something in Uttar Pradesh, and the new CEO coming in might have some strategy views. I think that will probably put DMart and Trent neck to neck. Probably today DMart up, unless the margins are really bad.
So why do you say that there is an overestimation of the impact of quick commerce? Are you basing that on certain studies that you've looked at, certain behavioral patterns?
Yeah, I think there is a clear market for quick commerce, and it's covered by my colleague. But the market for DMart is also existing, and both are sort of feeding off by displacing the unorganized players. And the market is big enough for both. So for the QC guys to continue at 50, 60, 70% growth rate does not mean that DMart can't grow at 20%. I think it's more about what DMart does, whether they can get the right products into the stores, which they are now doing, whether they can open stores fast enough, which will define their growth, than competition.
So would you agree then that when it comes to the operations of these two entities, and we're talking about them in two blocks here, investors have been forced to accept a certain level of burn, cash burn for the quick commerce, for the kind of growth that they're delivering. And on the other end of the spectrum, the growth has not been fast enough. So that is really the big question with DMart. What, in your opinion, is acceptable, and what is the best that it can get? At what point would you say you have to change your view on DMart based on the trajectory of growth?
I think 20% is the number in most folks' mind.
Okay.
So when I look at this year, they had around 17% growth for FY25. If next year, either with faster store addition or a little bit uplift in consumer demand, because what is positive for FMCG is also positive for them.
Correct.
So that, if it pushes up to 20%, I think most investors will change their view about DMart's growth trajectory.
So I think that's going to be an interesting one to watch out for. And a Trent versus a DMart again becomes a very interesting play overall as well. But thank you, Jignanshu, so much for coming to the studio. Always a pleasure to have you here as well. So that's the overall strategy you should be watching out for if you have to look at Trent, if you have to look at DMart, and you already got a view in terms of what's happening with the Shoppers Stop in terms of strategy. So these are the three stocks we should be on our radar as well. But let's quickly slip into a short break. Up next, we will speak on gold with Navneet Damani, Group Senior VP, Head Commodities Research, as well as Saurabh Gadgil, CMD at PNG Jewelers, to discuss more. Please stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
Welcome back. You're watching India Market Open, and we have just about stepped into green territory on the benchmark Nifty 50, 24,357 on the charts right now, and we're treading water, so to speak. But beyond equities, we've been looking very closely at another asset class, and that is gold, because of the kind of red-hot rally that it has had, not just in the last few months, but also since the start of 2024. And the kind of run that you've had over the last 1 year, despite the recent correction, is upwards of 35-40%, right? So the question that we're asking this Akshaya Tritiya, and compliments of the season to you if you're tuning in, is what are people doing with gold, and what should you do in terms of your investments with gold? Navneet Damani, who's a group Senior Vice President and Head of Commodities Research at Motilal Oswal, joining us to talk about the latter, and to talk about the former. Of course, we have Saurabh Gadgil, who's the Chairman and Managing Director of P&G Jewelers. Since it is Akshaya Tritiya, let me go to you first, Navneet, on what your anticipation is, what you've seen in recent festivals, and the tendency, from what we found out, of buyers coming to stores, exchanging jewelries and buying lighter. Is that something that you're anticipating? What are the volumes that you expect will come through this festive season?
Well, thank you for having me on the show. We've seen a sizable run-up in gold prices. As you mentioned previously, it's about 25% year-to-date returns just in the last 4 months. And as we speak, it's pretty volatile. Every alternate day, you're seeing about 1,500 points movement in gold. This is something unlike what gold is likely perceived as an asset class. It's typically a safe haven asset class, and today it's more of a financial asset than a safe haven asset. So there is enough and more demand for gold even at every price point, and people are just waiting for a reasonable correction to gather it once again, because this in the last 5 years have delivered a better return than any other asset class which most of the people are investing into. Now, what is going to be the demand for Akshaya Tritiya? I think Mr. Gadgil will be able to tell you better, as he owns a jewelry store and probably a chain of jewelry stores. But I think the ground level research that we've done, typically the footfalls are lower. And there is more of cannibalization between gold to silver at this point in time. People are preferring lower caratage of gold, or probably waiting for silver as an investment, because that is not caught up significantly as far as gold is concerned. And I think price point wise, we are about 4% or 4.5% away from lifetime highs. Better levels will be anticipated, and there are a dearth of people waiting on the sidelines for any correction to enter into this metal at a lower price point.
Right. I mean, Navneet, good morning, and Saurabh, good morning as well. I think, Alex meant to ask that question to Saurabh, and he just said Navneet. But Saurabh, let me take that with you as well. How are you looking at it in terms of the demand? If you have to compare the last couple of years, are you seeing the mood come off, taking into consideration higher pricing, and that in turn impacting volumes?
Yeah, good morning, and wishing everyone a happy Akshaya Tritiya. Like Navneet said, right now, prices are at all-time high. There's been huge appreciation in gold. But having said that, people's interest in gold as an investment, as a store of wealth is very strong. Yes, we have seen a lot of people swapping old gold for new jewelry. So primarily wedding shopping is almost today 50%. The currency is old gold, and that is what people are preferring today because of the high prices and due to that the budget constraints. But in between, there were a lot of fears on gold seeing a huge correction, and gold could see a big downfall. But that has not happened, and that again has reinforced people's faith that looking at the geopolitical situations around the world, gold seems to be an asset which will be in a bullish mode, and that has really seen people coming and entering the gold market physically. There's been no selling pressure, and people are buying gold. Quantity has been a little struggle because of people's budget, but in value wise, we'll be 30-35% more. So Akshay Tritiya, I think value-wise, the industry should be aiming for around a 20-25% hike over last year. In terms of volumes, I think we could see a dip, maybe a single-digit dip, around 8-9%. But the sentiments are bullish. Today is a whole day of Akshay Tritiya, right from morning 8 o'clock till midnight is the Muhurat. So, we see a lot of, pent-up demand being converted today. Bookings have been moderate. I would not say there have been super bookings, but bookings have been quite decent. And people interest in the festival in Akshay Tritiya as a part of this Sadhe-3 Muhurat is reinforced again. So we're hoping for a good day of sales as we progress today.
Point made, Saurabh. Thanks for answering the question that I originally asked. Navneet, and to you, you fielded it quite well. Even though the question was not intended for you. But let me ask you this then, because you've seen a little bit of a cool off in gold prices from those elevated levels of close to 2,500, rather 3,500. See, there you go. The numbers have moved so quickly that I'm talking about 2,500 still. But $3,500 in the international market. Where do we go from here? Because a lot of people are talking about gold-silver ratio, but that's not panning out. And while you have trade tensions, they've dissipated somewhat. So does that come into play? Dollar has remained below 100, stays at 99. If that does move above 100, is that the biggest risk factor for gold?
Well, there are a lot of risk factors as we speak. Primarily, it's largely driven by a trade war situation between China and US, and the tariff imposition on each other has kind of taken the center stage. Demand side story continues to remain as it is, but the supply side story is pretty robust, but the demand side scenario has changed drastically, largely because. Now, what has happened? You see dollar index correcting from 106 levels to 98 levels within a span of no time. And the so-called cuts in interest rate which the US was talking about seems to be a far-fetched at this point in time, because these kind of tariff is going to lead to higher inflation, slower growth, and eventually the postponement of rate cuts is likely to happen. So all in all, this scenario is not likely to play well neither for US nor for China. And both of these biggies have to come on the table and probably settle out their issues, because China is in a phase of recovery over the last 4 years since the COVID, and US also is not in a great state. The 10-year GSEC is also a very interesting number, where it was down to about 3.6, 3.7% and now shot up to 4.3%. Primarily, US is sitting on a 36 trillion debt, and to service this debt at a 4.3, 4.4% kind of a yield is going to be a very, very massive task for the US Treasury. So I think this is a matter of time when these trade-related tensions are going to come at a standstill, and maybe the prices are likely to kind of stay where they are or at least cool off.
So Navneet, when you talk about prices cooling off, what's the potential that one should be watching out for? How much downtick from the current levels?
Well, we don't have a number in place, primarily because every now and then you see the statement keeps on changing very significantly.
Yeah, but we can have a range, right?
Kind of $100. Yeah. So that's what I'm coming to. We as a broking house, and as we expect that anything closer to 3,200 and 3,150 is a level where you will see buying interest come once again. On the domestic front, if I say about 91,000 is a level where we expect that buying interest will be very massively into gold. But we also spoke about the gold to silver ratio. Historically, we've seen that it is only two instances gold to silver ratio has sustained above 100 level for a brief period of time, once during COVID and once during 1980s. As we speak, it is around 102, 103. We expect that this ratio has placed its hand, and maybe it's time for now silver to outperform gold, and this ratio can have some skewness back to about 1992 levels once again.
Okay, so then as a house, while you're not giving targets on gold at this juncture, that's understandable, Navneet, would you say that the advice right now that you're dispensing is perhaps book some profits if you can in gold, if you've got the ability to, and I'm talking about primarily people who are investing in ETFs, and would you say that it makes sense at this juncture with silver having underperformed in a big way? And if I'm not mistaken, 1 year performance or 6 months performance, I think silver was down 2% last I checked. I'm not sure what the current value is, but would you say that there's a trade in silver?
So in the year 2024, silver gave you about 34% kind of returns, while gold gave you about 31% kind of return. For the year 2025, for the last 4 months, silver has underperformed, whereas gold has rallied very significantly. Now, there is definitely a trade where we expect that silver could eventually catch up and the rally could extend to 110 and 125, 1,25,000 rupees per kg for silver over the next 12 to 18 months. Now, gold, we have definitely have a target of 1,01,000 rupees as a target and maybe $3,800 as a target. But buying comfort is not at the current price. We expect that if an investor has to invest, it has to be a better price. If it's a tactical investment, one should look to stay away from gold. But if it's a long-term investment, you have to definitely park some money, then wait for a price correction of about 5%, where your risk and reward will be favorable to enter and maybe garner about 15% returns over the next 2 years.
Thanks, Navneet. Saurabh, running short of time, we just have a minute. Very quickly, is the retail growth lower as compared to the growth you're seeing in gold prices? And in terms of the old gold exchange, how much is that contributing, just to get us an idea?
The retail growth in terms of value is more than the gold price appreciation. I think retail growth in value terms would be around 30%, which I think is quite good considering the entire market scenario. People are looking at gold as a currency to buy new jewelry, and that today is around 50-55% of the entire sales. So that typically was in the range of 18-20%, which has gone up to 55%. And I think that's primarily because of the high prices and people's budget constraints. But having said that, people are buying jewelry. Wedding shopping is going strong. Diamonds have seen a good run as we speak. And I think overall people's interest in jewelry remains strong. Silver and gold, I beg to differ, do not compete because silver to hold physically is very difficult. Yeah. So the silver physical buying is very different than gold physical buying. And these markets both coexist. So I think overall things are looking good for the industry as we speak. All around, just the data has come from World Gold Council, where India has been the largest importer of gold last year. So that really speaks on the India's volume consumption.
Absolutely.
And I think things as we go ahead look the same. So let's all hope that this Akshaya Tritiya and the coming year should be a good year for the industry.
Absolutely, hoping for the same as well, because we'll wait for all of us and our husbands and wives to buy each other gold and jewelry for our investments as well. But thank you, Saurabh. Thank you, Navneet, so much for joining us on the show. And all the husbands who are listening as well. I think, Saurabh is promoting purchase of jewelry. But let's quickly slip into a short break. Lots more lined up on the other side. Please stay tuned.
That's huge. That is a biggie. It's out of it.
Gold Plus Clear Glass. Far ho ya near, sab kuch dikhe clear.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
welcome to NDTV Profit, and you're watching Profit Insights. And joining me today is Vivek Paul, Global Head of Portfolio Research at BlackRock Investment Institute. Vivek, thank you very much for joining us on NDTV Profit. You know, we're going through a age where we are seeing a big disruption happening globally with respect to trade, and that's having an impact in terms of how stock markets are performing and various other asset classes are performing. As you look at it, how do you see the US trade rhetoric which is coming in from Donald Trump, impacting flows, and where do you see this getting settled?
Well, firstly, thank you so much for having me on. You're completely right. I mean, it's amazing to think that it's it's still in the month of April where we have had just material shift in the narrative in terms of the global trade dynamic. And we expected, of course, some material news and material rhetoric, but I don't think it's fair to say that many expected the extent of the volatility that we've seen. And you're right that it's shaping flows. And let's take India directly as an example. As we know, for a bunch of years, we saw material kind of inflow into Indian equities from foreign investors, which really started to sort of arrest something in the middle of last year, all the way through to the first quarter. And actually, what's really interesting is you look at the period of flows in the post-April 2nd announcements, and actually that's become positive again for foreigners in India. And I think that really goes to show that this is an environment where there's a relative game and there's an absolute game at play. Undoubtedly, in terms of the absolute scenario, this is an environment where we are going to end up with greater tariffs globally than we had in the past. That seems to be the clear direction of travel. But there's an enormous range of potential outcomes within that. And it is shaping the narrative. It is shaping the trade dynamic. It is shaping the opportunity set for international investors. If I think about our own positioning, our own sort of portfolio recommendations, where we started the year in terms of the sort of more broad Asian kind of complex, we had a near-term preference for China with a longer-term preference for India. As we've kind of come into the more recent period, we've softened that China preference. That's now neutral, given the particular impact of the trade dynamic and uncertainty on China. But we continue to reiterate that long-term opportunity set for India. And I think actually some of the structural benefits India can face in this environment is perhaps even accentuated by the volatility that we've seen.
How do you see trade shaping up with respect to India, given the fact that in the last 9 days alone, we have seen close to $4 billion of foreign flows coming into the country. And as you said, there may be a pause coming in because there's a trade reversal which is happening from China, and it could be flowing into other emerging markets into India.
Yeah, I mean, it's critical, right? I mean, I guess we've talked for a while, I think, about the idea that India has a unique opportunity in an environment of greater sort of global dislocation from an economic perspective, because it can play a role with both the United States and with China and really kind of insert itself more centrally into some of those global systems. And I think what we've seen over the course of the recent weeks is some of that starting to come true, right? We've seen the idea of major sort of manufacturers of telephones kind of thinking about using India more as a hub for some of that supply. We've seen Chinese exporters kind of think more about using Indian companies as a means of gaining access of their end exports into the American economy. So I think you're starting to see some of the dynamic we were postulating before coming through. I think that's one important point to make. I think there's another point I think implicit in your question, which is the ability, I think, of India to kind of come out of this with a relatively more favorable outcome. And you've seen comments from leading officials in the administration saying that they anticipate sort of progress with India and some of those trade talks to be accelerated relative to international peers. And that makes sense, because actually, if you think about the share of the sort of US imports that are kind of affected by this for India is comparatively small. The Indian economy is relatively resilient to this dynamic. And actually, structurally, from a sort of geopolitical perspective, it's probably an easier deal to be done with India, at least according to the US officials, than there is perhaps with China. So the ability to kind of make more material progress in terms of getting a deal, the starting point of the fact that there's less interconnection between India and America relative to India and China in terms of those supply chains mean that perhaps we do see a more favorable outcome, and that will lead to more stories like I started this answer talking about, of international trade being sort of rewired a little bit through India.
How does a portfolio manager look at it from the point of view of asset allocation? We're seeing Trump flip-flopping on announcements. There is a great deal of uncertainty which is coming into play. That's creating a volatility in place for a fund manager who is planning to allocate through various geographies and asset classes. What should he be reading, and how do you see that translating into investments into geographies or asset classes?
Yeah, and this is the debate that we're all having in the asset management community, and I guess more broadly, investors at large. And I think one thing I would sort of caution against, I think trying to predict the next headline, the next kind of bit of news flow with regards to trade negotiation or whatever else it might be with regards to the trading policies is really hard. It's a fool's errand to try and understand exactly or try and forecast exactly the next step in a negotiation pattern. What I think we can do, though, is try and think, where are the boundary conditions, right? Where are the bigger kind of sort of dynamics, which mean that will prompt a reversal in a particular path or the rhetoric. And we're kind of framing this in the notion of thinking about the immutable economic laws that are actually going to govern what the end state looks like. And there's two that we particularly highlight. One is to do with the idea that you can't just, if you like, you can't just kind of change the terms of the trade deficit without having an impact on the foreign sort of flow and foreign funding of US assets. And I think we saw that sort of immutable law dynamic really coming into fruition right at the start of April, where we saw the 90-day kind of pause on tariffs come immediately after the fears in the treasury market of spiking yields. And I think you see there that the idea that the market forces of the yield movements kind of then influence the ultimate direction of travel of policy. I think you also saw some element of that when it comes to the second immutable law that we think about when we're trying to govern the space and navigate the space, which is the idea that the trading interconnected nature of the global economy has taken decades to build, and you can't just change it overnight without experiencing or anticipating some material economic damage. And I think when you saw in the course of the last couple of weeks the idea that leading CEOs were kind of pointing out to the world that there could be some impact here from kind of trying to change too much too quickly, you then again started to see some softer rhetoric come out, and therefore a bit more of a market rally in the course of the last week on account of that softer rhetoric. So trying to guess the very next move is really impossible. Trying to think about what are the bigger picture boundary conditions that can then influence the ultimate outcome, I think that is where we need to think a little bit more. And in that spirit, in that vein of taking that slightly bigger, longer term approach, that's where we see the opportunity arise in India, because the structural dynamics we've been talking about for a period of time, the demographic dividend that India faces, the digitization of the Indian economy. These are structural drivers which we think it's important to focus on, because it can be very easy to get carried away with the very near term and only focus on, if you like, the very near term tactical dynamics. We actually sometimes need to take a little bit of a step back, and that's where the structural opportunity lies. And the final thing I'll say in answer to your question, when we're building longer run portfolios, for an international investor, we would indeed think a little bit more about holding a greater allocation to benchmark weight in Indian large cap equity.
So that's the conversation that Sajid has had with Vivek Paul of BlackRock, where he's clearly indicating that limited direct exposure to India on the back of Trump tariffs is what you're watching out for, and maintains a neutral stance, at least for the next 6 to 12 months, believes that India stands out as a relative bright spot over the long term and sees greater than benchmark weights for large cap India equity. So that's a strong word coming in from BlackRock. But moving on, let's also welcome in Abhay Agarwal, Managing Director at Piper Serica Advisors. Abhay, good morning and welcome to the show. And this is Hiral on this side. Abhay, we were just listening to the conversation that my colleague Sajid had with BlackRock, and their key stance that they're picking up right now is that maintain a neutral on India over the next 6 to 12 months. However, India is in a bright spot from a longer term perspective, and they see greater than benchmark weights for large cap India equity. How would you read into this?
I think it's a very positive sign, Hiral, and I'm not surprised, frankly, because I think when we also talk to some of the large asset allocators, everybody has India on the top of their list for allocation. And I think there is realization that India is, despite its size, its potential, is still a $5 trillion market cap. And if you compare that to China, which is about 18 trillion, US, which is about 60 trillion, you start seeing a medium to long-term opportunity. And I think that's what the BlackRock gentleman was alluding to, saying that you need to look beyond the near-term issues, near-term challenges, and believe that there is a very solid medium to long-term story that will outperform. And the reality also is that as we grow, we will need foreign capital because the domestic capital will not be enough to support the growth that we are seeking. So I think it's a good mix of the large allocators, large foreign allocators, optimism about India opportunity and the potential of Indian market to outperform other global markets, and also what we need as a country in terms of foreign capital to support our growth. So I think overall positive. I think if we get this constant flow of foreign capital, which is long-term capital plus domestic capital, which keeps coming into the market, I think this will support the growth that we are seeking as a country.
Abhay, good morning. Alex here. I'm just wondering where that flow comes through, because there have been instances over the past couple of weeks where you had 8,000 crore on one particular day of net buying by foreign institutions, and you couldn't really make out. Usually you can, where you see the bank index or you see a few stocks in the banking pack move quite substantially, which have traditionally been favored by foreign institutions, but you couldn't tell the next day where the deployment took place. So is it the traditional banks and IT and more banks than IT, or is it going beyond that now, considering the kind of float that is available even on the broader end?
So, Alex, I would split that flow into two parts. One is the typical ETF kind of flow that tracks indices and that finds its place in ETFs or stocks that are part of the index. And then there is a part which is more active, that is seeking opportunities, making differentiated bets. So that would not necessarily go into index heavyweights, and that would go into companies that are promising to be next multi-baggers. I would split this flow not on a daily basis, but overall basis. 75%, let's say, is ETF driven, and 25% is active. The 25% active, you do not immediately know, but you start seeing a pattern emerge over 2-3 months as companies announce their shareholdings, and you see which company the FPI shareholding has gone up. So I think on a daily basis, Alex, it's difficult to pinpoint exactly where the money is going. But I think if you watch it for a quarter, that's when a pattern emerges. What I'm seeing right now is that there is a judicious mix. There are people having conversation about which are the emerging sectors in India, which will take the leadership and create higher market cap. And increase their weight in the index compared to what we call the traditional defensive bets like IT or that kind. Banks and pharma, I think this time is there is a lot of conversation about banks and pharma because they are in the large cap side seen as growth drivers.
Abhay, my question is, yes, on the sectors, but known for probably capitalizing on the market fear. Are you doing that currently? And if so, how much percentage are you holding in terms of cash position? And which are the sectors where you're increasing your positions?
Yeah, Hiral, so as active equity investors, when we get money from our investors, it is part of their equity allocation. So we typically refrain from taking cash calls on that. We just assume that this is the money that they would want to be invested in high quality stocks, high quality portfolio at all points of time, because they would have taken cash calls on the rest of their portfolio. So with that mandate, we typically do not have more than 10% cash in the portfolio at any point of time. We seek opportunities where we see that something has, been mispriced by the market, high growth stock that has corrected, that excites us. So we typically do not take cash calls at this point of time. I think our cash holding would be between 6 to 10%. In terms of sectors that we are overweight on, we are overweight on EMS. Again, but not by recommendations, but we have pretty much all the top stocks like Dixon, Amber, Sirma, Keynes in our portfolio, in our model portfolio. And then the second sector that we are not getting overweight, but adding to the portfolio, which we did not have for a long period of time, is banks and especially small banks and NBFCs. This is a bit of a contra call because there is still a lot of negativity around this sector. But what we see with RBI support, government support, and greater liquidity in the system, the banks are kind of getting back on their feet. And microfinance is a bad word right now because it's a cyclical bottom. But again, we believe that at this bottom of the cycle is when you need to take some risk and make these bets on the faster growing financial services, financial lenders. So these are the two sectors that we are, if you can say, bullish on. And the third continues to be pharma, which has been an overweight for us for last couple of years.
Okay, I'll get to pharma in a bit, but Abhay, if you can, and I'm not asking you, of course, to give a recommendation here, but just because we're speaking on a morning where the Bajaj twins are getting beaten down, and Bajaj Finance in particular, because of the outlook that they have given, and you spoke about fast-growing financial companies and lenders at that, seemingly a bit of a pivot by this company to say that it is going to go a little slow on unsecured, and that is going to have implications for its ROE, for its ROA, and for the growth that it has in play. What would your reaction to something like that be?
So again, Alex, let's split that whole sector into two parts. There are very large lenders like Bajaj Finance, and then you have HDFC Group, including HDB Financial Services, and then you have a couple of other large lenders. And these are companies that are trading at valuation, simplistically seen as multiples to their book value, which are at a level that they cannot have a quarterly miss or negative commentary. So I think a lot of their stock price correction is driven by the fact that they are market darlings and they trade at a high multiple. Again, great franchises, so it's a matter of time that they recover. Our focus is more on the smaller lenders, and these are the lenders that got more beaten down by the markets because of poor results last quarter, and the current quarter is slightly better, not that there, but the commentary is positive. So what I think last quarter, if you went through every lender's commentary, everybody said that we will cut down on unsecured and focus more on secured, constant commentary, and which makes you wonder that are all lenders, part of a herd mentality that everybody gets out of unsecured at the bottom of the cycle, and when the cycle picks up, everybody gets into unsecured lending because that's where the highest NIMs are. So I will not be surprised if this commentary changes again as the unsecured lending picks up. The government has already provided a credit guarantee. The money is flowing in for microfinance lenders against the guarantee schemes. We have seen that money come in for some of the banks and microfinance companies. There is nudge from the RBI to banks to lend to NBFCs and to microfinance companies because they don't want the credit to dry at that level, because these are self-employed people. You need to make sure that they have enough liquidity. RBI has put strong guardrails there, from 5 lenders to 3 lenders as of April 1. So I think a lot of things have changed in the system, and the impact of that will be felt over next 6 months. So I think rather than wait for that to emerge, we believe that it is a good time to start betting on these smaller lenders who have higher allocation to unsecured lending in their books.
Right. So that's an interesting take on that front. Abhay, sectors that are overvalued, let's look at those aspects as well. Would you make any exits at this current point in time? Because even Indian markets substantially are still overvalued. Probably there is some bit of room for correction as well. But if someone has to reallocate their portfolio, exit the overvalued sectors and make new bets, which other sectors would you advise that should be exited?
So Hiral, I would look at, and the way we look at it is that we compare the sectoral valuation and the company valuations to the potential growth. So, and when we do that analysis, we are very objective and there are no holy cows for us there. So I think one sector that we have been completely underweight in and have zero exposure to for last 2 years is IT services. Now, IT services companies have seen a stock price correction, but I don't think it is still enough, because if a company is guiding for a 0 to 2%, 0 to 3% growth, with margins under pressure, with the competitiveness of the business under pressure, lack of innovation, then I still don't understand that why would anybody look at them as defensive bets and pay a 20 to 25 P multiple for a company that itself is saying that it will not grow at more than 2-3%. So I think the whole IT services pack, just because of historical reasons that it has been a money spinner, is something that trades at a very high valuation than it should. And I think markets will realize that as the earnings commentary, growth commentary stays cautious for the next couple of years. So that is one sector. The second sector is this whole large cap FMCG companies. Again, same problem. At regional level, we are seeing emergence of competition from local brands, and the larger companies have still bit of that arrogant style that we are so strong that we will be able to control our market share and grow. But that is not playing out. So you see some of the large companies struggling for volume growth, struggling for price increases. And trading at multiples which are 40 to 60 times PE multiples for these low growth companies. So I think these two sectors, though they may seem defensive, are not investor friendly, because even if you have them in the portfolio, I don't think any return will be made for next 2 years.
So IT and FMCG, point well made, Abhay. I do want to circle back on to what you were saying on pharma, and to widen that also into the healthcare space, because I think now there is so much to talk about in that space, so much that is happening domestically as well. But would I be right in assuming that you're focused on domestic players in the pharmaceutical space, given the kind of uncertainty you have globally, or would you look through that, as some people are saying they're doing, because it's not so easy to shift supply chains?
So we have a mix, Alex. So we have a hospital company for like 10 years in our model portfolio, which is Apollo Hospital, done well for us. And we see that as a proxy for India healthcare in terms of hospitals, diagnostics, pharmacy, the entire integrated play. Then we have large generic exporters and CDMO, so Divi's and Dr. Reddy's fit in there. We believe that is where there is a significant shift from the US regulator and the US importers looking at India more favorably. And also The Indian generic companies have also cleaned up their act over the last 5 years. They are more US FDA compliant. Their pipeline is the strongest ever. Pipeline of new product launches in the US is strongest ever that I have seen. You know, some of them have 150 launches coming up over the next 1 year. So I think as these things play out in a very favorable market environment, where China will definitely not fully go away, but whatever else comes in, even a part of that is very big for Indian companies. So I think it's a very positive environment that Indian pharma exporters are. And Divi, especially because of the CDMO presence, I think that will continue to become a bigger and bigger business and will have higher margins also. So that is the second part of our healthcare bet. And the third part is this whole focus by the government on making sure that spurious drugs in India are weeded out by regulating very heavily the manufacturing of domestic pharmaceuticals. So earlier, because of tax breaks, a lot of small plants came up all over the country. But now that is being consolidated by the government. And there are 3 listed players, and we have 2 of them in our portfolio. So there, the bet is that this will be like an outsourced manufacturing for Indian consumption, you know, Indian brands by large brand manufacturers. And that will grow, and that will generate higher profits for these domestic CDMO players. So I think that's the integrated healthcare play that we have in our portfolio.
Right. So these are going to be interesting names to watch out for, hospitals, CDMO players, et al. But thank you, Abhay, so much for joining us on the show and sharing your views. Clearly, you know, sectors which have the potential, sectors which you can exit and rebuild your portfolio as well from here on, Alex. And that's the word coming in from Abhay, but completely out of time. But that, it's a wrap on this edition of India Market Open. From Alex, the team that put this show together, and myself, a thank you. And please stay tuned to NDTV Profit to get all your queries answered on our next show, which is Ask Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Watching NDTV Profit, I am Mahima Vajrajani and this is Ask Profit, a show that gets all your stock related queries answered. Viewers, you can either call us or WhatsApp us your queries on the numbers that are flashing on your screen. Before we move on to the queries, let's take a quick check as to how the markets are doing at present. Let's pull up the benchmark indices, the Nifty 50 as well as the Sensex. Well, the Nifty 50 has seen a certain amount of bounce back but still trading around 0.1% lower. The Sensex also trading within the similar range, down by about 0.1%. Let's pull up the broader markets. There you go. Nifty mid cap 150 is almost recovered and trading flat right now. The small cap 250 is down by about 0.7%. Of course, it's important to keep in mind that expiries are also playing their role in trade today. Let's pull up the overall Nifty heat map and see what counters are putting in pressure on the entire Nifty pack. The Bajaj twins, of course, are putting pressure significantly in terms of Nifty 50. Trend also down by about 3.5%. With respect to where sectors are concerned, let's pull up the sectoral heat map as well. In terms of sectors, it's a mixed bag overall. There you go. There's Nifty Realty, which is up by about 2% PSU Bank under pressure. Nifty Defense, interestingly, has reversed its roles. Morning, it was up by about 1.5%, which is right now down by about 1.8%. There's some gains being seen in Nifty FMCG. Nifty Pharma has slightly reversed. It was down in trade yesterday by about 1%, but it's leading with gains of about 1% today. Nifty Metal is seeing gains of about 0.23%. Let's also pull up the overall Nifty total market or BSE 500 to see as to what counters are buzzing in trade today. It's definitely a very earnings specific market. Stocks which are giving good set of numbers are seeing significant amount of gains, but stocks seeing a slight pressure in terms of missing their estimates are being cratered down. In terms of stocks that are doing well in trade today, there you go. They see it on the back of its earning up 6%. Schaeffler also on the back of its earning up around 5.7%. Macrotech up 4%. Sonata Software up 4.7%. Godrej Properties also up 4%. Praj Industries not doing very well on the back of its earnings. Revenue was down nearly 12%. Bajaj Finserv and Bajaj Finance. We talked about the Bajaj twins. Not a very impressive guidance given by the management, down by about 5%. Shoppers Stop, significant downtick in terms of its profits, which is why the stock is seeing significant amount of pressure. Westlife down by about 4%. So that's with respect to where markets stand. Let's start with the queries for the day. Then our first query is from Piyusha Raj Purohit, who has purchased Coal India shares at 446 a piece, and she's bought 765 odd shares. Currently sitting on a loss of around 44,000 odd rupees, and wants to know as to she should average from a longer term perspective or not. Nirav, very good morning to you and welcome to the show. My first question to you is about Coal India. What's the view like?
Yeah, good morning and thank you for the invite. As far as Coal India is concerned, I think advise to wait for the results before taking a decision to average the stock or not. I think it's advisable to hold the existing holdings at this point of time.
Okay, so that's the view with regards to where Coal India. We're also joined by Vaishali Parekh, Vice President Technical Research at Prabhudas Leeladhar, also joining us now. Vaishali, quick view on the charts for Coal India.
Hi, very good morning, all of you. So I think Coal India has seen substantial correction right from 540 to now currently at 387 levels. So I think 370 acts as a very good support for her to average out. So that way her cost will come down. And once we see the momentum setting in, maybe can get good returns coming towards at least 430, 440.
Okay, so that's the view with regards to where charts are concerned for Coal India. Our first caller for the day, Biral, is calling in from Mumbai. A very good morning to you, Biral. How can we help you?
Hi, good morning.
Good morning.
Yes, so I'm holding shares of a company called Reliance Infra.
Okay.
So I would like to know the prospects of the company
Okay.
from the current scenario. Whatever is happening, whatever developments are happening in the company. Based on that, what do you analysts think about the company?
Okay, and you want to continue to keep holding this from a longer term perspective, Biral?
Correct. Yes.
Okay, then I'll take this up with Nirav. Nirav, your view on Reliance Infrastructure?
Well, the group has been struggling. We all know that Anil Dhirubhai Ambani group has been struggling. And as far as Reliance Infra is concerned, I think that the order book position, etc., needs to be ascertained. I think there are better quality bets in the infrastructure space. So it's advisable to shift to some more better quality names at this point of time.
Biral, if you're still there on the line, I believe this is a significant amount of quantity that you've bought. I just wanted to understand as to what percentage of your portfolio is Reliance Infrastructure right now. And in fact, you've also entered at a very low level and you're sitting on a profit of 26 lakh rupees. So I wanted to understand as to how the dynamics stand.
No, so I personally believe that it's, the time has come for the debt to rise. Most companies, not only Reliance Infra, in general. Because, and it's better to buy a company which is, gone down a lot, but which has a good quality, like kind of they have good businesses with them. And rather than buying a very, a huge, big company, at a very, very expensive price, it doesn't make sense. So Reliance Infra has a very good business. Yes, tough times over there, but I think they have kind of faced the tide. And I think it's extremely underpriced at the moment, based on the businesses that they already own. Not talking about the future, just based on what they have. I think it's extremely underpriced.
No, so Biral, I wanted to understand as to what percentage of your portfolio is this holding?
Well, I wouldn't be aware of that.
Okay,
but
all right.
Yeah.
All right, okay, no problem. Thank you so much for joining us, Biral. All right, the next question is from Gurpreet Singh, who's writing in from Mohali and wants to know about Bajaj Finance. He's currently having 53 odd shares and wants an opportunity to get some profits out of this particular counter. From a longer term perspective, he wants a target. He's sitting on a loss of 42,000 rupees right now. Nirav, I'll come to you again. If you have had the chance to go through the earnings, the management has lowered its guidance overall. How are you viewing it, and do you think the stock will continue to be under pressure for some time?
Well, I think the results of Bajaj Finance, there has been a temporary blip. Definitely, there's been a cut in the AUM guidance, and that has disappointed the market. But I think we are likely to see some more correction, some more pain in the stock. But that should be used as an opportunity to add or average the stock rather than thinking about exiting the stock.
All right, so that's the view with regards to where Bajaj Finance is concerned. Our next caller, Murli, is calling in from Bengaluru. Murli, a very good morning to you. How can we help you?
Good morning, madam. Thank you for taking up my query.
Go ahead with the query, Murli.
Yeah, I bought CRISIL 100 shares.
Okay.
At the rate of 4,416.
Okay.
Being one of the, very limited listed rating agencies.
Right.
And results are today.
Right.
What shall I do? Should I hold, sell, or add more?
Okay. Murli, I'll take this up with Vaishali. Vaishali, with respect to where charts are concerned for CRISIL, what are they indicating?
You're talking about CRISIL, right? So I would say, the stock is showing signs of bottoming out, and as long as 4,200 on the chart, this level is intact, I think you can expect a further run up, at least coming up to 5,000, 5,200. If we see further run up coming in, I think in all likelihood this would get into a trend, and one can expect a target of 5,500 plus. So hold on with a stop loss of 4,200.
Okay, so that's the view with regards to where charts are concerned for CRISIL. Our next question is on JSW Energy. Avinash from Bengaluru is holding around 2,900 odd shares, bought at 509 a piece. So he's rupees. So he's bought it at elevated levels and sitting on a loss of 1 lakh rupees right now, and wants to know as to what should be the next course of action for him. Nirav, what do you suggest?
Well, I think it's advisable to hold the stock because the JSW Energy has got a lot of capacity which is lined up in the near future. And the prospects for the power sector appear to be quite promising. So the advice is to hold.
Okay, hold is the view coming in on JSW Energy. All right, our next caller, Ishwar from Andhra Pradesh, is calling in. Ishwar, a very good morning to you. I believe you have a query on Shriram Finance.
Yeah. Very good morning. Yeah, I recently purchased 1,000 shares of Shriram Finance at 620.
Okay.
I want to know what are the further actions needs to be taken in this case.
Okay, and you bought this from a fundamental point of view, or did you see the charts for the counter?
No, fundamental point of view.
Fundamental point of view. Okay, so I'll take this up with Nirav again. Nirav, in terms of Shriram Finance, where Q4 earnings are concerned, PAT was missed, and this was on account of a higher credit cost. Margins also saw contraction. What is your reading with respect to this counter, and should he continue to hold right now?
Well, yes, he should continue to hold because this is a kind of a cyclical business, and I think Shriram Finance is a very, very credible player as far as the commercial vehicle financing is concerned, truck financing is concerned, and they're likely to benefit from the lowering of the interest rates trajectory also going forward. So hopefully things should improve in the forthcoming quarters. So the advice is to hold.
Okay, so that's the view coming in on Shriram Finance. Our next question is from Ranjan, who's writing in from Bengaluru. And the person is planning to invest in Syngene International and Biocon. Is this the right time to enter and at the right valuation or not is something that he's trying to understand. I'll take this up with you, Vaishali, purely because I want to know as to a comparison between both Syngene as well as Biocon. Which chart is more attractive enough to enter right now?
So let's talk about Biocon right now. It's not really in a trend. It's in a range of 300 as crucial support. To my understanding, 300 should not break. So if Biocon needs to be accumulated, I think keep 300 as your support levels and start accumulating this stock. And also, once you buy this, once the stock moves above 360, this is going to get into a good trend, and that will confirm a further uptrend. So right now, I would say that just follow a range bound. Buy it with 300 as support. And as far as Syngene is concerned, so when I'm comparing Syngene and Biocon, I think Syngene also is equally corrected, and it's not showing any strength. It's below all the moving averages. So I would say Biocon is a better bet.
Okay. Biocon is a better bet between the two, is the view coming in from Vaishali. Our next caller, Venkat, is calling in from Bengaluru. Venkat, a very good morning to you. How can we help you?
Good morning, ma'am. This is Venkat. So I am holding Swiggy stock. I am holding at 385 rupees, and I have around 670 shares. I am 20% loss now. Right. So I want to know if I can average this, or I have to hold or sell.
Okay, got your query, Venkat. I'll take this up with Nirav. Nirav, do you think he should continue to hold? He's sitting on a loss of 50,000 rupees right now. You know, every analyst I talk to, I mean, the comparison is always with Zomato, and everybody has a consensus view that is Zomato over Swiggy always. What's your view? Should he continue to hold Swiggy?
I think he should continue to hold Swiggy for at least the next couple of quarters and see how things pan out before taking a decision on the further course of action.
Okay, so that's the view with regards to Swiggy. Next question is also from the consumption pack. Sandeep wants to buy Trent stock and wants to know whether this is the right time to enter or not. Vaishali, do you think the charts are attractive enough right now for a Trent?
So, well, I would say buy it with a strict stop loss of 5,000 because right now it has taken a support, but this stock is prone to a corrective move if 5,000 levels break. So, if one has to buy, take it as a trading strategy, 5,000 stop loss and look for a target of 5,600 to 5,800.
Okay, and Nirav, your quick view on Trent and its earnings?
Well, I think this quarter was very interesting because we saw majority of the store additions. 1/3 of the Zudio portfolio has been added during this quarter. So this was being reflected in the numbers. Going forward, it's going to be difficult for them to sustain this kind of growth momentum. So I think the company would have to search for new growth levers going ahead. So it's going to be definitely a challenging path ahead. So expect the stock to move sideways or with a downward bias.
Interesting. Expect the stock to move with a downward bias is what Nirav is saying, and he's expecting a sideways move, but with a downward bias is what he's saying. Interesting to keep an eye on that, of course. Our next caller, Naveen, is calling in from Hyderabad. Naveen, a very good morning to you. I believe you have a query on SBI Life.
Hello.
Hi, Naveen. I can hear you. Go ahead with your query.
I bought a SBI Life 500 shares
Okay.
at a price of 1754.
Okay.
Should I hold or exit?
Okay. Naveen, did you see the charts while buying the counter?
No.
Okay, so you saw the fundamentals of the company. Okay. Naveen, I got your point. I'll take this up with Vaishali. Vaishali, SBI Life is the counter. What are the charts indicating?
So see, right now also the stock is showing a lot of strength, and today's candle also shows that it's getting a new round of momentum. So if it's bought at this level, I think just hold on for a longer term perspective. In all likelihood, this can go towards 1950 levels as I'm looking at the weekly chart. But if you are a trader, then I think keep a stop loss of around 1680.
Okay, so that's the view with regards to where SBI Life is concerned. Next question is from Arjun Rao. He wants to know whether he could hold or Sterling and Wilson right now. Nirav, lots happening with the counter. The stock has been under pressure since past 2 odd months. What's wrong with the counter, and do you reckon that he should continue to hold?
Well, I think there's been a substantial correction in the Sterling and Wilson stock, and I think that all started with the possible impact of the Trump's actions on renewable power projects, etc. And the stock has been beaten down very, very badly. Going forward, I think it's going to be a slow recovery going forward, if at all. So it will be a patient wait will be required for the stock to recover.
Okay, our next caller, Tejpal, is calling in from Hyderabad. Tejpal, a very good morning to you. How can we help you? Hi Tejpal, can you hear me? Okay, we seem to have lost his line, but we do have his query. He is holding 4,500 odd shares of Zaggle, bought at 338 a piece. Vaishali, on the charts, what are the kind of stop loss and resistance levels that you're observing for Zaggle?
So I would say Zaggle also, it has shown good corrective move from 550 levels, and currently it's just consolidating at these levels. So it's moving in a band of 300 to 380. That's the range that what we are witnessing. So keep a stop loss of 300 and go all out. If 380 is crossed and we sustain above it, then it brings in a lot of strength to look for a target of 440. So that's the way to look at this stock.
Okay, so that's the view with regards to Zaggle. Our next question is from Yogarani, who's writing in from Saudi Arabia. Thank you so much from writing to us all the way from Saudi Arabia. And he's holding 450 odd shares of SBI at 818 and wants to know as to what should be the next course of action for him, whether to hold or sell. Nirav, what's the view like?
Well, the advice is to wait, and I think the price is slightly on the higher side, but I think once the results are out, we will get a better idea of how things stand. But the outlook is definitely positive.
So that's the view with regards to where SBI is concerned. Our next question is from Beacon, who wants to know about Patel Engineering. He's bought it at the levels of 61 rupees. Vaishali, on the charts, how does Patel Engineering fare?
So I think the worst seems to be over as long as 42. It's technically, if you were to ask me, it's making higher bottom formation. So 42 should be taken as a stop loss. And I think we can expect a bounce up to 48 at least. And then gradually it can move towards 52 levels. So I think this level is ideal to add as long as 42 levels are kept intact.
Okay, so that's with regards to where charts are concerned for Patel Engineering. Our next caller, Shrikant, is calling in from Orissa. Shrikant, a very good morning to you. How can we help you? Hi, Shrikant, can you hear me? Okay, I think we seem to have lost the caller. Vaishali, his question is on Bajaj Finserv. He's holding 50 shares at 2050 a piece. What are the charts indicating for something like a Bajaj Finserv? I mean, the stock is seeing significant amount of pressure today, of course, on the back of earnings. But do you think that this is the right time to make an entry?
So I would say yes, Bajaj Finserv. I mean, for this long-term trend to remain intact, 1900 levels need to be held on. So that's what we are seeing, that the stock has seen good erosion. So buy it with a stop loss of 1900, because if 1900 levels break, then it can trigger a further downslide going towards 1850 to 1800. So well, the risk-reward ratio from here on is quite favorable. 1900 should be taken as a stop loss.
Okay, so that's the view with regards to where Bajaj Finserv is concerned. Our next question is from Pavani, who is writing in from Vijayawada. She's bought Motherson Sumi at 171 a piece and bought 50 shares. Whether she should hold, sell, or add more from a longer term perspective. Neerav, I'll come to you on this one. What's the view like?
Well, the outlook for auto ancillaries seems to be improving, and I think with Trump's recent statements with respect to auto ancillaries, I think it augurs well. So the idea could be to add more also from a medium-term perspective.
All right. So, Neerav, thank you so much for giving that view. Our next question is on Praj Industries. Now, this is one counter that posted its earnings yesterday, and the street is quite disappointed with respect to where earnings stand, because in terms of all the key metric numbers, the numbers did not seem attractive. Revenue was down 15 odd %, EBITDA down 42 odd %, net profit also saw a degrowth of 56 odd %. Couple of factors not working in the favor of the company, Neerav. The person, that is Dharma from Andhra Pradesh, has bought 80 shares at 610 levels. Should he continue to hold or exit at the current levels?
Well, I think patience will be required at this point of time, because the performance has been very disappointing, but the company has tried to put up a brave front and tried to give a positive guidance going forward, because they are looking at various projects on the export front. They are working on energy transition and climate action related projects, but I think it will be a slow churn from here.
Okay, so that's the view with regards to where Praj Industries is concerned. Our next caller, Amar, is calling in from Hyderabad. Amar, a very good morning to you. I believe you have a query on Waaree Energy.
Yes, very good morning to you too. Thanks for taking the call. I would like...
Yeah, go ahead with your query, Amar. Hi, Amar, I can hear you. Go ahead with your query.
Yeah. I would like to know about Waaree Energy, that currently I am holding 10 shares, but I wish to accumulate furthermore.
Okay.
How much of furthermore shares I can accumulate? For example, if I am ready to invest another 20 shares in future, and I am ready to hold this share for another 2 years.
Okay.
So how good is the metrics for another 2 years, and can I accumulate more shares?
Okay, Amar, any specific reason as to why you want to invest more in Waaree Energy only? Like, have you studied the company?
The one major reason I feel is that is one among the solar PV panel manufacturing firm which is corely based in India. That's one more major reason which I feel to put more money on it. But apart from that, on the books or any other pros and cons I need to understand. That's why I'm asking this question specifically.
Okay, got your point, Amar. I'll take this up with Neerav again. Neerav, what's the view like for something like a Waaree Energies?
Well, yes, the growth has been quite encouraging. We've had a good set of numbers from the company, and I think margins are quite attractive, and particularly taking into account the fact that he has a 2-year horizon, and definitely the outlook is looking quite promising. So he can add the 20 shares which he plans to deploy the money over there.
Okay, buy is the view coming in on Waaree Energies from Neerav. Our next caller, Arijit, is calling in from Kolkata. Arijit, a very good morning to you. How can we help you?
Very good morning. Actually, I bought 90 shares of BSE at 6,700.
Okay.
And now I am at a loss of 23k.
Okay.
So what to do?
Okay. Okay, Arjit, got your query. I'll take this up with Vaishali. Vaishali, in terms of charts, are the charts attractive enough right now to continue to hold BSE? We also have a query, a similar query from Sravat, who's writing in on our WhatsApp channel as well. He wants to also know about BSE levels. What are the levels that you're observing on the charts?
So I would say actually the entry level has been at too high a level. So now that he's already bought, keep a stop loss of 6,200 because we've seen a one-way rally right from 4,000 levels to yesterday's high of 6,800. So I would say keep a stop loss of 62 because if that gets broken, you can see some profit booking emerging in then. So till then, just hold.
Okay, hold is the view coming in on BSE. With that, it's time to slip into a very short break, but stay tuned. We'll be right back answering more queries on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Apollo ties. Now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Welcome back. You're watching Ask Profit, a show that gets all your stock-related queries answered. For viewers who are just tuning in, you can either call us or WhatsApp us on the numbers that are flashing on your screen right now. All right, our next query, Satyan is writing in from Bengaluru. He wants to know as to what would be a better pick between Crompton and Havells from a longer term perspective. Neerav, I'll come to you on this one. Havells came out with its earnings where the comment commentary coming in from the management was that because of the summer delay, their secondary sales are being impacted, and this is especially in the RAC segment. On the other hand, Crompton today, Jefferies has come out with a note and it gives a 41% upside on the counter. Which one would you pick between the two?
Well, I think I would go with Crompton at this point of time because I think their fans and the pump segment, etc., have been doing quite well. So, Havells, we've seen they have been lagging behind a bit, but I think the Lloyd's air conditioning has been doing quite well. And that has boosted the performance in this quarter. But I think on a comparison basis, I think I would go with CG Crompton Greaves Consumer Electricals.
Okay, so Crompton over Havells is the view coming in from Nirav. Our next question is from Kiran Tejwani, who wants to invest in Sagility India from a longer term perspective. Nirav, would you go ahead and buy Sagility India right now?
Well, I think the stock is in a consolidation mode, and I think we have to see what is going to be the impact of outsourcing and near sourcing, etc. All these deals which are going to take place in the IT space. The IT space generally has been under pressure, so I think I would stay away from Sagility at this point of time.
Okay, our next caller, Govind Kumar, is calling in from Hyderabad. Govind, a very good morning to you. How can we help you?
Yeah, very good morning, ma'am. Very good morning to all of you. Ma'am, actually, the price of 156 rupees, IRFC 5,000 numbers of shares purchased, ma'am.
Okay.
Present rate can I average, ma'am?
Okay.
For at least 2 to 3 years. Because of this is laggard sector, the present is not catch up railway sector is.
Okay. Govind, got your query. Vaishali, I'll take this up with you. IRFC, should he average out at the current levels? So he's bought at the levels of 156 and bought 5,000 shares.
I'll just have a look.
Sure.
So, well, IRFC, I guess one can, because this has seen a good erosion and even the indicators are showing that it's ready for a new round of momentum to set in. And I think these are attractive levels. Keep a stop loss of 120 and look for a target of 150.
Okay, look for a target of 150 on IRFC is the view coming in with respect to where charts are concerned for IRFC. Our next question is from Vipul, who's writing in from Mumbai. He has 500 odd shares of Geo Finance at an average price of 202 and wants a long-term view on this particular counter. Nirav, what's the view like?
Well, I think you should add more.
He should add more. Okay. All right. So that's the view coming in on Geo Finance, Vipul bhai, if that answers your query. Our next question is on Nalco. Raja from Chennai is sitting on a loss of 9,000 rupees right now is what he is indicating, bought at the levels of 248. Should he hold, sell or average out is his question. Vaishali, I'll come to you. What are the charts indicating for Nalco?
I think this is an attractive level to buy and add more because I think technically it has seen decent correction. And once the stock gets into momentum, you can look for a target of 180 to 200 levels. So according to me, it's a good level to buy.
So that's the view with regards to Nalco. Our next question is on IOCL. Jeevan is writing in. He's bought IOCL at the price of 130 and wants to know whether he can continue to hold from a longer term perspective or not. Neera, what's the view like?
Well, definitely he should hold from a long-term perspective, and if possible he should add more too, for considering the fact that it's a very good dividend yield stock too.
Continue to hold is the view on IOCL. Our next question is on Eris Life Sciences. Vaishali, I'm not sure if you have a coverage, but if you can look at the charts for Eris Life Sciences and tell us as to what's the kind of resistance and stop loss that you're observing.
So I would say yes, today's low was pretty much at a support level. So take today's low as a stop loss if that's meant for a trading strategy. And the near-term resistance lies at 1515. So 1400 as stop loss and 1550 is the resistance. Let's see either ways. Once it moves, the chances are all the more it going towards 1550. It can go further up to 1600 also.
Okay, our next question is from Kiran Kumar, who's writing in from Telangana. He's holding 100 odd shares of IHCL at an average price of 798. He's asking, do I need to add more or hold for now? Neera, Nirav, with respect to the entire hotel pack, because I saw one more query on Lemon Tree as well. What are your views on the entire hospitality sector as a whole, and plus your view in terms of IHCL and Lemon Tree? And if not those two, what would you pick in the entire hotel space?
Well, the hotel space is looking quite interesting because there's been a sharp improvement in the operating metrics also. The demand has also picked up. There's been an increase in travel. There's been an increase in inbound, outbound tourism also. So I think that has changed the fortunes of the hotel industry. Plus, most of the hotel-related players are looking at 30% plus operating margins. The margin trajectory is also improved. We are looking at asset-light models too. So I think preferred pick is Indian Hotels Company Limited. Lemon Tree has also done an expansion, so it's looking quite good. We like Taj GVK also. We like APJ Surendra Park Hotels. Sheraton Hotels is also looking quite interesting. So the entire pack is looking quite interesting.
Okay, the entire sector looking attractive from Nirav's point of view. Our next question is on Titagarh. Amar Krishna is writing in from Bengaluru, has 4 shares of Titagarh bought at 1016 a piece. Should I hold, buy or sell for the next 1 year? Vaishali, on the charts, Titagarh, what are they indicating?
Well, I think the downside is pretty much restricted according to me. So hold, there is no clarity in the trend. It's still in the oversold zone as well. But I think just wait, because like most of the rail stocks, this too should participate in an upward rally and give a good bounce back. So I would say hold on for now.
Hold is the view coming in on Titagarh. Our next caller, Shailendra, is calling in from Orissa. Shailendra, very good morning to you. How can we help you?
Good morning, madam. Madam, I want to purchase shares of Jindal SAW.
Okay.
For 1 lakh rupees. For
Okay.
1 lakh rupees.
Okay.
So I want to know fundamental point of view from long-term view.
Okay.
1 year plus.
Okay. And would you be okay if you would want to divide that 1 lakh rupee in 2 or 3 different
Yes, madam.
stocks?
Yes.
Okay.
I can do that also.
All right, Shailendra, got your point. Nirav, so he has 1 lakh to deploy basically right now and wants a view whether he should put the entire 1 lakh rupee in Jindal SAW or should he divide that between 2 to 3 stocks? And if yes, what 2 or 3 stocks that would be?
Well, I think he can diversify his holdings, maybe invest a part of it in Jindal SAW, a part of it in Welspun Corp, and the third could be Jindal Stainless.
Okay, so Chandra, I hope that answers your queries. Those are the 3 picks that you can diversify your portfolio in. All right, the next question is on Tata Consumer. Neha from Bengaluru wants a short-term view from a 3 months perspective. She's making a profit of 12% right now. She's not given us as to what level she's bought it at, but she is sitting on a 12% profit and wants to know the stop loss and target for the next 3 months. Vaishali, on the charts?
So I would say, well, it is definitely in a trending this. So keep a stop loss of 1145 and look for a target of 1200. That is what I would look at right now.
Okay, look for a target of 1200 for Tata Consumer in the next 3 months. Next caller, Ramesh is calling in from Mumbai. Ramesh, a very good morning to you. How can we help you?
Morning. Yeah, I bought purchased at 412 BLS International.
Okay.
1,500 share. I want to, what is the outlook for 1 year?
For 1 year, okay. Did you see the fundamentals of the company or did you see the charts while buying the counter?
No, fundamental, I have seen the fundamental.
Okay, you've seen the fundamental. Nirav, I'll come back to you again. BLS International, what's the view like?
Well, it's in an interesting space, immigration-related services, etc. So I think the view would be to hold from a medium-term perspective.
Okay, can hold from a medium-term perspective is the view coming in on BLS International. All right, our next question is on HBL Power, if I'm not wrong. Kishan is writing in and is holding 150 odd shares at 600 odd rupees and sitting on a loss right now. He wants to know as to what should be the next course of action for him. Should he add or continue to keep holding? Sorry, this is HBL Engineering, if I'm not wrong. Vaishali, HBL Engineering, what's the view like with respect to where charts are concerned?
So I think this too is now consolidating, right? If I'm seeing the long-term chart, I mean the weekly as well as the monthly, it is at a good support level. So if it's for a long-term perspective, actually 450 to 400 is the support band. So I would say accumulate more because the stock is never going to go out of fashion. I mean, I think this will do well in long term as well. So buy more at the support level.
Okay, buy more is the view coming in on HBL Engineering. Our next question is from Aniket, who's writing in from Karnataka and wants to know the best entry price for PN Gadgil. Okay, so he's asking whether PN Gadgil or Goldium International, which of these is a better stock to invest in for the next 2 to 3 years? Neera, what's your view like between the two, and which one would you prefer and why, of course?
I think we would prefer Goldium International because they've become very aggressive and first mover advantage kind of in lab grown diamonds. So they have set up their 6th store recently for lab grown diamonds. So I think I would prefer Goldium International.
Okay. So Neera prefers Goldium International over PN Gadgil. Our next question is on Clean Science and Technology. The person has bought 320 odd shares at 1450 rupees. Mahesh is his name and wants a comprehensive view on this particular counter. Neera, I'll come to you again on this one. It's basically into chemical manufacturing. What's the view like? Should he continue to hold, or maybe switch to an attractive counter in the similar space?
Well, chemical space is just coming out of a lull. So I think we should see in the forthcoming quarters improvement in the operational metrics. So the advice is to hold with a medium-term horizon.
Okay. Next question is a very interesting one. Neera, the person is holding 1 share of MRF and wants to know whether he should continue to hold that or not. I believe he's bought at the levels of 1 lakh, if I'm not wrong, if I'm understanding the query correctly. But that 1 share, should he continue to hold?
Yes, definitely.
Okay, so continue to hold MRF is the view coming in from Neerav. All right, the next question is on Tata Motors. Vaishali, on the charts, Sravant wants to know as to how Tata Motors charts are faring.
So, well, we saw that the stock showed signs of bottoming out at 540, 560 levels, and then it's got into a trend. So, well, we've seen some bounce back coming in, but right now 630 would act as the near-term support, and the resistance lies at 700. So, depending on your time horizon and your propensity to hold, keep these levels in mind and take your call accordingly.
Okay, so that's the view with regards to Tata Motors. Our next caller, Jijo, is calling in from Kerala. A very good morning to you, Jijo. How can we help you?
Yeah, madam, good morning. I just want to know regarding one stock, Fed Bank Finance.
Okay. Yeah, go ahead with the query.
Okay, I was holding 1,000 stocks, around 100 average. So I just want to know I can hold for a long time or short time. What is the status, hold or sell?
Okay, got your query, Jijo. I'll take this up with Neerav. Neerav, Fed Bank Financial Services is the counter. He's holding 1,000 odd shares at 100 apiece. What's the outlook like for this particular counter?
Well, it's going to be a slow burn from here. So I think definitely patience will be required. But I think advice is to continue to hold.
Okay, so that's the view with regards to where Fed Bank is concerned. Our next question is on Vedanta. So Jayesh from Mumbai is writing in and he's purchased 200 shares of Vedanta, bought at 489 a piece, and wants to know whether he should hold or sell. Vaishali, on the charts, how is Vedanta faring?
I would say stock is doing pretty well. Right now, for near-term basis, it's consolidating at 400 level support. I would say hold, or this can be bought at every decline. Trading target would be 450, 460, but above that, one can look for a target of 480 to 500 levels. So hold with a support of 400, probably add more.
Okay, hold Vedanta is the view with respect to where charts are concerned. Our next question is from Achudan, who's holding Reliance, 1,604 shares, bought at 1,338 a piece. What is the short-term target to continue to hold is his question. Vaishali, on the charts, what should be the stop loss and resistance levels for Reliance?
So I would say keep a trailing stop loss of 1380 and 1410, 1415 is a near-term resistance. If the stock moves above 1410, 1415, I think this can go to 1450 levels also. So keep a stop loss of 1380.
Okay, keep a stop loss of 1380 is the view coming in on Reliance. Our next caller, in fact, is from Rani, who's calling in from Chennai. Rani, a very good morning to you. How can we help you?
Good morning. I wanted advice on Ganesha Ecosphere. I'm considering buying it for mid to long term, maybe two to 3 years time horizon. So are they good levels to buy it at now? And maybe a fundamental technical view on the company.
Okay, got your question, Rani. I'll take this up with Nirav. Nirav, these waste recycling companies, are something that have become literally a sector as a whole. People have been talking about them. What's your view with respect to the entire space as well as for Ganesha Ecosphere? Is this a good time to make an entry?
Well, most of these companies in this space are trading at very premium valuations, considering the fact that it's become a fad of late. So I think it's advisable to stay away from these counters, considering the fact that the valuations are very, very rich.
Okay, so that's the view coming in on Ganesha Ecosphere and as well as the entire waste management space. All right, the next question is also an interesting one. Lakshmi Narayanan from Chennai has been holding 200 shares of HUL for more than 20 years now. It's interesting because he's not given us the levels at which he's bought the counter, but wants to know as to what is the long-term outlook on the stock. Nirav, I'm assuming that because he's bought it 20 years back, he might be sitting on a significant amount of profit. Do you suggest him to book profits right now, because the company has not been performing well since quite some time now, and this is because a lot of headwinds are underway for FMCG. Even the first quarter of FY26 is not looking very attractive. Do you think he should book partial profits or full profits or continue to hold?
Well, I think holding the stock for more than 20 years, I think there would be sentimental reasons attached to not selling the stock in the first place. So I think, well, it's true that HUL has been struggling. There's volume growth has been under pressure. There's been a lot of competitive pressure also as far as the company is concerned. But the advice is to keep the faith and hold on for some more time.
Okay, so that's the view with regards to where HUL is concerned. Our next caller, Murli, is calling in from Bengaluru. Murli, a very good morning to you. How can we help you?
Good morning, Mahima. First of all, I would like to thank you for giving the opportunity to talk to you. I'm a big fan of NDTV. Yeah, I watch NDTV almost every day. My query is about Hyundai Motors. I purchased at a price of 1960. This was during the time of IPO. Now, and the quantity is 40 shares. Now I'm sitting at a loss of almost 10,000. So please advise me whether to hold or sell.
Murli, first of all, thank you so much for those kind words. You've made our day, certainly. Just wanted to ask a couple of follow-up questions. You bought this post its IPO, or did you get an allotment for this particular counter?
Yeah, I got the allotment.
You got the allotment, okay.
And later, when the price went down, that time once again some few quantities I added. Yeah.
Okay, you bought a certain quantity. Okay, I'll take this up with Nirav because I am not sure if we have enough data on the charts for Hyundai Motors. Nirav, what's the view like for something like a Hyundai Motors, because he's sitting on a loss of 1 lakh rupees right now?
Well, I think Hyundai a quality player, but on the bourses of the markets, I think we've seen the stock has been an underperformer. I think it's better to shift to a stock like Mahindra & Mahindra, which has far better prospects.
Okay, just a quick correction. He's sitting on a loss of 10,000 rupees and not 1 lakh rupees right now. All right, the next question is from John, who's writing in from Dubai. He wants to buy Canara Bank for 1 lakh rupees. So what's the view like? Vaishali, do you think that he should deploy the entire 1 lakh rupees in Canara Bank itself, or some other banks looking attractive on charts right now?
Why not? I mean, actually, PSU banking stocks have not really participated to the extent the private sector. So if you were to ask me, Canara Bank is technically very well placed. I think this is having a good chartical pattern of higher bottom, higher top formation. So I would say continue. I mean, you can make a purchase of the stock with 92 as support level, and once we see the stock moving, we can. I won't be surprised this going towards 120, 130. So according to me, it's a buy.
Okay, buy is the view coming in on Canara Bank. Okay, our next question is from Yash, who's writing in from Karnataka. He's bought 500 odd shares of HDFC Bank. Should he hold or sell at the current levels? Neera, what's the comprehensive view like?
You should definitely hold.
Definitely hold. Okay, so that's the view for HDFC Bank. Our next question is on your tech stocks. I think what Akshay wants to try to understand is if this is a good time to enter in Tata Elxsi or not. Vaishali, on the charts, what is Tata Elxsi indicating? Is this the right time to enter?
I would agree so, because according to me, IT stocks have got a good corrective move, and now they are showing signs of revival. So talking about Tata Elxsi per se, that too, I think this stock, which if I look at it from the longer term perspective also, right from 9,000 levels, it has corrected to make a low at around 5,000. It's showing signs of reversals. I would say start accumulating with 5,300 as support levels. And once we see some clarity and the stock surging high, this can go towards 6,800 to 7,000 to start with.
Okay, so that's the view with regards to charts for Tata Elxsi. Our next caller, Uma, is calling in from Bengaluru. Uma, a very good morning to you. How can we help you? Hi, Uma, can you hear me? Okay, I think we seem to have lost Uma, but we do have her query. It's on ACC. She's holding 50 odd shares, bought at 2,250 a piece and sitting on a loss of around 18,000 odd rupees right now. Neera, what's the view like on ACC?
Well, ACC has been under pressure, so I think it's better to shift from ACC to Ultratech, which is a market leader.
Okay, our next question, and also standard disclaimer, ACC is also a part of Adani Group of companies, and NDTV Profit, owned by Adani Media Group, is also a part of Adani Group of companies. Our next question is from Pranav, who's writing in from Ambala and wants a view on MRPL. He's holding 100 odd shares, bought at 143 a piece, that is 143 a piece, and wants to know as to what should be the next course of action for him. Vaishali, on the charts, Mangalore Refinery and Petrochemicals, how the charts faring?
I would recommend a buy even at these levels, because it is showing signs of improvement, and I think this will go towards 160 as a short-term target. So this is a positive stock right now.
The next question is from Dhur Jyoti, who's writing in from Assam. He's purchased Blue Star at the levels of 1750 a piece and bought 40 quantities and wanted to know about the future outlook for this particular counter. Neera, what's the view like for something like a Blue Star, and if you can compare that to a likes of a Voltas as well?
Well, I think Voltas is more into the home unitary ACs, home ACs, and the electromechanical side of the business, whereas Blue Star is a pioneer in commercial refrigeration. So I think they continue to do very well in commercial refrigeration space, and their home AC segment is also picking up quite well. So definitely Blue Star is something which is for the long haul. So you should definitely invest with a medium to long term horizon.
Okay, definitely invest from a medium to long term perspective is the view coming in on these AC counters. All right, Neera, Vaishali, it's time for rapid fire round. You guys know the drill. Keep your answers as short as possible, and I'll try to throw as many questions as possible. All right, our first question is on Gujarat Gas. The person has bought it since its IPO in 1991. Should he continue to hold or now for the next 1 year? Neera, what's the view like?
Hold.
All right, PCBR is the next counter. Somik from Kolkata has bought 5 shares and wants to know as to what should be the long-term perspective for this counter. Neera, once again to you.
Add.
All right, KFin Technologies bought at 310 a piece. Pramod from Thrissur wants a view on this particular counter. What are the charts indicating, Vaishali?
So KFIN is positive, hold.
Okay, IDFC First Bank, Sivanesh from Tamil Nadu is holding 1,000 shares and wants to know as to should he enter at the current levels from a longer term perspective or wait for correction? What are the charts indicating, Vaishali?
Wait for correction.
Wait for correction. Okay, the next question is from Satyan, who wants to know about Shalby Hospital. He wants to know whether he should add more at the current levels or not. Neera, what's the view like?
No.
Okay. Ovi from Mumbai wants to understand as to what stock she could add from a perspective of 1 year to 18 months right now. Vaishali, any one chart that is looking attractive to you right now?
Tube investment.
Okay, Motherson Sumi at an average price of 130 is bought by Ganesh from Bengaluru. With respect to where charts are concerned, what's the view like, Vaishali?
Hold.
Okay. Kiran Reddy from Andhra Pradesh. Her query is on Ircon, bought at levels of 272 and bought 1,200 odd shares. Should she continue to hold or sell? Neera?
Sell.
Okay. Sanjay from Bengaluru is holding GPIL at 192 a piece. Wants to know whether he should buy or accumulate more from a longer term perspective. Neera, any view on this particular counter? That's your Godavari Power and Ispat, by the way.
Yeah, hold.
Okay, our next question is from Rahul and wants to know the future perspective for Rama Steel Tube. Not sure if Neerav has a coverage, but on the charts, Vaishali?
Rama Steel Tubes, which is 10 rupees.
Yes.
Well, hold with a stop loss of 9.
Okay, all right. With that, we're completely out of time on this edition of Ask Profit. Neerav, Vaishali, thank you so much for taking out time and giving us all those insights. All right, like I said, we're completely out of time in this edition of Ask Profit, but stay tuned. Know your company on the other side. We'll be right back after a break.
That's huge. That is a biggie. It's out of there.
गोल्ड क्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Hello and welcome. You're watching KYC. Today we're going to talk about CEAT. It's the tire company that we're going to talk about, but there are some nuggets and facts that you didn't know about, and we'll talk about some of those as well. But first off, why and what do I want to know about CEAT, which likely will determine whether an investor should consider or not consider this one. First off, in terms of plans and levers with regard to international business, they forayed into and bought Camso from Michelin Tires. How does that add up with regard to business plans? That's the first thing I really want to know from a medium-term perspective. Also, raw material prices. This has weighed down with regard to gross margins more so at the start of last year, but has continued to weigh down even in Q3. And that is something that I'd want to know about, whether that gets carried forward to next year as well, or whether the pass-through of prices has started to happen, if so, by how much. There's plenty that's happening on the geopolitical arena. How does that stack up in terms of risk as well as currency risk? What and how would that play out? And the fourth one is replacement demand, because a large chunk of what CEAT does is with regard to replacement. And therefore, this is something I'd really want to know. What's the outlook looking like in terms of replacement demand? Because nothing looking good with regard to auto in terms of numbers. And therefore, replacement will be something which will be a key monitorable and a lever for growth going forward. Let's talk about the company now. What does CEAT do? It was founded in the year 1924, and thereafter, back then it was manufacturing electricals and telephone cables. It diversified and began manufacturing tires only in 1945. And thereafter, the Indian arm was established along with the Tatas in 1958. After that, really, the journey began in 1981 when RPG Group acquired CEAT. So that's when things started to turn for CEAT. And currently, it's India's fourth largest tire maker by market capitalization. It also is a very, very strong player within the Indian market with regard to tires across, whether you call it two-wheelers, three-wheelers, cars, SUVs, and even when you're talking about CVs and heavy vehicles now, that they are going to be manufacturing those kinds of tires. The increased presence with regard to international segment, this has obviously come through and with its acquisition of Camso business from Michelin, and we'll talk a little bit about this slightly later, but let's first focus in on what the business and the products are. CEAT has around 2,000 SKUs, and they've added around 150 in FY24. Thereafter also it has continued to add new SKUs. Currently, in terms of revenue share, truck and bus is relatively around 30% odd, which is the larger chunk, but you look at 2-3 wheelers, a healthy share there, 27% odd. PV, UV is around, and utility vehicles, passenger vehicles, utility vehicles is around 21% of the revenue. And then you have off-highway and LCV, which is roughly 22% of the revenue. So very, very balanced, right, in terms of its mix as to where the revenue comes from. In terms of market mix as well, and this is where it starts to get interesting. Look at replacement. 53% is what it gets from the replacement market. So a large chunk of the top line comes from the replacement market. Then there's OEM and exports. Exports also fairly decent, 19%, and OEM is around 28%. In terms of manufacturing, where does it manufacture? It has 6 manufacturing facilities and 3 smart facilities, and they have facilities in Nashik, Mumbai, Halol, Ambernath, Nagpur, and Chennai. The current capacity is around 3.5 crore tires, and the Nagpur capacity is being upped. So the Nagpur capacity will go up by 30% by FY28, 400 crore of capex that is being planned with regard to the Nagpur facility. So that's how it will likely play out. Now let's talk about the acquisition, because that's the elephant in the room. It's going to be a $225 million acquisition in terms of value, likely to play out by May of this year. This is going to be funded 30% by internal accruals, 70% by debt. So more debt will likely come on the balance sheet as this plays out. And the cash outflows will start from Q1 FY26. As I did mention, May is likely the timeline with regard to how this plays out. In terms of sales, so all of this is obviously all production linked. Now let's talk about sales. Replacement network covers around 5,500 dealers that they have, 530 retail format stores that they have, and 950 special channels that they market and sell their products through. And they have a very strong presence in Sri Lanka within their international business. They have a 51% of the tire market share in Sri Lanka. So very, very strong where that geography is concerned. They've also incorporated a new entity in Indonesia to aid their global presence. So a lot of that will also hopefully aid the numbers going forward. In terms of research, they have a facility in Halol and they have a facility in Frankfurt. And of course, we'll speak with Arnab Banerjee, who will join us shortly, who's the Managing Director and CEO at CEAT Tires. But let's first start off and look at the metrics that we'll consider with regard to a CEAT. And joining me, of course, today is Puneet. He'll just join me shortly. But first off, on the metrics, let's quickly look at those. Income statement, balance sheet, cash flow, return ratios, shareholding. We'll also look at street cred, street coverage, and valuations. We'll look at all of those and try and break them down and obviously give our KYC rating with regard to that. But, you know, I've spoken enough. Puneet, why don't you take over with regard to the income statement? Firstly, good morning, welcome.
Well, good morning as well. You know, definitely a very interesting time for any kind of tire maker. It's been a very last 4 quarters, very tough market essentially. But when you look at CEAT, we've taken the last 3 to 4 years in terms of revenue. Income statement for the company has grown by roughly 12% CAGR, and this has been slightly disappointing compared to its peers, but it has made up in terms of EBITDA as well as profitability in this particular time frame. We've seen the EBITDA grow by 27% CAGR. Margins have come in at 11.2%, and while they've fallen from the previous year, it has been a considerable jump over the last 3 years. And at that point of time, the profitability has also improved to 471 crores. It's you know, one of the key things that it's come down from the last year because of natural rubber prices amongst others, but overall it has been a strong 88% CAGR in terms of profitability, Harsh, over the last 3 to 4 years.
Yeah, so the other piece also, Puneet, to understand is, can these margins sustain? What's the risk looking like on that count?
I think currently, as of this year, we've seen the margins fall dramatically, and because of natural rubber prices. So because it's a commodity business, that will always be the case. But because of operating leverage, the company should be able to go back to between the 12 to 13% range, and we'll quiz the management on that aspect as well, because they were already at 13.3 last year. And now because of natural rubber prices, the margin has come off. But you know, it'll be interesting to know the management perspective and what is the range they're looking for in terms of margin going forward.
Okay, so that's the margin picture. Let's look at the balance sheet now. And in terms of equity capital, how it's placed, around 4,500 odd crore in terms of its equity capital that it has. Mind you, the market cap is around 13,300 odd crore. And in terms of debt to EBITDA, it's just about 2 times currently. So in that sense, there is enough lever, enough cushion available for debt in that sense, at least at this point. But they're also going to make an acquisition, which is Camso, and they're going to use 70%, they're going to use some amount of their retained earnings into that. And therefore net debt to EBITDA, maybe some of that goes up because of the fact that you might have some amount of more leverage and some amount of lower cash on the balance sheet. Currently it's sitting on 430 crore of cash, as you can see. So fairly healthy in that sense with regard to the balance sheet, at least at this point. But cash flow, Puneet.
Well, definitely, you know, that's one of the key areas to look at now. The key reason being that while the cash flow from operations has steadily increased over the last 3 years at 20% CAGR, it is the net cash flow number that's slightly disappointing, and hence we're giving it a thumbs down as of now. You know, it's just 7 crores in terms of you know, this year of FY25, and the key aspect is of course about the investments that the company has been doing over the last couple of years, as well as impacts of capex that has been happening as well. So that's one of the key reasons why the net cash flow numbers are slightly disappointing, and that is also slightly having an impact on the return ratios, which we'll get to eventually. But we've given it a thumbs down, Harsh, on this aspect that the net cash flow number hasn't grown and actually has fallen meaningfully over the last 3 years.
Right. That brings me to the point where I would want to understand, Puneet, better in terms of how return ratios are evolving before I take up shareholding.
Yeah.
So why don't you speak about that?
Yeah, that's the other part because of the investments and the constant investments that they've been doing because of increasing the capacity to what they are right now. The return of equity is just 11.7%, and the key reason is that it is the lowest amongst the 4 other listed players that are there in the market. In terms of return on capital employed as well, because there has been an investment phase going on. That is the other key reasons, and hence, Harsh, the thumbs down, at least in terms of return ratios.
So return ratios are thumbs down as well. So those couple of factors still need to be looked at while we are assessing CEAT, and maybe a change there could well turn the numbers. But let's look at shareholding pattern now. The promoter holding is very, very steady. It's been so for now the last at least 3.5 years. From March of 22, the promoter holding has been a solid 47 odd percent. In fact, from March of 21 as well, and even March of 20, largely it's been 47%, give or take maybe 60 basis points. So a very, very strong promoter holding, of course a strong promoter as well to back it up. What's probably changed is you had a strong FI investment. So if I'm looking at maybe the March 22 number in terms of shareholding, the FI investment was around 23%. It's fallen to 15% because one key FII and Amansa has sold some part of its stake. You also have a decent DII holding, so plenty of DII interest, and that has been bumped up. So from March of 22, DIs have really participated in this one. They've hiked their holding from 11.5% to 21.5%. So that's where it's come in. And public holding has always been fairly decent in this one. It's been around the 15 to 16% odd number. So a decent shareholding pattern in that sense, a strong promoter ownership, decent amount of FII and DII participation as well. So in that sense, it looks decent from a shareholding perspective. I'm also going to quickly look at street coverage. Well, we have 16 buy calls, 2 hold calls and 3 sell calls on this one. Potential return of roughly 12%. It's given a 20% return in the last 12 months, so fairly decent on both of those counts. And I'll try and cover street cred as well as part of this. Street cred, I mean, it's been a multi-bagger of sorts, nearly a 4-bagger over the last 5 years. So been extremely strong in terms of its medium term, which is the last 1 year, but also the last 5-year returns that it's given. It's given a 284% return in the last 5 years. So a multi-bagger of sorts in that sense. Thumbs up on both of those counts. Puneet, valuations.
Valuations for, and we've done a comparison with the other tire makers as well, because currently CI trading at 18 times price to earnings now. The results that come yesterday, but we've not seen any kind of brokerage calls come in, and that's largely because the analyst con call is scheduled today at 4 o'clock. So we might see some revisions tomorrow in this aspect. But as of now, FY26 price to earnings at 18 times. It is just slightly above Apollo Tires, and JK Tires is the one which is the cheapest at 10 times price to earnings. Both MRF as well as something like a Balakrishna Tires is, in terms of more expensive in terms of this ratio of price to earnings at roughly 25 times. And for Balakrishna Tires, it's largely because the margin profile is at roughly about 27 odd percent, and that's one of the key reasons. The other aspect is MRF, being one of the biggest tire makers of India, has that valuation premium, but growth across the tire makers has been slow in this particular time frame, Harsh. So while valuations, we've given it a neutral rating because of uncertain environment as of now, and some key commentary from the management in terms of growth prospects for at least the near term FY26, and how does the margins play out, will have one of the key effects on valuations going forward.
Okay, so that's largely the breakdown with regard to a CEAT. Let's quickly bring on board Arnab Banerjee, who's been sitting here, and quickly, it's good to have you, Mr. Banerjee. First off, I want to first ask you with regard to the margin outlook. Margins have improved for sure in Q4, so there's been an uptick. Talk to us about raw material pricing and the pricing of finished product, and what's really leading to that margin uptick. I believe, sir, you're on mute.
If you break down raw material into 2 major buckets, which is crude based Crude Q4 and Q3 was pretty flat, and Q1 onwards it is going to go soft. It is going soft already. So crude-based materials such as synthetic rubber, synthetic fiber, carbon black, etc., are going to come off their peaks. The natural rubber is fairly steady. Even now, domestic prices are about 195 to 200. And international prices have been coming off, so they have come down to about $1,700 per ton. So on the natural rubber side, we yet to see softening. Overall, what it means is that we have had a flat Q4 over Q3 in terms of raw material prices, just about less than 1% drop. Similar trend will be there in Q1 over Q2. So very small drop, broadly flat. And we expect a significant drop in Q2. So that's the outlook as of now.
So specifically, sir, in terms of international demand, and it's Puneet this side, and thanks so much for joining in. I just want to start off with Europe. How are you seeing the current market scenario there? Because while it has been disappointing over the last year, have you seen any kind of change in this particular quarter? What are the kind of conversations that you're having with clients?
Europe has been, we have had headwinds on the OEM of OHT in Europe. However, if you look at aftermarket, where we play in OHT as well as passenger as well as truck bus radial, because of our small base, and I mentioned this, though the market is not really growing, it's sluggish, but because of our small base and our growth coming from essentially more and more market access, we expect Europe growth to be stable even in FY26. FY25 was also good for Europe. We expect that trend to continue in FY26.
And, Mr. Banerjee, one other thing was in terms of, you spoke about off-highway tires. And, we have a couple of questions on Camso as well. You mentioned a timeline of roughly 6 to 9 months on Camso, and that will essentially, be in the off-highway tires segment. What is the current timeline? Where is the progress of this acquisition? And just to start off with, and then I just have a couple of more questions on Camso.
Right. So all the antitrust approvals are in the bag now. So we are engaging increasingly to integrate the business. Q1 will see a standalone performance as is for CEAT. We expect to integrate Camso line item wise by Q2 beginning.
And essentially, how would that be for margins? Because while this year was an aberration because of commodity costs, you generally operate in the 13 to 14% range. With Camso, do you think the street is appreciating the acquisition for you enough? Because while the stock prices are today, in terms of any kind of movement in terms of margins, are you anticipating this to go to roughly for next year specifically around the 14 to 15% range, and eventually in a couple of years we should be looking at 16 to 17% range, which is somewhat similar to your peers?
So the size of the business as is, as we inherited, is about 10% of our overall size in top line. The margin profile is definitely superior, but in the initial few quarters, because of integration related issues, we have not bought an entity, if you know. We have bought a carved out business, right? So which has got a lot of allocated costs currently. So that portion of learning will be there over 2 to 3 years as to how we establish this as an independent entity. But inherently, from the customer side, the business is remunerative and margin accretive for sure. So on that 10% saliency also will grow. So in the medium term, margin will be definitely more than the rest of CEAT business as you see today. But the initial few quarters, we have to settle in and we have to figure out what's what.
Right, sir. And sir, where do you see therefore debt move and internal accruals? What's the impact like with regard to cash flow?
Yeah, so the key ratio that we track is debt to EBITDA.
Yes.
And as per the agreements, etc., 4:1 is the safe mark, but internally 3:1 is the safe mark. And post Camso acquisition, and given the normal capex that we have planned, which is about 900 to 1,000 crores, which is in the normal course of business, brownfield expansions, and the margin profile and the growth that we see in the current year, we expect the debt to EBITDA ratio to be safely well within the 3:1 mark, well below that.
Okay, and this would include the 400 crore of capex that you are expected to put out for the Nagpur facility as well. In terms of, and sorry, I'll just add one more question to that. In terms of total capacity, how much does it add? How much does the Nagpur 30% add to your total capacity?
Yeah, I'll come to Nagpur. See, we have several enabling resolutions which have been okayed by the board, including Nagpur. However, we managed to keep the whole capex in a bite-sized bucket of around 1,000 crores. This year also, it's about 946 crores. I mean, FY25. FY26 will be around 900 to 1,000 crore. Whether it includes Nagpur, how much of Nagpur, we'll have to see basis demand and supply scenario and capacity utilization scenario. We also have a significant capacity in an outsourced setup at Hyderabad on two-wheeler. And this 1,000 crore, out of that 1,000 crore, about 70-75% is growth capex, which will go into Chennai truck bus radial, Chennai passenger radial, Ambernath OHT, and Nagpur. So the overall amount will be within 1,000 crore for FY26.
And so, new car demand, especially on the passenger vehicle side, which makes up about a quarter of your numbers, doesn't seem to be picking up, at least as we see it right now. Is replacement really where the larger opportunity lies, and what's the traction and what's the expectation like on that segment?
When you talk of passenger car demand, you're, I guess, talking about the OEM market, where the demand was muted, low single digit.
Right.
Replacement market also has been mid-single digit kind of growth, so it was not very buoyant. Primarily because we are seeing soft demand overall for all kinds of tires in urban market. We define urban as 50,000 plus population town. Whereas rural demand is going strong, there's a difference of at least 4-5% between rural demand and urban demand. Since most of the passenger car tire four-wheeler demand will come from urban areas, we don't expect a very buoyant market in replacement either in the coming year. Whereas two-wheeler will grow faster in aftermarket because of the rural demand.
And Mr. Banerjee, I also wanted to get your view on continuing with the replacement demand on the truck and bus side on the replacement, because there was expectation of a high single-digit growth over the coming quarters. Are you seeing that for yourself as well?
We are okay with truck and bus radial demand. We expect the OEM demand also to come back, and we expect our share of business in OEM to go up in the current financial year, FY26. We have done well market share-wise in truck bus radial, but as you know, we are a small player here. We still have single-digit market share in truck bus radial. On a small base, we are growing pretty well. No complaints there.
And so truck bus radial, you mentioned about the growth as well as your market share in two-wheelers. Would that be the highest growth segment in replacement going forward for you?
Two-wheeler has done well, especially scooter tires. As you know, the scooter market is booming. Yeah, scooter market is booming. And it's not just in urban areas, but also in contiguous to urban areas, a lot of small towns. It's surprising to see that the motorcycle ownership of household is now being replaced more and more by scooter ownership. So we are pretty bullish on scooter, also on motorcycle that's growing well. And in both, we have had significant gain in market share in aftermarket because of our very strong rural network in FY25, and we would like to incrementally chip away at market share and maintain our leadership in two-wheeler.
And just continuing this point in terms of, you mentioned about passenger, in terms of farm segment specifically, is that also a growth segment for you, whether it's in rural, if you can talk about that as well, because you said the rural is outgrowing urban, two-wheelers is outgrowing, passenger cars, and that's kind of seen in the auto sales number as well. Just in terms of farm, how are you seeing that specific segment, and what's your market share if you can quantify it?
Yeah, farm OEM volumes are a little volatile, little cyclical, but farm aftermarket is a little bit steadier, but highly seasonal. We expect farm tires also to do well in the coming year because it is dependent on the farm, on the rural economy, especially the farm and non-farm economy. Both are doing well. So we expect farm tires also to be robust in terms of growth in FY26.
Okay, Mr. Banerjee, I know I'm running short on time. 30 seconds, if you can give us a view with regard to pricing and what is the kind of return ratios? Is there an internal target with regard to return ratios? Because you do so much of capex and therefore trying to understand that.
Yeah, so as the raw material price cools off, hopefully by end of Q1 and in Q2, we expect the margins to grow as the industry in the past several times has been able to hold the price line in terms of when the raw material goes down and hasn't been able to pass on the full impact when raw material goes up. So if that happens, we are pretty good at about 40% plus gross margins. We are now operating at about 37.5 if you see the Q4 results. So once we cross 40% plus, our EBITDA will be in a good shape and everything else will fall in place.
And sir, anything on return ratios very, very quickly? Is there a target internally?
No, which return ratios are you talking about?
So on the capital that you invest back in the business, ROIC, ROC?
So ROC would be, we would definitely like to look at mid double digit kind of thing to start with.
Understood. So something in the mid-teens. Thank you so much, sir. Thank you for joining us this morning and accommodating us.
Thank you very much.
Right. Puneet, it's an interesting conversation, very frankly. That aspiration to get to a 15% ROC is quite healthy in that sense. That surprised me a bit. Anything how would you view and judge the conversation? What were your key takeaways?
I think in terms of the Camso acquisition, and I think you spoke about it at the start of the show, that will increase the company's off-highway tire segment. It'll double it essentially in the next 2 quarters. I think that will drive margins and then the return ratios. And I think that will be one of the key aspects. I think if an investor is looking at it in terms of how to value the company in terms of price to earnings, because we saw that it was one of the, at least the cheapest stock, at least in the tire space of the top 4. I think that will be one of the key drivers in terms of valuation going forward.
And what about valuing Camso? Believe $225 million is value for something like a SEAT in terms of
definitely,
how can
because building presence in off-highways is very difficult. And in terms of having a set dealer network that you just incorporate, I think that's one of the biggest advantages.
KYC rating flashing on the screen while we have this conversation. He was non-committal with regard to pricing. Is that a concern? But he seems to be fairly okay with the fact that gross margins will go towards 40.
Yeah, definitely. And we've been a little hard on the ratings because we're being very speculative on what the current scenario is. But I think in 6 months, we should do this again and definitely look at how the changes are of Camso acquisition in terms of margins and return ratios. Yes.
Let's do that. For now and for today, the stock is flying in trade on the back of those numbers. PAT was a bit of a miss, but outside of that, and that's because of interest and certain one-offs. But outside of that, the numbers were fairly solid. I mean, 13+% in terms of margins. So, so decent. But with that, completely out of time on this edition of KYC. From Puneet, myself, Ariana puts the show together. Thanks so much for watching.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
Hello and welcome to Markets at 12. I am Puneet Zaveri, and let's first quickly look at how the markets are doing, because today is the expiry session, but it has been an interesting day to say the least. We were expecting an implied open of roughly about down 100 points, currently standing at roughly just about flat to a slight tinge of green on the index. We are off the lows by about 70 points on the Nifty. Similar to the Sensex as well, much of the lows by about 300 odd points. Let's look at the key contributors to the Nifty before we move to the sectoral index, because again a day marked by earnings as well as movements because of that, and a lot of news flow actually. On the positive side, contributing to the Nifty is of course HDFC Bank, some positive contribution from Reliance as well as Maruti. Bajaj Finance is one of the key negatives today, and that's after the company mentioned in its guidance for AUM has been slightly lowered in this particular quarter for FY26, and that has hampered the stock performance to say the least. SBI as well is back in the news because of they've announced the QIP and results expected this Saturday as well, so another one to watch out for. And Tata Motors also down in trade today, and that could largely be because of the news coming in from President Donald Trump on tariffs, some concession to auto parts. So we are seeing some, if you can also look at something like a Sona BLW as well, what's doing in trade, and Motherson, because those are expected to benefit, while someone like a Tata Motors is expected to not have any kind of material impact. Sona BLW down 2%, results are expected today. Motherson also. So the tariff news definitely, and some concession definitely not helping the stock today. Let's also look at the sectoral index real quickly, because that is one of the other thing I wanted to see, because we're seeing Realty Index come back today, been negative over the last couple of days. We've seen the PSU Bank being one of the biggest losers in trade today. That's another thing. And Nifty Pharma as well was the biggest gainer at the start of the trading session. Slightly, it's slightly slipped from those highs, but still 0.8% up as well. Let's quickly look at the mid cap and the small cap index as well, how they are faring, if they are beating the benchmarks today in trade or no. Let's pull that up very quickly. Similar to the benchmark actually, just 0.04%. And finally the BSE 500, because that's been another one reacting a lot on the back of news flow. CAT, we just did a KYC at 11:30. If you missed it, to watch it on YouTube. Schaeffler again buzzing on the back of numbers, and Sonata Software has been continuously inching up. They've got a new deal yesterday of $70 million. That's helping it. On the negative side, we've seen some pressure on earnings like Praj, Shoppers Stop, and we spoke about the Bajaj twins as well. But let me go across to my colleague Mahima real quickly, because we were seeing the flashes of Varun Beverages coming out with its earnings. Mahima, if you could fill us in with some key highlights, was it a hit or a miss according to you?
Well, it's not a hit nor a miss. It's in line numbers for Varun Beverages. So the numbers have come in line with what Street was expecting. In terms of revenue, there's a growth of 29%. The expected growth was 25%, so slight beat in terms of revenue. EBITDA grew at 28% at 1,264 odd crores. Margins were expected to be flat at 22%. 20%, but they've come at 22.7%, so a slight beat there as well. In terms of net profit, it's grown at around 35%, which was expected to grow around 38%, so a slight miss there as well. But overall, the numbers are in line. Now, in terms of what has happened, volumes have significantly grown for Varun Beverages this quarter. In terms of the overall volumes as compared to last quarter, it's grown around 30% in terms of the overall volume growth, and the organic growth has been around 15%, which has come from South Africa as well as the DRC region. Overall, in terms of realization per case, that has increased by 1.8% in India and remained flat in the international markets. Of course, this is on the back of acquisition costs also being higher there. In terms of the overall South Africa business, they've achieved 144 million cases, which is a 13% growth in terms of volume. In terms of looking ahead, they see immense headroom for growth in India's beverage market, supported by overall rising per capita income, accelerating urbanization, as well as expanding electrification. Due to relatively lower margin, the management is saying that the profile of owned brands in the South African market and overall higher mix of CSD in India has also kind of impacted the margin. Gross margins have slightly also declined on the back of higher raw material costs. Raw material costs have seen a uptick of around 35% in trade. Even the purchase of stock in trade has gone down, which has acted positively in favor of the margins. It's come down to around 70%. So this is the overall view as to how so far calendar year Q1 for Varun Beverages has panned out. And of course, just to give viewers a perspective, Varun Beverages follows calendar year, hence this is the first quarter of earnings for them.
Well, thanks for that, Mahima, getting us the review. We've seen some reaction on the stock on the negative side, but as Mahima highlighted, numbers largely in line. And the conference call is also scheduled today at 2:30, so might see some reaction in closing as well. But just moving away slightly from the markets, because there's a big headline this afternoon that Prime Minister Narendra Modi is holding a crucial meeting of the Cabinet Committee on Political Affairs. Now, this huddle is being held to decide India's course of action after the terrorist attack in Pahalgam and right after a meeting of the Cabinet Committee on Security. My colleague Aishwarya Jain gets us this ground report.
Well, what we can update is all the members of the CCS, be it Defence Minister Rajnath Singh, Home Minister Amit Shah, Finance Minister Nirmala Sitharaman, External Affairs Minister Dr. S. Jaishankar, all have arrived at the 7th Lok Kalyan Marg at Prime Minister Narendra Modi's residence, because the first meeting that Prime Minister will chair will be of the Cabinet Committee on Security, followed by the CCPA and CCEA, and later the full-fledged Cabinet meeting will take place. Of course, this comes a day after that big meeting that took place, that had taken place at the Prime Minister's residence, where what had been stated by their sources within the Prime Minister's office, that Prime Minister has given full responsibility and had affirmed full faith in our Indian Armed Forces. Prime Minister has already stated that it is now up to the Indian Armed Forces to decide the mode, time and target as far as the action against Pakistan is concerned. Let me again show you these visuals from 7 Lok Kalyan Marg, which is Prime Minister's residence, as leaders are continuously arriving over here. As far as the Cabinet Committee on Security meeting is concerned, as I mentioned, after yesterday he held high-level talks with Defence Minister Rajnath Singh, National Security Advisor Ajit Doval, the Chief of Defence Staff Anil Chauhan, and all armed forces heads, during which he gave forces a free hand taking operational decisions such as manner in response of targets and timings. It is now the Prime Minister which is chairing the CCS, the second round of CCS. Of course, remember, it was Prime Minister Narendra Modi. Some crucial decisions were taken after Prime Minister Narendra Modi returned back from Saudi Arabia. It was, of course, the suspension of Indus-Water Treaty, the closing of the Wagah-Tari border, the suspension of the visas for the Pakistani nationals who are living in the country. The deadline was given, and perhaps in the last 1 week we have seen smaller steps being taken by different ministries who are involved in this decision-making process as well. And how far this implementation has reached is be also be briefed to the Prime Minister today in these meetings. But yes, as Prime Minister had given a straight message, whether there will be more decisions that can come out from the CCS or the CCPA, which is again a very important body. They last met in 2019 after the Pulwama terror attack, and just few days after we saw the airstrikes being conducted by the Indian Armed Forces. The Indian Armed Forces to take place, and therefore the reason perhaps now at the 7 local landmark we can inform that the Cabinet Committee on Security meeting under the chairmanship of Prime Minister Narendra Modi has finally begun.
Well, thanks for that, Aishwarya. But let's move on now to the primary markets, because we have a main board IPO, Aether Energy, that's on way. It's the last day to invest in this particular IPO, and we now have Astha Jain, the senior research analyst at Hem Securities, also joining in. Astha, good to have you here, and good afternoon, and thanks so much for joining us today. It's been a dry run essentially in terms of IPOs on the main board over the last 2 months, the first one, and it's a very interesting one to start us off. So actually, before I get into the business, I think the one question that's been there is the valuation concerns in this expensive market, which has seen a lot of correction, right? So I just wanted to start off first with valuation. Generally, is the last thing that we do. But in valuations, we've seen, the EV to sales as well as price to sales multiple. When you look at something like Aether Energy and compare it with its nearest peer, which is Ola Electric, and we can have the graphic also on screen. That's one of the key things I want to start with, because it's more expensive on both those metrics versus Ola. For price to sales is at 5.7 versus 4 times for Ola Electric. EV to sales also at 6 times currently at the price band that they've given of 321, the upper price band. How are you viewing this in terms of context for valuations for Aether, to just start us off, and then we'll get into the business of it?
Hi, good afternoon. Talking about discounters, first of all, I want to say on evaluation methodology, definitely it is overpriced. Yes, price to sales as well as EV by sales, both are higher as compared to Ola. But if I see the Ola, the bandwidth there is high because they have various products in their product basket. Here, Aether is mainly betting on its 2 products, that is Aether 450 and Aether Rista. Especially Aether Rista, which they have launched in 2024. It is a family scooter, and basically this product of theirs is getting good traction in the market, and on that basis only we have seen that their gross margin has increased significantly. It was 9% and then it has increased to 19%. Similarly, if I see their market share, because in the RHP they have given the market share of 12%, but according to latest Vahan portal data, their market share has also increased. So this Rista is really playing very strongly for them. So what I mean to say here is that on the valuation methodology, this IPO is looking overpriced, and that too in this type of an environment when we all know there are certain uncertainties related to geopolitical situation right now. So looking after all these factors, that this IPO is coming at this point of a time when there are certain geopolitical concerns, and when the pricing is also not very cheap, they have taken full valuation. So yes, and that is why we are also recommending that this can be a risky bet to apply the IPO at this point of a time where the macros are quite uncertain, and hence we are recommending to see or to wait till listing before deploying the funds in this IPO.
Fair point, Astha. But what's interesting also in terms of this IPO is actually, you spoke about market share, and I'll come back to that in a bit, is the product categories as well. Because the Rista scooter actually has done very well in the market, and now it's almost 50% of the company's sales. It just launched about last year. So, and of course the 450X was a performance scooter, so addressing a very niche market in terms of the whole electric vehicle landscape. If there's any kind of correction in terms of stock price over the next couple of months and years, where I wanted to get your view, do you see this as a very, in terms of business prospect, a very strong company in terms of the products that it has launched, because they've expanded into multiple battery sizes as well? So how are you viewing the current product categories of Aether Energy when you also compare it with something like Ola? Because Ola has a higher profile, but with the Rista, it's expected to address a higher market and help margins as well, right?
Yes, in fact, we have done some ground check also, and from that we got that report that definitely this Rista is really playing well for them. But now, if I talk about the product categories, yes, Aether is mainly betting on 2 of its products. There is one more point. In case of Ather, if I want to differentiate it from Ola on the subjective matter, then Ather is basically betting on its quality, innovation, R&D, whereas Ola is having a strong distribution network, as well as their balance sheet is somewhat strong in size as compared to Ather. So the quality is major focus of this company, and that is why we have seen that they are slowing developing. Because in case of Ola, we have seen that Ola has launched various products in the time frame of some few years, whereas in case of Ather, they have because they were strongly focused on the innovation and quality. So products which are coming from them are also less in number as compared to Ola. So if I look about all these factors, then definitely their product is far better than Ola at this point of a time, and this is what I have taken from some dealers also. But we have to consider one more point. This is a fourth number player in the electric two-wheeler space. Why? Because first number is Bajaj Chetak is holding the first rank because their electric two-wheeler is doing very, very well, and it is much ahead of the sales as compared to Ather. Second rank comes to TVS and TVS Motors. In fact, their electronic two-wheelers is also in a great demand. So, and afterwards Ola. So this is a fourth number player in the electric two-wheeler space. And now Honda is also coming out with its product. In fact, they have already come out with the entry-level product. This is what I got from the ground information, and now in the June-July, maybe they will launching some very strong product. So competitive intensity is also very high. So betting on only these two products is really good. But in the future, if we can see some more product launches from the Honda, Bajaj, etc., then definitely this can give them a tough competition. So this point also we need to keep in mind.
And you fair point, Asta, because we're seeing a lot of competition as well. And I also want to ask you a question on the use of proceeds effectively from this IPO, because you also mentioned briefly that for R&D spend specifically, they are spending approximately 750 crores. That's what they've put in the RHP, and roughly increasing the capacity in Maharashtra as well for 927 crores. That's a different strategy from something like Ola Electric, right? Because Ather prides itself on its technology. Do you see that as an advantage, at least in terms of business prospects, to the clear focus on R&D for something like an Ather Energy?
Yes, and I think since beginning they have this clear focus on the R&D, and that constitute almost 46% also. So yes, they have a strong focus on R&D, and that is giving an edge to them. Because if you look their Ather Rista or Ather Put 50, in fact the product is really very, very strong. So yes, definitely it will help the company in posting good numbers going ahead. But whether the company will be able to recoup its losses, whether the company will be able to meet the competition, because already at this point of a time they are standing fourth in terms of sales. But Bajaj being the first one, followed by TVS Motor and then Ola. So, and as I have told you that now Honda is also actively coming into the electric two-wheeler space. So we really need to see whether these deployment of issue will really help the company in posting good numbers going ahead. And that is why we have given it in our note to our client as well, that just wait for the listing and then take a decision regarding the deploying of proceeds. Right now, we feel that it can be a risky bet.
Fair point. As the last two questions from my side. First, of course, in terms of market share, and we were highlighting it on the screen for while in Q4, the market share of Ather has gone up. Over the last 3 years, it's just inched up from 10.6% to 11.5% and now 11.4%. On the other side, we've seen Ola's market share actually crack down to roughly about a third of the market now, with both Bajaj as well as TVS at roughly 20% each now. So how are you seeing, just in terms of market share for Ather, any kind of prospects that you see in terms of growth going forward? Because they are also expected to come out with the electric bike eventually, but that's some time away. So how are you tackling this market share point, because it's not really grown over the last 36 months?
Yes, they will be coming out with the electronic motorcycle. also. And yes, market share has got increased because, as I have already told you, that their Rista is playing wonders for them. It is getting good traction. So now Ather was basically concentrated in the South market, especially I suppose Telangana, Karnataka, etc. But now Gujarat market is also giving good response to them, and that is what we have seen, that their market share has started increasing because they have now started targeting the other markets than South markets. So yes, market share has increased, but still all these things we should see in the wake of 2 points. First of all, whether valuations are reasonable enough to deploy the funds at this point of a time. Because even I have done some other calculations also, that in case if this IPO can list at the will list at the premium in any of the situation, maybe geopolitical tension ease out and other factors. If other factors will be favorable, then maybe if some premium listing if can expect, then how much upside it can pose. So I think there is not a more 10% more than 10% upside in this counter. This is, I have done my calculations, and I'm just telling you, I'm not saying that it can command 10% premium. In case if it will list, then not more than 10%. So is it worth to take the risk of that 10% at this point of time? I don't feel so. And hence I'm recommending just wait for the listing and then take any decision. Right now, we feel it is a very risky bet.
Fair enough, Asta. Just one point on financials as well, and you did highlight it in one of the questions, because the gross margin, while it has improved from 9 to 19%, it's still EBITDA negative in the mid 20s. And that's similar to what we've seen for Ola Electric as well. They've also roughly had negative 25% EBITDA margins. The question that I had was, Ola Electric actually came out with a filing that they are expecting to be EBITDA break-even in Q1 of FY26. Does that change any kind of view for you for Ather, or do you feel that it might take some more time for both these players to stabilize and get break-even on at least EBITDA going forward?
I think it might take some more time for both these players to, stabilize, as you have said. Because what my point here is that if the competitive intensity will intensify, because what happened, these big companies, that is Bajaj, TVS, they are already having very, very strong distribution network. Here they have an edge over Ather. So they have a strong distribution network, strong after-sale services. So we really need to see that whether the company will able to provide. We have listened to the management also, and management is saying that in the past, they were not so much bothered about the distribution network. Now they have started investing there also. But I think all these things will take time to come up. Meanwhile, these established players, they already have a very, very strong distribution network. So I think coming at the EBITDA positive level will really take some time. I'm not saying that it will not come, but it may take some time. And till that time, we really want to see how the performance of company will be going ahead. And hence, we are recommending to wait to deploy the funds in the site.
Got the view, Asta. So wait for the IPO before investing, let it list, see how the market is performing in terms of stock price for Ather. But definitely, the business prospects look very interesting. I think that's the summary from this discussion. Asta, then, thanks so much for joining in, giving us a whole host of views across the metrics for Ather as well as Ola Electric as well. But another stock that we are tracking today is Bajaj Finance. Now, the company is actually cracked following its Q4 results. Street is spooked by higher provisions, muted margin as well as guidance. Let's listen in to Rajiv Jain's excerpt from the Bajaj Finance media con call talking about higher provisions and guidance going forward. Listen in.
Let's just now cover the one-timers. There are two one-timers in Q4. In Q4, company annually conducted again the refresh of its ECL model, which principally incorporates the last 12 months portfolio performance and forward-looking macro outlook. Given the higher flow forward rates that we have actually seen through the year and elevated credit costs in the last 3 quarters, the redevelopment of the ECL model resulted in an additional ECL provision of 359 crores, and primarily, rather mostly, in stage 1 assets. So that's one impact to in the P&L, in the credit cost line. The second impact is in the PAT line, which is that the company has reevaluated its income tax position on deductibility of certain expenditures based on favorable court and tribunal orders in recent years, and accordingly, in the process, the company has reversed 249 crores in tax expenses from previous years and 99 crores from the current year, resulting in an overall tax reduction of 348 crores in Q4. So if you look at the table below, I'm on panel 5, you will principally see that expected credit loss reported is 2329.
Well, that was the management of Bajaj Finance, but let's stick with, stock definitely tanking in trade today, but, has been a rank outperformer in terms of stock performance over the last couple of years, definitely. But let's stick with the banking and financial space, because next in focus is IndusInd Bank. Now, that's after Sumant Katpalia resigned as the MD and CEO 11 months before his tenure was supposed to end. This comes after an investigation over IndusInd Bank's accounting discrepancies, which has continued turmoil at the bank. To understand what this can mean for the company, we spoke to Abhizar Divanji. He's the founder of Neostrat Advisors LLP. Listen to what he had to say.
What has really happened is that the real kicker is not the derivative transaction. The real kicker has been RBI saying that your term is extended only by 1 year, effectively saying that I'm not going to extend it for. Effectively putting the organization or a bank in the limbo where it is operating only on a short-term basis in 1 year, and it was inevitable that the bank had to find a new CEO. Thereafter, of course, the derivative disclosures happened and it hastened the whole process. I rightly think it's hastened the process because at least gives some more certainty. The bank will look more aggressively for a CEO maybe earlier. So that is going to happen, and the bank will get back to stability quicker. But the real issue is that this is a regulatory driven move. Imagine something like this happening in the corporate world in a manufacturing company, where there is no regulator who decides what's the tenure of the CEO. The CEO would never have resigned.
Yeah, Abhizar,
Look at it, that is such a regulatorily driven thing, where unless the regulator says, sorry, I'm not extending your term, the CEO does not go.
Yeah.
The other thing is that, we have a board which is so regulatorily driven again. How much do I put responsibility on the board? The question I'd like to ask. Because the regulator says every policy has to be approved by the board, and the board gets so involved in the nitty-gritty of the organization that the larger business picture is missed.
Yeah.
So, this is maybe an overtly vigilant regulator pushing down on a bank or a regulated financial institution. So I would look at it more as that, because we've discussed enough about the derivative issue.
Yes.
Well, that's all the time we have at Markets at 12. Stay tuned to NDTV Profit for more.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
Hello and welcome to our special show, Gold Rush. Now we hate to tell you so, but your grandma and your mother were so right. The Indian women's love for gold has now passed the acid test of global uncertainty. With Trump's tariffs and the world economy in chaos, everyone is now flocking to buy gold, the safest possible haven. Gold is extremely valuable now. Today, that is on Akshaya Tritiya, the price of a 24-carat gold is inching closer to 98,000 rupees per 10 grams. 22-carat gold is closing in on 90,000 rupees per 10 grams. And now, today is Akshaya Tritiya, like I said, and it is a customary to make a purchase of gold in many families. My colleague Charu Singh is at Mumbai Devi Road at a jewelry store, and she's with some excited customers. Charu, how is it looking there?
Hi, so as you just said, Akshaya Tritiya is an auspicious occasion for the Hindu and Jain religion because they believe that the wealth accumulated in any form on this day is only going to double over and benefit over the coming years. Now, we are here at the Zaveri market in Umedmal Tilokchand Zaveri, who have been here for the last 100 years, and we are going to be talking to Mr. Suresh Jain to, basically explain to us how this entire thing is, played out, how many customers come, and how there is an excitement about the entire hustle bustle in the market. So sir, बताइए आज के दिन कितने लोग आते हैं?
आज का दिन ज्वेलरी में एक बहुत बड़ा दिन है, 3.5 मुहूर्त का दिन है और बड़ी अच्छी बात है। अक्षय तृतीया के दिन लोग धनतेरस की तरह साउथ में इसको सेलिब्रेट करते हैं और आज यहाँ पे भी जिनको लेना है वो एक अच्छे भाव से जो भाव 1.25 लाख 1,02,000 पे चला गया था, आज 96,000 हुआ है। तो भरपूर सुबह से हम लोग आए, 9 बजे से आए, रोज यूजुअली 11 बजे आते हैं, 9 बजे से बाइंग शुरू हुई है। कोई कॉइन लेके जा रहा है, कोई बड़े सेट लेके जा रहा है, इस तरह की अच्छी ग्राहकी चल रही है। एक बेस्ट टाइम है। 3.5 मुहूर्त की वजह से लोगों का उत्साह भी और बढ़ा हुआ। लोग ऐसा मानते हैं कि कॉइन ले जाते हैं या कुछ भी सोना ले जाकर घर में उसकी पूजा करते हैं और उसके बाद उसको कबाड़ में रखते हैं। सालों साल वृद्धि होती है, ऐसी फीलिंग के साथ लोग खरीदारी कर रहे हैं। एक अच्छी सी खरीदारी हो रही है।
And we must also understand that from the last year, this festival has given, an increased rate of about 32% in the rate of gold. And as per several analysts as well, the rate is only going to increase to up to even 7% for the next year. However, there have also been recommendations made to, go up to buying silver as well. That's all from the ground report of NDTV Profit for now.
Well, yes, let's also welcome in Sachin Jain, the regional CEO, India World Gold Council. Sachin, coming to you first, 32% jump in the last 1 year, but what we have seen in gold prices. What is your analysis showing? How much more of an upside can we expect when it comes to gold?
Hi, first of all, thanks for having me on and wishing all your viewers a very happy Akshaya Tritiya. As your colleague just now mentioned, it's a day by which, prosperity happens, things multiply. And I'm certain people who invested in gold and have perhaps bought last year have felt that this is the truth. To your point, what's been happening with gold? We at World Gold Council don't predict price, but the fundamentals on which gold demand is based on, the gold pricing is based on, things like geopolitics, things like a safe haven promise of gold, things like central bank buying, the investor class that's really been accumulating gold, particularly from the last from the 1st of January upwards. I think the pillars of strength of gold are very much in the favor of what gold is. So I think it's going to be a very strong foresight even for the coming time. And my only bit would be that you need to look at gold from a long-term perspective and long-term view. And from that perspective, it's certainly going to be performing very well.
As you were mentioning that there are multiple fundamental reasons why gold prices are rising higher. But can you just give us some idea of how long will this upcycle in gold prices last?
Well, actually, there are various reasons, as I mentioned. So if you look at last year, the dominant factor of the whole progress or the change in price that we saw was geopolitics, started by the real wars and moving into the trade war conversation. The first quarter was dominated by the trade war conversation and how the Liberation Day would sort of ease it out and get more clearer. If you look at the last few months, it's been largely dominated by the financial markets where the investments have gone up. I mean, look at gold ETFs. Last entire year, the addition of the AUM was about $3.8 billion. And just this year, the addition has been upwards of $17-18 billion. That's already happened. And, if I were to share some rallies with you, the $2,000 to $2,500 per ounce took about 1,780 days. The $2,500 to $3,000 took just about 220 days. And from the 1st January, and we dished $3,500, took half of that time. So it's been a very strong upward movement from that perspective. Now, what element will play out? I think when you look at long term, the elements around central bank buying will be strong. The elements around, how geopolitics is not going to be all settled down will play out.
So, you've seen prices kind of, seeing a very significant uptick. Like you said, investments and the financial markets have what's been driving. But we have seen somewhat of a correction, I wouldn't call it a correction, some weakness in the past 2-3 days in terms of prices, even today morning. Do you feel that, the bull run is over or there's more to go? And would there be a period of consolidation or correction, or could we see the bull run continuing as it is?
Well, I think what you mentioned, I would say as correction, and I would agree to you that these are corrections and small sort of adjustments. But I wouldn't see, when I look at and the whole analysis of what's happening around gold and what's the pillars of gold, I think the mid to long term, a lot of that is in the favor of gold and the gold's growth. Now, some corrections will happen, perhaps yes. Would it be certain to saying what's going to happen to gold in the long term? Long term elements are very strong, and that's what I would repeat. So short term, I wouldn't worry so much, and the fact being that the confidence in gold is strong, the confidence on central banks of different parts of the world is strong, and those are the core elements which impact the gold price.
And coming from, from the demand perspective, right? Like today we are having this chat because it's Akshaya Tritiya, but I saw in the release, the demand for jewelry has gone down, and it's consumer behavior when prices are going up, somewhat hesitant to buy fresh gold and jewelry. How do you expect demand to play out from the jewelry standpoint and coming from there?
Well, actually, it needs to be well interpreted. So when our report says that the volume has gone down, whereas the value of what the jewelry has been bought is upwards of 22%. Now that's huge. The fact that consumers have invested their hard-earned money to buy jewelry for that increased percentage is a big promise on their confidence in gold. If a family has, for example, in a budget for a wedding is 100,000 rupees, that budget wouldn't become 140,000 rupees as gold has gone up. But the share of 100,000 rupees for a wedding, the share on gold has only gone up. That's purely how confident consumers are in jewelry. So when you look at consumer demand for jewelry, I think we need to look at it from a value perspective as well, which certainly has gone up. And we've always historically seen, and be it level of when gold was at 20,000 rupees to 40,000 rupees to 60,000 rupees, and last year hovering between 60 to 75,000, every time the price of gold goes up, the consumer waits and watches. Once it's consolidated, the consumers come into the market. And that's what we believe will happen this time around as well. Unfortunately, what's happened is in the last 3 to 4 months, the rally has continued. The price is really, moving so fast, which the consumers not been able to sort of, lay their hands on what they could call is stability. And I foresee that consumers will come back. And you need to look at the consumer demand from the lens of value as well as volume. And when you look at the value, so if I'm an individual or I'm a family, I have only that much money and I've invested that 22% more of that in gold. And that gives a great sign of confidence.
Right, sir. So a couple of questions on the macro side. Now, as you were mentioning that one of the reasons behind this rally overall globally in the gold prices is the fact that central bank has been buying. You have access to so much data, so much analysis that goes in. How much more or for how much long more will this buying from central banks globally will continue for gold?
Well, see, central banks' minds is again dependent on how the geopolitics environment is, number one. It's also around this whole growing conversation around de-dollarization. It's been going around, and that's not today, that's been going on for about 18 months. The whole conversation around the weakened dollar. And generally, when you look at the various things that are happening between banks and the debts in the world, if you look at just the debts that are happening in the world of A country versus B, it's just huge. And I think the growing element around, particularly around the sort of growing markets and the developing countries, the importance of having your strength and your sensibility around gold is playing out. I mean, we've seen over the last 18 months, last year, the large impetus was by the Central Bank of China buying. Then India has been buying quite a lot. RBI has bought quite a lot. 2023, we bought about 17 tons. To 2024, RBI bought upwards of 78 tons. So that's been a huge growth. And we believe that that's impetus around, again, the environment, around geopolitics, around de-dollarization will continue. But countries will be investing in gold to have a reflection of their strength.
Got it. Sachin, lastly, what about the demand from the ETF perspective? How is that playing out?
Very strongly. I mean, ETF is a phenomenal product. I think it's a product that sort of you can fractionalize the buying of gold. I mean, the smallest unit, one single unit is 90 rupees. That's 0.01 of a gram of gold, which is great. I think as a product, it's regulated. As a product, it is backed by physical gold. And I think the Indian consumer, as we go forward on more awareness on ETF, I believe it's going to go much, much stronger. To give you some numbers, end of 2020, 1st January 2024, the AUM was about 41 tons. 1st of January 2025, the AUM was about 59 tons. And you could say that 18 tons is not so large, but 18 tons on 41 tons is very significant. And we've already seen that this year there's been great growth. And I really believe that this product is at a cusp. It is here to grow, and a large form of various investments in financialization of gold will come under ETF.
Right. Well, thank you, Sachin. Thank you for joining us and giving us your time and your perspective about the gold prices. Thank you, and a very happy Akshaya Tritiya as well. Well, moving on, we also spoke to Navneet Damani of Motilal Oswal and Saurabh Gadgil of PNG Jewellers about the surge in the gold prices and asked them if they expect the volumes to go up further during festive season. Listen into what they had to say.
So we've seen a sizable run-up in gold prices. As you mentioned previously, it's about 25% year-to-date returns just in the last 4 months. And as we speak, it's pretty volatile. Every alternate day, you're seeing about 1,500 points movement in gold. This is something unlike what gold is likely perceived as an asset class. It's typically a safe haven asset class, and today it's more of a financial asset than a safe haven asset. So there is enough and more demand for gold even at every price point, and people are just waiting for a reasonable correction to gather it once again, because this in the last 5 years have delivered a better return than any other asset class which most of the people are investing into. Now, what is going to be the demand for Akshaya Tritiya? I think Mr. Gadgil will be able to tell you better, as he owns a jewelry store and probably a chain of jewelry stores. But I think the ground level research that we've done, typically the footfalls are lower. And there is more of cannibalization between gold to silver at this point in time. People are preferring lower caratage of gold or probably waiting for silver as an investment, because that is not caught up significantly as far as gold is concerned. And I think price point wise, we are about 4% or 4.5% away from lifetime highs. Better levels will be anticipated, and there are a dearth of people waiting on the sidelines for any correction to enter into this metal at a lower price point.
Right. I mean, Navneet, good morning, and Saurabh, good morning as well. I think, Alex meant to ask that question to Saurabh, and he just said Navneet. But Saurabh, let me take that with you as well. How are you looking at it in terms of the demand? If you have to compare the last couple of years, are you seeing the mood come off, taking into consideration higher pricing, and that in turn impacting volumes?
Good morning, and wishing everyone happy Akshaya Tritiya. Like Navneet said, right now prices are at all-time high. There's been huge appreciation in gold. But having said that, people's interest in gold as an investment, as a store of wealth, is very strong. Yes, we have seen a lot of people swapping old gold for new jewelry. So primarily wedding shopping is almost today 50% the currency is old gold, and that is what people are preferring today because of the high prices and due to that the budget constraints. But in between there were a lot of fears on gold seeing a huge correction and gold could see a big downfall, but that has not happened, and that again has reinforce people's faith that looking at the geopolitical situation around the world, gold seems to be an asset which will be in a bullish mode, and that has really seen people coming and entering the gold market physically. There's been no selling pressure, and people are buying gold. Quantity has been a little struggle because of people's budget, but in value-wise, we'll be 30-35% more. So Akshaya Tritiya, I think value-wise, the industry should be aiming for a 20-25% hike over last year. In terms of volumes, I think we could see a dip, maybe a single-digit dip, around 8-9%. But the sentiments are bullish. Today is a whole day of Akshaya Tritiya, right from morning 8 o'clock till midnight is the Muhurat. So we see a lot of pent-up demand being converted today. Bookings have been moderate. I would not say there have been super bookings, but bookings have been quite decent. And people interest in the festival, in Akshaya Tritiya, as a part of this Sadeti Muhurat is reinforced again. So we're hoping for a good day of sales as we progress today.
Point made, Saurabh, and thanks for answering the question that I originally asked. Navneet, and to you fielded it quite well, even though the question was not intended for you. But let me ask you this then, because you've seen a little bit of a cool off in gold prices from those elevated levels of close to 2,500. Rather 3,500. See, there you go. The numbers have moved so quickly that I'm talking about 2,500 still. But $3,500 in the international market. Where do we go from here? Because a lot of people talking about gold-silver ratio, but that's not panning out. And while you have trade tensions, they've dissipated somewhat. So does that come into play? Dollar has remained below 100, stays at 99. If that does move above 100, is that the biggest risk factor for gold?
Well, there are a lot of risk factors as we speak. Primarily, it's largely driven by a trade war situation between China and US, and the tariff imposition on each other has kind of taken the center stage. Demand side story continues to remain as it is, but the supply side story is pretty robust, but the demand side scenario has changed drastically, largely because now what has happened. You see dollar index correcting from 106 levels to 98 levels within a span of no time. And the so-called cuts in interest rate which the US was talking about seems to be a far-fetched at this point in time, because these kind of tariff is going to lead to higher inflation, slower growth, and eventually the postponement of rate cuts is likely to happen. So all in all, this scenario is not likely to play well neither for US nor for China, and both of these biggies have to come on the table and probably settle out their issues, because China is in a phase of recovery over the last 4 years since the COVID, and US also is not in a great state. The 10-year GSEC is also a very interesting number, where it was down to about 3.6, 3.7% and now shot up to 4.3%. Primarily, US is sitting on a 36 trillion debt, and to service this debt at a 4.3, 4.4% kind of a yield is going to be a very, very massive task for the US Treasury. So I think this is a matter of time when these trade-related tensions are going to come at a standstill, and maybe the prices are likely to kind of stay where they are, or at least cool off.
So Navneet, when you talk about prices cooling off, what's the potential that one should be watching out for? How much downtick from the current levels?
Well, we don't have a number in place, primarily because every now and then you see the statement keeps on changing very significantly.
Yeah, but we can have a range, right?
Kind of $100. Yeah. So that's what I'm coming to. We as a broking house, and as we expect that anything closer to 3,200 and 3,150 is a level where you will see buying interest come once again. On the domestic front, if I say about 91,000 is a level where we expect that buying interest will be very massively into gold. But we also spoke about the gold to silver ratio. Historically, we've seen that it is only two instances gold to silver ratio has sustained above 100 level for a brief period of time, once during COVID and once during 1980s. As we speak, it is around 102, 103. We expect that this ratio has placed its hand, and maybe it's time for now silver to outperform gold, and this ratio can have some skewness back to about 1992 levels once again.
Okay, so then as a house, while you're not giving targets on gold at this juncture, that's understandable, Navneet. Would you say that the advice right now that you're dispensing is perhaps book some profits if you can in gold, if you've got the ability to, and I'm talking about primarily people who are investing in ETFs. And would you say that it makes sense at this juncture with silver having underperformed in a big way? And if I'm not mistaken, 1 year performance or 6 months performance, I think silver was down 2% last I checked. I'm not sure what the current value is, but would you say that there's a trade in silver?
So in the year 2024, silver gave you about 34% kind of returns, while gold gave you about 31% kind of return. For the year 2025, for the last 4 months, silver has underperformed, whereas gold has rallied very significantly. Now, there is definitely a trade where we expect that silver could eventually catch up, and the rally could extend to 110 and 125, 1,25,000 rupees per kg for silver over the next 12 to 18 months. Now, gold, we definitely have a target of 1,01,000 rupees as a target, and maybe $3,800 as a target. But buying comfort is not at the current price. We expect that if an investor has to invest, it has to be a better price. If it's a tactical investment, one should look to stay away from gold. But if it's a long-term investment, you have to definitely park some money, then wait for a price correction of about 5%, where your risk and reward will be favorable to enter and maybe garner about 15% returns over the next 2 years.
Thanks, Navneet. Saurabh, running short of time, we just have a minute. Very quickly, is the retail growth lower as compared to the growth you're seeing in gold prices? And in terms of the old gold exchange, how much is that contributing, just to get us an idea?
Retail growth in terms of value is more than the gold price appreciation. I think retail growth in value terms would be around 30%, which I think is quite good considering the entire market scenario. People are looking at gold as a currency to buy new jewelry, and that today is around 50-55% of the entire sales. So that typically was in the range of 18-20%, which has gone up to 55%. And I think that's primarily because of the high prices and people's budget constraints. But having said that, people are buying jewelry. Wedding shopping is going strong. Diamonds have seen a good run as we speak, and I think overall people's interest in jewelry remains strong. Silver and gold, I beg to differ, do not compete, because silver to hold physically is very difficult.
Yeah.
So the silver physical buying is very different than gold physical buying, and these markets both coexist. So I think overall things are looking good for the industry as we speak. All around, just the data has come from World Gold Council, where India has been the largest importer of gold last year. So that really speaks on the India's volume consumption.
Absolutely.
And I think things as we go ahead look the same. So let's all hope that this Akshaya Tritiya and the coming year should be a good year for the industry.
Absolutely, hoping for the same as well, because we'll wait for all of us and our husbands and wives to buy each other gold and jewelry for our investments as well. But thank you, Saurabh. Thank you, Navneet, so much for joining us on the show, and all the husbands who are listening as well. I think, Saurabh is promoting purchase of jewelry.
Well, that was what MOSL as well as the management of PNJ Gadgil had to say about gold prices. Well, but that's all that we have on this special show of Gold Rush. But lots more lined up on the other side. Just stay tuned.
That's huge. That is a biggie. It's out of it.
Gold Plus Clear Glass. पार हो या नियर, सब कुछ दिखे clear.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential. Markets trend range bound and are back in the green. Realty stocks and oil and gas stocks prop up in the indices.
Bajaj twin shares crack over 5% after Q4 earnings as Bajaj Finance's guidance misses analyst expectations.
Well, the market is not impressed with Trent's fourth quarter earnings. The stock is down 3% as it posted its lowest revenue growth ever.
Stellar earnings from auto ancillary company Schaeffler. The stock zooms over 12% as the stock zooms over 6%. Profits are up 12% and revenue surged by 14%.
Tire maker CIAT gains close to 8% on the back of the earnings that were better than the street estimates. Although profit was down 8%, margins were better than what the street was anticipating.
Top-level meetings are scheduled for today. Prime Minister Modi chairs a meeting with the Cabinet Committee on Security. The Cabinet Committee on Economic Affairs and the Union Cabinet too are set to meet today to discuss the Indo-Pak tensions in the wake of Pahalgam.
Welcome back. You're watching Profit Buzzers on NDTV Profit with me, Somit Sarkar, and my co-anchor, Mihika. Well, first up, Prestige yesterday is the stock that has been buzzing in trade on the back of the launches that it has done of its first housing project in Delhi NCR with a revenue potential of 12,000 crore. Mihika, how are you looking at this stock? In fact, there was an upgrade that Morgan Stanley had also done that increased upgrade their reach into equal weight from underweight when it comes to Prestige estates.
So what Prestige Estates has done, it's launched the Prestige City project, which is in the NCR region. Now this marks the debut of the company in the NCR region, and they're launching the first phase, which is Oakwood and Mulberry. Now the first phase, the overall gross development value of the phase is potential is at 9,000 crores, and they expect the gross development value potential of 12,000 crores post the second phase launch of Mayflower. So why is the project important? Well, the project was delayed and expected first in Q3 FY25, and the delay in this project was one of the key reasons that the company is missing their FY25 pre-sales guidance. However, the project now sets the tone for a strong launch pipeline for our Prestige Estates for FY26. In terms of your FY25 business update, you have pre-sales down 19% year on year, and they missed the pre-sale guidance of 24,000 rupees by 29%, and this is mainly because of the delay of the project that has now been launched. We also had a City on Prestige Estates. The brokerage maintained a buy target price of 1,600, which offers a 16% upside to the previous day closing price. But with that, let me welcome Brijesh Ali, Head Technical and Derivatives at Retail Research at IDBI Cap. Brijesh, how does a Prestige Estate look on the charts?
Yeah, hi, good afternoon. So basically, lately the stock has gained the momentum, and from the level of 1300, there has been a very strong buying which is observed in the Prestige. So maybe from the current level, we can speak of another 150 points kind of a move in the Prestige. I think in the near term, this can go back to 1600 levels. So there has been shift in the trend. So the bias is positive. The trend and momentum both supports the bullish outlook. So I think I would be riding this momentum. Somebody who's having a position should hold on to the longs. And 1550 to 1600 is what can be the next leg of upside. So view remains bullish.
Well, another counter that has been in focus is Bajaj Finance. The stock is down nearly 5% in trade after it reported its fourth quarter earnings. Let's get in Harsh with more details on the same.
Well, Bajaj Finance's numbers slightly on the softer side where Q4 is concerned. Also commentary with regard to FY26 not looking as positive as was at the end of Q3. Let me take you through it. Margins slightly on the softer side. You're expecting maybe a 10 to 15 basis point improvement with regard to cost of funds in FY26 due to the repo rate cut. 75% of their borrowing book is fixed, and therefore the margin impact may not be large with regard to the rate cut. So that's the first piece. The second is with regard to provisioning. Now, provisioning was a big disappointment. A larger chunk of provisions made than what was expected. So credit costs were elevated for Q4. The credit cost number came at 2.33%. There were certain changes made in the manner of computing the expected credit loss, and that has led to this flow through with regard to the around 360 odd crore of flow through with regard to credit loss, and therefore if I remove that, the credit cost picture is at 1.97%, which is largely in line. But that elevated credit cost is definitely a disappointment. When you're looking at FY26, the guidance is 1.85 to 1.95%. So increase with regard to the credit cost guidance in that sense versus the 1.75 to 85 band in which they had guided for in FY25, pre-FY25. So maybe that also is a bit of an overhang. The other piece is with therefore regard to growth and profitability. They've tapered down their growth expectation from 25 to 27. They've said they'll grow at 24 to 25% for FY26. They've also therefore tapered down with regard to ROA from the 4.6 to 4.8% band. They've said 4.3 to 4.7%. That's the goal for FY26. Also the ROE therefore pulled down from 21 to 23%. ROE is now expected to be around the 19 to 21% band. So across the board, metrics being brought down, and that's how both the Q4 numbers as well as commentary panned out.
Well, let's also listen into what Rajesh Jain had to say about the companies going forward and what are the reasons behind the higher provisioning.
Let's just now cover the one-timers. There are two one-timers in Q4. In Q4, company annually conducts and conducted again the refresh of its ECL model, which principally incorporates the last 12 months portfolio performance and forward-looking macro outlook. Given the higher flow forward rates that we have actually seen through the year and elevated credit costs in the last 3 quarters, the redevelopment of the ECL model resulted in a additional ECL provision of 359 crores, and primarily, rather mostly, in stage 1 assets. So that's one impact to the in the P&L in the credit cost line. The second impact is in the PAT line, which is that the company has reevaluated its income tax position on deductibility of certain expenditures based on favorable court and tribunal orders in recent years, and accordingly, in the process, the company has reversed 249 crores in tax expenses from previous years and 99 crores from the current year, resulting in an overall tax reduction of 348 crores in Q4. So if you look at the table below, I'm on panel 5, you'll principally see that expected credit loss reported is 2329.
Right. Brijesh, coming to you on Bajaj Finance, few days back we had seen the stock hit an all-time high. It was at an uncharted territory of 9,500 plus, and today after this fall the stock has fallen below its 50 DMA. So where do you see how much more of a downside do you see for Bajaj Finance from current levels?
So basically, when the stock hit this all-time high level, there has been a distribution. The majorly the profit booking, if you see for the last 4-5 trading sessions, continuously the stock is trending down. And post result, there has been a gap down. So I think this follow through selling might be there. So we'll be looking for 8,300 level, maybe another 300 points down from the current level. So one of the reason why, because during the mid correction, the rally came from those points, from the 8350 mark. So somewhere close to 8300, 8350, I think there will be a demand zone, because structurally from the long-term perspective, I think the still is, from the technical point of view, the stock has seen a weekly breakout on the level of 8,000 level. So maybe this closer to 8,300 level, which I believe mostly it should be coming. So whenever it comes close to those levels, somebody who's stuck at higher price can look to add the long bets, or maybe somebody wants to take a fresh bet can look to add near 8,300 levels.
Okay, that's the view coming in on the Bajaj trends. But Schaeffler is another stock that is in focus. Now, the company has had a double-digit growth in revenue as well as net profit in Q4. Puneet joins us with the details. Puneet, what worked for the company?
Well, thanks for that. So it was expected to be, a decent quarter for the company, but in terms of growth prospects as well as what's happened in the export market, it's been a strong quarter on those facts. Now, when you look at the numbers, revenue is up almost 16%, coming in at 2,174 crores. Margins as well have gone to 18% versus 17.6% in the same time last year. And net profit is subsequently up almost 15% to come in at 252 crores. When you look at, the segmental performance of the company, the vehicle lifetime solution business, which is the third largest contributor in terms of revenue, that's up almost 27% in terms of revenue. The other automotive tech, which is the largest business, and almost 40% of the revenue is up 14% in this particular quarter. And in terms of, the intercompany exports as well as bearing solution business, which have seen, over the last year, they've now been segmented differently now. So that is up almost 14% as well in this particular quarter. The company did highlight that, increase in exports, while they had a lower base last year, has been higher than what they had anticipated. And, Kotak Securities also sees the export business revenues increase by roughly 23% in this particular quarter, possibly driven by strong performance in, in European Union, as well as what's happened with its foray into newer markets, with something that the company had spoken about. Finally, they also see, the gross margin also increased by 140 basis points in this particular quarter. And that's mainly driven by, the richer product mix as well. So multitude of factors, including the export growth, that's one of the key factors that's worked for the company in this particular quarter. And the outlook for the next year also looks buoyant for the company.
Okay, thank you, Puneet, for giving us those details. Brajesh, I'll come to you. How does the Schaeffler look on the charts? Very flat performance year to date. And even in the one-year performance, it's down about 5%. Could we see a recovery coming in?
I think the stock is in the early stage of forming a bottom kind of a formation, because this level of 3,000 has acted as a very decent support from the weekly time frame. So I think on a immediate basis, the momentum will just start. I think this is going to last somewhere close to 3650 level. So in the near future, if this level is taken out, then there will be a good amount of trend reversal, and then we can speak about 4,000 plus level. But on an immediate basis, this rally would get a little bit of fizz of maybe some profit booking can be seen at 3650 level on an immediate basis. And then structurally, if this level is taken out, then we can talk further upside.
Right. Another counter that has been buzzing in trade is CEAT, another auto ancillary in fact. It's a tyre maker which has surprised the street today. The company delivered poor growth metrics, but the numbers were much ahead compared to what the street was estimating. Let's get in, Puneet, with more details on that.
Well, thank you for that. So definitely one of the biggest factor was the margin performance in this particular quarter. We saw that the natural rubber prices have largely remained stable compared to the previous quarter, but the margin performance has improved. Now, in terms of revenue, it was up 14%, which was another big positive number. Street was anticipating largely 6 to 7% growth, so definitely beating estimates there. We've also seen EBITDA was down 1%, and this was this number, the overall margins are now coming at 11% versus 13% in the same time last year. But because of the natural rubber prices, it's better to look at the quarter-on-quarter performance in terms of margins, while the commentary as well has been one of the other things to watch out for. So the company also spoke about, we did the KYC show, and they did mention about the replacement market being very strong, as well as rural outperforming the urban markets, amongst other things. But overall, it was a decent set of numbers, compared when you look at with the estimates, and essentially the valuation is another aspect to look at. It's 18 times price to earnings. I think only Apollo is below that valuation. And in terms of the new acquisition of Camso now with coming in over the next couple of quarters, there are things that are looking up for the tire maker, who's had the last 3 to 4 quarters have been difficult because of natural rubber prices. But overall, a decent set of numbers and con calls scheduled today at 4 p.m. Where the company could talk more about the demand going forward.
Well, we also spoke to CEAT's MD and CEO Arnab Banerjee on a special show KYC today. Let's listen into what he has to say about the company's outlook, margins and the return ratios going forward.
Yeah, so as the raw material price cools off, hopefully by end of Q1 and in Q2, we expect the margins to grow as the industry in the past several times has been able to hold the price line in terms of when the raw material goes down and hasn't been able to pass on the full impact when raw material goes up. So if that happens, we are pretty good at about 40% plus gross margins. We are now operating at about 37.5 if you see the Q4 results. So once we cross 40% plus, our EBITDA will be in a good shape, and everything else will fall in place.
And sir, anything on return ratios very, very quickly? Is there a target internally?
No, which return ratios are you talking about?
So on the capital that you invest back in the business, ROIC, ROC?
So ROC would be, we would definitely like to look at mid double digit kind of thing to start with.
Well, Brijesh, coming to you on CEAT, in fact, post the CEAT numbers, it's Apollo Tyres also, which is also up in trade. So when you look at CEAT and Apollo charts, which is that stock that you would prefer here?
Yeah, so purely from the chart point of view, I think there's a good amount of opportunity in the Apollo Tyres, because CEAT is something which I think will get some selling pressure, because today after the good amount of upside, the volumes are missing. Even though when the stock is up, stock is up on a 10% week-on-week basis, there is a distribution close to 3600 level. So I don't think there is a fresh opportunity. Somebody who's having a position can ride the momentum, but then profit booking would be a wise decision in this year as of now at the current structure. But coming to Apollo Tyre, I think one can still try to take the long bet, because there's an opportunity, and this segment is likely to perform on the higher side, because I think it's more with the traders bet. So I think Apollo Tyre should do good.
Thank you, Brijesh, for giving that outlook on something like a CEAT. But the next space we're going to talk about is actually gas transmission. Now, what happened is Nifty 50 has been very volatile in 2025, and momentum strategies have historically often not worked during this time. So what we looked at was focused and value funds and what kind of sectors they were either investing in and selling it. Now, when you look at what the focus funds have been selling, it's been counters and sectors in gas transmission, realty, construction and IT. Whereas value funds have been buying gas transmission, banking, chemicals and metal counters in the non-ferrous space. And this is what brought up the one sector that was common in both this was gas transmission. So the key question that we're presenting is there value in gas transmission stocks? And the entire thesis was based on the investment strategies of a focused fund vis-a-vis a value fund. Now, a focused fund has a concentrated portfolio, and they buy what's going up and basically sell what's going down. Value funds, on the other hand, base it on fundamentals and often invest in counters where the markets are not in favor. They buy what's going down, but at attractive valuations backed up by their fundamental analysis. And that's where we got gas transmission stocks. And if I could just pull out a IGL or an MGL and a Gujarat Gas, all of these counters on the screen, I believe Indraprastha Gas is something that is buzzing in trade today, and it's up 4 to 5%. Sumit, you track the oil and gas space very closely. Something like an IGL, what are the factors that are kind of working for the company?
Well, it's not only me. You also used to track IGL. But yeah, for IGL, if you look at, there are multiple reasons. Firstly, the Q4 numbers were very strong. The guidance that the management has given is pretty strong. They're expecting the medium-term margins to be anywhere between 6 to 7 rupees per SCM, as against 4.3 that they, in fact, 4.6 that they earned in fourth quarter. So a clear headroom of around 2 to 2.5 rupees upside on the margin side. When it comes to volume, they ended the fourth quarter with a volume of around 9.2 MMSCMD. But again, for FY26, if you look at the guidance, it's 10 MMSCMD, which is again a solid growth, around 8 to 9% growth that they are looking at on the margin front. And couple of days back, not couple of days back, at least 10-15 days back, we had clearly mentioned that the APM gas allocation this time that was reduced was actually positive for city gas distribution companies. And one of the major reasons behind that was the fact that this time the reduction was clearly replaced by new well gas. Now, new well gas is obviously a bit expensive compared to APM gas, but it's much cheaper when compared to other sources of gas like Henry Hub, Spot LNG. So they do not have to worry about gas sourcing anymore, even after the reduction in the APM gas allocation. So that is one positive coming in. Plus, fourth quarter numbers were solid, and the outlook that the company has given is also pretty much strong for IGL, in fact, and that also could be the reason why Mahanagar Gas is up in trade, right? Or is it valuations?
There's also valuation factors. Like you mentioned, what's working for the gas companies is lower margin trajectory thread. There's more clarity. The demand is steady. They're expanding into new geographies, and there's low competition from other alternatives. But valuations are actually below the average. Now, the current one-year forward price to earnings ratio for something like an IGL stands lower than the average forward. The same thing is what we're seeing for an MGL as well as a Gujarat Gas. IGL, out of the three counters, trades at the lowest one-year forward P of around 12, while MGL stands at something like a 15 times, while Gujarat Gas actually stands at around 23.5 times. Another factor is the kind of FY26 earnings potential expected. Now, IGL numbers are already in, and analyst consensus estimates on the street expects revenue to grow 10% in FY26 versus FY25. EBITDA to see a 15% expansion. However, net profits to be flat. And same thing with an MGL and a GGL. There is expectations of an earnings potential and growth in FY26. Lastly, analysts do recommend it's largely bullish for something like an IGL and MGL, 10 to 14% upside, while it's skewed lower for something like a Gujarat Gas. Rajesh, I'll come to you. IGL, MGL, GGL, what counter looks better on the charts? We have IGL buzzing in trade today, as well as a Mahanagar Gas trading with positive bias, and even something like a Gujarat Gas, it's slightly under pressure.
Yeah, so today specifically there has been some volumes which has picked up in the IGL and MGL. So, but when I see these charts, the directional trade still looks quite difficult because the trend is still down. And these the stocks for all the three like MGL, IGL, and Gujarat Gas, they are just doing a consolidation. So there can be a consolidation breakout, and then this can be more of a trading opportunity. But whether to take this as a positional bet, it will be a very risky trade, because even though if there is a breakout or maybe some consolidation, we see a upside momentum. I'm not pretty confident whether this momentum will sustain. So yeah, somebody wants to play the trading bet and keep a small stop loss and trade for that 5-10% kind of a rally. So that kind of opportunity is there. But for the larger picture, I think we need to wait a little longer and see the more confirmations. So on an immediate basis, I think there's a trading opportunity.
Well, thank you, Brijesh. Thank you for joining us and giving us your perspective about the markets and the stock that we spoke about. Moving on, Capital Small Finance Bank reported its fourth quarter numbers. The profit grew 21%, while the NII improved by nearly 19% on a YOY basis. We spoke to the MD and CEO of Capital Small Finance Bank. Let's listen to what he had to say on the outlook going forward.
What the trajectory is going to be like for a Capital Small Finance Bank. You're a sub 10,000 crore bank, both in terms of loans and deposits. What's the growth clip you're targeting? Because sub 20% is what you've done in FY25. Can we expect an acceleration going forward is what I want to understand.
Yeah, Harsh, actually, as we all know, financial year 25 was marked by high interest rate regime and a tighter monetary policy. And there were elevated asset concerns, of course, in a few segments that we have seen. But in spite of all this, like as you have mentioned, we have grown 17% year on year. And just to give you, and we are into secured lending, where are the almost entire portfolio is secured portfolio, and we target the middle income group. The middle, we are neither at the bottom of the pyramid, nor we are we are targeting or chasing the HNIs. So our segment is middle income group, which is presently I would say growing and doing very well in our country, where we expect that definitely our growth numbers for this current year are going to be much better than what we have done last year. Because last year there were constraints. Now we have already seen recently 2 rate cuts, and we do expect more also to come in this financial year. So to me, and into the segment of lending into which we are, because we are into MSME, mortgage lending, agriculture, and again in each and every segment chasing the same middle income group.
And therefore, what should the growth number look like, sir? So better than this year, but would it be early 20s? Would it be late teens? How should one look at that number?
Harsh, at this moment, keeping the environment which has started improving, we are giving a conservative figure of 20% plus, but it all depends upon the conditions at macro and micro level. If the conditions are supportive, we expect a better growth than this. I'm giving you a conservative number. Yeah.
Point taken. Sir, with regard to cost of funds, you are doing an impressive job. What's helping you stand out? Because I haven't seen too many small finance banks do sub 6% in terms of cost of funds. Maybe a quarter here or there, but otherwise you are there. And therefore, my follow-on question to that is, where should margins lie? How should one look at margins?
Harsh, actually, just to give you a brief about our deposit franchise, we are also retail oriented into that. And again, the deposits also come from the same set of customers. So we are chasing the same set of customers, both for assets and liabilities, and both are retail. So our to give you, our deposits are 92.5% are retail deposits, and we are chasing the middle income group. For loans, we want that our aim is that we become the primary banker of our customer. His main cash accounts are with us. We chase that set of customers in any of the product buckets that I mentioned earlier, whether it is MSME, mortgage, agri, or any other. So this helps us in building up a retail deposit franchise as well. So otherwise, if I share with you, the NIMs have improved. We have improved from 3.9, which was last financial year closing, to 4.2, and similarly the ROTA also. So now the downward interest regime, we are ready, and we want to protect this NIM, if not growing it further in this regime, because the interest rates are interest cuts have started, and we do expect. And
if I can ask you, Mr. Samra, what's the likelihood of that? What's the likelihood of you protecting the 4.2, 4.1, 4.2% margin number?
No, actually, the thing is, of course, the EBR the loans on EBR has already gone down. But for us also, we have 45% fixed rate book and 55% is floating. But out of 55, 25% is EBR, and rest majority is MCLR based, which is on a yearly reset. So like to balance out the so that there is not much impact or pressure on the NIMs, and we are able to protect it. So like we have planned our asset liabilities in a way that we are well protected in both the regimes, whether it's an upward interest regime as we were witnessing for last many years, and similarly I'm quite hopeful that we'll be able to protect our NIM of 4.2, which presently we have closed in this last financial year as on 31st March. And ROTA, which is we have improved from 1.3 to 1.4, and we see some improvement into that. But I would say in this year, I would not say there's going to be an exceptional, but we will see some improvement to this as well, since presently also we are a low CD ratio company. So as the CD ratio improves, will have a favorable impact on ROTA. Yeah.
Point taken. And therefore, sir, brings me to the question of credit cost. You have a 99% secured book, if I understand right. Would you continue to opt for only secured business even going forward? The 20% growth that you do will be secured. And are you looking at alternative segments to venture in terms of the secured business? What's the risk like? What's the credit cost that you're penciling in for next year?
Harsh, majoritarily we'll be targeting the products what we are doing. Majority of the growth will be coming from, we are a branch-led business model, and majority of the growth will be coming from the segments which I have already discussed. We have no aspiration to go for unsecured lending. Even for a few alternatives, say going forward with BC channel, etc. Still co-lending is still not allowed to small finance bank. We are quite hopeful that RBI allows to small finance banks as also. And if the alternate business that we are adopting or we will adopt are also going to be in the same DNA, the business into which we are secured lending, which fits very well into our DNA of secured lending.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
Hello and welcome to NDTV Profit. You're watching Top Trades. I am your host Varsha. With me is Puneet Zaveri. Well, let's see how market has been performing. Well, there's been a kind of recovery, Let's see where Nifty is. Well, Nifty is kind of flat, but let's see, who are the contribution when it comes to benchmark index. Therein, on the gainer side, you do have, HDFC Bank, RIL, Airtel, Maruti, who are the top contributors when it comes to Nifty 50, while on the loser side you have Bajaj Twins, of course, on the back of numbers. You have SBI, you have Ultratech and Bajaj Auto as well when it comes to benchmark indices. Well, let's see the sectorial heat map, which are the sectors who are gaining. Well, Nifty Realty is up almost 2.5%, healthcare is up, so quite I would say Nifty Oil and Gas is up almost 0.29%. But let's shift our focus when it comes to broader markets. Let's see what broader markets are doing. Let's pick up Nifty Mid Cap 150. There you go. It's under pressure, slight under pressure. But let's see who are the contributors when it comes to Nifty Mid Cap 150. On the loser side, well, let me see, you have BSE, CG Power, IDBI Bank, Star Health when it comes to loser side, while you have IGL, Nippon Life, Fortis Healthcare when it comes to gainers. On the Nifty Small Cap 250, let's see what that counter has been doing. You have Praj Industries when it comes to loser side. The stock is under pressure on the back of weak numbers that the company has been done. There you go, Praj Industries down almost 7%. You have KFin Tech on the loser side as well, Westlife Food, Sterling and Wilson, and 5-Star also, when it comes to on the loser side. So, but Puneet, broader markets are actually very under pressure, but benchmark indices have been recovering, right?
Yes, definitely. And it's the banking stocks that are kind of providing the much needed support as well. But let's also welcome in Vaibhav Vidwani, who's the fundamental research analyst at Bonanza Portfolio. Vaibhav, good afternoon, and thanks so much for joining in today. Just wanted a quick view on the index first, because we've seen a lot of numbers now come in. Some which have really disappointed the street today, like Bajaj Twins. Any outlook that you have currently on the Nifty?
If we see in our Nifty, most of the stocks are the financial stocks, and the large cap bank stocks like HDFC and ICICI are the stocks which ICICI have delivered better than expected results, and HDFC CD ratio has declined below 100%. So these things shows that larger stocks still have good potential, and in upcoming quarters, these stocks will support Nifty. So I think so. I'm a little optimistic regarding our Nifty because of these things, as these large cap stocks still have that potential to protect our Nifty.
Right. Thank you, Vaibhav, for that view. Well, let's move ahead. And Vishal Mega Mart and Shoppers Stop came out with their Q4 earnings. Vishal Mega Mart's net profit is up almost 88% in this quarter. On the other hand, if you see, Shoppers Stop increased expenses affected the company's revenue. Mahima joins in to give us more details.
Right, so I'll start with Vishal Mega Mart. Well, both retailers, but completely different earnings for both of them. In terms of Vishal Mega Mart, revenue growth was overall led by a growth in same-store sales growth, which came at around 30%. There was preponement of festive demand of Eid and Ugadi, which helped the revenue growth. In terms of the retail footprint, that got expanded by 85 odd stores. Profit was led by overall improved cost efficiencies as well as operating leverage, and other income also aided the PAT. In terms of the numbers, revenue was up 23%, EBITDA was up 42%, margins up 193 basis points, and overall net profit was up 88%. Shoppers Stop, where overall store opening did disappoint, increasing expenses did weigh on profits, and overall private brand share also saw a decline, which kind of impacted the overall margins as well as profitability. What impacted profits was purchase of stock in trade was up 17%, finance cost up 22%, depreciation increased on account of store additions at 11%, and other expenses was up 12%. So in terms of store additions, they opened 21 stores this quarter. So this is the overall view as to how Vishal Mega Mart and Shoppers Stop fared in Q4.
Well, thank you, Mahima, for all the details. Vaibhav, coming to you, how are you seeing numbers when it comes to Shoppers Stop and also Vishal Mega Mart?
For Shoppers Stops, I say that because decline in urban demand, as they have because they have reduced the high cost of living, urban centers cut their discretionary spending. So these things impacted their revenue. Their profit is declined by 91%. So I think so in upcoming quarters we can see this little bit stress in their profitability and their numbers. And our RBI is also taking initiatives to improve the flow of funds in the market so that our urban demand can improve. But still, in the near terms, I expect that their numbers will be quite maintained at this level. So I'm a little cautious about the Shoppers stock.
Got that view, Vaibhav. But another stock that's in focus is Varun Beverages. After the company announced their quarterly earnings about a couple of hours ago, the numbers were largely in line with estimate. But for more perspective, Mahima is still joining with us. Mahima, what worked essentially for Varun Beverages, do you think, in this particular quarter? Numbers largely in line with estimates?
Right, numbers largely in line with the estimates, as you rightly mentioned, but what worked was the volume growth overall on the consolidated front of business. Realizations, however, did lack growth. In terms of numbers, revenue was up 29%, EBITDA up 28%. Margins were a surprise because they were expected at 22%, which came at 22.7%. Net profit grew by 35%. Now, why did the margins overall decline as compared to YOY percentage? Relatively lower margin profile because of own brands in the South Africa business. Higher mix of carbonated soft drinks in India. Raw material prices went up by 38%. Purchase of stock in trade was, however, down by 69%, but this was also offset by depreciation being increased by 75% due to the overall commissioning of new plants as well. In terms of volume growth, the consolidated volume growth stood at 30%. Organic volume growth in India stood at 15%, and South Africa volumes grew by around 13%. In terms of realization, that did lack growth. Realization per case was up 1.8% in India. Realizations were completely flat in the international markets, and around 0.9% decline in per case realization in consolidated numbers were seen. Lastly, in terms of South Africa update, in terms of integration of overall South African territory, that has progressed well, and that has been reflected in the numbers as well, and volume growth as well. They've achieved overall 141 million cases over trailing 4 quarters now, and net realizations were lower on account of higher mix of own brands, as well as there was improvement which was expected, but that has not taken place. But the management has said that improvement is expected in realizations and margins going forward. So this is the overall view as to how Q4 has panned out for Varun Beverages.
Well, thanks for that, Mahima. The stock has recovered actually from its lows of the day as well. Stock was down almost 3 to 4% when the results came. There you go. Day's low 507, currently trading at 529. Vaibhav, Varun Beverages is another very interesting pick there. How are you viewing the stock post its earnings? Are you also anticipating, while the valuations are on the higher side, what's your view on this particular stock, anticipating growth going forward as well?
Yes, I believe that this stock will perform well in upcoming quarters also. There we can expect that the anticipations, the company have that ability to stand as per the expectations, and they can deliver expected numbers in upcoming quarters. So I'm a little optimistic about Varun Beverages.
All right. Well, moving on, 2 stocks which are in focus. One is IndiaMart Intermesh. Now, this is on the back of Q4 numbers that the company has announced. Well, if you see the key highlights, the revenue growth was flat quarter on quarter. EBITDA margins that you're seeing is supported by lower investments. But there have been churn among silver tire subscribers. So this has been concern going on with IndiaMart since quarters, and that also remains elevated. Subscriber addition remains muted for the company, and net profit, the huge spike in the net profit that you're seeing is aided by other income. Now, just if you see margins were at 36.7% versus 38.9%. But overall, if you see, the numbers are weaker, on the weaker side when it comes to quarter on quarter. Well, Jeffries on IndiaMart, if you see, Jeffries has maintained underperformed rating with target price of rupees 2,000, and what they say is slower growth warrants de-rating according to Jeffries, and there's been continued growth challenges that the company has been seeing, and the collection growth at 9% remains lackluster as per Jeffries. So weaker set of numbers when it comes to IndiaMart. Well, on the next I have Praj Industries, again weak set of numbers. I think the stock is down almost 6-7% today, and the key highlights why the reason the weaker growth that the company has seen in this quarter is the revenue and EBITDA impact that you're seeing is led by slower execution and rising input costs, and the negative operating leverage has led to 200 basis point of miss in EBITDA margin. Weakness in revenue appears to be driven by deferral in start of new bioenergy jobs, and order intake during the quarter, if you see, is around 1,000 crores, and the consolidated order backlog stands at around 4,293 crore. But Vaibhav, especially on India Mart Intermaze, so there's been concerns when it comes to addition of subscribers, and of course the collection, slower collection growth. How are you viewing this counter? Do you track it?
My view on this particular stock is that like they are not their attrition for their customers is quite high, and it is quite hard for them to maintain their client base if we have observed in previous quarters also. So I'm a little pessimistic about the India Mart because their client base is a little stressed in near terms.
Got the view, Vaibhav. And we've seen the stock being under pressure as well, specifically post last quarter as well, Varsha, where the premium subscription number had actually come down as well, and stock was down 10% post quarter 3 earnings as well. But another stock that's in focus is Blue Jet Healthcare. After Motilal Oswal gives its coverage and starts covering the stock in this particular day. Varsha, what are some of the key highlights from this particular report?
So just to give an reference what this company does, so they are into contrast media. So whenever you do an MRI, there's a dye which has been injected, and that's nothing but the contrast media. So now why Motilal Oswal has initiated a coverage on this stock is, one is because this company Blue Jet is actually building legacy business with niche offerings when it comes to contrast media and intermediates and API, that is active pharmaceutical ingredient, the main salt that you have in your drugs. After muted growth from FY 20 to 24, company is expecting a good growth because contrast media itself, the segment itself is growing into double digit. So the key reason why Motilal has given an initiation. A pharma intermediary segment is expected to see sharp rise according to the brokerage firm, and they are also expecting a margin increase and reducing supply chain risk due to the backward integration that the company has been doing. Contrast media is expected to contribute 36% of revenue by FY 27, and of course the revenue growth will be driven by the new products that the company has been coming in. Recent commission of that plant 6 adds significant capacity addition, which will actually help to build on the top line that the company is expecting, and that's one of the reasons why Motilal has given an initiation. And lastly, if you see, stock is actually trading at an attractive valuations according to brokers. So these are the key reasons why Motilal prefers Blue Jet Healthcare. Vaibhav, Motilal finds valuation attractive. How do you see this counter considering the contrast media segment, because DVs is also into contrast media segment and expanding a lot because the segment itself is going into double digit?
So if we see, contrast media currently have 67% contribution in their revenue, and high intensity sweeteners have 18% contribution, while pharma intermediaries have 13% contribution. So currently they are focused on pharma intermediates, and that's what will support their revenue and profitability in upcoming quarters. The reason means, as you also told, that they will reduce their revenue contribution for the contrast media in upcoming years. So pharma intermediates will support their profitability, and that's why I'm also optimistic regarding that stock, because they are trying to mitigate their risk by decreasing exposure in the contrast media. And the reason behind that is that in contrast media, some raw materials are being these things are dependent upon the China. So that's what is impacting their revenue growth in the contrast media, and their pharma intermediates are the good segment of their business for them with high margins. So that's why I'm a little optimistic about this particular stock.
All right. Got that view. Thank you, Vaibhav, for joining this conversation. Pleasure to have you. And moving on, earlier today we spoke to Vivek Paul, who is a global head at BlackRock Investment Institute, on how can India gain from the US-China trade war. Listen in to the slides of that conversation.
Well, firstly, thank you so much for having me on. You're completely right. I mean, it's amazing to think that it's it's still in the month of April where we have had just material shift in the narrative in terms of the global trade dynamic. And we expected, of course, some material news and material rhetoric, but I don't think it's fair to say that many expected the extent of the volatility that we've seen. And you're right that it's shaping flows. And let's take India directly as an example. As we know, for a bunch of years, we saw material kind of inflow into Indian equities from foreign investors, which really started to sort of arrest something in the middle of last year, all the way through to the first quarter. And actually, what's really interesting is you look at the period of flows in the post-April 2nd announcements, and actually it's become positive again for foreigners in India. And I think that really goes to show that this is an environment where there's a relative game and there's an absolute game at play. Undoubtedly, in terms of the absolute scenario, this is an environment where we are going to end up with greater tariffs globally than we had in the past. That seems to be the clear direction of travel. But there's an enormous range of potential outcomes within that. And it is shaping the narrative. It is shaping the trade dynamic. It is shaping the opportunity set for international investors. If I think about our own positioning, our own sort of portfolio recommendations, where we started the year in terms of the sort of more broad Asian kind of complex, we had a near-term preference for China with a longer-term preference for India. As we've kind of come into the more recent period, we've softened that China preference. That's now neutral, given the particular impact of the trade dynamic and uncertainty on China. But we continue to reiterate that long-term opportunity set for India. And I think actually some of the structural benefits India can face in this environment is perhaps even accentuated by the volatility that we've seen.
How do you see trade shaping up with respect to India, given the fact that in the last 9 days alone, we have seen close to $4 billion of foreign flows coming into the country. And as you said, there may be a pause coming in because there's a trade reversal which is happening from China, and it could be flowing into other emerging markets into India.
Yeah, I mean, it's critical, right? I mean, I guess we've talked for a while, I think, about the idea that India has a unique opportunity in an environment of greater sort of global dislocation from an economic perspective, because it can play a role with both the United States and with China and really kind of insert itself more centrally into some of those global systems. And I think what we've seen over the course of the recent weeks is some of that starting to come true, right? We've seen the idea of major sort of manufacturers of telephones kind of thinking about using India more as a hub for some of that supply. We've seen Chinese exporters kind of think more about using Indian companies as a means of gaining access of their end exports into the American economy. So I think you're starting to see some of the dynamic we were postulating before coming through. I think that's one important point to make. I think there's another point I think implicit in your question, which is the ability, I think, of India to kind of come out of this with a relatively more favorable outcome. And you've seen comments from leading officials in the administration saying that they anticipate sort of progress with India and some of those trade talks to be accelerated relative to international peers. And that makes sense, because actually, if you think about the share of the sort of US imports that are kind of affected by this for India is comparatively small. The Indian economy is relatively resilient to this dynamic. And actually, structurally, from a sort of geopolitical perspective, it's probably an easier deal to be done with India, at least according to the US officials, than there is perhaps with China. So the ability to kind of make more material progress in terms of getting a deal, the starting point of the fact that there's less interconnection between India and America relative to India and China in terms of those supply chains, mean that perhaps we do see a more favorable outcome, and that will lead to more stories like I started this answer talking about, of international trade being sort of rewired a little bit through India.
How does a portfolio manager look at it from the point of view of asset allocation? we're seeing Trump flip-flopping on announcements. There is a great deal of uncertainty which is coming into play. That's creating a volatility in place for a fund manager who's planning to allocate through various geographies and asset classes. What should he be reading, and how do you see that translating into investments into geographies or asset classes?
Yeah, and this is the debate that we're all having in the asset management community, and I guess more broadly, investors at large. And I think one thing I would sort of caution against, I think trying to predict the next headline, the next kind of bit of news flow with regards to trade negotiation or whatever else it might be with regards to the trading policy set is really hard. It's a fool's errand to try and understand exactly or try and forecast exactly the next step in a negotiation pattern. What I think we can do, though, is try and think, where are the boundary conditions, right? Where are the bigger kind of sort of dynamics, which mean that will prompt a reversal in a particular path or the rhetoric. And we're kind of framing this in the notion of thinking about the immutable economic laws that are actually going to govern what the end state looks like. And there's two that we particularly highlight. One is to do with the idea that you can't just, if you like, you can't just kind of change the terms of the trade deficit without having an impact on the foreign sort of flow and foreign funding of US assets. And I think we saw that sort of immutable law dynamic really coming into fruition right at the start of April, where we saw the 90-day kind of pause on tariffs come immediately after the fears in the treasury market of spiking yields. And I think you see there that the idea that the market forces of the yield movements kind of then influence the ultimate direction of travel of policy. I think you also saw some element of that when it comes to the second immutable law that we think about when we're trying to govern the space and navigate the space, which is the idea that the trading interconnected nature of the global economy has taken decades to build, and you can't just change it overnight without experiencing or anticipating some material economic damage. And I think when you saw in the course of the last couple of weeks the idea that leading CEOs were kind of pointing out to the world that there could be some impact here from kind of trying to change too much too quickly, you then again started to see some softer rhetoric come out, and therefore a bit more of a market rally in the course of the last week on account of that softer rhetoric. So trying to guess the very next move is really impossible. Trying to think about what are the bigger picture boundary conditions that can then influence the ultimate outcome, I think that is where we need to think a little bit more. And in that spirit, in that vein of taking that slightly bigger, longer term approach, that's where we see the opportunity arise in India, because the structural dynamics we've been talking about for a period of time, the demographic dividend that India faces, the digitization of the Indian economy. These are structural drivers which we think it's important to focus on, because it can be very easy to get carried away with the very near term and only focus on, if you like, the very near term tactical dynamics. We actually sometimes need to take a little bit of a step back, and that's where the structural opportunity lies. And the final thing I'll say in answer to your question, when we're building longer run portfolios, for an international investor, we would indeed think a little bit more about holding a greater allocation to benchmark weight in Indian large cap equity.
Well, that was BlackRock's view on India, among other things, but that's all the time we have on this edition of Profit Top Trades. From Varsha, me, and everyone who puts the show together, thanks so much for watching. India Market Close comes up next.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Well, largely doing nothing on the Nifty. Welcome to India Market Close. I'm Harsh Saita. With me is Hiral Dadia, and let's look at where the index is. It's a flat line even today. We saw this yesterday as well as day before, so that's how at least the week has been for the benchmark. And in terms of how the Bank Nifty is doing, a slight bit of headwind when it comes to how the Bank Nifty is performing today, around 0.4% odd lower. Let's look at the Nifty constituents and zoom in and talk about maybe a few names which are doing well. Now, in terms of the way the stocks are moving, it's largely HDFC and Bajaj which are the top gainer and top loser, even Steven with regard to those two behemoths within the financial pack. Reliance has sort of a muted move today in comparison to what it's done this week. SBI being one of the drags, and obviously Bajaj Finserv on the back of Bajaj Finance's performance also taking a bit of a knock. Let's look at the heat map on the screen as well and try and zoom into pockets which are doing well. Well, you have a Maruti which is zooming in trade today, and SBI Life and HDFC Life also doing fairly well for themselves. So the life insurance pack is doing well. What's not doing as well is the Bajaj Twins, but outside of that, Trent taking a bit of a knock after the kind of move that it saw yesterday. Tata Motors and some pockets within auto. Mind you, you'll have auto sales data also come through on Friday now. Of course, it's a truncated week and a holiday tomorrow. So a couple of those pockets to look out for in that sense. Let's look at how the advanced decline in the breadth is doing. Mind you, the breadth has been even Steven over the last couple of days, but today turning sharply negative with regard to the advance decline ratio. The declines outstripping the advances by at least 3 times. And let's look at how the mid-cap and small-cap indices are doing before we look at sectors in particular. And some sectors which will be really tracking, 1/3% lower on the Nifty mid-cap. So some bit of pain there. The Nifty small-cap down 1.3%. This is where a bulk of the pain is, but very close to the day's low with regard to the Nifty small-cap. Something again that we'll be tracking today. That's how the heat map with regard to sectors is panning out. Realty standing out in trade today. Pharma doing really well as well. There's some bit of outperformance in those pockets. PSU banks is where some pain is. Defense, frankly, nothing to complain about there because defense in general has done very well, at least over the last couple of trading sessions. So today, par for course, that 1.3% lower number with regard to defense. Autos are largely flat ahead of and IT too, but autos more so ahead of obviously the April numbers, which will come out maybe in a day or two. But let's bring on board Shivangi Sharda of Motilal Oswal joining us this afternoon. Shivangi, hi, good afternoon. Want to quickly take your view with regard to the index and the bank nifty. The Nifty, bank nifty, what levels are you tracking and how is it looking at this point?
Very good afternoon, Harsh. So we've seen that the indices have witnessed a little bit of a rub-off at the higher zones. But the good part is that we've rallied well in the last 4 weeks. And we've seen that, the index has been sustaining at higher zones, which is a very positive part. Now, overall, we've seen that there has been the scattered pockets where the buying has been emerged in terms of sectors, which has somehow, managed to hold the index each one of the day in the last 4 to 5 weeks. Now, overall, we've seen that, of course, heavyweights are on the forefront right now, but the consolidation that we're seeing from the last 5 trading sessions has indicated that there is very strong support-based buying, but then again, a little follow-up missing in action at the higher zones, which is making it a little lackluster. So overall, we are going for buy on decline strategy. While 24,000 is an important psychological level, 24,200 will be the immediate support to watch out for. And the next level, 24,650 on the upside. Now, of course, today is expiry for Nifty, but then again, we've seen that the index has been in a very narrow range, in a very consolidative mode ahead of the holiday. So there is some sort of a lackluster move that we need to deal with. So advice would be to go on for option strategies instead of naked positions, which would help traders. Now, talking about Bank Nifty, there has been an outperformance here from the last 2 series. Of course, after after touching a lifetime high territory, there has been some profit taking. But overall, we are still respecting 55,000, which is a very close level right now. But that is acting as an important level right now, where there are a lot of put writers which are positioning themselves. Now, on the upside, we're looking at 55,750 as the immediate hurdle for Bank Nifty, but buy and decline to continue here with strength continuing in the heavyweight private names.
Right. So that's with regards to Nifty and Bank Nifty. Shivangi Hiral on this side. So what would your top picks be, taking into consideration the way trade is panning out right now?
Good afternoon, Hiral. So, talking about my top picks for this afternoon, first up would be, we've seen that there has been good buying interest across, spaces like which are related to gold and jewelry. Of course, today is Akshaya Tritiya, and it has a lot of importance. We've seen that, Titan has been one stock which has seen a good rub-off of this effect and consistently made higher top, higher bottom in the last 4 weeks. Now, year-on-year basis, we've seen that this stock has been a wealth creator. Recently, there has been smart buying in the last 4 weeks, and in the last 15 trading sessions, out of which 13 have, closed in green, which indicates that strength of the bulls is to continue here. The jewelry segment of Titan has registered 24% year-on-year growth, supported by, of course, higher gold prices and the way this metal is shining. Now, gold jewelry alone rose by 27%, while gold sale coins jumped around about 65%, which is reflecting the strong demand here. And of course, with the festivities kicking in, this stock is poised to do a good up move here. So recommending a buy with a target of 3,500 levels on an immediate basis with a stop of 3,330 levels. Now, the second pick on my radar is IGL, which has seen a recent price volume surge here. RSI is showing positive divergence, and with the kind of diversification we are seeing across the board, across sectors, this is one stock which is now started to just move. On a monthly basis, we've seen that the stock has consolidated, but the good part is there has been good support-based buying from the lower levels, which is making a comeback of the bulls here. Now, it has surpassed its immediate hurdle levels of 193 zones, and it is getting ready for a upside move. So recommending a buy here with a target of 200 and a stop of 190 level.
Right, so that's with regards to where the top picks go, Titan and IGL, and we'll try getting you a bite of the conversation that we had with the management of PN Gadgil as well. But before that, another piece that has been interesting is with regards to where the gas stocks are concerned, and IGL being Shivangi's top pick. One link or one piece that my colleague Mika has put together is taking into consideration the volatility Nifty has seen this year and how momentum strategies often never work during periods of market downturns. And that is what has led to her research to analyze allocations of focused and value mutual funds and how gas transmission, that has been the contra pick. Mika gets us all the details on the same in a short while. But overall, if you see in terms of the pick, it's mainly, it's been very flat in terms of IT, but it's mainly IGL and MGL that have made it to the list. But moving from there on, a set of other companies that are on our radar today are IndusInd Bank and Bajaj Finance. Shivangi, what are both their charts indicating today?
Now, of course, with Bank Nifty on the soar, we've seen that some pockets have contributed time and again. NBFC financial space have been one which were, the first up. But of course, we've seen some sort of a rub-off in the last 4 trading sessions in stocks like Bajaj Finance. And we've seen that the stock has, slipped lower and gave up its gain of the last, 1 month. But overall, this stock is again respecting its key retracement levels, and it might be a wait and watch for a good level to enter again. Now, talking about IndusInd Bank, this one has been a slow and steady mover, and we are expecting banking stocks to overall outperform, and continue doing so. And IndusInd would be one such stock which has been doing quite well from the last 4 weeks, where it's making higher top, higher bottom. On a monthly basis, the stock is still, trending lower. So overall, long-term structure might not have changed, but the immediate short-term structure indicates that there could be, a quick upswing that one could capture onto.
Okay, let's now let's go back to that conversation which Hiral was referring to, the volatility in the Nifty this year and how momentum strategies often never work during periods of market downturns, and that's largely led our research team to analyze allocations of focused and value mutual funds and how gas transmission could be the contra pick within this pack. Mika is here with all of those details.
So when we analyzed what focus funds were selling, the kind of sectors that allocations and average holdings were decreased in was gas transmission, realty, construction materials and IT, whereas value funds were buying the gas transmission space, banking, chemicals and the non-ferrous metal space. Now the key question when we see gas transmission coincide or in both of the columns is there value in the space. Now why we were looking at these funds is because of the investment strategies that they follow. Focused funds have a more concentrated portfolio. That's why they buy what's going up and sell what's going down. However, value funds on the other hand, it's based on fundamentals. They buy the stocks that are not in favor of the markets, that are actually falling down, but at attractive valuations with research and fundamental backing. So now what's working for the gas transmission space? You have stable and rising CNG and PNG demand. You have expansion into new geographical areas, lower competition from other alternative alternative fuels and better clarity on margin trajectory. And it was actually the margins that stood at risk just a few months ago when the APM allocation was reduced. However, because of a lot of risk to margin, it was again allocated. But as of April start, they again reduced the APM gas allocation for the gas transmission companies. However, this would be replaced by new well gas. New well gas is a little expensive from the APM gas that is allocated to the gas companies. However, it is much cheaper than the other alternatives that the gas companies would have to previously go to, and margins can improve. In terms of valuations, the current one-year forward price to earnings ratio for an IGL, MGL as well as a Gujarat Gas is below the average. And if you look at the FY26 earnings potential, there is growth expected. IGL 10% revenue, 15% EBITDA uptick. Mahanagar Gas a 10% revenue and a 5% EBITDA uptick and a 4% growth in their net profits. And Gujarat Gas EBITDA is expected to grow by 22%. Lastly, how the street views it, well, it's largely bullish for something like an Indraprastha Gas and Mahanagar Gas, 18 and 21 buy calls respectively, and an earnings and a potential upside of 10 to 14%. However, for something like a Gujarat Gas, the street view is bearish. You have 16 sell calls and only 9 buy calls, and there's only a 2% upside to the previous closing price.
Okay, so again, IGL, MGL and GGL, Gujarat Gas, 3 stocks that you're focusing on. Though what's interesting is you have IGL and MGL which have the highest buy calls versus GGL, so that's what you're looking at. And that tells you where the concentration is so far. But let's pull up all the sugar companies in trade. You have the cabinet which has gone ahead and approved increase in the sugarcane FRP, which is the fair and remunerative prices, by nearly 15%. Current FRP is 340, so that's another 50 rupees approximately that could have been added. So around 400, 390 to 400 is what you should be watching out for. What would that mean is what is going to be interesting, because that's the money that will be going to the sugarcane farmers, right? So that will probably dent a hole in the margins of sugar companies, Harsh, and that's, I think, one of the reasons why you're seeing all the sugar companies that are trading under pressure at the day's lows. Awadh Sugar 3.5%, Praj Industries 7.5%, but Praj is also reacting to the quarterly numbers. Apart from that, Bajaj, Hindustan, Sri Renuka, if you can just pull up all those charts and see, there you go. The pressure has continued in today's day of trade. Shivangi, very quickly, what would your strategy be with all of these sugar names today? Yes, there is pressure. Any picks on the short sell side or on going long?
Of course, sugar stocks have been quite volatile, and we've seen that they have been highly, having a high beta counter as well. So overall, these stocks tend to sink after moving in 3 to 4 trading sessions. So there has been pressure in stocks that we check, like Balrampur Chini, and stock has been witnessing a little bit of a rub off from the last 4 trading sessions, but overall on the weekly basis it is still holding up on the upward sloping channel. So we'll have to wait and watch for this to hold around about 550 levels. If it manages to hold above the same, we could see a rebound from here, and again trend picking up. But again, this is a conditional wait and watch trade.
Okay, Shivangi, thank you for those views. We'll let you go on that note. Thanks for joining us this afternoon. Let's quickly take a fundamental view. We're joined by Feroz Aziz, Joint CEO at Anand Rathi Wealth. Feroz, it's been a while. Good chatting with you, and many congratulations on the promotion as well, the elevation to Joint CEO. But today is going to be more about understanding what the thought process is with regard to what are you advising your clients. You were one of the early ones to call out that small and mid caps were in a zone which you were not comfortable with. We've seen a bit of a correction thereafter. How do you view both the small mid cap as well as the large cap index given the global context?
Yes, Harsh, it's always an honor to have a conversation with you. And thanks for your wishes on the elevation. Then coming to markets, I think Indian markets, we believe, are a very investor-friendly market. they're investor-friendly market because there are several circulars and further strengthening of speculative activity being restricted. So that's why you see that market rebounds are far more prominent. Like last financial year, there were 2 days when it was the lowest, which was 21,885 on 4th of June. On both of those days, I went on media channels, and it was reasonably clear that we are almost bottomed out, because we are a cash market driven capital market. Because there are limits on net shorts which a person can build. You cannot have more than 2,27,000 or 2,20,000 now of naked short positions in the derivative segment. You call, sell, put, buy, and future sell. These are 3 short positions. This cannot sum total to more than 2,20,000 Nifty, which is abysmally small number. That's why you see exaggerated days like the Trump's Black Monday was almost bought into. So coming back to your more important point, what are we telling our clients? We are telling our clients that anytime, Bill, if you get the index at an 8-10% discount from the peak, because that's something which you can numerically measure. Are we at the trough? We will never know. But are we below the peak? We will always know. 26 September 2024, when Nifty was at 26,200 and odd, from there on, if I get a 22,000 level, if I compute the fall, it was 14%, 15%. So anybody who has large capital sitting outside, I would definitely tell him to buy at 22,000, because he's got a 14-15% correction, which is what is the peak to trough average for the last 24 years. So, plug all the gaps of equity is what we've been telling through the full quarter. As you would see in our results also, we collected the maximum amount of money in the worst of the sentiment last year. During our results, we shared what is the net flow, or significantly more than the previous quarter as well. And coming to the mid cap, small cap, I think the equilibrium is just around the corner between all the 3.
Right. Feroz, good afternoon. This is Hiral on this side. Good speaking to you after really long. You talk about, yes, the equilibrium is probably around the corner in terms of your mid caps and small caps. But what are valuations telling you? Because there is fear. And with the fear, if you have to look at what the investor is watching out for is, can I still have further room of valuations which could bottom? And then is when I will look at entering the markets. What would you have to say?
Firstly, when it comes to small cap, there are several small cap indices. BSE has its own small cap. There is a small cap 100 index. I think the first clarity which needs to be emerging, like you've on the screen, you see NSE small cap 250. This is the one which everyone should ideally track, because SEBI says NSE small cap 250 is relevant to domestic mutual fund investors. So first confusion which I'm trying to remove from your viewers' mind is which small cap index to track, because this is where the 35 lakh crores industry of equity mutual funds is considered. This is considered as the tier 1 benchmark. So point 1. Point 2, since there are 250 stocks, painting them in one brush in any circumstance is going to be a very difficult task. Either overvaluation or undervaluation or normal valuation, because these 250 stocks belong to different industries and different pricing models is what I would apply to value a certain business, depending on the industry it comes from. Now coming to the median valuation for all these 250, I think they've come into a very, very good zone, because earnings have done its job. Of course, people have spoken, earnings have been not so good, but I personally think earnings have been good. And if you look at the numbers, you will be pleasantly surprised that we have already seen a 10 to 12% growth in earnings in the first 9 months of the NSE small cap 250. And the last quarter results, I think almost about 38 of these 250 companies have declared results. And the earnings again for these 38 companies, which is almost about 14 to 15% weightage, has already given you about 10 to 12% earnings growth. So earnings growth support and already a correction of a significant nature is telling me that now there is a lot to do bottom fishing. But there's one strategy which I've back tested for years, if not decades, which works. If you want me to articulate that, I can probably do it for your viewers.
Do that, Feroz.
Yes, great. So what you do is you do a test. See, bad times help you understand who's strong. So if you take the last 1 year, step 1, take the last 1 year. Find out which were the worst 10 days in the last 1 year. arranged them in the descending order, saying that इस 10 दिनों में market 3% गिरी, 4% गिरी, 5% गिरी, या 2% गिरी. You now know which are the worst 10 days. That's step one. Step two, find out which of the NSE small cap 250 stocks were positive on these worst 10 days. Once you get the positive stocks of these, and then you see whether there are any common stocks figuring in these list of these 10 days. If let's assume there's a stock which is positive 6 out of these worst 10 days, what does this imply? It implies that whoever currently owns this stock is not a fluid owner. अगर वो ट्रम्प के गिरावट के दिन अगर ये स्टॉक नहीं बेच रही ओनरशिप, that means they are not looking at the market, they're looking at the business stability. So whenever the markets are uncertain, always buy businesses. When the markets are doing very well, buy the price. When you see stocks which are positive on a bad day, that's the evidence that the ownership of this stock is very solid ownership and it is not dependent on some market movement. And those are the stocks which will throw up the best bounce backs when the tide turns. So this you can backtest for the last 25 years. This is the best strategy during market uncertainties. Very bad strategy when the market is going helter-skelter and positive, but a very good strategy when there's a sideways or a riskier movement like aapne kaha, that there's fear. This is the best strategy I have been able to backtest over the last couple of decades.
I'm sure you've done this already quite a lot of times. In the current exercise that you would have done to get these names, what comes up to you?
I'm not qualified to.
No, I know. I'm not asking you to give. I'm not asking you to give a view in terms of your recommendations, but and this is something which is an exercise which will directly give you the data. So anything that you could tell us on that?
See, there are about 7 stocks which figured. Okay, and if anybody went through the same steps, he's going to get the same output, like you rightly said. Okay, but I don't know whether I'm compliant in mentioning those names. This is why I'm being cautious. Okay, but I got 7 names which had a common factor, which were there in all these worst days. Out of which there are 2 stocks which I saw which had 6,000 crore of free float. That means, देखिए क्या है कि when demand doesn't decide the price of a stock. This is one thing which I realized after a lot of statistical analysis. If there is so much demand on a certain stock, but if the supply is not stopping, the stock will never discover its value. Like you see some stocks in the banking sector operating at 9 PE. There's enough demand for them, but there's so much more supply also coming in. So let me not dodge your question. I've dodged your question anyway successfully. All I'm saying is there are about 7 stocks which are common. Largely, there are some stocks from the financial services industry which appear.
Very, very interesting. Firoz, I wonder how allocation to commodities should be placed at this point. Gold has beaten the index over a longer period of time now, given the recent rally. How do you view commodities and how should you play it?
See, Harsh, in my opinion, of course, I would not be love to say this, but gold is not able to compete with equity. See, what happens is if you buy gold, it's not about the price. You will find 5 years of no movement in gold. Right? As an ornament, it's great. As a bar, it is great. If I put 30% of my portfolio in gold and don't see movement, you see 2018 to 2022, something thereabouts. You will see at least bouts of 5 years. In the last 35 years, you will find 4 years pockets where gold gave 0 return. Right? That doesn't happen with Nifty. But still, gold has a big place for Indian investor. But competing with equity will require some more degrees of no sideways movement. Gold gives sideways movements and it goes unnoticed because people don't notice its price. Nobody looks at your channel to look at gold's ticker price. But Nifty ticker price is clicking on the right hand bottom corner every second, but not gold. So point I'm trying to make is gold is a very relevant asset class in India because people have to start to learn to replace debt. People are spoiling their futures, their inflation-proof need, just putting money in debt left, right, center and supporting the government in their fiscal deficits, supporting banks for the net interest margin. but they're not supporting themselves so a good replacement to debt is gold. Half of your debt money should be in gold, and you will be able to get double-digit return even at these prices for the next 5 years, because the price of 1 lakh or 97,000 has not come on the back of rupee depreciation. This time it is because dollar gold has gone through the roof.
Right. So Feroz, we're running out of time, but 3 top sectors that you would place your bets on right now.
I would place my best bet on Nifty banks, Bank Nifty. I would definitely put IT, and I would also look at auto, and I would be very bearish on FMCG.
That's an interesting one. You know, I would love to talk to you with regards to your views on IT, but we will definitely touch base once again next week, probably, to understand why are you bullish in terms of IT when the world is negative overall. But thank you so much for joining us on the show and sharing the views. So that's an interesting one. And avoid in terms of consumption, where the world is talking about that 1 lakh crore mark that will be in the hands of the individuals. In fact, it comes into effect today, as and when the salaries start kicking in everyone's bank accounts. But overall, first we will slip into a short break, and then we will get you lots more on the other side. Please stay tuned to NDTV Profit.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,000.
Welcome back to India Market Close. Let's quickly pull up Vedanta on your screens. The numbers have just come in, and it seems that the numbers have mid-street estimates overall. If you see in terms of the EBITDA, 11,466 is what the number has come in at. The expectation was around 12,356, so a miss coming in on that front. In terms of the margins as well, the overall expectation was 31.2%. That margin number has come in at somewhere in that 28 kind of a range. The versus was around 28.8, so that is also a miss. Revenue at 40,455. That number is a beat because overall the revenue number expected was 39,600 odd crores. So these are the key numbers that we are watching out for. But Mika, If you see in terms of the initial numbers, it seems that the numbers have met street estimates.
So if you look at your net revenue, they've, it's a slight marginal miss. Net revenue is up 4% at 39,115 crores versus the estimate of 39,500 odd crores. EBITDA has also seen a very marginal uptick of 3.3%, 11,100 odd levels versus the expectation of the street of over 12,300 crores. In terms of margins, they remain very flat on a Q-on-Q basis. The expectation was some marginal improvement at 31%. However, it's come in at 28.4%, and net profit is down at around 3,500 crores, and it's fairly in line with estimates. Higher material costs as well as power and fuel costs, which saw an uptick on a quarter-on-quarter basis, was what impacted the EBITDA. In terms of your segment-wise revenue, zinc and lead, it was up 4% in the India operations at over 7,000 crores. Silver was up 15%. These are largely what Hindustan Zinc numbers that had come in, and we'll get you more details once we get them.
Okay, thanks so much for that context, Mihika, with regard to Vedanta's numbers. Not doing much in terms of stock price action. A little bit of volatility over the last few minutes, but largely in the green nonetheless. But let's go across to our segment Heard on the Street very quickly. Soumi joining us with all that's happening in dealing rooms. Soumi, the one thing that's changed today versus the last couple of trading sessions is the breadth has turned unfavorable to a certain extent. Small cap seeing a bit of pressure today. What are you hearing from dealing rooms, and what's the sentiment like?
Well, it's the geopolitical tensions that is what has worried the street again, that we had seen couple of days back. So that's the only reason why people are not carrying any long trades, because it's a holiday tomorrow.
Sure. Yes.
So
that makes sense.
Yeah, right. It makes sense for them, yeah. So, yeah. But yeah, stock specific, if you look at it's PNB Housing, which has been buzzing in street, and dealers indicate that Carlyle Group has appointed bankers to sell its stake in PNB Housing. Now, Carlyle owns close to 10.4% stake in PNB Housing under the name of Quality Investments, and it might as well be a clean out trade. That is what the dealers are indicating. So if it's a clean out trade, it could well be positive for the stock. But if it's not a clean out trade, then again the overhang would remain on PNB Housing. When it comes to Axis Bank, recently the bank in its board meet, where it also announced its earnings, had approved a fundraise of close to 20,000 crore rupees. Now, dealers are indicating that the bank might launch its QIP anytime soon in next week. That's what the dealers are indicating. When it comes to Dr. Reddy and Divi's Lab, there's a positional trade that large HNIs are playing out. They are selling Dr. Reddy and buying Divi's Lab. So keep an eye out for both these counters in pharma names. And in Kotak Mahindra Bank, the share price of Kotak Mahindra Bank so far was standing out, given the fact that it was outperforming the Nifty Bank Index. At one point of time, Kotak Mahindra Bank was up more than 1.5%. Right now, it's just up 0.3%. Dealers are indicating that there are sell flows on DI desk when it comes to Kotak Mahindra Bank. And lastly, it's JSPL. Now, dealers are indicating that large HNIs have started to accumulate this counter at lower levels ahead of its Q4 numbers, on anticipation that a positive announcement related to a mine opening might come in along with the Q4 numbers. So keep an eye out for JSPL as well in trade.
I think, thanks Somit for this. Stay with us, but PNB is an interesting one over here. I think you did a KYC Harsh on PNB as well, and what stood out for me is, in terms of the valuation perspective, way cheaper. If you see in the last 1 month as well, almost I think a 25 to 30% is the kind of up move that you've seen on the counter. Right? With all of that said and done, do you think an exit for a Carlyle at this point in time is the best way forward in terms of valuations?
Well, frankly, Hiral, I don't know what the constraints are. Maybe they are closing a fund, and maybe they have to return investor money.
Multiple reasons.
So some of these can be business reasons rather than just from a return perspective.
But no, from a business perspective.
From a business perspective, I think that it looks like a very solid business. We'd given it a 6.5 on 8 on our KYC ratings, and therefore from a business perspective, it looks good. The outlook also is extremely good. They're looking at a 20% growth over the next 2 years. By the time they reach the 1 lakh crore in AUM by FY27, 40% of their book will be higher yielding, and therefore margins will go up from 3.7 to 4.1%. That margin uptick, with no significant credit cost reflecting in the numbers that they are anticipating. They are anticipating just a 0.25% of credit cost, 0.25%, so 25 bips, which is extremely low. If that's the anticipation, they'll probably continue to do the ROA of 2.6%. And given that it's valued at just 1.6, it surely looks, or rather 1.49 at this point, which is trailing 12 months. 1 year forward is even more reasonable. You look at it from that perspective, it makes a very solid case in that sense for a 20% growth franchise to be valued, housing finance franchise to be valued at that
Maybe
level.
it's valued cheap because of this overhang that has been there, because Carlyle has been continuously selling its stake.
It's very possibly that, and we had highlighted that. In fact, that was one of the reasons why we didn't give it a full 7. It would have otherwise got a 7 because of this overhang with regard to PE selling. So we had to give the shareholding pattern a neutral. But Aditya Shah Kushbora joining us. Aditya, you track lenders closely. Would PNB Housing feature on your list?
Particularly not to Harsh. Okay. As you have clearly pointed out that there's an overhang of a PE seller, and the other promoter within PNB Housing Finance is the PSU Bank, and as we already know, these companies never tend to progress generally. We've seen LIC Housing Finance languish at the price at which it was for about 5 to 10 years. Nothing has happened. So in my perspective, even though the metrics look really good, purely from a promoter perspective, I tend to avoid this trend.
Right. So that's with regards to your housing finance names. Two of the other names that I want to pick up from the banking space is Axis Bank, from what Somit was mentioning, as well as a Kotak Mahindra Bank. And, overall, Axis is what you're talking about, a fundraise, probable QIP on the cards. Kotak, there are sell flows on the DII desk at higher levels. Kush, what are charts indicating what both these names?
Hi, Hiren. Well, I think as far as the banking names go, I think they are starting to find some sort of a base or some sort of supports, but the momentum seems to be missing. Now it could be owing to a couple of factors. Now, as far as both these names go, I think Axis for me has a slight edge over Kotak in terms of the kind of momentum, kind of run that it's had, the kind of volume that it's had in the last couple of sessions. Also, it's consolidated, but with a positive bias. Kotak's largely been in a broad, in a tight range rather. So if you were to pick one of the two, I would pick, Axis Bank for higher levels of 1235, 1270, also with a stop loss around the 1160, 1150 zone. Kotak, perhaps, after the seller run that is given in this calendar year, could go sideways. It has a tendency of consolidating for, rather long periods. So if I were to pick one of the two, it will be Axis over Kotak.
Interesting, Axis over Kotak. Kush, I'm going to ask you a couple of questions before I go back to Aditya. So first one being, how are you looking at the Nifty and the Bank Nifty at this point? What are levels you're tracking?
Hi, Harsh.
Hi,
so,
good afternoon.
The positive view on Nifty, Bank Nifty remains. And, even yesterday in the closing show, you, me, Hiral, we were discussing how the 24,350 mark is, a bit of a stiff one. Has proven to be the same today as well. If you look at the options data for the monthly expiry today on Nifty, being a 50 multiple and not a 100 multiple, the congestion on the call and the put side is very high on the 24,350 call and put. So that is suggesting that perhaps the expiry could be somewhere there about give or take 50 points. So I think this consolidation could go on. I did listen to you and Somit also speak about how the geopolitics is perhaps playing on investors' mind. It is starting to show in the data as well, in the sense that you're looking at a negative divergence on the daily charts for the Nifty. I would love to attribute this to the monthly expiry pressure, and hence not read too much into it just yet, and maintain my view that 24,800, 24,600, 24,800 levels on the Nifty are still intact. So I'll go by that view unless the data changes for the worse in the coming days. But just to point out that yes, there is indeed a negative divergence on the Nifty popping up early days, but something to take note of. Bank Nifty, not so much of a worry, in terms of where it's going, except that the 56,000 level has proven to be a bit of a resistance twice, and that's the level that it has to take out before it moves to those 56,400, 57,200 kind of levels on the upside. So this is a positive consolidation and a healthy one for Bank Nifty. I remain slightly more bullish on the Bank Nifty than the Nifty.
Interesting. Kush, your picks for this afternoon?
With a slight caution, in my tone, I'm going with a long and a short. The long is on CSB Bank. We've seen the stock do rather well, over the last month and a half, 2 months. Now it's consolidating, but if you see the volumes, there's very clear. There are very clear signs of accumulation happening in this stock. The stock trading in the range, but the volumes have picked up. So for a near-term target, if someone wants to play, then 365, 375 are your levels. 345 is where you place that stop loss. But a positional bet could see the stock moving higher as well. I've got a sell call today, and that is on Voltas. We've seen the stock underperform. I had a sell call a couple of days ago. Also, the stock actually gained some ground. But now, if you see it starting to give up all those gains, trading close to the low point of the day with a marginal uptick in volume. So I think 1220, 1200 are your targets on the downside. 1255 is a stop loss. It's not a bad idea to keep a short position also in the portfolio in volatile times like these.
That's with regards to Voltas and your top picks. Kush, very quickly, your view in terms of Vedanta, because as soon as the numbers have come initially, it was pretty much flat, no major moves coming in there. But right now, you are seeing that little bit of a spike that's come in on the counter. What are charts indicating? Because again, last 1 month, it's down almost 9 to 10%.
It is, but if you perhaps shorten the data or the time frame a little bit, let's say about 15 odd sessions, and the stocks actually revived quite smartly from those 360 levels all the way up until 430. Now what's happened in the last 5 sessions is that it's gotten into a range which is 410 on the downside and 430. I'm just rounding it off, 428 actually. So 410 and 430, and right now it's bang in the middle of that range. So for me, this is a bit of a range play. Given the uptick in the volumes, on the day that the stocks closed higher, suggesting some delivery markup, I would actually err on the side of, the bulls, which is keep a stop loss just under that 410 mark. So 405 could be your stop loss. And you could perhaps play a long trade on this one for targets of 435 and 450. This is a positional call, mind you. So this is a good consolidation for last 3 to 5 sessions. After a big up move of 10-15 sessions, I think I'll take this positively for Vedanta at the moment.
Right. And Aditya, what are fundamental views indicating with regards to a Vedanta? Because you're talking about the demerger there, plus the way the numbers have come out. What would you advise?
At the moment, I would be very careful on the commodity side of the business because we're already seeing Donald Trump playing around with tariffs, and China and US are at it. Until and unless there's a deal between China and US, any deal between any country of the world with the US does not really matter. China is a big player in the commodity market, and in the commodity market, it will tend to hold back the prices if it does not have a deal with the US. So I tend to be very, very careful on stocks like Vedanta or any metal stock per se, where valuations are really very expensive and Trump holds the key to what is going on.
Okay. All right. Let's quickly move on. Stock of the day, Vishal Mega Mart, stock buzzing in trade, and strong Q4 numbers overall. Mahima is here to break down the numbers and why the stock is buzzing. Mahima.
Right. So definitely a great quarter for Vishal Mega Mart once again. It's been a great year, in fact, for the tier 2, tier 3 retailers. In terms of the numbers for Vishal Mega Mart for Q4, the overall revenue was up 23 odd %, EBITDA up 43 odd %, margins improved by 193 basis points, and net profit saw a significant jump of almost 88%. Now, what has worked exactly? Couple of things. High share of private label products have overall contributed largely to the top line and also to the margins and profitability. Lean cost structure is helping aid margins. Efficient supply chain is also something that is kind of increasing the profitability, and high loyal customer base is what is aiding the top line. In terms of overall top line growth, this was led by a strong same-store sales growth. It came at around 13.4% this quarter. Rural demand recovery overall in FY25 has been great, and because Vishal Mega Mart's presence is there in tier 2 and tier 3 cities, it is helping in terms of its top line growth. Even the preponement of festive demand of Eid as well as Ugadi has helped the overall revenue growth because for Vishal Mega Mart, there is more concentration of stores in the south. Own brands revenue also overall contribution increased to around 73% from 71% mark. In terms of store additions, they expanded their retail footprint by 85 odd stores. The total store count now stands at around 696 stores and presence over 458 cities. The average store size, however, was still steady at 17.5 lakh square feet, 17.5 thousand square feet. In terms of margin expansion, this was on account of couple of reasons. Strong private label traction, one thing. Improved category mix is something that has also aided the margins, and overall better sourcing efficiencies and supply chain improvement have also aided the margins. Lastly, in terms of profit growth, that was led by overall improvement in cost efficiencies as well as operating leverage. And of course, there was also an overall jump in their other income, which has also aided the profit, which was around at 18.6 crores, which is versus that of 17 crores. So other income has more than doubled for the company. So this is the overall reason as to why the stock has seen significant amount of gains today, and how, of course, Q4 has panned out for something like a Vishal Mega Mart.
Interesting one. Vishal Mega Mart, if you just pull up the stock, thank you, but Mahima, for getting us the details as well. 10% up move. And with this, let's pull up a Go Fashion on your screens as well. 52% uptake in terms of profitability. The margin has improved and come in at 30.5% versus a 29.7%. And that stock is also seeing gains of a little over 2%, 10%. So both these counters is what I want to talk to Kush and Aditya about. But before that, let's quickly address IOC numbers that are flashing at the bottom of your screen. Overall, in terms of the profit number, 7,265 crores is what you're looking at in terms of IOC. We were expecting a number of, I think there is some change on that one, but that's an interesting number that you're looking at in terms of the profit. Revenue has seen a growth of around 0.6% at 1.95 lakh crores. So that is a slight miss in terms of what the street was estimating. The profit number is an interesting one because 1,646 crore was the expectation, and that number has come in at little over 7,000 odd crores. Margins were expected at around 3.5%. Let's quickly see what the margin profile looks like, and let's just pull up this chart. There you go. It's seeing a clear spike in terms of the stock price in terms of IOC, 2.8 to 2.9%. I think it'll be interesting if we can get Somit on the show as well, producers, to give us as to what has happened, because from a 1650 crore expectation in terms of the profit number, it's over 7,000 odd crores in terms of profitability. So what has worked is what we need to understand. 13,572 is the EBITDA number versus an expectation of 6,755. So a strong jump coming in there. Margins have improved substantially versus what the street was estimating as well. Aditya, your quick view firstly in terms of IOC, because numbers are way better than what the street was estimating.
Yeah, numbers are good, but the broad sense is the HPCL divestment is the big trigger for IOC, BPCL, and HPCL itself. Until and unless the government does not does not sell off HPCL, there will not be a good re-rating on IOCL. IOCL is good from the perspective of dividends. The results are really very good. But then again, the upside is really capped with respect to the divestment that the government really needs to.
Okay. Kush, what would you advise in terms of charts on a IOC?
Yeah, I think I have to agree with Aditya on this one. The upside seems capped at the current level of about 140, because that's been the resistance for the last 6-7 sessions. If you see the call congestion also very heavily concentrated at the 140 mark. Plus, it's got multiple resistances, 143 as a 200-day moving average, 145 the next level of call congestion. So yeah, if you do have it from lower levels, you might want to consider booking some profits and exiting, at the current juncture. I wouldn't advise any fresh positions given it's facing a couple of resistance points, going forward.
Fresh positions is the word coming in from Kush, but I think what we should be awaiting is the total GRM number for this quarter, because that is something that will tell you as to why this stock is seeing these kind of gains on a sequential basis. So around, if I'm not mistaken, $2 or $3 per barrel is what it was in the previous quarter. If you have to look on a quarter-on-quarter basis, what the number looks like in this quarter is what we have to see. But clearly, EBITDA, margins and profitability, a clear beat coming in there, but the HPCL bit is a major overhang, as Aditya was mentioning. Let's just pull up a HPCL, BPCL also on the screens and see what those stocks are doing in trade. And we have now Somit who's joining in. Somit, interesting set of numbers from our IOC, because first I thought it's an error that I'm reading in terms of the profit number. 1650 was around the expectation. We are way below above that.
Well, yes, in fact, it has not actually come as a surprise to the street because the stock was up 2% and it's remaining at that level, and that is the reason behind this is yesterday BPCL also reported similar kind of a beat. Now, this beat has come in on the refining front. The street was estimating a lower refining margin given the fact that Singapore gross refining margin on a sequential basis well lower. From $5 it had dropped to $3, but BPCL yesterday reported refining margins of $9.3, and something similar was street was expecting from IOCL as well. And yes, the beat has come in on the refining front for IOCL as well. Yet to get the GRM number, but it must be on the refining front, and also there would have been some inventory gains for IOCL in the fourth quarter of FY25. Marketing segment could have been weaker on a sequential basis, but it's the clear beat that has come in on the refining front and on the inventory front, which has led to this solid state of numbers. Street was estimating, I guess, the EBITDA number to be close to 6,755, and the company has reported an EBITDA of close to 13,500 crore. We are yet to get the breakdown of these numbers, but yes, a clear beat on the refining front has led to this solid set of numbers coming in from IOCL.
Okay, so that's the take coming in from IOCL. Thanks so much for that, Somit, for putting that into context. But we'll shift focus, eye on the globe. We have David Morrison, Senior Market Analyst, Trade Nation, joining us this afternoon. You know, Hiral and David, you know, there's been plenty of FII interest in India of late. The last 10 trading sessions, we've seen $4 billion of FII inflow. What's changed, in your opinion, David, with regard to India?
I think it's the first inkling that President Trump has blinked, really, in terms of his tariff escalation, tariff war, trade war against China, but you know, tariffs against other countries. The fact that he has backed down, and there's still very much, although there's a little bit of confusion going on, and I think that's quite deliberate as far as the Trump administration is concerned, they are broadly hinting that negotiations have taken place. And it's India that really is in the spotlight on that. Although there's also talk about some deals being done with Japan and the European Union, it does look like India is first up on this. And I think that's really why there's so much interest now and so much more flow going in that direction.
Okay. So if you're seeing that kind of flow that's coming into Indian equities, which are the sectors that the European FIs are betting big on?
Well, I suppose it's really anything where China has been the main provider of these things. So, I mean, I think that's the other thing, really, that Europe and other importers are now looking for alternatives to China, very much so. They also realize that the Trump administration has its eyes on countries like Vietnam and other near neighbors of China in terms of sort of they are aware that these are areas which have been not just competition to Chinese manufacturing, but also places where relabeling has gone on as well in an effort to avoid the threat of tariffs, which has been around for quite some while. So I think that's the thing, really. It's thinking, where are the danger areas? Where could we have a problem sourcing certain materials and parts and whatever? And then that's where the money's going. I feel that's really the situation.
So when you talk about the India and European Union free trade agreement, talks are ongoing. Next round is again in May 2nd week. Taking that into consideration, anything that you would put your bets on?
Well, I tend to look at a sort of the more general outlook. And I was just thinking about sort of how markets have moved really since, well, not just since the Liberation Day imposition of all the reciprocal tariffs from the Trump administration, but then, of course, the fact that Trump backed down very quickly, just about a week later. And we're now in a situation where there's a postponement for 90 days. And bear in mind, we're more or less a third through that already, but we still have a blanket 10% tariff on goods. And of course, China has this enormous 145% tariffs on its exports to the US. And of course, on the other side, China has imposed 125% on the US. So what I think the problem is, I think that the markets have reacted very, very positively to this backtracking by the Trump administration on tariffs, and also the fact that President Trump's attack on Fed Chair Jerome Powell has been dampened down. He has backed away from that, and they've reacted accordingly. We've seen markets, stock markets going from being very oversold now to much more neutral levels. But an awful lot of good news, I think, is getting priced in by the US stock markets in general, and it wouldn't take much for markets to take a bit of a hit, just a little bit of disappointing news. Bear in mind, as far as the US is concerned, we've got some very big tech companies reporting tonight and tomorrow. And we've also got some very important data with advanced GDP, core PCE, the Fed's preferred inflation measure, and then, of course, on Friday, non-farm payrolls. So I think that I could see that there are certain markets, such as the US dollar, which is very oversold and is now having a little bit of a bounce against everything. US stock markets, which were very oversold, but are now having a bit of a bounce and are back to more reasonable levels. And now there's a sort of consolidation going on as traders, investors sit back and really are waiting for news flow, whether it be on tariffs and trade, or whether it be on tech earnings and indeed US economic data.
David, just taking a step back here, markets more or less globally have done fairly well despite the amount of uncertainty that has gripped, economies globally. Now, in that sense, how do you look at valuations given that bond yields are holding quite steady when you're looking at it over the last month or so, which is pre-Liberation Day and current? How do you therefore assess valuations globally?
Well, I think there are certainly areas outside of the US which are very fairly, if not very attractively valued. And I think there's certainly been a switch in emphasis for investors to maybe turn away and sort of put aside the idea of US exceptionalism, which was certainly the story of the sort of the last half of last year, and really saying, well, there is no alternative. You have to be invested in US and forget about the rest, really. Now, that situation has really turned around on its head. Yes, the valuations for the big tech, the Magnificent Seven US stocks have come down. They come down perhaps quite dramatically in some respects, but they're still not particularly cheap. They're not, in fact, they're nowhere near being cheap. They're still very expensive. And yet there are certainly areas, there are certainly stock markets around the world, India included. The UK is a little bit undervalued when you consider the composition of the FTSE 100. It's certainly a sort of an alternative to the tech-driven stocks that tech-driven indices in the US. So I think that's what investors are doing now. They have sort of reduced their exposure to the US and to US tech in particular, not hugely, but by a significant amount, and are looking for sort of better valuations elsewhere. And I'd just like to say one thing, if I may, and that is that the Dow Jones Industrial Average may be down about 10% or so from its last peak. The Dow Jones Transportation Average is down around 24% at the moment from its November high. And I think that is actually quite a danger signal for markets in terms of how much damage the tariff escalation and the trade war has done already, despite the fact that it's only, less than a month old.
Right, David. Very interesting times and very volatile as well. So always good having your view. Thanks for coming in and speaking with us. But
thank you so much.
What we're going to do, thanks, David. What we're going to do is we're going to slip into a very short break. We have a packed show, of course. On the other side, we'll give you the bull versus bear view with regard to our Bajaj Finance and more. So stay tuned.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
Welcome back. You're watching India Market Close. We'll take it straight to the bull versus bear on a big buzzer on the Nifty 50. 5% lower on Bajaj Finance. Let's try and break this down a little bit better. Now, in terms of the AUM growth guidance, it's achieved the guidance. 26 to 28% was the guidance band. They've achieved it. That's the bull case. They continue to achieve whatever they really guide for. And that's the one big positive when it comes to Bajaj Finance. The bear case, the FY26 loan growth guidance is tapered down. 24 to 25% is the loan growth guidance. If they do that, great. But is there a further downward bias to that growth number? We'll have to wait and watch for another quarter or two, and what is the kind of guidance that comes through on that count. Credit costs are better than industry for sure. We've seen pressure with regard to unsecured lending across the board. Bajaj Finance has come out relatively unscathed. 2.05 to 2.1% credit cost in this kind of an environment is not bad at all. But they continue to remain elevated. 1.85 to 1.95 is the band that they've guided for with regard to where FY26 is concerned. Again, could there be upside bias or rather downside bias to that? Well, you could well say that there is that risk. When you're looking at what was expected or what is expected FY26, you are expecting profit growth of 25%. Plenty of levers to take care of that, including credit cost. But what you are seeing is an ROA and ROE taper with regard to the guidance. The guidance has always been 4.6 to 4.8%. Now they widened the band and reduced the guidance. So 4.3 to 4.7% on the ROE metric versus 4.6 to 4.8, and on the ROE from 21 to 23 they've now guided lower for 19 to 21. So that kind of impacting the bear case situation. Let's look at valuations. It's well below the 5-year average. 6.2 times price to book is the 5-year average as per Bloomberg, versus 4.7 times is the current 1-year forward price to book value. So well in terms of the discount, but lower growth, lower ROA, lower ROE. With all of that, would you give a larger discount to that 5-year average price to book is really the question. But whatever it is, we are seeing a 5% lower on Bajaj Finance. Hiral.
Absolutely, a 5% pressure. 5% downtick coming in on a Bajaj Finance, I beg your pardon, and you have a FinServ also, which is seeing a counter impact. Let me also welcome in Vineet Bulinchkar, Head of Research at Ventura Securities, and we have Kush Bora, who stays with us as well on the channel right now. But Vineet, your quick view in terms of the Bajaj twins firstly.
So with respect to Bajaj Finance, I was not really perturbed by the lower guidance because, as your base keeps expanding, your the growth percentage will obviously come down. You can't keep growing infinitely at 25+%. Having said that, the disappointing was the fact that they've lowered their ROE and ROA guidance, and that is where the sell-off is happening. So that is a cause for worry, and so there would be downgrades on this. And I expect that over a period of time, the price would adjust to around 83-8400 levels.
Okay.
How would you look at it, Kush, from a technical perspective?
So Harsh, I think I'll wait and watch on this one. The reason being that ever since mid when the stock hit about 8600 for the first time after a while, there have been actually 3 legs of negative divergences. Although the stock went on another 1000 points from there, hit 9600, and now is seeing a bit of a correction. I think all of these negative divergences over the course of 2-3 months is now adding up. If you see today, of course, we know the news, we know the numbers. On the back of that, the stock is slipping lower. It's also broken the 50-day moving average, which stands near the 8700 mark. Support is close to the 8400 mark at first, and then about 8250. So if it does come to those levels and does look like it's holding ground, perhaps I might consider. At the moment, I'll perhaps just wait and watch. Let this dust settle and see whether stock actually finds a feet here and revives. Otherwise, it could, as I said, slip lower to 8400, 8250 as well.
Got it. Vineet, let me come back to you with regard to some of the other financials. There were developments with regard to an IndusInd as well. And even in terms of how Bajaj Finance is valued at this point, it's sub 5 times, not too many times that we've seen that kind of a valuation on Bajaj Finance. You want to elaborate on what kind of upside you see on this one, and because you clearly see it as an opportunity to buy?
Yeah, so see, we've got some negative headwinds in terms of what is happening on the border. Macro things will turn a little bit sour. But today, as the consumer benefits start kicking in of the lowering interest rates, the liquidity splurge, and also the fact that we have the income tax cuts that have come in, we will see growth kind of continue. So when you're guiding for 25-26% growth, I think when the price adjustment happens, then it just continues on ahead. I'm not very pessimistic on this stock. I think it's one of the best stocks to have in your portfolio in terms of the financials, and we continue to believe in that.
In terms of IndusInd Bank from a business perspective, but let's shift focus to tire companies. You have CEAT, which is gaining in trade, and this is despite delivering a poor set of growth metrics in the fourth quarter. It looks like the street had expected much worse. We spoke to Arnab Banerjee, the MD and CEO of CEAT. Let's quickly listen into that conversation. The stock is at the day's highs with gains of over 9%.
Margins have improved for sure in Q4, so there's been an uptick. Talk to us about raw material pricing and the pricing of finished product and what's really leading to that margin uptick.
If you break down raw material into 2 major buckets, which is crude based, crude Q4 and Q3 was pretty flat, and Q1 onwards it is going to go soft. It is going soft already. So crude based materials such as synthetic rubber, synthetic fiber, carbon black, etc. are going to come off their peaks. The natural rubber is fairly steady. Even now, domestic prices are about 195 to 200, and international prices have been coming off. So they have come down to about $1,700 per ton. So on the natural rubber side, we yet to see softening. Overall, what it means is that we have had a flat Q4 over Q3 in terms of raw material prices, just about less than 1% drop. Similar trend will be there in Q1 over Q2. So very small drop, broadly flat, and we expect a significant drop in Q2. So that's the outlook as of now.
Right. So that's with regards to CEAT. Let's also pull up a Excite on the screens, because overall, if you see in terms of the numbers, there is some bit of muted move coming in there. The stock is now seeing cuts of almost 4.5-5%, and they've clearly indicated that there have been some bit of challenges in few of the segments, specifically with regards to lower demand. They're expanding. Capex has been lower, and this is mainly on the back of tough market conditions. However, they're expecting an improvement in the demand scenario from here on. and they will continue to drive sales and achieve cost efficiencies, because if you see the margin number, that has come in at 11.2% versus a 12.9%, so a downtick on that front. In terms of your profits also, they've dropped by around 10%, and similar is the kind of cuts on the EBITDA. Kush, let me come to you. Exide as well as CEAT. Auto ancillaries, two different reactions. What are charts indicating?
Two different stories, different directions. They're moving in. Let me start with CEAT first. A very stellar move on this one, and has been going on for the last 4 weeks now. In fact, on a weekly basis, if you see, the 30 to 75 mark was a stiff resistance for the last about 8 to 9 odd months, ever since mid-September. So on a weekly basis, if it does close above this level, then this is going to be a breakout very clearly. I think this move could well continue higher for levels of about 3420 and 3500 as well. Although it's a big move, but with the kind of setup that we're looking at, there's a good possibility that this could well extend. Trailing stop loss for this one, or a stop loss for this one, if you want to initiate a fresh, is at 3250 mark. Exide, on the other hand, is a very different story. This is one of those stocks which has which has attempted a recovery but has fizzled out, and it's not just today. It's been the case for the last week, about week and a half or so. In fact, the entire space is seeing a short build up over the last few sessions. Even Amara Raja, if you see, has actually seen cuts and trading at the low point of the day. So I would actually consider going fresh short on Exide for levels of about 346 and 340, with a stop loss around the 360 mark. So Exide has had a fairly decent run, but as I said, has failed to take out key resistance levels and becomes a short candidate again.
Very interesting. Now, the other one that's expected to declare numbers is Zomato, or what's now called Eternal. They're expected to deliver a strong quarter this time around. My colleague Mahima is here to tell us what we can expect from Eternal's fourth quarter numbers.
Right, so in terms of Q4 for Eternal, revenue growth might be on a strong footing, but overall PAT is going to see a significant downtick, and a sharp decline will be on the back of a significant amount of dark store additions. In terms of how numbers will fare QOQ revenue is expected to see a growth of 7%, EBITDA is expected to fall around 37%, margins expected to fall to around 1.7% versus that of 3% earlier, and net profit may fall around 29%, but year on year picture, revenue is expected to rise around 63%, EBITDA is expected to rise around 18%, margins expected to fall to 1.7% versus that of 2.4%, and net profit may see a significant downtick of around 76%. In terms of what to expect, of course, first thing, significant dark store expansion to weigh on overall profitability as well as margins. Food delivery gross order value to further decline because of the competition coming in from various quick commerce as well as food delivery players. Adjusted EBITDA to further deteriorate for quick commerce. Losses in quick commerce to extend because of dark store additions. The district business might see a revenue growth because this time a lot of concerts have been exclusive only with district. Some IPL matches have also been only exclusive with district. Hyperpop business might also see a good growth this quarter. In terms of key monitorables, the first thing, execution of how additional dark store will take place. Secondly, how execution of 10-minute deliveries that they announced last quarter is taking place. Competition landscape, of course, the commentary coming in terms of competition, especially in the quick commerce space. Performance of district, management commentary on that. And lastly, contribution of Hyperpure and district to the overall revenues of Zomato. So all of these things will be the key monitorables, and so overall in terms of Eternal, strong revenue growth for sure, but profits will decline on a significant footing. So this is the overall view of what you can expect of Eternal's Q4 numbers.
Thank you so much, Mahima, for getting us the details. So that's going to be a stock we should be watching out for in today's session. And just a quick update in terms of Ather as well. The IPO has been fully subscribed as we speak right now. But let's quickly slip into a short break. We will talk about all of these stocks with our guests, Vineet and Kush.
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments?
You have Adani Power's numbers flashing at the bottom of your screen. You're seeing revenue up around 7%ish, maybe 6.5 odd percent. 14,237 crore versus the 13,300 crore number. EBITDA flat at 4,800 crore. And what you're seeing in terms of margins is a slight bit of downtick, given that top line expanded and EBITDA hasn't or has remained flat. 34 odd percent is where the margin numbers come in at. And then you have profit after tax, which is coming at 2,637 crore versus the 2,737 crore number same time last year. So that's how the numbers are stacking up with regard to an Adani Power, seeing a bit of a downtick on the stock as well on the back of those numbers. But let's quickly look at Eternal, because we were discussing that. Vineet, just want to understand from you, how do you view Eternal and the Zomato and the Blinkit business moreover, because that's the mainstay at this point, which is driving growth. There's also competition coming in. It's a volatile environment with regard to these businesses. How do you view them, and would you at all turn positive at some point with regard to an Eternal?
So, we were earlier very positive, but, the Blinkit business is not scaling up as how we like it to happen. So the AOVs are, as they go into tier 2, tier 3 towns, they're going to kind of come down, so that will compensate for the growth. Second is district is doing well and will continue to do well. So, but we need to see how better it can get from here. So keeping that in mind, I still think that, there's a little bit of a 10 to 15% downside on the stock as we go into the results from here.
10 to 12% downside on this stock. Kush, Zomato and Swiggy, anything that comes to your radar ahead of the numbers?
No, it's a wait and watch. Swiggy hasn't really done all that great, price action wise. It's actually testing the recent lows near the 300, 308 mark. Plus the volumes on the way down are actually picking up. So that's not a very encouraging setup at all. But speaking about Eternal, we've spoken about a range on Eternal for a couple of times now, which is 240 on the upside and about 200 on the downside. It's now trading close to that upper end of the range. If the numbers do come out positive and the range is taken out, then perhaps you could see move towards the 255 to 70 zones. After about a 3.5, 4 months of consolidation. If it doesn't, then this resistance will start acting up again, and it could again slip lower to 220 odd levels, perhaps even lower as well. So for me, it's a range play right now. I wouldn't buy because it's closer to the upper end of the range. Perhaps a little lower would have made sense. The risk reward ratio would have been favorable, but not at the moment.
Okay. And Kush, while we're at it, what's your BTST STBT call? We have a holiday tomorrow. What's the sense?
Still driving a BTST, Harsh. So Naveen Fluorine, we've had a good run on this stock. It's resisting around this 45 or 20 odd zones, but just barely by the skin of its teeth, holding above it. The overall structure is positive, but what I take heart from the fact is that it's not really swung too much, with the vagaries and the volatility of the market. the volumes on the way up have been fairly decent. So from a positional standpoint as well, or a BTSC standpoint, you could consider long positions on Navin Fluorine with targets of 45.80 and 47.10, with 43.20 being his stop loss.
Okay, so that's with regards to Navin Fluorine. Let's quickly look at the auto sector. Now, amid the global uncertainty and the Trump tariff tantrums, auto remains a key sector to watch, and that is why the April auto sales numbers are going to be very important. Let's bring in Puneet to tell us what could be on the cards. Puneet, over to you.
Well, thanks for that. It's going to be the first month of FY26, and it's going to be very interesting because we are seeing within segments there are companies that are underperforming in this particular month. Like, for example, in the two-wheeler space, we're expecting almost a 13% drop in sales for something like a Hero MotoCorp on a year-on-year basis. And that is one of the key negatives because we've seen domestic motorcycle market slow down. This is going to affect Bajaj Auto as well. On the other hand, TVS is expected to report the highest growth led by scooter sales as well as a buoyant export market for the company. And Eicher expected to report low single-digit growth, but the growth nonetheless. In terms of passenger cars as well, M&M is continuing its march on from the last year. Again, a 15% growth anticipated for something like a Mahindra and Mahindra. The key result, they are also expected to report its results on 5th May. So some update on the electric vehicle space will be something to watch out for. But in terms of April sales, is going to be is going to report a highest growth again. For Maruti, it's going to be industry growth of 3 to 4%, while a decline of Tata Motors and Hyundai is expected, led by higher discounts as well. But SUVs will drive the growth again in passenger vehicles. In terms of commercial vehicles, it's going to be a slightly subdued month, but we are seeing outperformance in something like a VECV, which is the commercial vehicle arm of Eicher Motors, while Tata Motors is expected to report a decline, again continuing its trend from the previous year. We've seen e-bill generations a little higher, and fleet utilization has also been higher, which is an encouraging sign, but still not reflective in the sales numbers. And finally, on tractors, low growth essentially in this particular month, and that's largely because the Gudi Padwa month got shifted from April to March in this particular year. Last year it was in April, so the growth will be lower, but it's still expected to show growth for both Escorts as well as Mahindra. So the three big winners in this particular month will be TVS, Eicher as well as M&M, while on the loser side, Hero MotoCorp will be the biggest one to watch out for in terms of sales as well as momentum going forward.
Okay, thanks so much for that, Puneet. Now, Kush, very quick take with regard to a Maruti, stock up 3.3%. Just trying to understand how much of this is technical.
Quite a bit, it seems like, because the stock was actually seeing a bit of pressure. The resistances were around the 12,000 mark. It took support near the 200-day and the 20-day moving average convergence around the 650 zone, and it's now given this breakout. So I think this momentum could well continue, and it's been a while coming. For a while now, it's had that 12,100 level as a resistance zone. Clear past that on the back of good volumes. Weekly setup also looking encouraging. So I think on the way up, you could still gun for levels of 12,500 and about 12,800. Now this resistance zone of 12,000 will start acting as a support zone. So a good breakout, volume backed, and as I said, it's coming after a bit of a consolidation. So could well continue for higher levels.
Some of these life insurers, Kush, and HDFC Life, SBI Life, both of them seeing good upticks in trade today.
We've seen traction in some of these names, but hasn't really been a one-way ride, and which is actually a good thing if you ask me. It's not been that kind of a move where it's been a vertical up move. It, especially if you consider something like an HDFC Life, it had 5-6 sessions of negative close, and in the last 2-3 sessions it started to bump up. At the moment, it just seems a little overheated, so I'll be more comfortable buying it at declines close to the 730, 725 zones. Once again, if I get it closer to those levels, that's when it will become attractive. But from a medium-term perspective, it does look like a very strong setup. These stocks have paid their dues and are starting to move higher consistently. On the way up, don't rule out a move to 760, perhaps even a 785 kind of a level. So HDFC Life looking good. SBI Life has run up just far too much, far too quick, and far too high for my comfort. So I'll just wait and watch on this one. HDFC Life does look a little more steady compared to SBI Life.
Fair point. Vineet, your views with regard to life insurers? Anything changing?
No, bullish on HDFC Life. We see a 15% plus upside. SBI Life, we're still working on that. So once we complete our research, we'll get back to you.
Interesting. Three names that I want to talk to you about, Kush, is Reliance, HDFC Bank and TCS. Volumes absolutely heavy in terms of today's day of trade on all these three names. What should the strategy be?
I think all these, or rather, let me just restrict myself to HDFC Bank and Reliance. Both of these names are doing rather well. As you said, the volumes are also fairly decent. I would go out and accumulate some of these. Reliance perhaps might face a bit of a resistance around the 1400 mark, but once it crosses that, I think 1440, about 1475 are also in play. Support zone near the day's low, which also happens to be yesterday's low, which is about 1369 odd levels. So I think Reliance is gearing up for further up moves as well, after a longish bit of consolidation. Similar views on HDFC Bank. I've spoken a couple of times how in the private names, I like HDFC Bank and ICICI Bank, not in that order particularly, but yeah, I mean, these are the two that, I would prefer to stick to. Also, both of these provide you a fair degree of margin of safety in volatile times like these. Why not stick with the big names and have that cushion as well? TCS, not very comfortable. I still reserve my views on the IT space, despite having a decent amount of recovery in a lot of these names. But there could be some headwinds going forward from a technical standpoint. I think about 3,500 is the level to watch for. If it crosses that, then it might move higher. But I would rather look for shorting opportunities on TCS, Infosys, and Wipros of the world.
Right. Kush, quick one. Running out of time, Nifty expiry expectation would happen between 24,200 to 24,500. That's what it's seeming like. But on the downside, what is the level that needs to be protected? Because we're still watching out for 23,800 now.
Absolutely. You pinpoint 23,800 to 24,000. That's the zone that I have been maintaining for some time now. And that remains as a strong support zone for the Nifty going forward as well.
Okay, thank you gentlemen for coming in, speaking with us and giving us all of those views and perspectives. We'll let you go. It's about 30 seconds to close. Let's look at how markets are closing. Nifty closing at the day's low, 1/3% lower. It's been largely a range-bound day of trade except for that last-minute blip that we're seeing on the Nifty and the Bank Nifty. Let's pull up the intraday chart on the Nifty and we'll see that whether we are seeing a bit of a recovery or not, well, we'll have to wait and watch where we are closing in at. But 100 points lower on the Nifty day's low. Let's look at the Bank Nifty as well. Likely the same direction in that sense, but less accentuated, not as sharp as we're seeing on the Nifty. But that's the movement on the Nifty and the Bank Nifty. We've closed for the day. Let's look at the heat map. First off, they'll give us an indication of how the breadth has shaped up. Well, it's gotten worse as the day has gone by. Not unexpectedly, some of the winners have actually done better than what they were doing maybe an hour or so back. A Maruti, HDFC Life really standing out, along with an SBI Life. And HDFC Bank also up around 0.6% thereabouts. Let's pull up the contributors because the Bajaj Twins, Trent, Tata Motors, SBI are some of the key big losers. And those are also reflecting in terms of their contribution in terms of points. So some impact there visible with regard to the way those have played out. Let's look at the advanced decline and how the breadth has been, and it was worsening, in fact, by the minute, at least over the last hour or so, and it has. We started this last hour and a half of trade being 3:1 in favor of the bears, but we've closed in sharply lower. 354 advances to 1,860 declines, and that those last minute spikes that we're seeing on the advanced decline clearly reflecting what the markets have done. But it's also monthly expiry, weekly expiry, and therefore maybe that move may be justified to that extent. Let's look at the sectoral heat map as well. There you go. So Nifty Realty holding strong, Nifty Pharma outperformance evident. Outside of that, flat on the auto index, flat largely even on the oil and gas and the FMCG index. That's how at least those have played out. Nifty 50 is close flat as well. I'd want to have a look at that once before we close for India market close. Nifty PSU Bank is down 2% odd. And we are seeing defense seeing a bit of pressure as well today. Let's pull up the Nifty mid cap and small cap and let's see it intraday because that'll give us better perspective
there you go, day's low with regard to the Nifty mid cap 0.7%, but that last minute spike seen, Nifty small cap as well 1.8%, and that last minute spike seen. Let's pull up the Nifty 50 as well. Let's see how that one is settling in. Well, absolutely flat. So we saw that bit of the sharp steep fall, but we've closed in near the flat line. I want to pull up IT index as well. Let's see how that one has played out. There you go. Mirrors the Nifty 50. In fact, it's pretty much exactly how the Nifty 50 has done. So broadly, that's how it's playing out. 1/3% lower on the IT index as well. Last off, the BSE 500 top gainers, top losers. Some Nifty stocks will likely feature here, but within that basket of well-known stocks, CEAT definitely features. Within the Nifty 50, HDFC Life features. Maruti also up 3% odd, had a good day. In terms of the losers, you had a 5-star on the back of numbers. Bajaj Finserv Finance as well, largely along the same lines. On the back of numbers, UTI Asset was also on the back of numbers. A Shopper Stop was also, and Praj also impacted by numbers. So plenty of movers on the back of earnings, but that's how it's broadly played out. Cues for tomorrow, you'll have President Donald Trump speaking. You'll have the US mortgage numbers, you'll have US GDP growth rate, and US core PCE price index, which will come out. US initial jobless claims. Then you'll have some data from Japan and India's M3 money supply. You'll also have corporate actions in terms of specific companies, interim dividends, something to watch out for, but nothing material. You'll have KSB and ABB India as well in terms of their dividend payouts. Shares to exit lock-in, this will be a big one. Dr. Agarwal Healthcare, Afcons, also another big one. Deepak Builders, Honasa, Blue Jet also to be taken care of. Those are some earnings that you'll want to focus in on between tomorrow and day after. Mind you, tomorrow's a holiday, so we'll see you only day after, and likely you'll want to keep an eye out on all of these things as we close today and likely open day after tomorrow. Those are some names which you'll want to keep in mind. But with that, from Hiral, myself, and everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
Apollo Tyres, now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Hello and welcome. You're watching Market Express and I'm your host Himakshi Bahugna. Now let's get straight into the show. US benchmark indices end flat amid a range-bound trade ahead of market holiday tomorrow. The Nifty ends above 24,300 levels, whereas the Sensex gains over 100 points to end above 80,400 levels. Now broader markets also underperform. Sectoral action mixed on the Lal Street. PSU Bank's reverse gains from yesterday to become the top sectoral loser, followed by Nifty Media and IT Index. Meanwhile, the Realty Index emerges as the top gainer, followed by Pharma. Jefferies has put out a bullish note on CG Consumer with a buy rating and target of 480 rupees. The brokerage firm believes that premiumization and new orders in solar pumps will aid further growth. The risk-reward ratio of the company seems favorable. Trent was the big counter in focus yesterday after it released fourth quarter numbers. The company witnessed strong margin expansion in this quarter while store additions met guidance. Adani Green announces conversion of additional 500 crore rupees worth of warrants at 1,480.75 rupees, remaining due to be converted in July this year. In this next 3 months, the warrant price is 61% higher to the current stock price. Bajaj Finance is another big counter, which came up with their fourth quarter earnings yesterday. The company witnessed a slight miss on the net interest margins, while profitability remained in line with expectations. Provisions remained higher than expected, and the company has announced a dividend of 56 rupees per share. Now, the company expects stable net interest margin for FY26. Varun Beverages in focus after the company announced their quarterly earnings. The numbers were in line with the estimates. There has been a double-digit volume growth at the consolidated level. Realizations also lagged growth. Margins declined due to lower margin profile of the South Africa-owned brands and higher mix of carbonated soft drinks in India. Pune-based motion technology company Shofla India reported strong results in January to March quarter. Revenue from operations were up 14% from 2,110 crore rupees year on year. Margins of profit before tax also improved to 16.9%, which is close to 17% from 16.5% over last year. Now, net profit also witnessed strong growth at 265 crore rupees. The company achieved its fourth consecutive quarter of double-digit growth year on year, driven by strong domestic and export performance. The stock was also up 6% in trade today. Macquarie gives an outperformed rating on Westside and Zudio owner Trent with a target of 7,200 rupees. Macquarie is confident on Trent's growth given better than expected same-store sales and lower operating cost. Now, sees FY25 as more representative of business health. Coming up at 4 p.m., the first and exclusive interview of SEBI Chairman Tuhin Kanta Pandey.
A new chairman to steer the market regulator through a time of global uncertainty.
The volatility in the market is also is always a concern. So I think now things are stabilizing.
To protect the small retail investor.
You have studies talking about 90% retail investor losing money. Do you see that it's an over-regulation?
At least 9 out of 10 small investors were actually losing money. And we found that there was a particular problem in terms of, index options on the expiry day.
to find frauds like Genzol.
And I think it's a case of egregious behavior, and I think they should be penalized for that. And all exchanges also doing their due, because as a first line of regulators, in this case, they are the ones who actually regulate and give approvals.
Don't miss the mega exclusive interview with SEBI Chief Tuhin Kanta Pandey on NDTV Profit.
So viewers, don't miss that interview at 4 p.m. today. With that, let's move on with the show. So real estate firm Prestige Estates Projects launches its first housing project in Delhi NCR with a revenue potential of 12,000 crore rupees to tap strong consumer demand. The company will develop a housing project at Ghaziabad, Uttar Pradesh, called the Prestige City Indirapuram. With all approvals secured, Prestige Group has begun marketing the first phase in Oakwood and Mulberry, which together represent a gross development value of over 9,000 crore rupees. Vishal Mega Mart reported strong Q4 performance with 23.1% year-on-year revenue increase to 2,547 crore rupees, driven by 13.4% same-store sales growth and festive demand for Eid and Ugadi. Now, the company expanded by adding 85 stores. EBITDA also surged 43% to 357 crore rupees, with margins improving 193 basis points to 14.01%, reflecting better cost efficiencies and operating leverage. Net profit soared 88.5% to 115 crore rupees, boosted by other income rising to 18.6 crore rupees from 7 crore rupees. It was a disappointing quarter for Shoppers Stop. The clothing retail chain saw a modest 1.7% revenue increase over last year to 1,064 crore rupees. EBITDA was up 2% and margins slightly improved at 16%. However, net profit plummeted 91% to 2 crore rupees, driven by rising expenses. Declining contribution from private label brands and their shares in apparel sales further pressured the profits. Operationally, average transaction value rose 8% and average selling price increased 4%. The company disappointed on store openings as well. CEAT posts a 16% fall in standalone net profit during the quarter ended March, which is the fourth quarter, missing analyst estimates. Now, the tire manufacturer's net profit fell to 100.4 crore rupees for the fourth quarter, and as compared to 119.1 crore rupees for the same period last year. Now, that compares with a consensus estimate of 116 crore rupees by analysts polled by Bloomberg. CEAT proposed a dividend of 30 rupees per share for the fiscal year of 24-25, subject to the approval from the shareholders at the annual general meeting. The dividend will be rolled out within 30 days following the approval from the shareholders. Aether Energy's 3,000 crore rupees IPO gained momentum in the final hours of bidding as a late surge in institutional demand pushed the issue into full subscription. As of 1:24 p.m., the IPO was subscribed 1.1 times overall, though weak grey market signals and valuation concerns continue to weigh on listing sentiment. Jana Small Finance Bank's fourth quarter results show a mixed performance. Net profit fell sharply by 61.6%, which is nearly 62% over the previous year, largely due to increased provisions of 305 crore rupees for NPA accounts. Net interest income grew marginally by 1% to 597 crore rupees, while operating profit declined 14.4% to 293 crore rupees. Provisions were slightly lower, down 1% year-on-year and quarter-on-quarter at 173 crore rupees. A rise in slippages was also noted in Karnataka, but no issues were reported in Tamil Nadu. The bank expects margin improvements in FY26. Five-Star Business Finance reported robust fourth quarter results. Total income rose 22.7% over the previous year, and the net interest income increased 21% to 559 crore rupees. Net profit also grew 18.2% to 279 crore rupees. Provisions increased 31% year-on-year and 9% quarter-on-quarter to 25 crore rupees. Asset quality slightly weakened with net NPA at 0.88%. It's a huge beat on all parameters for oil refining giant Indian Oil Corporation. Profit was up 2.5 times, while revenues improved marginally. EBITDA, however, grew by over 90%. Good news for shareholders as well. The board has recommended a final dividend of 3 rupees per share. Motilal Oswal initiated coverage on Blue Jet Healthcare with a buy rating and a target price of 865 rupees, implying a 26% upside potential. The brokerage highlights Blue Jet's niche in contrast media immediates and pharma intermediaries, and API is expecting robust growth after a muted FY 2024 period. Now, peak growth drivers include new product launches in contrast media, NC intermediates and sweeteners, with the contrast media segment projected to contribute 36% of revenue by FY 27. The pharma intermediaries segment is set for a sharp uptick, supported by backward integration to enhance margins and reduce supply chain risks. Now, the recent commissioning of the Plant 6 boost capacity, and the stock is noted for its attractive valuations. Coming up at 4 p.m., the first and exclusive interview of SEBI Chairman Tuhin Kanta Pandey.
A new chairman to steer the market regulator through a time of global uncertainty.
The volatility in the market is also is always a concern. So I think now things are stabilizing.
To protect the small retail investor.
You have studies talking about 90% retail investor losing money. Do you see that it's an over-regulation?
At least 9 out of 10 small investors were actually losing money. And we found that there was a particular problem in terms of, index options on the expiry day.
To find frauds like Genzol.
And I think it's a case of egregious behavior, and I think they should be penalized for that. And all exchanges also doing their due, because as a first line of regulators, in this case, they are the ones who actually regulate and give approvals.
Don't miss the mega exclusive interview with SEBI Chief Tuhin Kanta Pandey on NDTV Profit.
Jewelers begin selling gold on the occasion of Akshaya Tritiya, considered an auspicious time to invest in gold as per Hindus. Jewelers and retailers, including Mirabai Tanishq, are adapting to record gold prices this Akshaya Tritiya by offering more lightweight and lower carat jewelry to boost sales. IKEA has opened a plan and order point in Bengaluru, focusing on personalized design services and plans to expand with more smaller format stores in key Indian markets: Bengaluru, Mumbai, Hyderabad, Chennai, Delhi and Pune. These smaller stores, located in residential hotspots, aim to enhance profitability, speed and accessibility. IKEA is experimenting with this format to drive growth, with online sales currently at 25% and expected to reach 30%. The company is moving towards profitability in India, with Delhi set to have soon to have both flagship and smaller stores. Prime Minister Narendra Modi will inaugurate the first World Audio, Visual and Entertainment Summit, that is WAVES, in Mumbai on Thursday, a 4-day event that will bring together the entire spectrum of the media and entertainment industry, envisioned as a platform to bridge the gap between traditional and emerging media. The Prime Minister has set aside nearly 10 hours for WAVES, where he will chair a meeting with the CEOs and industry leaders from the media and entertainment sector. Poonam Gupta will assume the role of RBI Deputy Governor on May 2nd. The government announced on April 1st that she will hold the post for a 3-year term. She is expected to oversee the Monetary Policy Department at the Reserve Bank of India. Gland Pharma backs the US drug regulator approval for latanoprostene bunode ophthalmic solution. The solution is used to treat glaucoma. The market and also has a market size of $1,521.2 million in 2024. Exide Industries stock falls after the company's net profit declines over 10% to 255 crore rupees versus 284 crore rupees year-on-year. The board recommends a dividend of 2 rupees per share, disappointing investors. The company announced that it will be investing up to 1,200 crore rupees in arm Exide Energy Solutions. Apple is eyeing India as an alternative to China for the manufacturing of iPhones, as Trump tariffs loom large on India. According to a report by Reuters, a new iPhone manufacturing facility in Tamil Nadu has begun production, and another will start shipping in May as the Cupertino-based tech major expands its manufacturing outside of China, its primary manufacturing base that is being impacted by the tariffs. A majority of workers in India are contemplating changing employers in 2025, as per a recent study by ION. The 2025 Employee Sentiment Study, which surveyed over 9,000 employees across 23 geographies, including the US, UK, China, India, and Australia, found that 82% of Indian employees are either in the process of moving employers or might seek new employment within the next 12 months. This is notably higher compared to the global average of 60%. Coming up at 4 p.m., the first and exclusive interview of SEBI Chairman Tuhin Kanta Pandey.
A new chairman to steer the market regulator through a time of global uncertainty.
The volatility in the market is also is always a concern. So I think now things are stabilizing.
To protect the small retail investor.
You have studies talking about 90% retail investor losing money. Do you see that it's an over-regulation?
At least 9 out of 10 small investors were actually losing money. And we found that there was a particular problem in terms of, index options on the expiry day.
To find frauds like Genzol.
Well, I think it's a case of egregious behavior, and I think they should be penalized for that. And all exchanges also doing their due, because as a first line of regulators, in this case, they are the ones who actually regulate and give approvals.
Don't miss the mega exclusive interview with SEBI Chief Tuhin Kanta Pandey on NDTV Profit.
Viewers, 8 people reportedly died and several others were injured after a newly constructed wall collapsed at the Simhachalan temple in Visakhapatnam, Andhra Pradesh. The incident occurred in the early hours of Wednesday after a 20-foot-long stretch collapsed during the Chandanotsavam festival. In a major escalation in the aftermath of the Pahalgam terror attack, Pakistan opened fire along the international border in Jammu and Kashmir's Pargawal sector last night. Earlier, Islamabad had tried to provoke New Delhi by violating the ceasefire along the line of control. According to defense sources, India has responded effectively. Prime Minister Modi chaired a Union Cabinet meeting for the first time since the April 22 terror attack in Pahalgam that left 26 people dead. Besides this, he also chaired meetings with the Cabinet Committee on Security, Defense Chiefs and the Cabinet Committee on Parliamentary Affairs on Tuesday, affirming that it is India's national resolve to deal a crushing blow to terrorism. The PM said that the Indian Armed Forces have his full confidence and complete operational freedom to decide on the mode, targets and timing of India's response. Coming up at 4 p.m., the first and exclusive interview of SEBI Chairman Tuhin Kanta Pandey.
A new chairman to steer the market regulator through a time of global uncertainty.
The volatility in the market is also is always a concern. So I think now things are stabilizing.
To protect the small retail investor.
You have studies talking about 90% retail investor losing money. Do you see that it's an over-regulation?
At least 9 out of 10 small investors were actually losing money. And we found that there was a particular problem in terms of, index options on the expiry day.
To find frauds like Genzol.
Well, I think it's a case of egregious behavior, and I think they should be penalized for that. And all exchanges also doing their due, because as a first line of regulators, in this case, they are the ones who actually regulate and give approvals.
Don't miss the mega exclusive interview with SEBI Chief Tuhin Kanta Pandey on NDTV Profit.
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
A new chairman to steer the market regulator through a time of global uncertainty.
The volatility in the market is also is always a concern. So I think now things are stabilizing.
To protect the small retail investor.
You have studies talking about 90% retail investor losing money. Do you see that it's an over-regulation?
At least 9 out of 10 small investors were actually losing money. And we found that there was a particular problem in terms of, index options on the expiry day.
To find frauds like Genzol.
And I think it's a case of egregious behavior, and I think they should be penalized for that. And all exchanges also doing their due, because as a first line of regulators, in this case, they are the ones who actually regulate and give approvals.
Don't miss the mega exclusive interview with SEBI Chief Tuhin Kanta Pandey on NDTV Profit.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4.
Amid global uncertainties and market volatility, SEBI, the market regulator, is steering through a complex financial landscape. Complex because the world order is resetting and no one knows what is going to happen next, how the global market is going to react. To shed more light on the evolving dynamics, we have with us none other than SEBI Chairman Tuhin Kanta Pandey. Chairman, sir, thank you for taking out time for us. I would like to start with, during your first day in office, you clearly set a tone by telling that, the focus area will be transparency, trust, teamwork, and technology. It's been 2 months in office. How are you driving your agenda forward, and what is your, the most significant learning so far in this current scenario?
Well, first of all, I'll take it from what you said. We have a fair amount of global headwinds, largely out of the trade policies and trade barriers that are coming. And that has, again, implications for capital markets. Be that as it may, we will have to deal with the situation, in the best interest of Indian capital market. So the trust and transparency, I say that, of course, all 4 T's, as I say, that basically they're pretty interlinked. But coming to the first issue of trust is a wider issue of how the people view SEBI and also how does SEBI view its ecosystem and the other market participants. Mm-hmm. So this mutual dialogue and the mutual thing which needs to be appreciated, the feedback and the mechanism to consult. Of course, we do have an established system of consultations. Those consultations need also to be more nuanced, more rigorous, and I think a discovery of really fine-tuning the processes, so to say. And transparency is again issue of how the market gets the information transparently about the issuers and how the issuers, both in terms of IPOs, in terms of listed things, and also how the SEBI, whatever it does, also is transparently available. Same thing is with teamwork. Teamwork is not only an internal teamwork within the SEBI, which includes different divisions, different departments, how to break the silos, how to bring them together, but also to have an external teams, which are so very important. The teams which are there from market intermediaries, market participants, and other players, the committees that we have, the PMAC, the SMAC, the IPAC, and how they are then sort of able to work collaboratively. So that is a broader teamwork issue. And technology, as you know, is a very important part of the piece, a very important piece now in capital markets. Technology with what the regulator has on both SupTech that we deploy and the RegTech, which is the regulatory technologies which regulated entities employ, and also the market intermediaries, the MIIs, the market infrastructure institutions deploy, and the risks that also get posed through the cyber risks and other risks, including of course on AI and computing risks.
Since we're talking about global uncertainties, you had your recent US visit. How's the mood among the foreign investors, and what is drawing their attention in terms of Indian equities and the Indian market?
I think I was in fact quite delighted to see that there's so much interest that India has currently, and despite the global headwinds, I think India has been able to provide very consistently. If you take a 30 years period since 1990s, Indian markets have provided to FPIs upwards of 8.5% rate of return X of dividends in dollar terms. And if you take any period, 5 years, 10 years period, I think the returns that Indian markets have offered to these things are consistently much higher than either the emerging markets, other emerging markets, or China, or even developing economies. So that is one which has been very well appreciated. The second part is the opportunities that India offers in terms of the consistent growth rate that India has been able to achieve, one of the highest, fastest growing economies among the large economies. Consistently, the demographic dividend that it has, the talent pool it has, the policy space which is available, the fiscal consolidation, the corporate balance sheets and the fiscal balance sheets are in good shape. So I think the overall they are looking at India as potentially a very important market for deployment. So there is a great deal of enthusiasm.
I'm sure, sir. So, taking cues from this and clearly that India growing role in the, global portfolios as well. So, do we see any ease of rule in terms of foreign portfolio investors? And in fact, what is being worked out when it comes to, allow foreign investor directly into Indian equities?
I think this was when, of course, when I visited, there was also IMF conference and spring meetings. And I attended also the ISCO, which is also the meeting of the regulators. And there is a financial stability expert group, FSEG. And we could share, different things, and also the engagement with FPIs at New York as well as Boston, and also in Washington DC. Now, this engagement process actually gives a lot of feedback. It gives you, sort of ideas where you can also simplify things, make it easier. A lot has been done. For example, there's an FBI outreach cell in SEBI which has reached out to, over the last few months, to about 2,000 FPIs, looking at their issues, if any. There is a common application form. A lot of improvement has been made there. The registration process, a lot of improvements have been done. And of course, there is a scope for more. And I think this engagement process will be able to, allay many of the concerns that they might have, and some of the recent changes which have happened for ease of doing business. They would be really, this engagement process puts, underlines that, and that there's an improved understanding about the Indian regulations.
So all you mentioned is the compliance side of it. Do we see some regulatory tweaking also in terms of the rule which we have at this point of time? Do we see something in the near term in terms of tweaking and modifying the rule which we have?
I think one is that, we will be constantly, in the engagement. I mean, we'll intensify the engagement. That gives you pinpoints that whatever we might they might have, and we can remove them. And it's in the context of, in general, simplification, rationalization exercise that we have undertaken towards what we call optimum regulation. And I think every department in SEBI is currently has started working on, how we can simplify the regulations. So to achieve more effective regulations, get that impact at the same time, whether we can get more with less onerous regulations, with less micro regulations, can we have the same kind of effective so far as the risk is concerned? And I think that exercise is started.
So talking about the regulation, one regulation around, FNOs, the derivative markets. Everybody is talking about that, whether it's a, over-regulation or not. But one thing the experts are saying about that, this could hurt volumes because the way it is designed, it's skewed in favor of large institutional investors. But of course, SEBI is coming from the point of view of retail investors, because you have studies talking about 90% retail investor losing money. How are you seeing this? What is your assessment at this point of time? And do you see that it's an over-regulation when it comes to derivative segment?
In the derivative segments, we had some issues around it when we studied this matter, and we put it out as this report also in public domain, where we said is at least 9 out of 10 small investors were actually losing money. The question is that whether the particular methodology which they were deploying was good enough, whether there was proper education. And we found that there was a particular problem in terms of, index options on the expiry day. I think that is where we find it was truly distortionary. The purpose of F&O market, which is also a very important market, is to hedge risks and also help price discovery. So to that extent, I think the market does that job. The derivative market is really important market. But sometimes I think if the distortions come in form of a particular way that we are looking at it. So therefore, we put out a consultation paper saying that, when we need to change the metrics, the risk metrics, where for options, in terms of risk metrics, we were having apples and oranges issue. We were, summing up, different components like futures and options. They're slightly different. And options, we were not counting the delta. And that delta is now, we intend to bring in so that we know exactly, how the, everyone understands what the risks are. And there are also certain things about the limits that was prescribed and some manner in which it will be done. The number of days where the index options were restricted, weekly expiries were restricted to 2 days. So these measures were really trying to take it from the point of view of holistically, not really trying to, unduly throttle the market, but to make it more this thing and improving the systemic nature of the market. So we have received a large number of 800 odd comments have been received. and we are seized of the situation, and soon we will come out with the clearer regulations around it.
Do we see guidelines soon, maybe in next board meeting?
Yes, I mean, these are the things that we can do. I mean, you don't require a board meetings for it, approval. This is something which we can handle based on the position paper that was put out and the comments which we received. A considered view will be taken.
Sir, speaking on the regulation, you reputedly said that, there is a need to review the decade-old SEBI regulation. Now, I also assume that other acts like income tax also, gone through that. All that redundant provision will be moved out, and we have new act altogether. Similarly, the same exercise we will see in the SEBI as well. How you're going to do that, one, and is there any timeline in mind to do that?
Yes, this exercise has actually begun. How we are attempting to do is to ask every department in the SEBI to engage with their respective stakeholders. Our big advantage is that we have a very active engagement process in SEBI, and I have publicly said also, and I've told the committees, I've told many representatives of associations who have come and met me to give their suggestions. And wherever we can, in a collaborative exercise, we can co-create these regulations more simplified, more contextualized, and I think trying to achieve an objective with as much simplicity as possible.
Any identification how many redundant provisions are there in the existing act? Any numbers, any calculation there, or still the work in progress?
I think the work has begun, and people have to really identify in consultations. So therefore, it's not exactly a numerical game too.
Okay.
Yeah, it's basically the type of provisions which are there in the thing, and somewhere it could be a question of making clarity in the language of the regulations, because sometimes if you have any vagueness around it, any ambiguity in the language, that may create problems. So the better thing is to make it clearer. In some cases, you would say that that's not really required now in the present context. May have been required in a particular context earlier in the past. That can go. So this is the micro detailing which every regulation will undergo, and it will go through a process. I mean, it's not really that this is the line and this is the deadline. Okay. I mean, we can always have a phasing in. Like we can attempt something, and something we can do it in the next board. By the next, and then by the subsequent board, we can also attempt a larger kind of rationalization.
Just for clarity, this will also go through the parliamentary approval process, same like in the other
regulations acts? These are the regulations which SEBI does it. It is within the same law, within the same rules. Since SEBI can issue regulations, so we are talking of regulations and circulars that is within the power of either the SEBI itself or with the SEBI board.
Understood, sir. So on the settlement cycle, SEBI has been pushing for faster settlement cycle, and we are already at T+1. What's your view on having T+O cycle, and do you see the viability of implementing T+O at this point of time?
Well, I think T+O was conceived as an optional one. It remains optional, and I don't think that we should be, we are very sort of, excited about pushing it any further. So T+1 to me is quite a good one.
Sure, sir. So on the IPO momentum we have seen since February, there is one or two mainstream IPO. Do you see that the slowdown is attributed to the global uncertainty, and how you're seeing the IPO market in rest of the year?
Well, I mean, as you know, that last year was a very big year for IPOs. India had the largest number of IPOs anywhere in the world.
Yes.
In fact, there were markets where IPOs are very difficult to come by. In India, we have a very big pipeline of IPOs which is there. Of course, the markets do adjust. Last few months, especially 2-3 months, have been fairly uncertain. Uncertainty is still there in the minds of the people, but last 2-3 months have been especially problematic in terms of where the world is going. So therefore, capital raising has been slightly, I just said that, postponed by many issuers, which I hope that it will resume soon, because as things get clearer, they may still get further things. So we hope that this will the new IPOs will start.
So you think that the companies are waiting to have some clarity on the trade side of it, which government is already negotiating?
Yes, also the trade, the trade and economy are also quite interlinked. So therefore, even if you are, because if they are expanding, if they are doing it and raising resources, and also the volatility in the market is also is always a concern. So I think now things are stabilizing on the capital market front.
True. Sir, on the stock exchange side of it, I would ask that, do you think that more players are required? Stock exchanges are first line regulator, and we have two main players at this point. So do you think that it's important to have more players for, for innovation, to increase competitiveness? What's your view on that, sir?
I think the regulations permit more exchanges also. I mean, nobody is stopping it. There is a certain minimum rules. 5% maximum one can have, 15% institutionally shareholding. It has to be a widely held structure, and that's about it. I mean, but the point
it becomes sensitive.
But the point is that it has to be, again, it's also an economic viability issue, because any new entrant then will have to sort of compete to get it, because there are two exchanges currently, and they are fairly robust to provide the services. So therefore it really depends upon that. I mean, as a regulation, we do not, we allow sort of multiple players.
So we have seen a BSE IPO, and I'm on the NSE IPO status. I just wanted to understand where it is, what challenges is it facing, and what is the regulator view when we could see some green signal from the regulator to NSE IPO?
I think the NSE and SEBI are in consultation on some of the key points on market governance issue, technology, litigation, pending clearing corporation, and some of these points have been gone back and forth. Hopefully that should be resolved early.
So any timeline given on the IPO?
I'm not able to give you exactly the timeline, but I can only say that this will be taken forward.
So moving on the corporate governance part of it, when a GenSol kind of incident happens, it affects the sentiments of investors, particularly in the startup IPO. Perhaps, more than drop in a price after listing, it's more about the trust factor gets shaken after such instances. Do you think it's one of a case where, promoters are at fraud, or you think that there's some steps or measure has to be taken to avoid the reoccurrence of such instances?
Well, I think it's a case of egregious behavior by a few. And I think no matter what kind of regulations you do, no matter what kind of laws you pass, there will be, if there is an egregious greed, and if there is, in my opinion, also inadequate supervision, because we can't be there in every boardroom. You have auditors, you have independent directors, you have people who should ask questions, key questions, and there is quarterly results. There are people who are informing in the exchanges. So as a regulator, we can only do as much. In fact, you would be asking that we ask too much.
So of course,
but still, if there is a certain, like if there is a false information, if there is a fraud, or if it is a moving of funds which is not correct, I think in the order, forensic auditors also has been ordered. So I think these are the kind of egregious behavior which nobody likes them, but they do happen, and I think they should be penalized for that, whosoever is responsible.
Similarly, in the SME IPO situation also, we have seen a lot of these tax evasion angle is coming up, it's emerging. So do you think that both exchanges, stock exchanges and merchant bankers should step up, be slightly more vigilant about the documents which they are handling as far as SME IPO is concerned?
Surely, I think there's a lot of responsibility on the merchant bankers on this score, because I think they should do a better work out of about that. On our part, I think that initially we have brought in some changes in the guidelines in terms of profitability. For example, there's a minimum operating profit has been mandated. There is also certain other tightening that has been done, that you could use the funds only for certain purposes, and not for your general corporate purpose, cannot be more than a certain limit. So we've brought in certain restrictions in order for that thing, and this money cannot only be simply for the repayment of loans from the promoters, for example. So, but it seems that it's prevalent in
But
the scheme was basically to facilitate the IPOs, in the point that helping the small and medium enterprises to raise resources possibly better and reduce their cost of compliance, and so therefore it was given to exchanges to approve, and instead of everything coming to SEBI. But I think that we have to really look at it. We will be watchful of how the things go on, and we hope that all the relevant parties in this will do circumspection while sort of reviewing the documents and putting it through, and the exchanges
all checks
also,
and balances,
and all exchanges also doing their due, because as a first line of regulators, in this case they are the ones who actually regulate and give approvals. So we expect them to do that, because that's what the scheme was meant for.
Yes. True, sir. Absolutely fair point. On the investor protection side, sir, I have two questions. One on the finfluencer role, the way they are coming up with all those stock tips, etc. How you are going to regulate that? Is there any broad framework in mind? When could we see some curbing there? If you could share some thoughts around.
Some of the points that on finfluencers SEBI has mandated is that unless and until they are registered, the SEBI intermediaries, market intermediaries will not be able to interact with them and all that. So that for, really looking at, their business model should not thrive while they are not getting, doing registered. And secondly, particularly if they are giving any false promise on the returns, which they cannot do. So I think efforts of SEBI has resulted in about 70,000 such things being taken down with the help of different social media platforms. But we need to be vigilant, and we need to continuously do that, because they can again spring up and things like that. On the other hand, we are also trying to ease the entry of the registered investment advisors and the RIAs. And recently I also met their association. Some of the work which has been done in case of their own rationalization, I think we need to do more also on ease of doing business for them. There is also for Parva, there is for past performance and accreditation, a new system is being brought out. I think both we have to see that this registered profession where the do's and don'ts are clearer, they grow in size, they are more, they come to advise the people, and at the same time the advisors who are self-appointed influencers and violating, they are taken down and the action is taken on them.
So of influencer is one part of it. Of course, the face is, you recognize the face and you fall for it as retail investor. But on the other side, the stock tips, across social media platform, for example, WhatsApp, Telegram. Are you in touch with these social media platforms as well to get some idea, some surveillance there as well on the tips where there is no name, no face? How to sort of curb that, how to reach out to the depth of it, to understand how to...
One of them is also to see the education, because I think we have been constantly putting it out, and we will also further accelerate it with the help of this, or investor education. Or when you are trying to get it, to not to fall prey to these kind of advice, which is especially meant to actually dupe them because what kind of interest one might have on this stock tipped advice. A simple question, if you ask him, why someone is advising me this in an unsolicited way? So there must be some interest which I must try to find out, and therefore I think the investors should go towards see more of documents. So much is online is available. And I think they should get into a league where, if they really want to be serious investors, and that will be my appeal to them. And I will really urge them to be more circumspect and not to fall prey to this, doubling return, tripling return, or stock advice of that kind. And and if at all they have, they should approach the registered ones.
Absolutely, sir. So moving on the common KYC system, there has been talk. Any progress there, and what's your view now? Again, it's you think that in the current scenario, we can have common KYC at this juncture? I mean, is it viable? Is it able to, regulator would be able to implement that? Because there has been it's been a pending thing.
Yes, I think the central KYC is an important issue. Now, we do have, as you know, under the SEBI system, we have a common KYC system where if you get registered, it goes to KRAs, and from there it can be free, it can be then downloaded and shareable. You don't have to do it again. So it's a common there. Now the issue is that how seamlessly the central KYC and the KRA system of SEBI can be made interoperable, and that will be our effort, that it can be very simply be made interoperable, so that at one we will have just one KYC, at least so far as PMLA matters are concerned. From their point of view, if we have one KYC across the financial regulator, that will be great. I think that will be our effort to resolve.
So if it's get implemented, any timeline, one, and second, how this is going to benefit investors in a long...
I think the Ministry of Finance is abreast of this matter. RBI, SEBI, we are all working in a committee, and the PMLA rules also needs amendment. This whole thing is a matter of priority for us.
So one question which comes to everyone's mind, it's a bit offbeat, but on cryptocurrency, government has been working on paper, we will see it's coming forth. But from the regulator point of view, what is the SEBI view on the cryptocurrency regulation, sir?
Well, cryptocurrency is a policy issue. So it's for the Ministry of Finance to really decide, because it's not with SEBI. So far as SEBI is concerned, this is not a security yet.
Yes, sir, but the suggestion has been sought from all the regulators, including SEBI. So just getting sense, what is SEBI view on the crypto regulation?
No, crypto means is not a regulated thing at all. So far. So that's my thing, and let a policy decision be taken on that.
Sir, one aspect which you also faced when you were with Finance Ministry on the minimum public shareholding. I wanted to understand, given the scenario at this point, you think that SEBI may again have to extend the deadline, which is coming in August. Is there a case to extend the deadline? You think so? Because many of the companies still not met, I'm talking about the CPSCs, not met the criteria.
Well, the CPSCs, the government do have the powers in respect of the public sector company to extend the, the MPS thing. And I think one of the reasons was that, you have had several of the, government entities, especially, the banks, the public sector banks, which had earlier achieved the MPS, and then they had to be recapitalized because of certain things. And so therefore they could not raise the money from the market, but it had to be recapitalized by the promoter, which is the government. In which case they again fell back,
Yes.
because of the recapitalization, and now they have to further dilute. So these are, I think, due to these difficulties, some of them have got, this time, and they may be working towards it. In the meanwhile, several CPSCs have already achieved the MPS, and some of them may not be able to possible also. Because if suppose a few companies, if they are really on the verge of closure, then they cannot be actually, do that, and therefore they would have to be delisted, or you have to get out of them, or they may be under closure. So those are the things where, while in number you might see them, but they are not really worth the MPS anymore. So I think broadly the government is moving in the right direction to do as much as they can to make whatever the remaining companies which can be made MPS as an MPS.
Okay, but no so far communication from the government to extend the deadline so far. I mean, it's premature also. We are sitting in April, August is still far. So last question on the point that considering that one of your first act as SEBI chairman to address the conflict of interest issue, I wanted to understand how serious is the concern?
Well, I think there has been a narrative on this issue for some time, and we also looked at it. Our last update was in 2008, and we had also internal problems when SEBI officials are dealing with that. Many a time, there's a lot of questions for them also, that whether there is a conflict of interest here or not. So I think the things have, when from 2008, there have been plenty of time has passed. And in the modern context, we must also look at it and make things comfortable. Also, the fact that there are no public disclosures still. I mean, even though there are some disclosures within the SEBI, but there are no public disclosures. So that is also a thing, is to what extent the public disclosure should come. So taking into all these considerations, that committee, in my opinion, is quite timely, and based on their advice, then we can move forward.
Maybe because other regulators doesn't have really the conflict part in their, you can say it code of conduct or anything for that matter, but SEBI seems to be proactively dealing with that.
I would not like to comment on other regulators,
yes, sir.
But you can appreciate that being a very active market regulator, we are in the thick of things on a daily basis. So therefore, I think it's better we address them as quickly as possible, so that we put these narratives to rest.
Well, that's the wrap of this special conversation. Thank you, Chairman Sir, for sharing your insight and observation. Thank you very much. Appreciate your time.
Apollo Tyres, now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
In the first and exclusive interview to NDTV Profit, SEBI Chairman Tuhin Kanta Pandey flags egregious behavior in the Gensol promoters case, also highlights merchant banker responsibilities for IPO scrutiny, and says the NSE IPO will come once the back and forth issues are resolved. And in a significant move, the government announces that the upcoming national census will include a caste-based survey, marking a major shift in India's data collection approach and addressing long-standing demands for detailed case demographics. The Nifty and Sensex closed lower with sectors like auto, FMCG and IT extending losses, while Nifty Realty stands out, driven by gains in Godrej Properties and Macrotech developers. Gold prices drop on the multi-commodity exchange impacted by a stronger US dollar and easing global trade tensions. On Akshaya Tritiya, MCX gold rates fell over 500 rupees, trading close to 95,000 per 10 grams. The Indian rupee reaches its highest level of the year, supported by equity inflows, increased dollar sales by exporters, and reduced bearish bets on the currency. Two powerful decision-making committees of the government meet to discuss India's response to Pakistan's state-sponsored terrorism after terrorists killed 26 tourists in Jammu and Kashmir's Pahalgam. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's dive right into it. Our top focus this hour,
The Modi government has announced the inclusion of a caste-based survey in the upcoming national census, marking a pivotal shift in India's data collection strategy. Union Minister Ashwini Vaishnav confirmed that the Cabinet Committee on Political Affairs has approved the move, addressing long-standing demands for detailed caste demographics. Now, this decision comes as the central government evaluates the inclusion of a caste count pending since 2021.
According to Constitution of India, census is a union subject. Some states have conducted surveys. I'm repeating the word, surveys, to enumerate castes. Some states have done this well, while some others have conducted such surveys purely from a political angle in a non-transparent way. Such surveys have created doubts in the society. Considering all these facts and to ensure that our social fabric is not disturbed by politics, caste enumeration should be transparently included. I'm emphasizing the word transparently included in the census instead of surveys.
A significant move coming in there by the government, but now let's take a look at how the markets fared today. Nifty and Sensex ended lower for the day, with HDFC Life Insurance and Maruti Suzuki emerging as the top gainers, while Bajaj Finserv and Finance were the top losers. Among sectors, we saw Nifty Realty standing out as the top performer, led by Godrej Properties and Macrotech Developers, while Nifty Auto, FMCG, Metal, IT, Bank, PSU Banks and Media extended their losing streak for the second day. Nifty Oil and Gas, meanwhile, broke its two-day gaining streak. My colleague Harsh with a quick roundup of all of the action in the market today.
Well, the index closed absolutely flat and nothing again to complain about. We've had 3 straight trading sessions where the Nifty has largely closed flat with maybe a mild negative bias. In terms of which stocks were moving, we had a few which dominated in terms of earnings, especially among the losers. Trent was one of them. Numbers came out yesterday. Stock was buzzing, down 4% today. You saw Bajaj Finance and Finserv, both of those down 5 and 5.5% odd in trade today on the back of, again, numbers. So some of those buzzing, and they had a clear impact with regard to the way the Nifty moved as well. They were some of the top contributors in terms of losers on the Nifty. In terms of gainers, you had an HDFC Life and SBI Life doing fairly well in trade. So that pocket doing well. There was also a Maruti which did very well in trade, 3% higher on a Maruti. So some of those movers are playing well in trade. In terms of some of the heavyweights, and HDFC was up around 0.7% as well. So that one too, one of the top contributors at least on the Nifty in trade. In terms of how the broader markets did, the advance declined first. The breadth of the market was sharply lower. So that was slightly different from the way how markets have done, at least over the last couple of days, where the advance decline has been even Steven 1:1. Today, especially, there was pressure with regard to the breadth and especially towards the fag end of the day. It was also Nifty expiry, and therefore to that extent you had seen some amount of pressure creeping in right towards the fag end. There was also volatility right at the end of the trading session, the last 5 odd minutes, where we saw sharp fluctuations, at least on the Nifty. What sectors did well, and in that sense, you had the Nifty Realty, which was up 2% odd on a day like this, sharp outperformer. You have the Nifty Pharma Index also doing fairly well. The Nifty Defense was one of the key losers in trade after a couple of days where it has done very, very well for itself. So maybe those pockets of trade to look out for. In terms of the broader markets, the Nifty Small Cap Index was down 1.8%, so pressure there. The Nifty Mid Cap Index also was lower in trade. So the broader market's not doing as well. The Nifty closing flat. Of course, it's a truncated week, and we'll have to wait and watch as to how Friday plays out.
Thanks, Harsh, for that. Meanwhile, Abhay Agarwal of Piper Serica Advisors has adopted a bearish view on the IT services sector, deeming it underweight. He attributes this stance to mounting margin pressures, insufficient innovation and overvalued stock prices. Agarwal anticipates that the market will eventually adjust to these challenges as the sector continues to underperform. Let's listen in.
one sector that we have been completely underweight in and have zero exposure to for last 2 years is IT services. Now, IT services companies have seen a stock price correction, but I don't think it is still enough, because if a company is guiding for a 0 to 2%, 0 to 3% growth, with margins under pressure, with the competitiveness of the business under pressure, lack of innovation, then I still don't understand that why would anybody look at them as defensive bets and pay a 20 to 25 P multiple for a company that itself is saying that it will not grow at more than 2-3%. So I think the whole IT services pack, just because of historical reasons that it has been a money spinner, is something that trades at a very high valuation than it should.
And Ather Energy, the much-awaited and viewed IPO, the 3,000 crore IPO has picked up momentum in its final hours with strong institutional demand, driving the overall subscription to 1.1 times by 1:24 p.m. this afternoon. However, concerns over valuation and weak grey market trends continue, and we'll try and get you more news on that later this evening. And for generations, Indian women have cherished gold, not just as jewelry, but as a trusted source of value. And today that faith has truly stood the test of time. With global uncertainty rising from trade tensions to market volatility, investors across the world are turning to gold as the ultimate safe haven. On this auspicious day of Akshaya Tritiya, gold prices are reflecting that global rush. The price of 24-carat gold is nearing a 98,000 rupees per 10 grams, while 22-carat gold is closing in on 90,000 rupees. My colleague Charu brings us a ground report from Mumbai's Zaveri market. Let's find out whether gold demand remains strong despite these soaring prices. Let's take a look.
Akshaya Tritiya is an auspicious occasion for the Hindu and Jain religion, because they believe that the wealth accumulated in any form on this day is only going to double over and benefit over the coming years. Now we are here at the Zaveri market in Umedmal Tilokchand Zaveri, who have been here for the last 100 years, and we are going to be talking to Mr. Suresh Jain to basically explain to us how this entire thing is played out, how many customers come, and how there is an excitement about the entire hustle bustle in the market. So sir, बताइए आज के दिन कितने लोग आते हैं?
आज का दिन ज्वेलरी में एक बहुत बड़ा दिन है, 3.5 मुहूर्त का दिन है, और बड़ी अच्छी बात है। अक्षय तृतीया के दिन लोग धनतेरस की तरह साउथ में इसको सेलिब्रेट करते हैं, और आज यहाँ पे भी जिनको लेना है वो एक अच्छे भाव से, जो भाव 1.25 लाख 1 लाख 2,000 पे चला गया था, आज 96,000 हुआ है। तो भरपूर सुबह से हम लोग आए, 9 बजे से आए, रोज यूजुअली 11 बजे आते हैं, 9 बजे से बाइंग शुरू हुई है। कोई कॉइन लेके जा रहा है, कोई बड़े सेट लेके जा रहा है, इस तरह की अच्छी ग्राहकी चल रही है।
Meanwhile, Sachin Jain, regional CEO of the World Gold Council, attributed the recent surge in gold prices to financial market dynamics. He emphasized the ongoing aggressive gold purchases by central banks, coupled with persistent geopolitical tensions, as key factors likely to sustain the rally in the near term.
If you look at the last few months, it's been largely dominated by the financial markets, where the investments have gone up. I mean, look at gold ETFs. Last entire year, the addition of the AUM was about $3.8 billion. And just this year, the addition has been upwards of $17-18 billion. That's already happened. And if I were to share some rallies with you, the $2,000 to $2,500 per ounce took about 1,780 days. The $2,500 to $3,000 took just about 220 days. And from the 1st January, and we dished at $3,500, took half of that time. So it's been a very strong upward movement from that perspective. Now, what element will play out? I think when you look at long term, the elements around central bank buying will be strong. The elements around how geopolitics is not going to be all settled down will play out.
Prime Minister Narendra Modi has chaired a high-level cabinet committee meet on security, his second one since the Pahalgam terror attack. Now, the CCS was briefed on clear cross-border linkages to the attack, which left 26 tourists and a local Kashmiri dead. Soon after, tensions escalated further, with Pakistan opening fire along the LOC in Pagarwal sector of Jammu and Kashmir. Now, this follows an earlier ceasefire violation along the LOC. India has responded effectively to both of these things.
This definitely constitutes an escalation, expanding the scope of hostilities from ceasefire violations to the international border. Is rare. It hardly ever happens, and it shows that there is a very specific effort by Pakistan to widen the scope of this escalation and tensions on the line of control into the international border. There are very many implications here because here you've got targeted ceasefire violations over the last 5 days that have been taking place at Pakistan army posts. But when you fire across the international border, it's not never happened before. It has, but it's extremely rare. And in the context of what's happening now, it is an escalation. You're firing into the Jammu plains. There are many civilian areas. This is an area right below the demarcation of the line of control where that actually starts in the Jammu area. Pakistan, it should be said, does not consider this part of the international border as an international border. They consider it a working boundary. They basically treat it like the line of control. It's very much part of the entire bilateral issue that India and Pakistan currently have. Be that as it may, for India, it's the international border, and therefore it constitutes a big violation. As you reported, Baramulla, Kupwara, Sundarbani, Naushera, and a couple of other sectors are seeing escalations of this kind. I was at the line of control in Baramulla yesterday where we reported on some of those ceasefire violations, obviously with due permission from the Indian Army. But this escalation clearly means that there is a deliberate and organized attempt to try and trigger some kind of a response from the Indian Army, because taking things from the line of control, where things are far more messy, firing happens on a fairly regular basis, even though there ironically is a ceasefire agreement since 2021, and these violations actually constitute the biggest violations since that agreement in 2021, 5 years ago. Firing at the IB is a completely separate dynamic. There is a certain sanctity to the international border. It is generally held sacrosanct. Firing has happened, but like I said, it's extremely rare, and in the aftermath and the backdrop of Pahalgam and the current escalation by the Pakistan Army, this is a very, very big escalation.
And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Apollo ties. Now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking node that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Apollo ties. Now there's a buzz of a positive corporate development related to its.
Hi, thanks so much for joining in. You're watching Your Money Matters on NDTV Profit. My name is Alex Matthew. Today I'd like to talk to you about credit risk and the fact that a lot of you have perhaps considered or have actually gone ahead and invested in corporate bonds that are available on applications like Wint Wealth and India Bonds and certain other applications. Is this something that you should consider doing? What are the dangers involved? We'll also talk about credit risk funds and the concept of buy now, pay later. We've also got tips and tricks for you to decide how to save on your electricity bill. All of that and more on today's program. But first, let me introduce our expert for the day. We've got Mrin Agarwal, who's financial educator and founder at FinSafe India. Mrin, thanks so much for taking the time. Let's start with the first topic, which has to do with buying of corporate bonds. Now, I've actually seen this, and I have anecdotal evidence, people going out and saying an A-rated corporate bond is available at a yield of 13% or 14%. And people think, wow, this is a fantastic return. It's a 4-year bond. Why don't I go and invest in it? What, according to you, are the risks involved, and is it captured in the value that you're getting?
So good evening, Alex, and lovely to be here today. And well, I think that a lot of times people are investing in these bonds just going by the names of the companies and thinking that they have heard about these companies, but these bonds come with huge amount of risk. And of course, the biggest one, you mentioned a single A bond. I was actually surprised to see that triple B minus bonds were also being sold on some of these online platforms. And, mutual funds typically invest in A and above. And if you look at most mutual fund portfolios, you would find very low incidence of single A rated bonds, right? And here you have bond platforms where you have the lowest quality of bonds that are available. So obviously they are going to come with a default risk. And platform is not going to help you in case of the default, right?
But let me stop you there, because I know that a lot of my viewers will be aware of this, but let's drive home this point, right? We've talked about certain letters. We've talked about A-rated bonds. We've talked about BBB minus rated bonds. These are effectively credit ratings which are issued by credit rating agencies. But Mrin, BBB is investment grade, and anything below that falls into dangerous territory. In fact, anything around that investment grade is also not out of the water in terms of the danger of default. And default means that you don't get your money back, correct?
Yeah, that's right.
So explain how that works. When you're talking about falling low on that rating scale, the company gives you more money because it's trying to compensate you for the risk that you're taking. It's as simple as that, isn't it?
Yes, absolutely. And in fact, see, most of the companies that are borrowing are NBFCs. And what they do is that they further lend out these monies, right? And typically the credit rating that they get is dependent upon how their business is doing. So if they've got a lower credit rating, it basically means that they have a moderate asset quality, or moderate profitability. They could be asset liability mismatches, or they could be companies who are fairly new in the business. What it really means is that things could go wrong, and that means that you could end up losing money. And let's not forget that in the last 5 years, we did see 2 AAA rated bonds also defaulting, and investors not really getting much of their money back.
Yeah, you're talking about ILFS, right?
And Diwan Housing, yeah.
Yeah, so these 2 entities. Now, let's talk about the other aspects as well, because one, you're effectively I feel that you're taking a certain amount of risk that can be compared to equity risk, because when you invest in equities, there is a possibility that all of your money gets wiped out if the company does not do well. But that's not something that you normally do when you're putting money into a bond. But in this case, you would have to be aware of the quality of the company that you're investing in, the debt of which you're investing in as well. So the question that I have for you is that when you look at that and you look at the tax treatment of this, effectively you're going to be paying slab rate, which is, if you're in the highest tax bracket, you're paying 30% tax on the interest that you earn, even if it's 14%. So you're not getting that much anyway, right?
So that's the whole point, Alex, right? That in most of the cases, you have to hold this bond till maturity. And if you do that, what it means is that it's going to be fully taxable. It is only in case of unlisted bonds. It's only in case of listed bonds that capital gains is applicable. But the point again is that most of these bonds are not really widely traded for an investor to go sell it off, right? So there is a liquidity risk, there is default risk. And, on this whole aspect of comparing it to equity risk, I don't think that it's correct, because at the end of the day, you could lose money in the stock, of course, depending upon the financials of the company and all of that. But I think, first of all, you can't compare a bond with equity, right, in the first place. And these bonds come with various other risks, we've seen in some of the cases that there are subordinated bonds that are available. A lot of times these bonds are being sold saying that there is a collateral that's available, but we know how difficult it is to call the collateral, right? So, on this whole comparison, saying that instead of putting money in equity, let me put money in a bond which is secured, right? Because then, maybe I'll not be able to lose my principal. The reality is that we know from past instances how difficult it is to call the security and to enforce the security and for investors to really get back their money. So I think this is not a good...
Yeah, but the point that I was making, I wasn't really comparing equity and debt. What I was trying to say is that if you are going to take on that kind of a risk, then you may as well invest in equity. Why would you go and venture into the far end of the bond market to try and get similar returns when you can invest in good quality companies and get similar returns with better taxation. If you're going to take that kind of risk, and you're actually pointing out that the risk that you're taking is higher in certain cases than you would take in equity. That was effectively the point that I was making. But there's another way that you invest in bonds that have relatively higher credit risk, where these funds exist in the mutual fund space. It's called a credit risk fund. And those two companies that defaulted, when you pointed out, ILFS and Diwan, after that, there's been a migration away from this category. Do you think that investors should contemplate this at all, and what are the pros and cons?
Certainly, yes, they can contemplate this category if they want to take a higher risk in their debt fund investing. And of course, after that incident, most mutual funds have also, kind of veered towards investing more in AAA and AA. So when you look at most of the portfolios right now, you'll see 80-85% exposure to AAA and AA and a very low exposure to really single A holdings. So I think for an investor who wants to invest in debt, doesn't want to take equity exposure, but at the same time wants a slightly higher return, and of course has a slightly longer holding term period of about 3 to 5 years, I think such investors can certainly invest into credit risk fund, keeping in mind that, the funds are investing not in, a fair bit of AA rated bonds.
I do want to ask about the return anticipation or expectation and benchmarking of returns when it comes to credit risk funds, right? Because as you pointed out, they may not be as high as they were between 2015, say, and 2019, because the composition of these bonds, composition of these portfolios has changed, as you pointed out, with a sizable amount in the top rated papers.
Yeah, so I would put it this way, that I think we are looking at about 100 to 200 basis points above what you can really get in a short duration debt fund. That's the way I would put it. Of course, when you look at the 1 to 3 year returns, the returns are looking really good, between 8 to 9%. But I would just say that probably 150 basis points above what you can get in a short duration debt fund for the extra risk that you're taking.
So, okay, so 7 to 9% or 8 to 9% is what you've gotten. And of course, we have to bear in mind that if you're looking at the past 3 years, then and we're looking at today's returns, then there is some benefit that is accrued from the drop in interest rates over the course of the last two monetary policies. So interest rates have fallen by 50 basis points. And whenever interest rates fall in the system, the capital gains that you get on these bonds will go up. And so therefore, there is a benefit there. But the migration out of debt and fixed income as a whole in mutual funds has taken place since the change in the tax treatment, which is that all gains emerging from debt funds are now treated as short-term capital gains and you're taxed at slab rate. And so people have ventured into hybrid funds where you have an improved taxation. Either you get equity taxation or you get taxation at long-term capital gains tax of 12.5% after 2 years. So should investors look at that category instead of this one, credit risk funds?
Not really. Somehow, Alex, I always believe that you should keep the debt and equity allocation separate. And really, not go that much by tax matters is what I would say. Certainly, I do not like conservative hybrid funds and, the categories which have higher amount of debt in any case. At best, possibly an arbitrage fund is not a bad idea, but I would not, I think, the risk profile is very different if you're shifting from a credit risk fund to an aggressive hybrid fund, for example, right? Because then it's more about the equity risk that you're really taking. So I would just, again, go back and say the same thing, that it is really the credit risk fund is meant for investors who want debt exposure, who are, willing to take a higher amount of risk to also get a higher amount of return. And I would actually say it's not a bad category also. In the last couple of years, there's been a good cleanup of portfolios, and I would say that it is certainly a good category to look at as well.
Okay, but if you compare this and if you look at a corporate bond fund, for example, which is also corporate bonds, but mostly only higher rated paper. Is there a significant difference between the two in terms of return profile? And when you're choosing between one and the other, how do you go about doing that?
Again, so corporate bond fund I think the return is going to be about 50 to 100 basis points lower. Of course, the credit quality is much better because 80% is going to be in AAA rated bonds. So again, I would say it's for people who don't want to take any credit risk at all. The corporate bond fund works really well.
Okay. And moving further up the scale in terms of credit risk, or rather I'm talking about having safer investments, relatively speaking. You're talking about gilt funds or government bond funds, right? So out of all of these three, like you would do in an equity allocation, Bryn, where you have a diversification that you do sometimes basis market capitalization, or basis the kind of allocation that you do. If you're looking at a diversified fund, a multi-cap fund would give you the kind of allocation towards all of those market capitalizations. Do you look at a similar allocation in debt funds as well?
So one thing is that, of course, all of these funds need to be looked at for a holding period of about 3 years. Now, investors do need to keep in mind that gilt funds can be extremely volatile, and it's completely dependent upon what's happening on the interest rates. Certainly in a falling interest rate environment, gilt funds do really well, but they can be very, very volatile. And I believe that there's really no need for people to go and take gilt fund exposure directly unless they're doing it as a tactical allocation, right? And this is because if you do a short duration debt fund, there would be some amount of gilts there as well. So I don't feel the necessity for investors in their core portfolio to look at a gilt fund. And as I said, at best, it can be looked at as a tactical allocation. But I think with a lot of the interest rate cuts already priced in, I'm not sure if it's a good tactical allocation at this point, So I would actually go towards the short duration debt fund. I would look at a credit risk fund if I'm willing to take higher amount of risk. And if I still, want to do something further, maybe a dynamic bond fund.
Fair point. And so therefore, just to conclude the first two conversations that we've had, the first, which is investing in individual corporate bonds, particularly lower rated papers, a big no-no. So avoid that. And if you're looking at taking a little bit of credit risk, perhaps you can consider credit risk funds, but know that you have to keep it for slightly longer. Min, of course, prefers the shorter duration funds. But Min, I want to talk to you about one more aspect today, which is buy now, pay later. And we're all familiar with the concept now because it's available so easily to everybody. If you're buying white goods online, then that's something that is available. You get great deals out there. But I saw a report the other day, Yukta, my producer, pointed out to me, Coachella is something that people are going to using buy now, pay later. It's not hit India yet. People are not necessarily going for festivals and taking vacations on buy now, pay later, but it could happen. What do you think about that?
Oh, I've been seeing all these travel now, pay later ads, with this holiday season coming up. So I think it's quite widespread. And honestly, I don't think it's a good idea to do this while you do have some very good deals and it's like, okay, no interest if you pay it on time. But the point is that it really makes you habituated to living life on debt and possibly spending much more than what you have the ability to actually spend. So, spending beyond your affordability. So I actually believe that as far as buy now, pay later is concerned, use it only if there is like some sort of a very urgent need for which, you don't have any other funds available, then it's fine to use it. And the fact is that, again, pay it within that period that has been given, the interest-free period. It works in those cases. Now, using it for funding every aspiration of yours is certainly going to cost you heavy because you'll just get into this circle of taking one and then taking another one to fund the first one and so on and so forth, basically.
So we actually interestingly sent out a poll on social media just to find out what all of you think. And I'm quite encouraged by the results, honestly. Only about 8.3% of you said that you would consider using BNPL or Buy Now Pay Later for concerts and clothes. 37.5% on electronics, which is understandable considering that so many white goods, laptops, televisions and the like are available on Buy Now Pay Later. Travel bookings is 12.5%. Think about that for a bit. And I'd rather wait and save. This is encouraging to me. 41.7% of respondents said that they would rather wait and save. So that's good news, Bryn, and hopefully the others are also listening to you. I just want to ask a couple of things here. Is there an interest component or a cost component in Buy Now Pay Later? How do you understand that?
So basically, if you don't pay it on time and you decide to extend the period, then there's going to be a 36% and odd interest that is going to be charged. And you have one option that at the end of the interest-free period, you can say that now I want to convert this into an EMI. So if you actually do that, so it will still cost you 27 to 35%, which I think is pretty high. I mean, always remember when you're paying this interest rate that your income is not growing at that rate. So you shouldn't be, it's criminal if you ask me, if you have to pay 27% or 35% interest, right? So yes, so on the default, 35%. On converting to EMI, 27 to 35% is the interest rate that's applicable.
Okay. And you mentioned what happens in the event of a default, but what are the other implications? It's like any other debt, right? It would hit your credit score.
Yeah, it's going to impact your credit score. It's going to be there on your credit report in case if you defaulted. And of course, even if you convert it into the EMI, it's going to come up on the credit score.
And so have you seen instances where people have had their credit scores impacted? How much of a dent can you see? Because these are not necessarily the largest payments that you make, 500,000, 2,000 rupees, but then that can add up.
Yeah, I'm sure it can add up. I mean, I don't have exact data on how much it will impact the credit score, but I'm sure it will. And again, we must remember, Alex, that people are not just taking one BNPL. At a time, people who are used to taking BNPL will have about 3-4 of them running parallelly on different sites. So all of that is going to add up in some form or the other if you're not going to pay it back on time.
Yeah, and by the way, a lot of lending companies are actually holding back and pulling back on their unsecured lending, which is essentially part of all of this. This is part of all of that. And so that should give you a sense of the fact that it's become very profligate, and you should bear that in mind. Bryn, thanks so much for joining today and for speaking about everything that we did speak about. Insightful conversation as always.
Lovely to be here as always, Alex.
All right, now there's an interesting update for investors into Bajaj Finance, and I'm not talking about the drop in the stock price that you saw today after the results came through. The company has actually announced a stock split and a bonus issue. So you're probably wondering how many shares you're going to end up with if you are invested in Bajaj Finance. First of all, remember that you have to watch out for the record date. That hasn't been announced yet, or at least I haven't seen it. As long as you hold shares on the record date, you will receive the benefits of the stock split and the bonus share issue. In this particular instance, they've announced a 1:1 stock split. And what that means is that if you have one share of Bajaj Finance, you will have that share split into two. So you will end up with 2 shares. And now on that split, you have the bonus issue, which is a 4:1 bonus, which means for every share held, you will get 4 more. And so if you had 1 on the record date, you will end up with a total of 10 shares. So hopefully that clears up things for you, and you have an idea of how many shares you're going to end up with. Of course, understand that the stock price is around 8,500 or thereabouts, or 8,600 or thereabouts. You should divide that by 10 and expect the price to correct once all of this does take place. All right, now the mutual fund industry is trying to reach out to as many people as it can, and there's an interesting update that has come through from SBI Mutual Fund. They've announced that they're tying up with India Post, and of course India Post is in every nook and cranny of our country. What they're trying to do is use India Post and its network to get KYC done. Here's a report about how it's going to work.
India Post is going beyond letters and parcels to bring mutual fund investing to your doorstep. In a big push for financial inclusion, the Department of Posts has tied up with SBI Funds Management to simplify the KYC process for investors, even in the remotest corners of India. The collaboration taps into India Post's vast network of over 1.64 lakh post offices, offering doorstep KYC services for SBI mutual fund customers. This service will simplify the onboarding process, especially for people living in rural or remote areas where access to traditional financial services is limited. As we know, the KYC process is mandatory for investing in mutual funds, and once completed, it's reflected across all mutual fund houses. Just 2 weeks ago, India Post had also signed a similar agreement with Nippon India Mutual Fund, further expanding doorstep KYC services for mutual fund investors. Now, just days after this MOU was signed, the Supreme Court has delivered a landmark verdict holding that digital access is part to the right to life under Article 21 of the Constitution. The ruling came on 2 PILs that highlighted the struggles of acid attack survivors and persons with disabilities who are often unable to perform facial verification or other visual tasks required in digital KYC. Nupur Dogra joins in with the details.
We have to understand these petitioners had moved the top court saying that iris scanning and fingerprints are 2 essential key features to make them part of this KYC procedure. But now, since due to acid attack or their own visual impairment, they are unable to access all these KYC norms. They are unable to be part of this financial system, digital financial system. Now the top court has in fact recognized this, the right to be included in financial system in digital KYC as a fundamental right under Article 21.
The Ministry of Communications says this initiative supports the government's Jan Nivesh program and aligns with the broader Digital India vision to digitize financial services.
All right. The mercury is rising, and that means your electricity bills are going through the roof in all probability. Now more than ever, air conditioning is being looked at as a necessity and not a luxury, particularly in places like Mumbai and Delhi. How do you keep your bill under control? We've got a few tips and tricks for you. First, take a look at how the bill is calculated. It depends, of course, on your usage. This is described in the form of units consumed. From a Tata Power bill, I've pulled the electricity tariff schedule. What happens is that the per unit cost goes up as you consume more units. So that's how the table looks. The cost per kilowatt hour when your usage is 100 units or below is just 2 rupees. It rises to 5.2 rupees for usage between 101 to 300 units, and the cost is more than double that at 10.79 rupees for usage between 301 and 500 units. Above 500 units, it goes to 11.79 rupees. Now, how do you bring down your usage? Your air conditioner consumes more energy when the compressor is working, and it will work overtime to keep the temperature low. So don't keep the temperature at 18 or 19 and instead keep it at 24 or even 25 degrees, and also use the ceiling fan to increase circulation. With the ceiling fan, not that it makes much of a difference, but remember that keeping it on a lower speed actually utilizes more electricity. The star rating on your big devices will also make a difference. The higher the star rating, the better the efficiency. That's primarily on your AC, on your fridge and washing machine. Then you can also unplug your electronic appliances when they're not in use. There's a concept called phantom energy consumption. That is, it consumes energy even when the appliance is off. Though that's not likely to move the needle too much, but it still makes a difference. And finally, make sure that your air conditioners particularly are serviced before the summer season when your utilization is the highest. Have you already used these tricks and seen a difference in your bill? Let us know in the comment section. And that brings us to the end of this edition of Your Money Matters. Thanks so much for watching. Do stay tuned. This is NDTV Profit.
Apollo Tyres, now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Hello and welcome to NDTV Profit, and you're watching Profit Insights. And joining me today is Vivek Paul, Global Head of Portfolio Research at BlackRock Investment Institute. Vivek, thank you very much for joining us on NDTV Profit. You know, we're going through a age where we are seeing a big disruption happening globally with respect to trade, and that's having an impact in terms of how stock markets are performing and various other asset classes are performing. As you look at it, how do you see the US trade rhetoric which is coming in from Donald Trump impacting flows, and where do you see this getting settled?
Well, firstly, thank you so much for having me on. You're completely right. I mean, it's amazing to think that it's it's still in the month of April where we have had just material shift in the narrative in terms of the global trade dynamic. And we expected, of course, some material news and material rhetoric, but I don't think it's fair to say that many expected the extent of the volatility that we've seen. And you're right that it's shaping flows. And let's take India directly as an example. As we know, for a bunch of years, we saw material kind of inflow into Indian equities from foreign investors, which really started to sort of arrest something in the middle of last year, all the way through to the first quarter. And actually, what's really interesting is you look at the period of flows in the post-April 2nd announcements. And actually that's become positive again for foreigners in India. And I think that really goes to show that this is an environment where there's a relative game and there's an absolute game at play. Undoubtedly, in terms of the absolute scenario, this is an environment where we are going to end up with greater tariffs globally than we had in the past. That seems to be the clear direction of travel. But there's an enormous range of potential outcomes within that. And it is shaping the narrative. It is shaping the trade dynamic. It is shaping the opportunity set for international investors. If I think about our own positioning, our own sort of portfolio recommendations, where we started the year in terms of the sort of more broad Asian kind of complex, we had a near-term preference for China with a longer-term preference for India. As we've kind of come into the more recent period, we've softened that China preference. That's now neutral, given the particular impact of the trade dynamic and uncertainty on China. But we continue to reiterate that long-term opportunity set for India. And I think actually some of the structural benefits India can face in this environment is perhaps even accentuated by the volatility that we've seen.
How do you see, trade shaping up with respect to India, given the fact that in the last 9 days alone, we have seen close to $4 billion of foreign flows coming into the country. And as you said, there may be a pause coming in because there's a trade reversal which is happening from China, and it could be flowing into other emerging markets into India.
Yeah, I mean, it's critical, right? I mean, I guess we've talked for a while, I think, about the idea that India has a unique opportunity in an environment of greater sort of global dislocation from an economic perspective, because it can play a role with both the United States and with China and really kind of insert itself more centrally into some of those global systems. And I think what we've seen over the course of the recent weeks is some of that starting to come true, right? We've seen the idea of major sort of manufacturers of telephones kind of thinking about using India more as a hub for some of that supply. We've seen Chinese exporters kind of think more about using Indian companies as a means of gaining access of their end exports into the American economy. So I think you're starting to see some of the dynamic we were postulating before coming through. I think that's one important point to make. I think there's another point I think implicit in your question, which is the ability, I think, of India to kind of come out of this with a relatively more favourable outcome. And you've seen comments from leading officials in the administration saying that they anticipate sort of progress with India and some of those trade talks to be accelerated relative to international peers. And that makes sense, because actually, if you think about the share of the sort of US imports that are kind of affected by this for India is comparatively small. The Indian economy is relatively resilient to this dynamic. And actually, structurally, from a sort of geopolitical perspective, it's probably an easier deal to be done with India, at least according to the US officials, than there is perhaps with China. So the ability to kind of make more material progress in terms of getting a deal, the starting point of the fact that there's less interconnection between India and America relative to India and China in terms of those supply chains, mean that perhaps we do see a more favorable outcome, and that will lead to more stories, like I started this answer talking about, of international trade being sort of rewired a little bit through India.
How does a portfolio manager look at it from the point of view of asset allocation? We're seeing Trump flip-flopping on announcements. There is a great deal of uncertainty which is coming into play. That's creating a volatility in place for a fund manager who's planning to allocate through various geographies and asset classes. What should he be reading, and how do you see that translating into investments into geographies or asset classes?
Yeah, and this is the debate that we're all having in the asset management community, and I guess more broadly, investors at large. And I think one thing I would sort of caution against I think trying to predict the next headline, the next kind of bit of news flow with regards to trade negotiation or whatever else it might be with regards to the trading policy set is really hard. It's a fool's errand to try and understand exactly or try and forecast exactly the next step in a negotiation pattern. What I think we can do, though, is try and think, where are the boundary conditions, right? Where are the bigger kind of sort of dynamics, which mean that will prompt a reversal in a particular path or the rhetoric. And we're kind of framing this in the notion of thinking about the immutable economic laws that are actually going to govern what the end state looks like. And there's two that we particularly highlight. One is to do with the idea that you can't just, if you like, you can't just kind of change the terms of the trade deficit without having an impact on the foreign sort of flow and foreign funding of US assets. And I think we saw that sort of immutable law dynamic really coming into fruition right at the start of April, where we saw the 90-day kind of pause on tariffs come immediately after the fears in the treasury market of spiking yields. And I think you see there that the idea that the market forces of the yield movements kind of then influence the ultimate direction of travel of policy. I think you also saw some element of that when it comes to the second immutable law that we think about when we're trying to govern the space and navigate the space, which is the idea that the trading interconnected nature of the global economy has taken decades to build, and you can't just change it overnight without experiencing or anticipating some material economic damage. And I think when you saw in the course of the last couple of weeks the idea that leading CEOs were kind of pointing out to the world that there could be some impact here from kind of trying to change too much too quickly, you then again started to see some softer rhetoric come out, and therefore a bit more of a market rally in the course of the last week on account of that softer rhetoric. So trying to guess the very next move is really impossible. Trying to think about what are the bigger picture boundary conditions that can then influence the ultimate outcome, I think that is where we need to think a little bit more. And in that spirit, in that vein of taking that slightly bigger, longer term approach, that's where we see the opportunity arise in India, because the structural dynamics we've been talking about for a period of time, the demographic dividend that India faces, the digitization of the Indian economy. These are structural drivers which we think it's important to focus on, because it can be very easy to get carried away with the very near term and only focus on, if you like, the very near term tactical dynamics. We actually sometimes need to take a little bit of a step back, and that's where the structural opportunity lies. And the final thing I'll say in answer to your question, when we're building longer run portfolios, for an international investor, we would indeed think a little bit more about holding a greater allocation to benchmark weight in Indian large cap equity.
If you look at how the trade is playing out, whether in equities or geopolitically, there's one section which is the central banks who are acting in a different manner. We have the European Central Bank, which is trying to ease in. There is the US Fed, which is trying to hold on to rates and trying to ward off the inflation or the sticky inflation which is coming in. In India, we have the Indian Central Bank, which is trying to ease rates again to push growth and credit offtake. How do you see all this playing out? And because all these will also influence the way portfolios are going to be built or the flows are going to come through. It's a little bit of dynamic in nature, but it still becomes tricky for a fund manager like you.
Yeah, absolutely. And I think let's kind of split this into thinking about what's going on in the DM world, in which there's still going to be some divergence, and also thinking about emerging markets in India. And in the DM world in particular, something that we've been talking about for a long time is this idea of this kind of structural tension between growth and inflation that is more prevalent in this environment, in this era, this new regime that we've seen in the last 3 to 4 years. And what I mean by that is there's a greater trade-off between prioritizing growth and prioritizing inflation. And it becomes becomes particularly tricky for some of those central banks who have more of a formal dual mandate. So if I take that sort of framing and apply that to the developed markets, in Europe, I think it's clear that the direction of travel is towards more easing to kind of shore up some of those growth fears, which have been more accentuated in the environment that we're in. In the United States, the difficulty there is that actually, well, firstly, the hard data continues to sort of support the fact that the US economy is in a relatively resilient state. We're going to get more important economic announcements over the course of this week to come that will give us more clarity on that. But the additional dynamic in the United States is that inflationary pressure continues to be somewhat elevated and somewhat persistent. And in an environment where we see tariffs increase, that is going to contribute to that inflationary pressure in the United States. When we switch to the emerging markets, when we switch to India in particular, it's a little bit of a different dynamic because it's less clear whether or not this is an inflationary or a deflationary dynamic when it comes to some of these countries, because the impact of tariffs is directly felt and also indirectly felt. Directly felt maybe for some countries is less extreme than it would be for major trading partners of the United States. Indirectly felt might be more important, because if it prompts a broader global slowdown, well, maybe that influences the inflation picture in those regional economies a little bit more. So the same global dynamics can have very different impacts for the path of rates in each of these different regions that we've talked about. And just to summarize to your question, I think we should expect greater volatility. We should expect greater dispersion. That's part of the environment we're in, right? This is not a story where all markets are going to go up and all markets are going to go down. This is much more a story of regional differences, of granularity mattering when we're building portfolios. And when we're trying to kind of navigate this environment, it's very much focusing on that granularity point more. We can't just assume all global rates do the same thing for the reasons we mentioned. We need to be more targeted in the exposures we're taking. That's the only way I think we can try and navigate this environment.
Mm-hmm. You spoke about the fact that you have preferences for benchmarks, heavyweight, if that is the case, which are the big sectors do you look at? Because of late we have seen financials are the one which are the new defensive, which is emerging in globally as well as in India. That's where more maximum funds or flows of parking themselves. Do you see there's a shift in the way flows are now looking at way to park themselves? Because at some point in time, FMCG used to be a defensive, or pharma used to be a defensive, but now globally we're seeing that financials have become the new defensive in that sense.
Yeah, there's loads to unpack in that question. First point I'd make, exactly to the dynamic you're talking about, we need to think of this much more in the lens of structural megaforces that are shaping the global economy. And some of the ones that we've really called out, we've talked a lot about this already, the geopolitical rewiring, which, as we mentioned, has a benefit for certain regions such as India. But also, I'll highlight two additional ones. AI as a transformational force, that's something we continue to believe structurally in. And that is part of the rationale as to why we think, well-targeted exposure towards, American companies still continues to make sense in this environment, because some of the greater beneficiaries of that AI megaforce are likely to exist in the United States. So that's a dynamic, I think, that we've seen, particularly in the recent re-rally of the global markets. AI kind of beneficiaries have kind of come to the fore there. But another megaforce we talk about is the notion of the future of finance evolving, the future of finance changing. And that is something to do with the nature of how people access the global economy, the way in which companies and governments are kind of funding themselves. And this is an environment where, indeed, I think financials can stand to benefit in certain regions and in certain sectors. And India is a case in point. So to directly answer your question when it comes to India, the sort of digitization trend, the financial services trend is something that we think is an important driver of future growth and future opportunity. But the final thing you mentioned, I think, is another really important one, which is the kind of characteristics given to certain sectors can themselves evolve. And you rightly highlighted pharma and healthcare. This is something that historically would have been seen very much as defensive sort of play. Now, more recently, it's become much more in the crosshairs. It's much more sort of central to the global narrative. Think the COVID experience, or think the kind of intersection it has with the dynamics around trade. So we shouldn't just think about the historical relationship some of these sectors have had with broad beta exposure. We've got to think more, how do they play out now with regards to the evolving megaforces? And so directly to your question, yes, I think there are opportunities in financials because of some of this future of financing trend evolving, particularly therefore in India. I think there's opportunities in AI, and that means some American stocks benefiting from that. That also means ancillary sort of companies who benefit from data centers and sort of the secondary beneficiaries. And we need to kind of re-question, is something defensive, is something pro-cyclical, because actually maybe the mega forces that are influencing it in a different way now.
Before we start, saw this reversal of flows maybe 6 months back. We were trading at a very high valuation, and then we saw correction across the board, whether it's the large caps, the mid caps, or the small caps. But the argument is that despite this steep fall of 30-40% for many of the stocks from the top, valuations are still rich in emerging markets, especially in India. So where do you see and how do you see flows and investments coming through for these companies? And is there a way to look at what works now or which stocks to go through?
Well, I'm going to take the other side of your argument a little bit. I would argue that actually for large cap stocks in India, I don't think things are expensive. I would not argue that they are expensive, and I know that's been something that has been said. But let me expand on why I believe this point. It's undoubtedly true that if you look at price earnings multiples and you compare them to periods of the past in Indian large cap stocks, then it's not obvious that it is anything other than medium to rich, and that perhaps is where this framing comes from. But I'd argue that that's not the full story, because when we think about price earnings multiples, particularly forward ones, we need to also consider, well, what are the earnings prospects that are likely to occur? What is the path of interest rates that is likely to occur? And that's why we actually focus a little bit more on the equity risk premium metric. So the idea of what is the risk premium market participants are assigning to Indian large cap stocks. And we find that on that metric, so allowing us to take into account our future expectations on the path of earnings growth and our future expectations on the path of rates, actually, we don't think Indian stocks on the large cap side look particularly expensive, particularly when you then compare it to regional and international peers. Now, on the small cap and on the mid cap side, maybe there's more of a story there, but this is why I would argue our preference would be very much on the large cap side, where I think there is more of a valuation benefit to be had. And so the kind of answer I'd give to your question is I would take the other side of the central framing that Indian stocks are automatically very expensive. I think when you look through the longer term picture, maybe they're not. And the reason I give that, again, just going back to my earlier point, is those structural drivers, the structural benefits that India has, where it's positioned on the geopolitical side, the demographic dividend that it kind of is likely to experience. That means that there is a case, we think, for those investors who can look beyond the near term. We're investing over the next 5-10 years to access Indian large cap stocks at, I would believe, reasonable levels today.
Finally, Vivek, if I were to ask you to give me a sense of which asset class would outperform from here on, and if I'm looking at gold, equity, bonds, forex, or fixed income, how do you see each of the asset class looking at, and especially gold, which has run up a lot in the last 1 or 2 years? How do you see asset class returns going forward?
Yeah, great question. So I would frame my answer to your question when in the context of we need to be really explicit about the time horizon we're considering when answering this. In the near run, with huge uncertainty that we have, with the idea that there's kind of things that we can learn over the course of the next couple of months that can really shape the years to follow, I think an asset class like gold can play a diversification role, which is maybe a greater one than it could have done in the past, for the reason that some of the other traditional diversifiers are more challenged in this environment. So historically, for the entirety of my career, when you see some element of a global growth sort of slowdown, you would anticipate that maybe long-dated United States government bonds would be a good asset to hold, because typically there is a flight to safety and those assets comparatively rally. That is not the environment that we're in now. Like we talked earlier about this idea of this immutable law and the notion that, actually the sort of spikes in bond yields can prompt changes in the ultimate policies that are pursued. That's the risk right now. We anticipate a greater rise of term premium, or the compensation that investors demand for holding long-dated bonds. So part of the attraction for gold in the very near term is actually some other typical diversifiers, such as long treasuries, are not, I believe, going to play exactly the same role. The dollar is another one. We've talked about that a little bit already. We've seen in the period since April the 2nd that actually the dollar has not played that traditional kind of safe haven status. And in this particular environment of this type of uncertainty, I would not anticipate it doing. Now, when you go to a longer horizon, that's when it starts to get, frankly, even more difficult, because there are worlds out there, there are paths out there which look very different from one another, right? I mean, if you were to kind of say, is there an environment where United States interest rates are at 5%? Is there an environment where United States interest rates are at 2%? I think both of those are potential outcomes that could occur in 5 to 10 years. And they are remarkably different views of the world. So it's much harder to have like a sort of real strong conviction across relative asset classes when it comes to the long end. What I would say, though, is that we would not use this period to be risk off on a strategic horizon basis. There are structural opportunities, but maybe it's not the traditional ones that we've talked about. For those clients of ours, for those investors who can access some of the private markets, I think maybe that's where some of the structural opportunities rise. The idea of infrastructure, I think, as a global demand for sort of retooling domestic infrastructure exists and governments aren't able to fund that, that is something that I would lean into on a long-term structural basis. And I would also say that developed market equities, when they are well positioned to kind of take account of these structural megaforces, emerging market equities, when they're well positioned to take account of these structural megaforces, also have a role to play in a structural portfolio. So much harder to do on a long-run basis. Near-run basis, I think there's a reason and a rationale for gold having a comparatively safer bet than other traditional diversifiers.
Vivek, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit.
Thank you so much, Sajid.
Apollo ties. Now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Apollo ties. Now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March.
Amid global uncertainties and market volatility, SEBI, the market regulator, is steering through a complex financial landscape. Complex because the world order is resetting and no one knows what is going to happen next, how the global market is going to react. To shed more light on the evolving dynamics, we have with us none other than SEBI Chairman Tuhin Kanta Pandey. Chairman, sir, thank you for taking out time for us. I would like to start with, during your first day in office, you clearly set a tone by telling that, the focus area will be transparency, trust, teamwork, and technology. It's been 2 months in office. How are you driving your agenda forward, and what is your, the most significant learning so far in this current scenario?
Well, first of all, I'll take it from what you said. We have a fair amount of global headwinds, largely out of the trade policies and trade barriers that are coming. And that has, again, implications for capital markets. Be that as it may, we will have to deal with the situation in the best interest of Indian capital market. So the trust and transparency, I say that, of course, all four T's, as I say, that basically they're pretty interlinked. But coming to the first issue of trust is a wider issue of how the people view SEBI and also how does SEBI view its ecosystem and other market participants. So this mutual dialogue and the mutual thing which needs to be appreciated, the feedback and the mechanism to consult. Of course, we do have an established system of consultations. Those consultations need also to be more nuanced, more rigorous, and I think a discovery of really fine-tuning the processes, so to say. And transparency is again issue of how the market gets the information transparently about the issuers, and how the issuers, both in terms of IPOs, in terms of listed things, and also how the SEBI, whatever it does, also is transparently available. Same thing is with teamwork. Teamwork is not only an internal teamwork within the SEBI, which includes different divisions, different departments, how to break the silos, how to bring them together, but also to have an external teams, which are so very important. The teams which are there from market intermediaries, market participants, and other players, the committees that we have, the PMAC, the SMAC, the IPAC, and how they are then sort of able to work collaboratively. So that is a broader teamwork issue. And technology, as you know, is a very important part of the piece, a very important piece now in capital markets. Technology with what the regulator has on both SupTech that we deploy and the RegTech, which is the regulatory technologies which regulated entities employ, and also the market intermediaries, the MIIs, the market infrastructure institutions deploy, and the risks that also get posed through the cyber risks and other risks, including of course on AI and computing risks.
Since we're talking about global uncertainties, you had your recent US visit. How's the mood among the foreign investors?
I think I was in fact quite delighted to see that there's so much interest that India has currently, and despite the global headwinds, I think India has been able to provide very consistently. If you take a 30 years period since 1990s, Indian markets have provided to FPIs upwards of 8.5% rate of return, X of dividends in dollar terms. And if you take any period, 5 years, 10 years period, I think the returns that Indian markets have offered to these things are consistently much higher than either the emerging markets, other emerging markets, or China, or even developing economies. So that is one which has been very well appreciated. The second part is the opportunities that India offers in terms of the consistent growth rate that India has been able to achieve, one of the highest, fastest growing economies among the large economies. Consistently, the demographic dividend that it has, the talent pool it has, the policy space which is available, the fiscal consolidation, the corporate balance sheets and the fiscal balance sheets are in good shape. So I think the overall they are looking at India as potentially a very important market for deployment. So there is a great deal of enthusiasm.
I'm sure, sir. So, taking cues from this, and clearly that India growing role in the global portfolios as well. So do we see any ease of rule in terms of foreign portfolio investors? And in fact, what is being worked out when it comes to allow foreign investor directly into Indian equities?
I think this was when, of course, when I visited, there was also IMF conference and spring meetings. And I attended also the ISCO, which is also the meeting of the regulators. And there is a financial stability expert group, FSEG. And we could share, different things, and also the engagement with FPIs at New York as well as Boston, and also in Washington DC. Now, this engagement process actually gives a lot of feedback. It gives you, sort of ideas where you can also simplify things, make it easier. A lot has been done. For example, there's an FBI outreach cell in SEBI, which has reached out to over the last few months, to about 2,000 FPIs, looking at their issues, if any. There is a common application form. A lot of improvement has been made there. The registration process, a lot of improvements have been done. And of course, there is a scope for more. And I think this engagement process will be able to, allay many of the concerns that they might have, and some of the recent changes which have happened for ease of doing business. They would be really, this engagement process puts, underlines that, and that there's an improved understanding about the Indian regulations.
So all you mentioned is the compliance side of it. Do we see some regulatory tweaking also in terms of the rule which we have at this point of time? Do we see something in the near term in terms of tweaking and modifying the rule which we have?
I think one is that, we will be constantly, in the engagement. I mean, we'll intensify the engagement. That gives you pinpoints that whatever we might they might have, and we can remove them. And it's in the context of, in general, simplification, rationalization exercise that we have undertaken towards what we call optimum regulation. And I think every department in SEBI is currently has started working on, how we can simplify the regulations. So to achieve more effective regulations, get that impact at the same time, whether we can get more with less onerous regulations, with less micro regulations, can we have the same kind of effective so far as the risk is concerned? And I think that exercise is started.
So talking about the regulation, one regulation around, FNOs, the derivative markets. Everybody is talking about that, whether it's a over-regulation or not. But one thing the experts are saying about that, this could hurt volumes because the way it is designed, it's skewed in favor of large institutional investors. But of course, SEBI is coming from the point of view of retail investors, because you have studies talking about 90% retail investor losing money. How are you seeing this? What is your assessment at this point of time? And do you see that it's an over-regulation when it comes to derivative segment?
In the derivative segment, we had some issues around it when we studied this matter, and we put it out as this report also in public domain, where we said is at least 9 out of 10 small investors were actually losing money. The question is that whether the particular methodology which they were deploying was good enough, whether there was proper education. And we found that there was a particular problem in terms of, index options on the expiry day. I think that is where we find it was truly distortionary. The purpose of F&O market, which is also a very important market, is to hedge risks and also help price discovery. So to that extent, I think the market does that job. The derivative market is really important market. But sometimes I think if the distortions come in form of a particular way that we are looking at it. So therefore, we put out a consultation paper saying that, when we need to change the metrics, the risk metrics, where for options, in terms of risk metrics, we were having apples and oranges issue. We were, summing up, different components like futures and options. They're slightly different. And options, we were not counting the delta. And that delta is now, we intend to bring in so that we know exactly, how the, everyone understands what the risks are. And there are also certain things about the limits that was prescribed and some manner in which it will be done. The number of days where the index options were restricted, weekly expiries were restricted to 2 days. So these measures were really trying to take it from the point of view of holistically, not really trying to, unduly throttle the market, but to make it more this thing and improving the systemic nature of the market. So we have received a large number of 800 odd comments have been received, and we are seized of the situation, and soon we will come out with the clearer regulations around it.
Do we see guidelines soon, maybe in next board meeting?
Yes, these are the things that we can do. You don't require a board meetings for it, approval. This is something which we can handle based on the position paper that was put out and the comments which we received. A considered view will be taken.
So on the IPO momentum we have seen since February, there is 1 or 2 mainstream IPO. Do you see that the slowdown is attributed to the global uncertainty, and how you're seeing the IPO market in rest of the year?
Well, as you know that last year was a very big year for IPOs. India had the largest number of IPOs anywhere in the world.
Yes.
In fact, there were markets where IPOs are very difficult to come by. In India, we have a very big pipeline of IPOs which is there. Of course, the markets do adjust. Last few months, especially 2-3 months, have been fairly uncertain. Uncertainty is still there in the minds of the people, but last 2-3 months have been especially problematic in terms of where the world is going. So therefore, capital raising has been slightly, as I said, that postponed by many issuers, which I hope that it will resume soon, because as things get clearer, they may still get further things. So we hope that this will the new IPOs will start.
So we have seen a BSE IPO, and I'm on the NSE IPO status. I just wanted to understand where it is, what challenges is it facing, and what is the regulator view when we could see some green signal from the regulator to NSE IPO?
I think the NSE and SEBI are in consultation on some of the key points on market governance issue, technology, litigation, pending clearing corporation, and some of these points, have been gone back and forth. Hopefully, that should be resolved early.
So, any timeline given on the IPO?
I'm not able to give you exactly the timeline, but I can only say that this will be taken forward.
So moving on the corporate governance part of it, when a GenSol kind of incident happens, it affects the sentiments of investors, particularly in the startup IPO. Perhaps, more than drop in a price after listing, it's more about the trust factor gets shaken after such instances. Do you think it's one of a case where, promoters are at fraud, or you think that there's some steps or measure has to be taken to avoid the reoccurrence of such instances?
Well, I think it's a case of egregious behavior by a few. And I think no matter what kind of regulations you do, no matter what kind of laws you pass, there will be, if there is an egregious greed, and if there is, in my opinion, also inadequate supervision, because we can't be there in every boardroom. You have auditors, you have independent directors, you have people who should ask questions, key questions, and there is quarterly results. There are people who are informing in the exchanges. So as a regulator, we can only do as much. In fact, you would be asking that we ask too much.
So of course,
but still, if there is a certain, like if there is a, false information, if there is a, fraud, or if it is a moving of funds which is not correct, I think in the order, forensic audit also has been ordered. So I think these are the kind of egregious behavior which, nobody likes them, but they do happen, and I think they should be penalized for that, whosoever is responsible.
Similarly, in the SME IPO situation also, we have seen a lot of these tax evasion angle is coming up, it's emerging. So do you think that both exchanges, stock exchanges and merchant bankers should step up, be slightly more vigilant about the documents which they are handling as far as SME IPO is concerned?
Surely, I think there's a lot of responsibility on the merchant bankers on this score, because I think they should do a better work out of about that. On our part, I think that initially we have brought in some changes in the guidelines in terms of profitability. For example, there's a minimum operating profit has been mandated. There is also certain other tightening that has been done, that you could use the funds only for certain purposes, and not for your general corporate purpose, cannot be more than a certain limit. So we've brought in certain restrictions in order for that thing, and this money cannot only be simply for the repayment of loans from the promoters, for example. So, but
it seems that it's prevalent in
But the
this
scheme was basically to facilitate the IPOs, in the point that helping the small and medium enterprises to raise resources possibly better and reduce their cost of compliance, and so therefore it was given to exchanges to approve, and instead of everything coming to SEBI. But I think that we have to really look at it. We will be watchful of how the things go on, and we hope that all the relevant parties in this will do circumspection while sort of reviewing the documents and putting it through, and the exchanges
all checks
also,
and balances,
and all exchanges also doing their due, because as a first line of regulators, in this case they are the ones who actually regulate and give approvals. So we expect them to do that, because that's what the scheme was meant for.
Yes. True, sir. Absolutely fair point. On the investor protection side, sir, I have two questions. One on the finfluencer role, the way they are coming up with all those stock tips, etc. How you are going to regulate that? Is there any broad framework in mind? When could we see some curbing there? If you could share some thoughts around.
Some of the points that on finfluencers SEBI has mandated is that unless and until they are registered, the SEBI intermediaries, market intermediaries will not be able to interact with them and all that. So that for, really looking at, their business model should not thrive while they are not getting, doing registered. And secondly, particularly if they are giving any false promise on the returns, which they cannot do. So I think efforts of SEBI has resulted in about 70,000 such things being taken down with the help of different social media platforms. But we need to be vigilant, and we need to continuously do that, because they can again spring up and things like that. On the other hand, we are also trying to ease the entry of the registered investment advisors and the RIAs, And recently I also met their association. Some of the work which has been done in case of their own rationalization, I think we need to do more also on ease of doing business for them. There is also for Parva, there is a for past performance and accreditation, a new system is being brought out. I think both we have to see that this registered profession where the do's and don'ts are clearer, they grow in size, they are more, they come to advise the people, and at the same time the advisors who are self-appointed influencers and violating, they are taken down and the action is taken on them.
So Finfluencer is one part of it. Of course, the face is, you recognize the face and you fall for it as retail investor. But on the other side, the stock tips, across social media platform, for example, WhatsApp, Telegram. Are you in touch with these social media platforms as well to get some idea, some surveillance there as well on the tips where there is no name, no face? How to sort of curb that, how to reach out to the depth of it, to understand how to...
One of them is also to see the education, because I think we have been constantly putting it out, and we will also further accelerate it with the help of this, or investor education. Or when you are trying to get it, to not to fall prey to these kind of advice, which is especially meant to actually dupe them because what kind of interest one might have on this stock tipped advice. A simple question, if you ask him, why someone is advising me this in an unsolicited way? So there must be some interest which I must try to find out, and therefore I think the investors should go towards, see more of documents. So much is online is available. And I think they should get into a league where if they really want to be serious investors, and that will be my appeal to them. And I will really urge them to be more circumspect and not to fall prey to this, doubling return, tripling return, or stock advice of that kind. And, and if at all they have, they should, approach the registered ones.
Absolutely, sir. So moving on the common KYC system, there has been talk. Any progress there, and what's your view now? Again, it's you think that in the current scenario, we can have common KYC at this juncture? I mean, is it viable? Is it able to, regulator would be able to implement that? Because there has been it's been a pending thing.
Yes, I think the central KYC is an important issue. Now, we do have, as you know, under the SEBI system, we have a common KYC system where if you get registered, it goes to KRAs, and from there it can be free, it can be then downloaded and shareable. You don't have to do it again. So it's a common there. Now the issue is that how seamlessly the central KYC and the KRA system of SEBI can be made interoperable, and that will be our effort, that it can be very simply be made interoperable, so that at one we will have just one KYC, at least so far as PMLA matters are concerned. From their point of view, if we have one KYC across the financial regulator, that will be great. I think that will be our effort to resolve.
So if it's get implemented, any timeline, one, and second, how this is going to benefit investors in a long...
I think the Ministry of Finance is abreast of this matter. RBI, SEBI, we are all working in a committee, and the PMLA rules also needs amendment. This whole thing is a matter of priority for us.
So one question which comes to everyone's mind, it's a bit offbeat, but on cryptocurrency, government has been working on paper, we will see it's coming forth. But from the regulator point of view, what is the SEBI view on the cryptocurrency regulation, sir?
Well, cryptocurrency is a policy issue. So it's for the Ministry of Finance to really decide, because it's not with SEBI. So far as SEBI is concerned, this is not a security yet.
Yes, sir. But the suggestion has been sought from all the regulators, including SEBI. So just getting sense what is SEBI view on the crypto regulation?
No, crypto means is not a regulated thing at all. I mean, so far. So I mean, that's my thing, and let a policy decision be taken on that.
Well, that's the wrap of this special conversation. Thank you, Chairman Sir, for sharing your insight and observation. Thank you very much. I appreciate your time.
Apollo ties. Now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know?
Hello and welcome to our special show, Gold Rush. Now we hate to tell you so, but your grandma and your mother was so right. The Indian women's love for gold has now passed the acid test of global uncertainty. With Trump's tariffs and the world economy in chaos, everyone is now flocking to buy gold, the safest possible haven. Gold is extremely valuable now. Today, that is on Akshaya Tritiya, the price of a 24 karat gold is inching closer to 98,000 rupees per 10 grams. 22 karat gold is closing in on 90,000 rupees per 10 grams. And now, today is Akshaya Tritiya, like I said, and it is a customary to make a purchase of gold in many families. My colleague Charu Singh is at Mumbai Devi Road at a jewelry store, and she's with some excited customers. Charu, how is it looking there?
Hi, so as you just said, Akshaya Tritiya is an auspicious occasion for the Hindu and Jain religion because they believe that the wealth accumulated in any form on this day is only going to double over and benefit over the coming years. Now, we are here at the Zaveri market in Umedmal Tilokchand Zaveri, who have been here for the last 100 years, and we are going to be talking to Mr. Suresh Jain to, basically explain to us how this entire thing is, played out, how many customers come, and how there is an excitement about the entire hustle bustle in the market. So sir, बताइए आज के दिन कितने लोग आते हैं?
आज का दिन ज्वेलरी में एक बहुत बड़ा दिन है, 3.5 मुहूर्त का दिन है और बड़ी अच्छी बात है। अक्षय तृतीया के दिन लोग धनतेरस की तरह साउथ में इसको सेलिब्रेट करते हैं और आज यहाँ पे भी जिनको लेना है वो एक अच्छे भाव से, जो भाव 1.25 लाख 1 लाख 2,000 पे चला गया था, आज 96,000 हुआ है। तो भरपूर सुबह से हम लोग आए, 9 बजे से आए, रोज यूजुअली 11 बजे आते हैं, 9 बजे से बाइंग शुरू हुई है। कोई कॉइन लेके जा रहा है, कोई बड़े सेट लेके जा रहा है, इस तरह की अच्छी ग्राहकी चल रही है। एक बेस्ट टाइम है। 3.5 मुहूर्त की वजह से लोगों का उत्साह भी और बड़ा हुआ। लोग ऐसा मानते हैं कि कॉइन ले जाते हैं या कुछ भी सोना ले जाकर घर में उसकी पूजा करते हैं और उसके बाद उसको कबाड़ में रखते हैं, सालों साल वृद्धि होती है। ऐसी फीलिंग के साथ लोग खरीदारी कर रहे हैं, एक अच्छी सी खरीदारी हो रही है।
And we must also understand that from the last year, this festival has given, an increased rate of about 32% in the rate of gold. And as per several analysts as well, the rate is only going to increase to up to even 7% for the next year. However, there have also been recommendations made to, go up to buying silver as well. That's all from the ground report of NDTV Profit for now.
Well, yes, let's also welcome in Sachin Jain, the regional CEO, India World Gold Council. Sachin, coming to you first, 32% jump in the last 1 year, but what we have seen in gold prices. What is your analysis showing? How much more of an upside can we expect when it comes to gold?
Hi, first of all, thanks for having me on and wishing all your viewers a very happy Akshaya Tritiya. As your colleague just now mentioned, it's a day by which, prosperity happens, things multiply. And I'm certain people who've invested in gold and have perhaps bought last year have felt that this is the truth. To your point, what's been happening with gold? We at World Gold Council don't predict price, but the fundamentals on which gold demand is based on, the gold pricing is based on, things like geopolitics, things like a safe haven promise of gold, things like central bank buying, the investor class that's really been accumulating gold, particularly from the last from the 1st of January upwards. I think the pillars of strength of gold are very much in the favor of what gold is. So I think it's going to be a very strong foresight even for the coming time. And my only bit would be that you need to look at gold from a long-term perspective, a long-term view. And from that perspective, it's certainly going to be performing very well.
As you were mentioning that there are multiple fundamental reasons why gold prices are rising higher. But can you just give us some idea of how long will this upcycle in gold prices last?
Well, actually, there are various reasons, as I mentioned. So if you look at last year, the dominant factor of the whole progress or the change in price that we saw was geopolitics, started by trade, by the real wars and moving into the trade war conversation. The first quarter was dominated by the trade war conversation and how the Liberation Day would sort of ease it out and get more clearer. If you look at the last few months, it's been largely dominated by the financial markets where the investments have gone up. I mean, look at gold ETFs. Last entire year, the addition of the AUM was about $3.8 billion. And just this year, the addition has been upwards of $17-18 billion. That's already happened. And, if I were to share some rallies with you, the $2,000 to $2,500 per ounce took about 1,780 days. The $2,500 to $3,000 took just about 220 days. And from the 1st January, and we dished at $3,500, took half of that time. So it's been a very strong upward movement from that perspective. Now, what element will play out? I think when you look at long term, the elements around central bank buying will be strong. The elements around, how geopolitics is not going to be all settled down will play out.
So, you've seen prices kind of, seeing a very significant uptick. Like you said, investments and the financial markets have what's been driving. But we have seen somewhat of a correction, I wouldn't call it correction, some weakness in the past 2-3 days in terms of prices, even today morning. Do you feel that, the bull run is over or there's more to go? And would there be a period of consolidation or correction, or could we see the bull run continuing as it is?
Well, I think what you mentioned, I would say as correction, and I would agree to you that these are corrections and small sort of adjustments. But I wouldn't see, when I look at and the whole analysis of what's happening around gold and what's the pillars of gold, I think the mid to long term, a lot of that is in the favor of gold and the gold's growth. Now, some corrections will happen, perhaps yes. Would it be certain to saying what's going to happen to gold in the long term? Long term elements are very strong. That's what I would repeat. So short term, I wouldn't worry so much. And the fact being that the confidence in gold is strong, the confidence on central banks of different parts of the world is strong, and those are the core elements which impact the gold price.
And coming from, from the demand perspective, right? Like today we are having this chat because it's Akshaya Tritiya, but I saw in the release, the demand for jewelry has gone down, and it's consumer behavior when prices are going up, somewhat hesitant to buy fresh gold and jewelry. How do you expect demand to play out from the jewelry standpoint and coming from there?
Well, actually, it needs to be well interpreted. So when our report says that the volume has gone down, whereas the value of what the jewelry has been bought is upwards of 22%. Now that's huge. The fact that consumers have invested their hard-earned money to buy jewelry for that increased percentage is a big promise on their confidence in gold. If a family has, for example, in a budget for a wedding is 100,000 rupees, that budget wouldn't become 140,000 rupees as gold has gone up. But the share of 100,000 rupees for a wedding, the share on gold has only gone up. That's purely how confident consumers are in jewelry. So when you look at consumer demand for jewelry, I think we need to look at it from a value perspective as well, which certainly has gone up. And we've always historically seen, and be it level of when gold was at 20,000 rupees to 40,000 rupees to 60,000 rupees, and last year hovering between 60 to 75,000, every time the price of gold goes up, the consumer waits and watches. Once it's consolidated, the consumers come into the market. And that's what we believe will happen this time around as well. Unfortunately, what's happened is in the last 3 to 4 months, the rally has continued. The price is really, moving so fast, which the consumers not been able to sort of, lay their hands on what they could call is stability. And I foresee that consumers will come back. And you need to look at the consumer demand from the lens of value as well as volume. And when you look at the value, so if I'm an individual or I'm a family, I have only that much money and I've invested that 22% more of that in gold. And that gives a great sign of confidence.
Right, sir. So a couple of questions on the macro side. Now, as you were mentioning that one of the reasons behind this rally overall globally in the gold prices is the fact that central bank has been buying. You have access to so much data, so much analysis that goes in. How much more or for how much long more will this buying from central banks globally will continue for gold?
Well, see, central banks' minds is again dependent on how the geopolitics environment is, number one. It's also around this whole growing conversation around de-dollarization. It's been going around, and that's not today, that's been going on for about 18 months. The whole conversation around the weakened dollar. And generally, when you look at the various things that are happening between banks and the debts in the world, if you look at just the debts that are happening in the world of A country versus B, it's just huge. And I think the growing element around, particularly around the sort of growing markets and the developing countries, the importance of having your strength and your sensibility around gold is playing out. I mean, we've seen over the last 18 months, last year, the large impetus was by the Central Bank of China buying. Then India has been buying quite a lot. RBI has bought quite a lot. 2023, we bought about 17 tons. To 2024, RBI bought upwards of 78 tons. So that's been a huge growth. And we believe that that's impetus around again, the environment around geopolitics, around de-dollarization will continue, but countries will be investing in gold to have a reflection of their strength.
Got it. Sachin, lastly, what about the demand from the ETF perspective? How is that playing out?
Very strongly. I mean, ETF is a phenomenal product. I think it's a product that sort of you can fractionalize the buying of gold. I mean, the smallest unit, one single unit, is 90 rupees. That's 0.01 of a gram of gold, which is great. I think as a product, it's regulated. As a product, it is backed by physical gold. And I think the Indian consumer, as we go forward on more awareness on ETF, I believe it's going to go much, much stronger. To give you some numbers, end of 2020, 1st January 2024, the AUM was about 41 tons. 1st of January 2025, the AUM was about 59 tons. I mean, you could say that 18 tons is not so large, but 18 tons on 41 tons is very significant. And we've already seen that this year there's been great growth. And I really believe that this product is at a cusp. It is here to grow, and a large form of various investments in financialization of gold will come under ETF.
Right. Well, thank you, Sachin. Thank you for joining us and giving us your time and your perspective about the gold prices. Thank you, and a very happy Akshaya Tritiya as well. Well, moving on, we also spoke to Navneet Damani of Motilal Oswal and Saurabh Gadgil of PNG Jewellers about the surge in the gold prices and asked them if they expect the volumes to go up further during festive season. Listen into what they had to say.
So we've seen a sizable run-up in gold prices. As you mentioned previously, it's about 25% year-to-date returns just in the last 4 months. And as we speak, it's pretty volatile. Every alternate day, you're seeing about 1,500 points movement in gold. This is something unlike what gold is likely perceived as an asset class. It's typically a safe haven asset class, and today it's more of a financial asset than a safe haven asset. So there is enough and more demand for gold even at every price point, and people are just waiting for a reasonable correction to gather it once again, because this in the last 5 years have delivered a better return than any other asset class which most of the people are investing into. Now, what is going to be the demand for Akshaya Tritiya? I think Mr. Gadgil will be able to tell you better, as he owns a jewelry store and probably a chain of jewelry stores. But I think the ground level research that we've done, typically the footfalls are lower. And there is more of cannibalization between gold to silver at this point in time. People are preferring lower caratage of gold, or probably waiting for silver as an investment, because that is not caught up significantly as far as gold is concerned. And I think price point wise, we are about 4% or 4.5% away from lifetime highs. Better levels will be anticipated, and there are a dearth of people waiting on the sidelines for any correction to enter into this metal at a lower price point.
Right. I mean, Navneet, good morning, and Saurabh, good morning as well. I think, Alex meant to ask that question to Saurabh, and he just said Navneet. But Saurabh, let me take that with you as well. How are you looking at it in terms of the demand? If you have to compare the last couple of years, are you seeing the mood come off, taking into consideration higher pricing, and that in turn impacting volumes?
Yeah, good morning, and wishing everyone a happy Akshaya Tritiya. Like Navneet said, right now prices are at an all-time high. There's been huge appreciation in gold. But having said that, people's interest in gold as an investment, as a store of wealth, is very strong. Yes, we have seen a lot of people swapping old gold for new jewelry. So primarily wedding shopping is almost today 50% the currency is old gold, and that is what people are preferring today because of the high prices and due to that the budget constraints. But in between there were a lot of fears on gold seeing a huge correction and gold could see a big downfall, but that has not happened, and that again has reinforce people's faith that looking at the geopolitical situation around the world, gold seems to be an asset which will be in a bullish mode, and that has really seen people coming and entering the gold market physically. There's been no selling pressure, and people are buying gold. Quantity has been a little struggle because of people's budget, but in value-wise, we'll be 30-35% more. So Akshaya Tritiya, I think value-wise, the industry should be aiming for a 20-25% hike over last year. In terms of volumes, I think we could see a dip, maybe a single-digit dip, around 8-9%. But the sentiments are bullish. Today is a whole day of Akshaya Tritiya, right from morning 8 o'clock till midnight is the Muhurat. So, we see a lot of, pent-up demand being converted today. Bookings have been moderate. I would not say there have been super bookings, but bookings have been quite decent. And people interest in the festival in Akshay Tritiya as a part of this Sadeti Muhurat is reinforced again. So we're hoping for a good day of sales as we progress today.
Point made, Saurabh, and thanks for answering the question that I originally asked. Navneet, and to you, you fielded it quite well, even though the question was not intended for you. But let me ask you this then, because you've seen a little bit of a cool off in gold prices from those elevated levels of close to 2,500. Rather 3,500. See, there you go. The numbers have moved so quickly that I'm talking about 2,500 still. But $3,500 in the international market. Where do we go from here? Because a lot of people are talking about gold-silver ratio, but that's not panning out. And while you have trade tensions, they've dissipated somewhat. So does that come into play? Dollar has remained below 100, stays at 99. If that does move above 100, is that the biggest risk factor for gold?
Well, there are a lot of risk factors as we speak. Primarily, it's largely driven by a trade war situation between China and US, and the tariff imposition on each other has kind of taken the center stage. Demand side story continues to remain as it is, but the supply side story is pretty robust, but the demand side scenario has changed drastically, largely because now what has happened? You see dollar index correcting from 106 levels to 98 levels within a span of no time. And the so-called cuts in interest rate which the US was talking about seems to be a far-fetched at this point in time, because these kind of tariff is going to lead to higher inflation, slower growth, and eventually the postponement of rate cuts is likely to happen. So all in all, this scenario is not likely to play well neither for US nor for China. And both of these biggies have to come on the table and probably settle out their issues, because China is in a phase of recovery over the last 4 years since the COVID, and US also is not in a great state. The 10-year GSEC is also a very interesting number, where it was down to about 3.6, 3.7% and now shot up to 4.3%. Primarily, US is sitting on a 36 trillion debt, and to service this debt at a 4.3, 4.4% kind of a yield is going to be a very, very massive task for the US Treasury. So I think this is a matter of time when these trade-related tensions are going to come at a standstill, and maybe the prices are likely to kind of stay where they are, or at least cool off.
So Navneet, when you talk about prices cooling off, what's the potential that one should be watching out for? How much downtick from the current levels?
Well, we don't have a number in place, primarily because every now and then you see the statement keeps on changing very significantly.
Yeah, but we can have a range, right?
Kind of $100. Yeah. So that's what I'm coming to. We as a broking house, and as we expect that anything closer to 3,200 and 3,150 is a level where you will see buying interest come once again. On the domestic front, if I say about 91,000 is a level where we expect that buying interest will be very massively into gold. But we also spoke about the gold to silver ratio. Historically, we've seen that it is only two instances gold to silver ratio has sustained above 100 level for a brief period of time, once during COVID and once during 1980s. As we speak, it is around 102, 103. We expect that this ratio has placed its hand, and maybe it's time for now silver to outperform gold, and this ratio can have some skewness back to about 1992 levels once again.
Okay, so then as a house, while you're not giving targets on gold at this juncture, that's understandable, Navneet, would you say that the advice right now that you're dispensing is perhaps book some profits if you can in gold, if you've got the ability to, and I'm talking about primarily people who are investing in ETFs, and would you say that it makes sense at this juncture with silver having underperformed in a big way? And if I'm not mistaken, 1 year performance or 6 months performance, I think silver was down 2% last I checked. I'm not sure what the current value is, but would you say that there's a trade in silver?
So in the year 2024, silver gave you about 34% kind of returns, while gold gave you about 31% kind of return. For the year 2025, for the last 4 months, silver has underperformed, whereas gold has rallied very significantly. Now, there is definitely a trade where we expect that silver could eventually catch up, and the rally could extend to 110 and 125, 1,25,000 rupees per kg for silver over the next 12 to 18 months. Now gold, we definitely have a target of 1,01,000 rupees as a target and maybe $3,800 as a target. But buying comfort is not at the current price. We expect that if an investor has to invest, it has to be a better price. If it's a tactical investment, one should look to stay away from gold. But if it's a long-term investment, you have to definitely park some money, then wait for a price correction of about 5%, where your risk and reward will be favorable to enter and maybe garner about 15% returns over the next 2 years.
Thanks, Navneet. Saurabh, running short of time, we just have a minute. Very quickly, is the retail growth lower as compared to the growth you're seeing in gold prices? And in terms of the old gold exchange, how much is that contributing, just to get us an idea?
The retail growth in terms of value is more than the gold price appreciation. I think retail growth in value terms would be around 30%, which I think is quite good considering the entire market scenario. People are looking at gold as a currency to buy new jewelry, and that today is around 50-55% of the entire sales. So that typically was in the range of 18-20%, which has gone up to 55%. And I think that's primarily because of the high prices and people's budget constraints. But having said that, people are buying jewelry. Wedding shopping is going strong. Diamonds have seen a good run as we speak, and I think overall people's interest in jewelry remains strong. Silver and gold, I beg to differ, do not compete, because silver to hold physically is very difficult. Yeah. So the silver physical buying is very different than gold physical buying, and these markets both coexist. So I think overall things are looking good for the industry as we speak. All around, just the data has come from World Gold Council, where India has been the largest importer of gold last year. So that really speaks on the India's volume consumption.
Absolutely.
And I think things as we go ahead look the same. So let's all hope that the Akshaya Tritiya and the coming year should be a good year for the industry.
Absolutely, hoping for the same as well, because we'll wait for all of us and our husbands and wives to buy each other gold and jewelry for our investments as well. But thank you, Saurabh. Thank you, Navneet, so much for joining us on the show, and all the husbands who are listening as well. I think Saurabh is promoting purchase of jewelry. But let's quickly slip into a short break. Lots more lined up on the other side. Please stay tuned.
Apollo ties. Now there's a buzz of a positive corporate development related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies. Joining me today is Vivek Paul, Global Head of Portfolio Research at BlackRock Investment Institute. Vivek, thank you very much for joining us on NDTV Profit. How do you see each of the asset class looking at and especially gold, which has run up a lot in the last 1 or 2 years. How do you see asset class returns going forward?
Yeah, great question. So I would frame my answer to your question when in the context of we need to be really explicit about the time horizon we're considering when answering this. In the near run, with huge uncertainty that we have, with the idea that there's kind of things that we can learn over the course of the next couple of months that can really shape the years to follow, I think an asset class like gold can play a diversification role, which is maybe a greater one than it could have done in the past, for the reason that some of the other traditional diversifiers are more challenged in this environment. So historically, for the entirety of my career, when you see some element of a global growth sort of slowdown, you would anticipate that maybe long-dated United States government bonds would be a good asset to hold, because typically there is a flight to safety and those assets comparatively rally. That is not the environment that we're in now. Like we talked earlier about this idea of this immutable law and the notion that, actually the sort of spikes in bond yields can prompt changes in the ultimate policies that are pursued. That's the risk right now. We anticipate a greater rise of term premium, or the compensation that investors demand for holding long-dated bonds. So part of the attraction for gold in the very near term is actually some other typical diversifiers, such as long treasuries, are not, I believe, going to play exactly the same role. The dollar is another one. We've talked about that a little bit already. We've seen in the period since April the 2nd that actually the dollar has not played that traditional kind of safe haven status. And in this particular environment of this type of uncertainty, I would not anticipate it doing. Now, when you go to a longer horizon, that's when it starts to get, frankly, even more difficult, because there are worlds out there, there are paths out there which look very different from one another, right? I mean, if you were to kind of say, is there an environment where United States interest rates are at 5%? Is there an environment where United States interest rates are at 2%? I think both of those are potential outcomes that could occur in 5 to 10 years. And they are remarkably different views of the world. So it's much harder to have like a sort of real strong conviction across relative asset classes when it comes to the long end. What I would say, though, is that we would not use this period to be risk off on a strategic horizon basis. There are structural opportunities, but maybe it's not the traditional ones that we've talked about. For those clients of ours, for those investors who can access some of the private markets, I think maybe that's where some of the structural opportunities rise. The idea of infrastructure, I think, as a global demand for sort of retooling domestic infrastructure exists and governments aren't able to fund that, that is something that I would lean into on a long-term structural basis. And I would also say that developed market equities, when they are well positioned to kind of take account of these structural mega forces, emerging market equities, when they're well positioned to take account of these structural mega forces, also have a role to play in a structural portfolio. So much harder to do on a long run basis. Near run basis, I think there's a reason and a rationale for gold having a comparatively safer bet than other traditional diversifiers.
Vivek, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit.
Apollo ties. Now there's a buzz of a positive corporate development related to one of the related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm.
Hello
and welcome viewers. You're watching Ask Profit on NDTV Profit and I'm your host Himakshi Bahugna. And on the show today, I will be taking up all your stock related queries. So don't forget to call us on the numbers that are there on your screens. You can also reach out to us on WhatsApp. Both the numbers, viewers, are flashing on your screens right now. And on the show, we are joined by Dinesh Sahni, Senior Research Analyst, Invest for Edu, on the fundamentals, and Sarvendra Srivastava, market strategist at 5 Waves Officials, on the technicals. Welcome to the show, gentlemen.
Very good evening, very good evening.
Good evening. Now let's get straight to the show with the first query, which is written to us from Hyderabad. Rahul holds 125 shares at 667 apiece of Tata Technologies. So he's looking whether he should hold or sell the counter, although he hasn't mentioned the time horizon. So firstly, I'd like to take the fundamental view on it. Dinesh, how are the fundamentals of Tata Tech looking like, especially after when TPG, has sold its stake worth over 1,000 crore in Tata Tech via bulk deal. So what do you have to say on that front?
See, overall, the view on the IT sector is mixed for me, including if we have seen the tariffs things, which has seen a headwinds for the overall sector, but now there is some clarity that Trump is ready for the deal. This is one thing. Second thing, the thing is, the overall sector management has guided that next quarter would be some stagnant. So my view is that for now, if someone wants to hold, they have to keep tracking the quarterly numbers and management updates. So if one has overall long-term horizon, they can hold for now, but they have to keep tracking the numbers and the management commentary.
Understood. Thanks for that view, Dinesh. And Sarvendra, I'd like to take your technical perspective also on the counter. So what's your view on Tata Tech?
Yeah, it's pretty simple. Very less data, but whatever data post-listing, I think this is just one-way street and going down. And right from around 1,400 levels, we were all the way back down to 600 odd. So this bounce from there possibly looks, the first month that we had a green shoot was the last month where we had a, what we call that we had a green decent bullish candle there. So bullish monthly candle with bullish formations, I think this pullback, if someone wants, I think this pullback around 650, 640, I think that area presents you a good risk reward in the short to medium term. Long term, we can't do much in this stock, but around short term, 1 to 3 months, I think it presents a good risk reward area around 640. And if at all you are interested around those levels, then you would also want to keep a stop below 600.
Understood.
And then look for targets in the region of 700, 720 going forward next 1 to 3 months.
Right. Thanks for that view, Sarvendra. With that, we have another WhatsApp query. Rajat has written to us from Bangalore saying that whether it's the right time to enter latent view analytics at the current levels. Again, he hasn't mentioned the time horizon, so I'd like to take both fundamental and technical view on it. But since he's looking for the correct levels, it's trading at 393 and was down in trade today over 2%. Sarvendra, are these the correct levels to enter the stock if someone wants to, purchase?
See, again, the same kind of a chart in the sense that you've got data post listing, and then it was almost one way down all the way till around sub 3, almost around 300 odd levels. So I think what we got, it was a decent bounce from 300 to 600. Again, getting corrected. Last month, again, this candle for the last month looks a little bullish to me. So purely again short to medium. In fact, short term, 1 to 3 months view here again. And I think as long as you stay above 360, I think you should be able to make some money if you buy around these 380, 390, that area you buy, and you keep a stop below 360 and look for targets back into the region of around 410, 420.
Understood. Thanks for that view. And Dinesh, I'd also like to take your fundamental view on the counter. What's your outlook on latent view analytics?
Sure. So based on what I see, the recent quarter gone by, which is December quarter. So overall, if I talk about the top line, it was a decent set of numbers. Margins were also in line. And if I talk about the bottom line, though it was a slight okayish for me as if I say, but what I would say is wait for quarter four numbers because it is due on I think 2nd of May. Maybe one should take a view based on that.
Understood. Thanks for that view. Now let's go across to another caller. So a caller is joining us. All right. So should I? Okay, there is a caller joining us from Bengaluru. Hi, Lokesh. Good evening.
Hi, thank you for giving the opportunity. So I hold 112 shares of Praj Industries at an average price of 566.
Okay.
So I would like to understand the long-term potential of this counter, and should I average it right now?
Yeah, and when did you buy these shares, Lokesh?
So I've been systematically investing this Praj Industry for I think 6 months. So I've been averaging it out.
Yeah.
Yeah.
Okay, and you are a long-term investor, I believe.
Yes, I'm a long-term investor.
Okay, okay. So Dinesh, today after reporting its quarter four results, the stock saw beating. It was down over 9% in trade. So not very good numbers there in quarter four that the company reported. So what's your outlook? Should the investors stay invested in this counter for another 1 to 2 years?
So everything is based on ethanol blending. So what I would understand is there is some room left for the company. I think if someone has a very long-term view, they can wait, but it will test their patience. If I say so, quarter four, as you mentioned, that it was a not so good set of numbers, and we also have a sugar news as of now. So if overall the prices to the farmers, which we have seen, they will be increasing. So that may play a sentiment negative on Friday's trading session, but that we will never know how the market will perform. And based on the news, we may see some hiccups in the sugar sector overall. That can be a short term, but what I say is if someone wants to hold for the very long term view, they can hold, but I think this will test their patience. However, on the other side, if they want to switch to the other industries, that would be a better thing to do.
Understood. Thanks for that view. And Sarvendra, talking about the technical aspect, will it be advisable for our viewers to, if they want to invest in a company like Praj Industries, who has reported not so good numbers in its quarter four? So is it like a buying opportunity also? Because the stock has fallen very sharply.
See, Amakshi, what we have to do is we have to keep broad filters and we have to keep broad baskets. So there are among the liquid names, well-traded names where this stock also possibly falls in that bracket. There are baskets. So this is a basket. This is a stock which did not make a new high in the 2020 to 25, 26 bull market. Its main top was in 2008, which means it did not participate in 15, 16, 17, 18, 20, 21. That entire phase where Nifty was constantly making new highs, this stock did not participate and went on to possibly break out of the 2008 shackles only in, I think, mid of 2021. So it is from that basket. It caught up very late, and it's a commodity play. So so you will get seasonality also here. So that is one basket. Then there's another basket where a mid-cap basket where a lot of stocks topped out in 2018. And then there's a basket where you would say the Ukraine high 21, 22. There are a lot of stocks which have kind of topped out there and not participated or basically underperformed the index. And then there are stocks which rallied till now and they have been part with the index. So four basic subsets: 2008, 2018, and then Ukraine high, and then the last one where it has performed with the market. So these four brackets, this is among the most weak stocks, I would say, that in that case, because for almost 14, 15 years, it didn't do anything and could not make a new high, could not signal a bull market. So I think, but those levels at 280, 300, that breakout remains decent. So I would say that, I don't know, this is a high beta name, and in that sector itself is high beta, so it can fall slightly more sometimes than the index. But I think around 310, 320 and 280, that was the mark. If I go and check, we were around 270-ish, 280-ish in that 2008 bull market. I think those will be long-term supports. But I think looking at the quarterly candles here and looking at the monthly quarterly candles, I think still still 2-3 more quarters of pain, price-wise and time-wise, I think is definitely possible here. So I would avoid right now.
All right, so that's an avoid on Praj Industries. With that, we are joined by a caller from Andhra Pradesh. Hi, Mr. Reddy. Good evening.
Good evening, madam.
Yes, how can we help you on the show today, Mr. Reddy?
Technicals of Suzlon Energy.
Okay.
Now, on the current CMP, can I exit or continue for 1 year?
Understood.
I will re-enter next technical punch.
Okay, okay. So, Sarvedra, since he's looking for a short-term view on Suzlon Energy, so what's the current trend like and what are the key support and resistance levels that you can see on the charts?
He's already bought? Can I
Yeah,
get his buying
yeah.
price?
He holds 9,000 shares at 55 a piece.
Is it a recent buy possibly, or he bought in the
Possibly
previous
because it's
time?
hovering around the similar levels. It's currently trading at 56. So I assume that he must have bought recently only.
So again, a high beta name, slightly risky in terms of it carries more risk than the low beta names. I would see a broad range here. So I would say that he's got to trade a broad range, and I think lower levels I can see all the way till 45, 46, and the upside possibly I think you're capped here. For the last 1 year, if I look at for the last 1 year possibly, these are levels which have been important. So around 60, I think they should get capped. So broadly, you're looking at a level between 45 to 60. Any upside momentum will only possibly come, and the stock will gain traction post a decent breakout out of 60, which would be by decent I mean a volume and price-led breakout out of 60 areas. If that is happening, then possibly you can see some upside. Else, I think be ready for the next 6 months to be trading this 45-60 band.
Understood, understood. And Dinesh, talking about Suzlon Energy's fundamentals, so do you see any sort of challenges with the company?
So the company has recently received several orders, and what I see is balance sheet has also become stronger. So clearly, I think one should wait, and it's a hold for me.
Okay, so that's a hold for long term on Suzlon Energy. With that, we're joined by a caller from Hyderabad. Hi, Amit. Good evening.
Hi, good evening.
Yes, how can we help you on the show today, Amit?
Yeah, I am my query is about Bombay Stock Exchange shares.
Okay.
I want to ask if it can go to levels of 10,000 per share.
Understood. And are you a long-term investor or a short-term?
Yes, I am a long-term investor. I can hold up to 13 more years.
Okay.
And yes.
So you're waiting till it reaches 10,000 mark.
No, I want to see if it goes to 10,000, then there could be another momentum.
Okay.
And it we also sense to keep it until NSE gets listed.
Right. And at what price did you buy these shares, Amit? If you could just tell me once again.
Yeah, average price of 650.
650?
Yes.
Okay. And okay, so that's very interesting. You have made significant profits there, Amit. So firstly, congratulations to you on spotting these levels. And talking about will it be reaching 10,000 mark? So, Dinesh, talking about the fundamentals of BSE, it is strong, but what suggestion do you have for Amit there? Do you see any sort of, positive momentum there in the near future?
Firstly, I want to congratulate the caller for holding so much time at least at 650 odd levels he have bought. So he is sitting at a very almost 5.7 lakh profit. So congratulations. Of course, Amit, I think you can hold for longer term. So see, we have seen hiccups recently for BSE based on the NSE news. So that was cleared by SEBI. So overall, what I can see is until and unless there is no challenges in terms of what is happening on NSE front, BSE is a very good company to hold. And over the long term, I think prospects are very nice. Based on the population, I think hardly 3 to 4% of the population is now trading, and we have seen Generation Z, Gen Z people have started trading aggressively, futures and options and etc. So I think the prospects are very nice over the long period of time. I see the company can reach further, but based on the numbers which we'll see quarter on quarter, the multiples can increase, which we have seen as of now. So of course, one can hold for longer term.
Okay, thanks for that view, and rightly said that Gen Zs have also started, coming in and started investing. So, Sarvendra, if a new investor wants to invest in BSE, so what suggestions do you have? What are the correct levels to enter? Because currently, it's trading at 6,359.
See, in the markets, we also say something like that herd mentality, and the herd comes in droves, and then you see these kinds of valuations. What I can see, ballpark, a P multiple of 93 is by no means value, right? So it's very, very overbought on all parameters. And since he's making so much of money, you have to have basic tenet there to follow that. You need to book some profits from time to time and rotate your stocks. So basically, if this has performed the way it has, you should definitely book some profit and keep some cash, maybe dry powder for better opportunities coming, and try and catch another BSE. See what he has done. See, from here, what he has done is almost a 10 bagger. So from 6,000 to 60,000, the journey will be more difficult, right? So to be another 10 bagger from here, a lot of energies will go, and a lot of things have to fall in the right place. But if the way he picked up BSE, if he picks up something else which is slightly better value, and then possibly try and make again that 5-10 bagger. But yes, so I would definitely recommend him to book some profits. I would say that I don't mind even keeping 50% dry powder with me, because I can ask him a question: what is the chance that it will go to 4,000-4,500 first? So before going to 10, if it goes to 4, he's losing 33%, more than 33% here. So I think that it's got a risk of running back towards 4,000, 4,500 mark. If he books some profit, keeps some dry powder, then possibly he gets better opportunities to buy. With all the geopolitical tension and everything, I don't see a stock at 90, 100 multiple being able to sustain. So, and this business comes and goes. We have been far long enough in this market to know that it's a cyclical business. So as long as the going is good, you get these numbers, and once the volumes dry up, and then suddenly you see some underperformance going in the market. So 1 or 2, 3 years, you can see volumes go drying down also. Just look at what Nifty futures with the margin increase and the lot size increase. I think the volumes have fallen by almost 40% of the Nifty futures. If Nifty futures can have that much of volume damage, then I'm just being a devil's advocate. You have to be alert, book some profits, keep some dry powder. You might find another 10 bagger somewhere else.
Thank you so much, Sarvendra, for that advice there. I'm sure Amit will benefit from it, and he will book his profits for now. With that, let's go across to a caller joining us from Noida. Hi, Amol. Good evening. Amol, are you there on the phone line? Yes.
Yeah. Good evening.
Good evening. How can I help you?
One question to Sarvendra ji.
Okay.
Like REC or Hereda, which will be the better stock to buy for short term?
Okay.
And what will be the right entry point?
Understood. And for how long are you planning to hold? Like short term, what is the time horizon?
1 or 2 months. Like
okay, 1 to 2 months
10%,
view.
Yeah.
Okay.
Yeah.
Understood. So Sarvendra, that question is directly to you. What will you pick among IRDA or REC for 1 to 2 months, which is fairly valued currently?
See, very simple. If 1 to 2 months is the horizon, there's no call. There's no buy call. Looking at what geopolitical setups are kind of currently emerging, and what global positioning also happening everywhere else, I think 1 to 2 months short-term trading is not advisable right now. And both these stocks have corrected, but not to my liking. So there could be still more corrections pending. So looking at the entire setup, the answer is very easy. Don't do anything right now is my advice. The rest, I leave it to him.
Okay, so don't do anything is what Sarvendra is suggesting, Amol. But if you would want to hold this for for more than 2 months, I'd like our fundamental view on the counter. So Dinesh, what's your sense? What should our caller be picking up between IRDA or REC?
So I won't be able to answer because currently I'm not tracking these companies. It's been 3 to 4 quarters. I'm not tracking these both companies.
Understood. And Sarvendra, you were saying something.
What I meant for investors at large is that this is not the goalpost to start something fresh. If you're already committed in something and then you're already there in that trade, then might as well you want to hold or trail a stop loss or do something. But this gentleman wanted to do something new for 1 or 2 months. So 1 or 2 months you don't do anything in such scenarios, and you don't do anything fresh. If you had something, fine, but if you don't have, why will you do a fresh setup from here where things are slightly not that clear over the next 30-40 days? It could easily escalate to a big problem or might fizzle out. But we have to watch it out next week, 10 days at least, what's happening.
Absolutely. Thank you so much, Sarvendra, for that. With that, we have a caller joining us from Bengaluru. Hi, Shankar. Good evening.
Hi, ma'am. Good evening, ma'am.
Yes, how can I help you?
Ma'am, Varun beverages has a 300 quantity, average price of 550.
Okay.
In February month, by ma'am, consolidation, ma'am, 2 months, ma'am. Today, quarterly results, ma'am. Revenue year-on-year 29%, ma'am. EBITDA year-on-year 28%.
Yeah.
Net profit year-on-year 35%, ma'am. Seller hold extra share average price, ma'am.
Okay. So 9th-month view on Varun Beverages. Firstly, Dinesh, I'd like to come to you. So how is Varun Beverages volume growth shaping up across domestic and international markets?
See, overall, my view on the Varun Beverage is very positive. We are tracking this company. The one disclaimer that yes, we hold the company in our portfolios as well. Yeah, so recent quarter numbers, yes, definitely it's a strong numbers as per me. And if I talk about overall margins, they have improved compared to the last year as well. So one thing is, if someone has 3 to 5 years, what can I say is that PepsiCo has very strong plans for India growth. So I think one direct overall beneficiary is this company. So if someone has 3 to 5 years of horizon, I think they can definitely hold the counter.
Understood. Thanks for that view. And Sarvendra, on the technical front, currently it's trading at 522 and was down in trade today over 1%. So what's your outlook on Varun Beverages? Are you positive?
See, again, very overbought, way overbought. No decent correction till now. If I look at the last almost 8-9 years, I think it's been all green. It's all BSC of green, and the stock has in that process in that period moved from around I think 22 odd rupees to 600. So it's almost it's like a more than it's almost a 30 bagger. So it was almost a 30 bagger. In a 30 bagger, once you start correcting, you might have decent corrections going forward. So the only benchmark, the only thing that I can see right now is the recent low that we printed around 408. We had a low at around 419, and then we had a previous low also around in those areas. So I think we definitely run a risk towards 400 is what I can see here. So I think still more headroom, more headroom on the downside.
Understood. Thanks for that view, Sarvendra. With that, we have a caller joining us from Andhra Pradesh. Hi, Kumar. Good evening.
Hi, very good evening.
Yes. Please tell me. Go ahead with your query.
Yeah, I'm not sure whether in which stock to invest, either in Sira or Kajaria Ceramics.
Okay. And are you a long-term investor, Kumar?
Yeah, I'm long-term investor.
And I'm seeing that you have a corpus of 1 lakh rupees.
Yes.
That you would want to invest. Okay. And why only these two companies? Why have you narrowed down only these two companies? I'm just curious to know.
Yeah, I'm seeing very low in both of these stocks, and also these are like home, like consumer durables. So I just want to see there will be developing. There is upcoming development, right, in these times.
Okay. So long-term view on Kajaria Ceramics or Cera sanitary ware. So Dinesh, Kumar has a corpus of 1 lakh rupees. So what suggestion do you have for him there? Which company should he be picking up, for investments?
See, the industry is going with lots of competition. Even the local players are seeing intense competition, and all the major. See, Kajaria, I think it's a very strong player. It is the largest player in the ceramics industry. And of course, Cera is also one of the largest player. I think both companies, if I standalone talk about rather than competition, so these are both companies are very strong. So On the picking side, it is the gentleman has done a very good job. But given that the competition is very high, and overall scenario, what I can see is can be extended for some several quarters. Maybe before buying into these stocks, they can focus on the quarterly numbers. For now, if one has 1 lakh of corpus, maybe they can start accumulating a little bit, maybe 15 to 20% off in both the companies.
Okay, so you should be starting to invest and basically accumulate in both the companies. 15-20% is what our experts are saying, Kumar. And Sarvendra, quickly, if you can just tell us your picks between the two.
I think both of them have downside still possibly pending. Some corrections which are pending here. So my thought is that I would possibly wait for another 10-12% downside at least in both the names before committing fresh capital. But yeah, if he wants to do a staggered buying, then he may, as rightly pointed, you can start with a 10% kind of a allocation each, 10 to 15% allocation each on those counters.
Absolutely. I hope, Kumar, your query has been answered there. And with that, we'll have to slip into a short break, viewers. Keep sending in your queries on WhatsApp and call in. We'll be right back for Ask Profit. Stay tuned to NDTV Profit.
Apollo ties. Now there's a buzz of a positive corporate development related to related to its European operations or European business that could come in. Now this EU operations contribute nearly 30% to the consolidated top line of the company, and there's dealers are also indicating that there could be a potential positive broking note that could come in from a foreign broking firm. In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity.
Welcome back. You're watching Ask Profit on NDTV Profit, and I'm your host Himakshi Bahugna. And I'm joined by Dinesh Sane on the fundamentals and Sarvendra Srivastav on the technicals. So viewers, please don't miss your chance to get all your stock-related queries answered. Just pick up your phones and call us right away. The numbers are there flashing on your screens right now. And with that, we are joined by a caller from Karnataka. Hi Rangesh, good evening.
Hello, good evening, madam.
Yes, please go ahead with your query, Rangesh.
Ma'am, I have Anantra shares, madam.
Okay.
Madam, number of quantities 157.
Okay.
I bought at 463, madam, price level.
Yeah.
Yes, ma'am. The time horizon is 1 year, madam.
Okay. Okay. So, so Dinesh, Anant Raj is the counter that Rangesh has invested in. He holds 157 shares at 463. Currently, it's trading at 452 and was also down in trade today over 3%. So, what's your sense on Anant Raj?
That one's for me.
I'm afraid that we're losing the line there, but Sarvendra, if you can take that one for now, Anant Raj.
Yeah, again, see, we got another stock which was in the 2008 basket and did not perform all the way in the 2020-2022 bull market. So this stock had a high in 2008 and that was around 395. So we've taken that number out only last year. And we are trying to kind of come and retest those levels possibly. So I would say that around 400, that's an important level. So if it holds in this correction, if it holds around 390, 400, then possibly, yes, I would say that you can go ahead and try and nibble in this one. And if you are, if at those levels you are buying, I think 370 should be the stop loss. So around 400, I think risk rewards would be better, and 370 will be a stop loss or a review point for that view.
Understood.
So he has to wait is what I would want to say here.
Right. So 370 should be the stop loss on Anant Raj. And yes, Dinesh, you were saying?
Yes, so I was saying that based on the recent set of numbers of March 2025, so on a year-on-year and quarter-on-quarter basis, the company has done very well. So in terms of operating margins, I think a good set of numbers on 26% compared to last year, 24%. And the balance sheet is also improving compared to last year. So yes, definitely it is a hold for me as of now. But one has to keep tracking the quarterly numbers. So for now, yes, it's a hold.
Understood. Thanks for that. And we have a WhatsApp query now written to us from Mahinder. He holds 500 shares of ITC at 4,234 and he's looking for a short-term view on the counter. Currently, I think the valuation, the numbers that he has written is not correct, I believe. I think it should be 423. So yes, Sarvendra, talking about ITC on the short term, what's your outlook? What sense do you make of the counter? How is it faring on the charts?
Being a defensive name and a quality defensive name in such uncertain scenarios and where possibly the market can go down, I think these stocks might outperform. And in a falling market, they tend to fall less, or maybe sometimes even rise a little bit. So I think in the short term, 1 to 3 months, I would say the horizon, in that horizon, I think definitely on the upside, 450, 460 is doable. And in the short term, if I want to see an area where you have to keep your stops or where you have to cut your risk, I think those numbers will be in the region of around somewhere around 405, 400. So I think around 400, 405 good supports, and possibly move back towards 450, 460.
Right, understood. And Dinesh, on the fundamental aspect of ITC, so how is its valuation compared to its peers?
See, the thing is, yes, definitely, it's a thing is that overall, if I talk about the segments, it's a very well diversified company, and as rightly mentioned, that based on this current scenario, the company is looking very nice for holding for at least a short term and as well as for long term. If I talk about the valuations, based on a TTM basis, I think it's almost trading at 27 times. And based on the historical valuations, it is almost, you can say, similar levels, median PEK basis pay, it is almost 25 to 30 basis, 30 times. So what I can say is, yes, one can hold based on the overall current scenario.
Understood. Thanks for that suggestion there, Dinesh. And we have a caller joining us from Chennai. Hi, Ramkumar. Good evening.
Yeah. Hi, good evening.
Yes, please go ahead with your query.
Yeah, my query is regarding IndusInd Bank. So I'm holding 70 shares at average price of 820.33.
Yeah.
So I'm looking for a 1 or 2 years long-term horizon.
Okay.
So I see that stock is very fluctuating upside and down. So what will be the target price I can set to exit, and I'm okay to add another 1 lakh in this stock. So should I enter it now or should I wait for something since the CEO resigned the text last night?
Understood, understood. So, Dinesh, when yesterday the CEO of IndusInd Bank, Sumant Katpalia, stepped down, so when we spoke to our guests and experts, so they suggested that, it's a good news for the company since the fundamentals of the bank remain solid. So, what's your outlook on this bank, considering the news that it has been, revolving around with, and also the investors who are holding IndusInd Bank shares, what should be their, outlook towards the counter?
I would only suggest someone to add after Q4 results. See, yes, definitely based on the fundamentals, the company is strong. And what we have seen is there are top level exits keep on happening for the bank. So my suggestion is that definitely if I talk about the NPAs, these are improving. So only after Q4, because I would suggest to be on a sidelines and see what will be the overall scenario after Q4 and what the management is saying. So for now, I think if one is holding, definitely they should hold, but fresh buying, I would suggest only after Q4.
Understood. So fresh buying only after Q4 results of IndusInd Bank. And Sarvendra, I would also like to take your view on this company. So how has it been performing so far? What are the charts suggesting? Sarvendra, if you can just unmute yourself.
Apologies.
Yeah.
See, I think what's happening here is that the stock was in news for all the wrong reasons, and corporate governance issues, when they creep up, I want all those things to settle down, I think. And in banking, if you have to trade something and make some money, I think they are far better than liquid names. So I would definitely like to pass this one. I would not like to comment.
Okay, understood. With that, we have a caller joining us from Mysuru. Hi, Chetan. Good evening.
Hi, ma'am. Good evening.
Yes. How can I help you on the show today, Chetan?
Kalyan Jewellers, ma'am, 200 quantity, average price 570.
Okay.
Hold or sell, ma'am. Kalyan Jewellers. Consolidation 3 months, ma'am.
Okay, and are you a short-term investor, Chetan, or a long-term investor?
Short term, 6 months, ma'am.
6 months view on Kalyan Jewellers. Okay. Because I can see that you are sitting on a loss of over 10,000. So Sarvendra, he bought it at 570. And, since amid all the US tensions there, tariff and, the global uncertainty situation, people are actually moving towards safe havens and jewelry space. So Kalyan Jewellers is one of them. So what suggestion do you have there for Chetan?
See, if all that is the concern, I would say that anybody wanting to do that should possibly go in pure gold bars. You could buy some of it in pure form and then keep it in small biscuits or something. If that's the whole idea, and if looking at the stock market and investing in that is the idea, I think still this is a very overbought, and still I think more cool off. I think here is possible, and this is a high beta name. This will be a high beta name always. It's always been high beta, so slightly stretched there. P multiples of around 18, of around 80. So that's also not comfortable for me. I think some more corrections due here. So I would say avoid right now. Give it a month or two, and then possibly call back and take a fresh view.
Understood. So call back after 2 months is what Sarvendra is suggesting, and take a fresh view on Kalyan Jewellers, Chetan. With that, we are joined by a caller from Chennai. Hi, Avdesh. Good evening.
Hi, ma'am. Good evening.
Good evening. Please go ahead with your query, Avdesh.
Ma'am, I want to invest in a chemical stock,
Okay.
chemical sector stock that caters to EV, pharma, and FMCG, and has good valuation and high growth potential. Okay. In that direction, I have shortlisted two, three stocks like Tata Chemicals and Himadri Specialty.
Yeah.
So, ma'am, I want suggestion in which stocks should I invest for the long term.
Okay. And
I have corpus around 1 lakh.
Okay. Okay. And for how long are you planning to hold these shares?
Ma'am, long term, very long term.
I would say 5 to 6 years or more than that.
Yes, not yes, 4 to 5 years.
4 to 5 years. Okay. So Dinesh, Avdesh wants to invest in the chemical space and he has narrowed down 2 stocks, which is Tata Chemicals and Himadri Specialty, and he has a corpus of 1 lakh rupees. So what suggestion do you have for Avdesh in which company he should be investing in at these levels?
So if I have to focus on one of the stocks, I think I would go with Tata Chemicals. But given that the recent quarter was not good, but see, it is very subjective. I think based on the commodities, I am very conscious based on what's happening in chemical side. So I am very cautious on the chemicals front. But if they have to focus on one of the 2 companies, I think Tata Chemicals is one of the good companies. And apart from that, I think he mentioned that he is focusing on the EV side. So one of the good companies which I am tracking recently is Excite Industries. I think he can also study that company as well.
Okay, so in the EV space, Avdesh, you can, actually look for Excite is what Dinesh is suggesting. And Sarvendra, do you have any view on the same Tata Chemicals or Himadri Specialty?
I would also go with the leading name. The more liquid name, I would go with Tata Chemicals. If at all I have to choose, but I still believe that both the names possibly could come down.
Understood. With that, we have a caller joining us from Chennai. Hi, Avdesh. Good evening. Avdesh, are you there on the phone line? Oh, sorry, Chandan. It's my bad. Chandan is joining us from New Delhi. Hi, Chandan. Good evening.
Hello, ma'am. Good evening.
Yeah. Good evening. Please go ahead with your query.
I am holding 1800 quantity of Jaggle prepaid OCN services at price of 334.
Yeah.
And my timeline is around 1 to 1.5 months. That's it. Extremely short duration.
Okay.
And so what should be my approach?
All right. And when did you purchase these shares, Chandan?
It's 2 days back.
2 days back. Okay. So in 2 days, you are sitting on a loss of 24,000 is what I can see. And you're looking for a very short-term view. Sarvendra, what suggestion do you have? Should he be booking his losses there or should he stay invested? Do you see any sort of upside in the counter?
These are all fancy names and never been a fan of these kind of names, and the data itself is very, very, very limited here. Nothing much to do. In the short term, 1 to 2 months, the stock is trading below all support. So it's trading with the long-term averages and even the short-term setup. So I think there would be continued pressure. I can currently see over the last 1 to 3 months, I think if I go and look at from Jan-Feb, the stock is getting sold at 370, 375 levels consistently. There's a seller there. Till you don't recover and go past those numbers, I think the pressure and the overhang will remain. And since it's such a limited data on the downsides, I think what I can see is there are openings still all the way to 250, 270 area also. So I think still not out of the woods, this one.
Understood. Thanks for that view. And, I would like to take a fundamental view also on the counter. So, Dinesh, what's your sense on the company? Zaggle Prepaid.
No, sorry, I won't be able to comment. I don't track this company.
Okay, okay, not an issue. We have a caller joining us from Bengaluru. Hi, Sandeep. Good evening.
Hey, good evening.
Yeah.
I have almost 3,000 shares of AU Small Finance Bank.
Yeah.
Bought at 642 something. It was going up, but last couple of days I'm seeing it has started falling. I just wanted to, my horizon is 6 months to 6 to 12 months, 1 year also actually.
Okay.
Can I continue because it is the main stock?
Yeah.
Should I hold everything or if the trend is loss making?
Yeah.
Should I at least take out some 25% of it for cash?
I would just like to reconfirm, how many shares are you holding? 24,000?
No, 3,000 shares.
3,000 shares you're holding of
20 lakhs total.
Yeah, and at a price of 640, am I correct?
642 I bought.
642. All right, understood. So 3,000 shares at 642, looking for a long-term view on AU Small Finance Bank. And yeah, so Dinesh, what suggestion do you have for Sandeep there?
So if I talk about the quarter-on-quarter NPA, it has slightly improved. But on the other hand, if I talk about the overall business, the profit before tax was almost not better than compared to last December quarter, but on year, it's a decent growth. So see, what I say is stick to the large companies in the segment, banks especially. So I prefer large private banks, the names like HDFC, ICICI Bank, Axis Bank. So always, if I suggest my clients as well, so I always tell them to prefer the all large banks for the long-term perspective.
Sure. Thanks for that view. And with that, we have a WhatsApp query. So Dhoor has written to us from Assam. He holds 50 shares of Blue Star at 1,750 apiece. He's looking for a technical view on the counter. Currently, it's trading at 1,706 and was down in trade today over 2%. And, you know, consumer durable space, the companies have been performing, have been seeing a beating in the past few days. So, Sarvendra, what's your sense on the counter, Blue Star?
See, if I go back 6-9 months, I think the stock has broadly been between 1,700 to around 2,300 with one or two maybe minor spikes on the upside. But 17 to 2,300 that's been the range here. Any break and close below 1,700 range. So let's keep a 20-point filter and say if it closes and breaks below 1,680, I'm afraid that I don't have good news for him. Because in that case, the entire 9-month period becomes a distribution setup where strong hands have distributed the stock and weak hands have bought. So below 1680, I think a lot of pressure possibly can come in here. The bad news here is that we have already broken the 200-day exponential already for the last 4 days. So I'm saying just as a confirmation filter, if at all it breaks and close below 1680, there's definitely trouble in this space. And if he's lucky enough to get a bounce back towards 1750, 1800, I would tell him to book out slightly on this one.
Understood. Thanks for that view. With that, we have a caller joining us from Tamil Nadu. Hi, Vasu. Good evening.
Good evening, ma'am.
Yes. How can I help you on the show today, Vasu?
Yeah, I'm holding Sriram Finance. 3,000 shares.
Okay.
At 639 rupees.
Understood.
Look for short-term investment.
Okay. And when did you purchase these shares?
2 weeks back.
So in just 2 weeks, you are sitting on a loss of over 81,000.
That's correct.
Yeah. And for how long are you planning to hold? 1 to 2 months or 3 months?
3 months.
3 months. Understood. So Sarvendra, he is sitting on a significant loss. So do you see any sort of recovery in the stock for, you know, in the coming 3 months?
See, nothing personal against him, but just for other viewers also to kind of learn from this case study that, yes, your intention might be right. The stock was moving in, had some positive momentum going forward, but the timing here may be a good stock, but bad timing. And he missed the fact that since September 2024, the stock has been unable to pierce past that 1730 hurdle. So I think that 1720, 1730 zone did the trick this time also. A pretty bearish candle last week is what I can see has formed at around that 70-20 mark. just slightly lower than that. So a pretty bearish weekly candle means next 3-4 months, next 3-4 weeks, sorry, could be slightly painful here. And I would suggest he should use any bounce if possible to get out as close to his cost price. And wait, if he wants to do a momentum trade, let a previous high or a previous, at least a swing high gets broken, or if you are bearish, a swing low gets broken, and then you take a momentum trade, not in between a range, and not in between in a range. If you take a trade, not at the upper end, you can't take a long trade at the upper end of a 9-month range. So get out in a bounce. Just book out. If you get a bounce near your cost, book out and then wait.
Yeah, understood. So book out on a bounce is what Sarvendra is suggesting, Vasu. And with that, we have a caller joining us from Hyderabad. Hi, Prabhakar. Good evening.
Good evening.
Yeah, how can I help you on the show today, Prabhakar?
This is regarding Fermil Pharma.
Yeah.
I'm holding 5,000 shares at the rate of 280 rupees.
Yeah.
And another REC also, I said, I think if you can able to address again, please address about REC also.
Okay. We have actually discussed about REC, but again, quickly for you, we can take that as well. But firstly, we'd focus on Piramal Pharma. So he's looking for a both fundamental and technical view on the counter. Firstly,